So hello all my dearest students of South India. I hope you all are doing good. I hope your studies are going on great. So finally the day has come for which you all have been waiting since long, and that is our master compilation, super compilation, whatever name you want to give, of past RTPs of institute, past mock test paper of institute and past exam paper of institute in around 4 to 5 hours. We will try to complete all of them. Around 24 papers we are going to revise in around 4 to 5 hours. That is something which is unimaginable for a student to revise themselves. So without wasting any further time, today we are going to first of all start with our RTP compilation, and that too in full English, especially for my dearest students from South India. Okay, so now we are starting with RTP November 2020, and the very first question over here is on PGPP. The very first question generally in the examination is of PGPP only. It is of total income, computation of total income along with tax liability sometimes. Okay, so let us start with this question. This question is about manufacturing of footwear business and leather product. Very important. Whenever there is a manufacturing of footwear and leather business, you have to be very careful that there can be some implication of 80JJAA. 80JJAA, do you remember? You have to employ the employee for at least 240 days. But in case of apparel business, footwear business and leather business, even if you employ for 150 days, that is much more than enough. So this is what the catch is all about in this question. Okay, so you have to be very careful with this particular point. Now the net profit of the assessee is 544 lakh. This is the first thing that you are going to write. The first adjustment is the accounts depreciation as per company law. So you will add that back. Okay, second adjustment is about you are about to pay some 64 lakhs to your creditor, but the creditor has waived off 12 lakh rupees and he has told you to pay only 52 lakh rupees. So now if the amount is waived off by the creditor, that is your income, and therefore you have to add it to your P&L account, but this is already credited to the P&L, so you don't have to do anything with this particular adjustment. This particular adjustment don't do any effect because it is already credited to the P&L. Okay, next one, employer contribution of 6 lakh rupees. Employer contribution you can pay up to the due date of filing of return, and employee contribution you have to pay by 15th of the following month. So this is employer contribution and you are paying before the due date of filing of return, therefore it is allowed. Since it is already debited to the P&L, you don't have to do anything with respect to this. Okay, the next one is an intelligent adjustment. You have taken a loan of 50 lakh rupees for buying some machinery. Now you have taken a loan of 50 lakh rupees at 12%, therefore the interest for the entire year will come to 6 lakh rupees. Okay, now but the machinery is put to use. You have to come to the next line. The machinery is put to use on 1st of November. Therefore from 1st April to 31st October, whatever is the interest that will come to, that is the interest of 7 months, will be capitalized to the cost of the machinery. Okay, so therefore the total interest of the entire year is 6 lakhs, and therefore the 7-month interest will be what? First of all, what is the multiple effect of this 7 lakh interest, of this interest of 3.5 lakhs? First of all, this interest of 3.5 lakhs is not allowed as an expense. It will be added to the PGPP income. Secondly, you will claim 15% depreciation, 50% of that because it is put to use for less than 180 days, and then you will compute 10% additional depreciation also because the assessee is engaged in what? Manufacturing. Okay, so you be very careful with this adjustment. It's a beautiful adjustment. Let's go ahead with the next one. You are making some payment to some contractor without deduction of TDS of 20 lakh rupees. So 30% will be disallowed if you make the payment to resident and do not deduct the TDS. Okay, next one, you are making some fair estimate for periodical wage revision of your workers' wages. Okay, you are making fair estimate. So fair estimate you are making in every 3 years, you make some fair estimate revision in wages and you pay that to the employee. Okay, because it is a fair estimate, it should be allowed as a deduction. Now this is not debited to the P&L. Because it is not debited to the P&L, it is allowed, so you have to reduce it from the P&L. Okay, now coming to some additional adjustment. First one, what is the depreciation on building? On building you will get 10% depreciation. What is the depreciation on plant and machinery? Now be very careful with plant and machinery. It is 340 lakhs total value. Out of 60 lakhs is the new machinery. So for new machinery, we will compute separately. Therefore, how much is the old machinery? Out of 340, old machinery is 280 lakhs. On 280 lakhs, you will get a depreciation of 15% completely. Now, on the new machinery, because it is put to use in November, 60 lakhs is the cost, plus 3.5 lakhs rupees, you have to add back what? You have to add back in the form of pre-acquisition interest, pre-usage interest. So 63.5 lakhs will become the cost of the asset. On that, because it is put to use for less than 180 days, you will get 7.5% depreciation normal and 10% additional depreciation. I hope it is clear to all of you. Okay, now next one, 80JJAA. Be very careful. 80JJAA, apparel business, footwear business, leather business, 150 days is also sufficient. Okay, this is what the ICI is playing with you. Now 24 additional employees are hired by the company. Okay, now out of which 12 employees were joined on 1st June 2023 at 23,000 rupees. Okay, so will they be eligible for 80JJAA? Yes, they will be eligible. But at the end it is written that out of that 2 employees were paid by bearer check. Now because they are paid by bearer check, those bearer check employees will not be covered over here. Okay, so only 10 employees out of 12, because you cannot make the payment by bearer check. In case of an existing company, you have to make the payment by 4 modes only: account pay check, account pay draft, ECS, and such other electronic mode. You cannot make the payment by bearer check. Therefore, this 10 lakh rupees, this 10 employees into 10 months from June to December, from June to March into 23,000 plus 4 employees were joined on 1st July at a salary of 25,500. Not allowed. If the emoluments per month is more than 25,000 rupees, you are not eligible for deduction under 80JJAA. So this employee is not allowed. Next, 1st November 2023, you have employed 8 employees. Now this is allowed because from 1st November to 31st March, it amounts to around 152 days. And for apparel business, leather business, 150 days is also sufficient. Therefore, these 8 employees are also eligible for what? Deduction under 80JJAA. So 8 into 5 into 20,000 plus the earlier one multiplied by 30% will come to 9,30,000. That will be the amount of deduction that you are going to get it. Okay. One last adjustment. Employee contribution of 3 lakh was paid in July. Was paid in what? July. Will that be allowed? The answer is no. It is not allowed because employee contribution has to be paid by 15th of the following month. If you pay in the month of July, it is not allowed. Employer contribution you can pay up to the due date of filing of return. Employee contribution you cannot pay. Therefore, this will be disallowed. Now, this will be computing your total income. After that, you compute the tax liability. How much tax? You have to ignore the MAT provision. You have to ignore the alternative tax regime. You have to compute as per the normal provision. Therefore, the turnover of last year is less than 400 crore, is up to 400 crore. Therefore, the tax rate will be 25%. 25% tax surcharge will be imposed because the income is greater than what? Greater than 1 crore. So, 25% tax will be imposed. 7% surcharge because the income is greater than 1 crore and up to 10 crore, and 4% cess will be imposed, and then you have to compute the tax. Okay, this is how you are going to go about with this particular question. Let's move on to question number 2 now. This is a question on exit tax. There was a charitable trust which got merged into a business, that is manufacturing business. You have to compute accredited income, and on that 34.944% tax you have to pay. What is accredited income? All assets minus all liabilities. Let us see all assets list by list. First of all, the land will be valued as per stamp duty value or market value, whichever is higher. So here higher value is market value, therefore land will be valued at 34 lakhs. Equity shares which are listed in stock market will be valued as per average price on the specified date. On whichever date it got merged, on that date, what is the average price? Average price is 160. So 160 into 75,000 equity shares for listed share. For unlisted share, preference shares, you have to take market value, not book value. So for unlisted shares, I am taking the market value as per rule 17 CB. Corpus fund liabilities, you do not take corpus fund in the liabilities. Okay, you take outside liabilities, you do not take provision for tax in the liabilities, and you take other liabilities for utility bills like outstanding expenses, etc. All these things, add all assets, add less all liabilities. Whatever amount will come will be accredited income into 34.944% will become your what? Will become your taxable amount. Okay, that will be the tax you have to pay as an exit tax. Next question. There was an assessee who is 60 years old and resident, an ordinary resident, and he has an apartment in Sharjah. He also has a bank in Sharjah. Now he is claiming that my total income is less than the basic exemption limit. Therefore, I am not liable to file return. Wrong, wrong, wrong. If you are an ordinary resident and if you have any asset located outside India, if you are a beneficial owner or beneficiary of any asset located outside India, including financial interest in any entity located outside India, then you are liable to file what? Then you are liable to file income tax return irrespective of your income. Then your income will not be seen. Don't worry about it. Okay. In that case, if you have a foreign asset or foreign bank account, you have to file the income tax return. Next question, question number 4. The assessee has filed the return. The assessment is also done, and the AO made 2 additions. One addition he made under section 69 unexplained investment, and second addition he made for a remuneration and interest paid to partners under 40B. Now the assessee challenged the first one, and the assessee challenged the first one. It went to appeal, and the appeal was decided. Now the assessee approaches you, what it should do for the second one. First one is closed. What it should do for the second one? Can it go for revision under 264 or can it go for rectification under 154? Be very careful. It is not possible to go for revision because under 264 it is written doctrine of complete merger. If a matter is already decided by a commissioner in an appeal, that matter cannot be touched for revision under 264. But yes, rectification under 154 is possible if there is a mistake apparent from record, because under 154 rectification of mistake, it is written that there has to be a doctrine of partial merger. Partial merger means a matter which is merged with a matter which is already decided, that will not be touched, but the other matter can definitely be touched. Therefore 154 is possible because there is doctrine of partial merger. 264 is not possible in this case. It was also held by the court in this particular case. Issue number 5 is also based on one case law. Do you remember there was one section by the name called as 292BB? That is, if the department send you a late notice or an improper notice, then if you cooperate in the department, don't challenge. If you cooperate with the department, then it is deemed to be a valid notice. If you want to challenge before the passing of the assessment order. If you challenge before the passing of the assessment order about the validity of the notice, about the properness of the notice, then the assessment is void ab initio. But the department has not sent the notice only. The department failed to send the notice. Can department cure this defect? The Supreme Court held in the case of Lakshman Das Khandelwal that failure to send a notice cannot be cured under 292BB. If the department did not send a notice only, if the department is sending an improper notice or a late notice, then 292BB can help the department. But if the department does not send the notice, then 292BB cannot help the department under any circumstance. And one last question of the first RTP that is we are doing over here. That is, this question is on transfer pricing. We need to identify whether transfer pricing will be applicable in these three circumstances or not. The first case, always remember, for applying transfer pricing, there has to be two entities, out of which one has to be non-resident, one has to be resident, or both can be non-resident. At least one party has to be non-resident. Secondly, both of them should be associate enterprise. And thirdly, there has to be a transaction between both of them in the nature of various ways, purchase, sale, royalty, etc., whatever it is. Now, the very first transaction is one entity is Indian company, one entity is foreign company. That is okay. Now, one entity is giving a guarantee of 12% borrowing of the other entity. Are they associate enterprise? And the answer is yes. If one entity guarantees at least 10% of the borrowing of the other entity, then both of them are deemed to be associate enterprise. Now, one is NR, one is non-resident, one is resident. Therefore, it is an international transaction and therefore transfer pricing is applicable in this case. Second case, there is a domestic transfer pricing applicable. Both of them, there are two units. One is delta, one is fee. But one of the unit is engaged in development of highway project, which is covered in ATIA, and another unit is not covered in ATIA. Therefore, one unit is covered under ATIA, one unit is not covered in ATIA, and it is providing some transfer of transfer of wires, etc., steel, etc., of 30,000 per metric ton to another entity. Okay. Therefore, if you multiply this, the value of this will exceed 20 crore rupees, and it is a domestic transfer pricing. Remember, when domestic transfer pricing is applicable, when one unit is eligible for what? ATIA, ATIB, ATIC, etc., and another unit is not eligible, and both of them do transactions between them, and the value of the transaction is greater than 20 crore rupees, then transfer pricing of domestic nature is applicable. Yet it is applicable. And the last case over here is there is a holding subsidiary relationship. Holding subsidiary companies are always associate enterprise, and one entity is resident, one entity is non-resident, and one entity is purchasing some machinery from another entity. Therefore, this should also be at arm's length price. Transfer pricing will be applicable in this case also. So this is your first RTP. So let's move on to the next RTP, that is RTP May 2021. The very first question over here is on non-resident taxation 115A. There is a foreign company, Lords INC, who is earning some income by way of fees for technical service of 3.2 crore from an Indian company, Yamuna Limited. And this company has an agreement with Yamuna Limited, and it is also approved by central government. It is very important that if you want to get covered in 115A or 44DA, there has to be an agreement between both of them, and that agreement should be approved by the central government. Very, very, very important over here. Now, they have incurred some expenses of 28 lakh rupees. Now, they have asked us question in two parts. First part, assume that Lords INC does not have a PE in India, and also we need to say whether Lords INC is required to file the income tax return or not. For remember that if a non-resident or foreign company does not have a PE in India, then section 115A will apply, and in 115A the tax rate will be 20%. Or DTAA rates, whichever is lower. Here DTAA rates are not mentioned, so we will take 20%. Okay, so 20% tax will be imposed plus 2% surcharge for foreign company because the income is greater than 1 crore rupees and up to 10 crore. Therefore, 2% surcharge and 4% cess. Okay, now there is not going to be any deduction of expense. This expense is not allowed under 115A. No deduction of PGBP and no deduction of any PGBP or IFOS expenses are allowed under 115A. Okay, now what about the filing of return? If the assessee only earns this income in India, and the TDS is deducted at 20% plus 2% cess, 2% surcharge and 4% cess, then no need to file the income tax return. Okay, but if the TDS is deducted at a rate lower than 20%, that is if the TDS is deducted as per DTAA, then the assessee has to file the income tax return. Here there is no mention about DTAA, therefore the TDS would be deducted on what? 20% plus 2% plus 4%. If the TDS is deducted as per 115A, no need to file what? Income tax return. The second part, the assessee has a P in India and the income is connected to this P. So now the assessee will maintain proper books of accounts, will conduct tax audit also, and the normal tax rates will be imposed on the assessee, that is 40% tax will be imposed on the assessee, and which all deduction will be allowed to the assessee. Let me show you. First of all, 3.2 crore is the income, is the revenue. Another 2 crore is the revenue. Against that, 28 lakh rupees expenses will be allowed. 21 lakh expense will also be allowed because these are expenses directly related to these incomes. Now, an expense which is not wholly and exclusively for Indian branch. if an expense is not only and exclusively incurred for the Indian branch, then that expense is not allowed under the income tax law. Okay, under 44DA it is not allowed. Plus, if any expense is paid to HO by the branch, if an Indian branch is making the payment to HO, then that is also not allowed. That is only allowed under one circumstance, if it is in the form of a reimbursement. But this is not a reimbursement. Because this is not a reimbursement, this will also not be allowed under the income tax law. 44AA assessee has to maintain books of accounts, and 44AB assessee has to conduct tax audit. The tax rates will be normal rates. I hope it is clear to all of you. The next question is a routine question of calculation of penalty. Nothing great as such. LLP is there. The return of income shows an income of 18 lakhs, but on processing the return under section 143 subsection 1, the income comes down to what? Comes up to 22 lakhs. Then while assessment, the income goes up to 35 lakhs. So how do you compute the underreported income? Underreported income is nothing but income assessed minus income processed. Therefore, 13 lakhs will become your underreported income. And then while computing the tax, will you compute tax on directly on 13 lakhs? No. First you will compute tax on 22 lakhs. Sorry, first you will compute tax on 35 lakhs and then minus tax on 22 lakhs. Always do like that. And then you will impose 50% penalty, because the question says that this is not on account of misreporting. Therefore, 50% penalty will be imposed on the assessee. Okay. Now, later on, even 147 assessment was done. At that time, the income was further raised to 42 lakhs. Now, how will you compute the underreported income? It is income reassessed, that is 42 lakhs, minus income previously assessed, that is 35 lakhs. Therefore, 7 lakh will be chargeable to tax in the hands of the assessee. Okay, that will be underreported income. Sorry, that underreported income, directly don't take tax, don't compute tax. Again, you will first compute tax on 42 lakhs. Whatever tax comes, 30% plus 4% cess, minus then you will compute tax on 35 lakhs. And then the differential amount will be tax on underreported income. On that, you will impose 5%. What? 5%. 50% penalty. That will be the penalty that the assessee has to pay under the income tax law. The third question over here, question number 9 over here, is on MAT, minimum alternate tax. So here we have to compute the minimum alternate tax of the company. For that, we need to compute the book profit of the assessee. Okay, what is the question asking? Question is asking the minimum alternate tax under 115JB. What is the minimum alternate tax under 115JB? It is 15% of the book profit. So first of all, let us compute the book profit. The net profit as per PNL is 52 lakhs. Then provision for loss of subsidiary, add. Then provision for doubtful debts, add back. Then income tax, also add back. Next one, be very careful. Provision for gratuity based on actuarial valuation. This will not be added back. Why, sir? Because this is not unascertained. Only unascertained liability is added back to the MAT. The unascertained liability is added back. Provision for as per the actuary is not unascertained. It is actually ascertained. Therefore, this will not be added back. Depreciation you will add back. Yes, depreciation you will add back. And then other than revaluation, depreciation you will reduce. So how much is the revaluation? You can see other information. 80,000 is on account of revaluation. Therefore, out of 3,08,000, 80,000 is revaluation. Therefore, how much is other than revaluation? 2,28,000 would be called as other than revaluation. So add 3,08,000 minus 2,28,000. Okay. Next one, penalty interest. No, do not add. Interest you will not add back. Even if it is unpaid, it is added back under the normal provision, not under the MAT. Penalty is not added back under the MAT. Under the normal provision, it is added back if it is for infraction of law. But under the MAT, it is not added back. Next one, 10AA deduction. Do not reduce. Let it be part of MAT, because on this book profit should be on this income, the tax has to be paid under the MAT. Okay. Do not reduce this. Then share of income from AOP BOI. Yes, on that MAT is not imposed. Therefore, reduce that, because that is exempt under 86. Any income which is exempt under section 86 has to be reduced from the MAT. Be very careful. And long-term capital gains also, you will not reduce from the MAT. Let it be part of MAT only. Then whatever the MAT will come, whatever is the book profit will come, 15% book profit, then 4% cess, no surcharge, because the book profit does not exceed 1 crore rupees. Now the second question is, what would be your answer? If Ganga Limited is located in IFSC and derive its income solely in convertible foreign exchange, then the MAT rate will come to 9% only. It will be only 9%. And last, if an IFSC unit distributes dividend, then what will be the impact on the company and on the shareholders? I am an IFSC unit, I am giving dividend. What will be the impacts on the company? What will be the impact on the shareholder? It is fully exempt in the hands of both the person. Company don't have to pay tax, even shareholders don't have to pay any kind of tax. Okay, I hope it is clear to all of you. Now the next question is question number 10, which is based on what? Which is based again on exit tax. Now, there was a charitable trust which was set up in 2014. In 2016, it changed its object, and in 2016-17, it got the registration of the trust. Okay, so 2014 it was formed, 16 it changed the objects, and 16 and 17 it was what? It was registered as per the income tax law. Then in 2023, it got merged with a private company which is not eligible for what? To LAB. Therefore, exit tax has to be paid. Again, you have to compute all the assets and then all the liabilities. Then the difference between the two will be considered as what? As your accredited income. On that 34.944% you will take. Okay. First of all, land. For land, what you should take? You should take the stamp duty value or the market value, whichever is higher. But The Surat land, you are not going to take. Why? Because this land was purchased before the registration. Any asset which was purchased before the registration shall not be taken for the purpose of accredited income. Okay. Only assets which are purchased after registration are to be considered for accredited income. Same is for the liabilities also. This Baroda asset, yes, it is purchased after the registration. Therefore, stamp duty value or market value, whichever is higher, therefore market value is 105 lakhs that you have to take. For quoted shares, you will take the highest and the lowest price average, that comes to 265 rupees into 33,000 shares that you will take for the quoted share. For unquoted shares, preference shares, you will take the market value, that is 210 shares into 1800. And in liabilities, total liabilities 112 lakhs. Out of that, you will not take, you will reduce corpus fund don't take, then provision for tax also don't take, reduce all these things from 112 lakhs, okay? And reserves and surplus also reduce, whatever is the balance that you will take in the liability, reduce it from the asset, and then you will get the accredited income, take the difference between the two, and that will complete your question 34.944%. So this is what your next RTP May 2021 is all about. I have taken over here only those questions which are not duplicated. Duplicated questions I have obviously removed from here because that will lead to what? Unnecessary wastage of time for you also and for me also, okay? So if there is any question which is repeating again and again, one time we have taken, subsequent time we have removed it. Okay, I hope it is clear. Just go through it and then we'll move ahead with the next RTP. So let's move on to the next RTP, that is RTP November 2021. Now this first question over here is a beautiful question. Pay absolute attention on this question. This is a question of two companies, X Limited and Y Limited. Let us talk about the two companies. Let us read about the two companies first of all. X Limited, an Indian company which is engaged in generation of electricity, and it was set up on 1/4/2018. And now this company has employed 500 new employees. All of them participate in recognized provident fund. Remember, if you want to claim deduction under 80JJAA, then you need to participate in the recognized provident fund. Okay. Now, out of that, all the payments are made by ECS. Yes, the payment also has to be made by account paycheck in case of an existing entity. In case of a new entity, it can be paid by cash also. Okay. Now, 18,000 per month for 150 employees, 22,000 per month for 150 employees, and 26,000 per month for the remaining 200 employees. Okay. Now, on 28th of September, the company has exercised the option for depreciating the assets at WDV method. As you all might be knowing that the assessee engaged in generation of electricity is eligible for SLM also, is eligible for WDV also. But if it follows WDV, then it can also claim what? It can also claim additional depreciation. If it follows SLM, then it cannot claim additional depreciation. Okay. Now, the turnover of 1819 and 1920 is 402 crore, 249 crore. And on 1/10/2020, it installed a new plant and machinery of 9 crore rupees and put the same to use immediately. Okay. Now, the company has received a dividend of 60 lakh rupees from other domestic companies, and it has distributed 72 lakh rupees to some other shareholders. Okay. Now, let's talk about Y Limited. Y Limited is also an Indian company. It is also set up on 1st of October 2020. It is engaged in printing of books. Now, it has also installed a plant and machinery and put to use. It has also employed 200 employees. They all participate in the recognized provident fund. Now, the gross total income of both the companies are 6.6 crore and 1 crore respectively, and they are subject to audit. Now, this gross total income is computed as per the special provisions under the Taxation Law Amendment Act. It means this gross total income is computed as per the alternative tax regime. This gross total income is not computed as per the normal regime. Okay. Now, it is computed as per the alternative tax regime. Now, we need to find out which alternative tax regime they have followed, 115BAA or BAB. Okay. Now, we need to compute the tax liability of X and Y as per the special provision. So, we need to identify in this question which special provision is applicable for them. Now, for the first company, the special provision which is applicable is 115BAA, because first of all, this company is not a manufacturing company. 115BAB is only for manufacturing company. Second reason why 115BAB is not applicable for this company is because this company is incorporated in 2018, and for 115BAB you should incorporate on or after 1st October 2019. Okay. So with that logic, this company will be eligible for 115BAA. Even this company will be eligible for 115BAA because 115BAB is not applicable for assessees engaged in printing of books. Printing assessees are not covered under 115BAB. So this assessee will also be covered under what? 115BAA only. I hope it is clear to all of you. Now listen carefully. The turnover, the GTI is 6 crore 60 lakhs and 1 crore rupees. Now remember, if an assessee is covered under 115BAA, then they are eligible for what? They are eligible for these chapter 6 deductions. ATM is allowed and even 80JJAA is allowed to the assessee. Let's talk about X now. Whether X will get 80JJAA? Yes. On 150 employees, 22,000 rupees is the emolument, so they will get 80JJAA. On remaining 150 employees, 18,000 is the emolument. On that also they will get 80JJAA. But on 200 employees, where the emolument is 26,000 rupees per month, they are not going to get what? They are not going to get the 80JJAA because the emolument is greater than 25,000 rupees. What about ATM? Yes, even ATM is allowed under 115BAA. The company has received a dividend of 60 lakhs and has distributed a dividend of 72 lakhs on or before the date. So therefore, lower of the two will be allowed as deduction. Therefore, the assessee will get two deduction. 30% of this and 60 lakh rupees of this. And therefore the tax liability will come to, total income will come to 3 crore 84 lakhs, and under 115BAA, the tax rate is flat 22%, flat 10% surcharge, and flat 4% cess, and this will be the tax liability of X Limited. What about Y Limited? Y Limited gross total income is 1 crore rupees as per 115BAA, but Y Limited will not get the deduction of what? Deduction of 200 new employees, because they are employed for less than 240 days. Because they are employed for less than 240 days, they will not be eligible for 80 JJAA. 80 JJAA is not allowed over here, and ATM is not there in Y case. Okay. Now the second one, compute the total income under the regular provision. How the income under the alternative regime will be different from the regular regime. In the regular regime, both the companies will get additional depreciation, which was not allowed under the alternative regime of 115BAA. So under the new this regime, under the regular provision, both of them will get additional depreciation. How much additional depreciation? See, the first company has purchased a machinery of 9 crore and it is put to use on 1st October, and therefore it will be eligible for what? It will be eligible for full 20% additional depreciation. And the second company has also purchased and put to use on 1st October, and that company will also be eligible for full 20% depreciation on 2 crore rupees. Therefore, how this will be different? It is only different with respect to this particular point, that is here 9 crore 20%, here 2 crore 20% additional depreciation will be allowed to both the companies. Okay. Apart from that, everything else is same. Now, the third and the last question, suppose for X Limited, if they opt for special provision, then which would be better? Okay. If they opt for special provision inserted by, for this purpose, you may assume that the book profit of X computed under 115JB for AY 21-22, then which would be beneficial? Remember, if they opt for special provision, then their tax liability will be 96,64,510 rupees. And if they opt for special provision, then the provision of MAT is not applicable. But if they opt for the normal provision, then on this normal provision, they have to compute tax, and they also have to compute tax on the book profit, which is 4.2 crore, and then they have to compute whichever is higher, which will be applicable. If you opt for 115BAA, then MAT is not applicable. If you don't opt for 115BAA, then you also have to compute the MAT liability under the income tax law. Okay. Sir, under the normal provision, what would be the tax rate? The tax rate would be 30%, because the turnover of the SSC of last year is greater than 400 crore. It is 402 crore. You can check it over here. I am circling, and therefore the turnover is greater than 400 crore. Therefore, in the current year, the tax rate will come to how much? It will come to 30%. Okay. I hope it is clear to all of you. This is how this question will be computed. It's a beautiful, beautiful question. Next question. There are 3 parts. Question number 12, in which we are supposed to answer with respect to trust. There is a trust which is registered as any other object of general public utility. Now remember, if a trust is registered as any other object of general public utility, then the commercial receipt should not be more than 20% of total receipts. Now the commercial receipt of this trust is 44 lakhs and the total receipts is 2 crore rupees, which is greater than 20%, which is exactly coming to 22%. Therefore, the trust will lose the exemption. It will not be eligible for exemption. Okay. Next one, a trust is paying a rent of 12 lakh rupees for 23-24 and rent of 15 lakh rupees for 24-25. And the TDS of both the rent is paid in the next year. The TDS of both the rent is paid in the next year. Therefore, what will happen? The TDS of first year, the rent of first year will be disallowed to the extent of 30%, and the rent of second year will be fully allowed, because in the next year it is paid before the due date of filing of return. So both the year TDS is paid before the due date of the next year. Okay. So therefore, the current year rent will be disallowed to the extent of 30%, and it will be allowed in the next year to the extent of 30%. 30% of 12 lakhs comes to 3.6 lakhs. 3.6 lakhs will be allowed as deduction in the next year. What about this? Out of this 15 lakhs, you will be allowed only how much? You will be allowed out of this 15 lakhs, full 15 lakhs will be allowed, because it is paid before the due date of the current year. Okay. I hope it is clear to all of you. And the third question is, a charitable trust was there. It has changed its object. Now we know that if a trust changes its object, and if the trust change its object, then it has to apply for a fresh registration within 30 days. But the trust unfortunately did not apply for the fresh registration. If the trust does not apply for the fresh registration, then it loses the charitable trust status. Therefore, the trust will be liable for what? Exit tax under 115TD at the rate of 34.944%. This is what this question is all about. The next question is about a Supreme Court judgment of a Bombay High Court judgment of Srimati Sunil Vishwambharanath Tiwari 2016. Now what has happened in this case? The assessee was eligible for deduction under ATIA, and the assessee was claiming a deduction of 18 lakh rupees. Now the AO has disallowed some 18 lakh rupees. Okay, so assessee is eligible for deduction under ATIBA, and assessee was claiming deduction of 40 lakh rupees. Now the AO has disallowed some expenditure to the extent of 60 lakh rupees. Okay, 30% of that is TDS non-disallowances, TDS non-deduction. So assessee disallowed, AO disallowed what? 18 lakh rupees. So that 18 lakh rupees is also disallowed. So now the question is whether this 18 lakh rupees is also eligible for deduction under ATIBA. So the Bombay High Court in the case of Sunil Vishwambharanath Tiwari has held that yes, this 18 lakh will also be eligible for what? will also be eligible for deduction under 80IBA. You have to give the deduction of entire 40 lakhs plus whatever is disallowed under PGBP. Therefore, entire 58 lakhs will be subject to what? Deduction as per this Bombay High Court judgment. I hope it is clear to all of you. The next question is on transfer pricing. Now, what exactly is there in the transfer pricing over here? First of all, to apply transfer pricing, we need to identify the relationship of associate enterprise, whether the two entities are associate enterprise or not, whether Delta and ALPS are associate enterprise or not. Yes, they are associate enterprise because one entity is giving loan to the other entity to the extent of 51% of the book value of the other entity. How, sir? See, the book value of the Delta is how much? Is 60,000 crore and the loan is given to the extent of 350 crore euros. Because it is euros, you have to convert into rupees. So if I convert into rupees, it comes to 30,800. So the asset is 60,000 crore and the loan is 30,800 crore, which comes to definitely more than 51%, 51.33%. Therefore, both of them are deemed to be associate enterprise. Now the question is, when you are giving loan to your associate enterprise, you are charging how much? You are charging 9%. But when you are giving loan to other enterprises, you are charging only how much? You are charging only 7%. So there is a shortfall of 2%. So that much amount has to be what? Added to the income statement in the form of a primary adjustment. So this will answer the first two questions. The first question was, examine whether transfer pricing provision would be attracted. The answer is yes. Both Delta and ALPS are deemed to be associate enterprise because of 51% relationship, and therefore that transaction is deemed to be associate enterprise. It is deemed to be international transaction, and therefore transfer pricing is applicable. Second question, whether primary adjustment will be made? Yes. On 30,800 crore, 2% is the shortfall of interest. Therefore, that 2% has to be added back to the income statement, which comes to 616 crore. That has to be added back to the income statement. Third, elaborate on the secondary adjustment if the primary adjustment is made suo motu by the assessee. Now remember, if the primary adjustment is made suo motu by the assessee, then the assessee has to bring back the money within 90 days from the due date of filing of return. If it does not bring back the money within 90 days from the due date of filing of return, then it has to consider this 616 crore rupees as deemed loan, and on that interest will be charged at the rate of LIBOR plus 3%. Why LIBOR? Because the transaction is denominated in foreign currency, therefore interest will be charged on LIBOR plus 3%. If the transaction would have been denominated in INR, then SBI MCLR plus 38.25% we would have taken. But here it is a foreign currency, therefore we are taking LIBOR plus 3%. Okay, is there any option available for me? Sir, what will be the period? Period will be including the 90 days interest will be charged. Interest will be charged from 1st of December only till 31st of March. Sir, is there any way I can just make some additional payment of tax? Yes, you can make a payment of tax of 18% tax, 12% surcharge, 4% cess. Once you pay that tax, after that interest will not be charged. But till the time you pay the tax, interest will be charged on you under the income tax law as per the concept of secondary adjustment. Okay. And one last question over here of this RTP. Pay attention, please. There is a non-resident, huge grant. A non-resident is there. It is providing some services to an Indian company, Himalaya Limited, and in return getting some getting some FTS, which is approved by central government. There is an agreement between both the party, and it is approved by central government. Therefore, now 115A and 44DA can apply. Okay. But the question says that the assessee does not have any fixed place of profession. If the assessee does not have any fixed place of profession, then the provisions of 115A will apply, and 115 says what? 20% or DTAA, whichever is lower. In first case, assume there is no DTAA, then the tax will be 20% as per 115A plus surcharge if applicable, and 4% cess. Assume that there is a DTAA and DTAA says that tax rate is 8%. If the DTAA says that the tax rate is 8%, then the tax will be charged at 8% only. It will not be charged as per 115A. And therefore, in this case, the assessee has to file the return also. Because if the TDS is deducted at a rate lower than 115A, then the assessee is supposed to file the income tax return also. In first case, there is no need to file the income tax return. In third case, the TDS rate is 20% because DTAA says 20%, 25%, and the income tax says that 20%. Therefore, TDS will be deducted as per 20% only. 20% will be charged plus cess will be charged plus surcharge if applicable will be charged under section 115A. Again, if the tax is deducted as per 115A, there is no need to file what? Any income tax return. Okay. And last but not least, if he has a fixed place of business, then to definitely 115A is not applicable, then 44DA is applicable. Under 44DA, he'll be chargeable with 40% tax, under not 40% tax because he is an individual, he will be charged as per the slab rates. And under 44DA, he will be given the deduction of all the expenses, but certain expenses are not allowed. If an expense is incurred partly for Indian branch and partly for foreign branch, then it is not allowed. Only expenses which are wholly for Indian branch, that will be allowed. Plus, any payment made to HO will not be allowed, but reimbursement made to HO will be allowed under the income tax law. Plus, assessee is liable to do tax audit, assessee is liable to maintain books of accounts, assessee is liable to file the income tax return. These are the things that assessee has to follow. So, this is what this RTP is all about. So let's move on with the next RTP, that is RTP May 2022. The very first question over here is on slum sale. So there is a company Beta Limited which is transferring one of its units to another company, that is Delta Limited, and we need to find out the capital gains as per slum sale. So few things to be kept in mind. How a capital gains is computed in case of slump sale? You need to compute the FVC, and FVC is nothing but FMV1 and FMV2, whichever is higher. Then you need to compute the cost of acquisition. The cost of acquisition is nothing but the net worth of the undertaking. So we need to compute all those things one by one. So first of all, we will compute the FVC. In FVC, what is FMV1? FMV1 is the FMV of the assets which we are transferring, okay, as per rule 11 UAE. So what all assets we are transferring? The units of omega, the fixed assets we are transferring, debtors we are transferring, and also we are transferring some liabilities, okay. So now be very careful. What is FMV1? FMV1 is A plus B plus C plus D minus L. Something like this is the formula, where A, B, C, D is asset, L is your liabilities. Now, for that purpose, let us see. In case of fixed asset, what is the first fixed asset? For FMV1, the land will be taken at what? The land will be taken at stamp duty value for the purpose of FMV1. Okay. Then what about the other assets? The other assets which represents plant and machinery, that will be taken at book value for the purpose of FMV1. In FMV1, we take book value for other assets. Okay. For land, we take the stamp duty value. And in case of debtors we are going to take the book value, that is 400 crores or 400 lakhs, whatever it is. For liabilities also we are going to take the book value as the FMV. You need to add all these assets and then you have to reduce the liability, you will get FMV1. What is FMV2? FMV2 is something which we have received. What we have received? We have received 600 lakhs as a consideration, that will become your FMV2. Now let us compute the cost of acquisition. Now for the purpose of cost of acquisition, the amounts will change slightly. For example, land, for the purpose of cost of acquisition, you will take the book value, okay. So for the purpose of cost of acquisition net worth, you will take the book value of land. Similarly, for the purpose of cost of acquisition net worth, for depreciable asset, that is plant and machinery, you are going to take the WDV as per the Income Tax Act. Which WDV? WDV as per the Income Tax Act. And for debtors, you are going to take the same book value, and for the creditors also, you are going to take the same book value only, okay. So land value changes from FMV to cost, and even the plant and machinery value changes from FMV to cost. After that, you will compute your capital gains. The capital gains is long term because the unit was set up in 2010-11. I guess the unit was set up in 2010-11. Therefore, it is more than 36 months. Therefore, it is what? It is long term. Okay. And because it is long term, still you are not going to get what? The indexation under the income tax law. I hope it is clear to all of you. Okay. I hope it is clear to all of you. Now let's move on to the next question, that is question number 2, which is a very good question on manufacturing company, etc, etc, etc. It's a PGBP question on total income. Okay, now pay attention. Question number 17. First of all, SSE was incorporated in December 2021. The business was commenced in Jan 2022, and SSE is engaged in manufacturing and sale of certain tiles. Then the SSE is also following 115 BAB, where you have to follow the concessional tax rate. So you have to answer according to 115 BAB. Okay. Now the very first thing is the net profit of the SSE. The net profit of the SSE is 220 lakhs. The first adjustment is the SSE is buying some one-time license fee, and for that the SSE has debited that to P&L. Now it is wrong. One-time license fee cannot be debited to P&L. It is nothing but an intangible asset. So what is the treatment that you are supposed to give? You have to add back to your profit and then reduce 25% depreciation, intangible asset. Okay. Second one, you are making 32,000 payment in cash to a transporter. That is allowed under income tax law. To transporter, you can make to goods transporter, you can make the payment in cash up to how much? Up to 35,000 rupees. Okay. Now the third one is an intelligent adjustment. You are receiving some rent of 60,000 rupees per month. It means total will come to 7,20,000 rupees per annum. First thing, reduce from PGBP and show under IFRS. Okay. And then again, you are debiting some municipal tax to the P&L account. So add back that municipal tax. And when you go to your house property income, you are not going to get the deduction of all these municipal taxes. Why? Because the SSE is following 115 BAB, and in 115 BAB, you do not get any deduction for other incomes. Suppose if you are earning some rental income, in 115 BAB, rental income is directly taxable at 22%. You are not going to get what? The deduction of municipal tax also, standard deduction also will not be given to you, nor any deduction of interest will be given under 115 BAB. So you have to be very careful with this point. Next one, you are making some donation for scientific research. That is not allowed under 115 BAB. Not allowed under 115 BAB. Next one, you are making some payment to contractor. TDS is not deducted. So 30% will be disallowed under the income tax law. Next one, you are receiving some dividend. So reduce from PGBP, show under IFRS. Okay. And then you are selling that particular shares which was purchased in 2017, and it is sold in what? It is sold in 2024 for 280 rupees. The FMV of that share on 31st Jan 2018 is 110. Whenever the FMV of any particular share is given on 31st Jan 2018, it means grandfathering clause is applicable. 112A will be applicable in that case. So in that case, what will you do? There are two things which you have to do. First of all, whatever is the gain, it is credited to the books of account. So whatever is the gain as per books of accounts, how much will be the gain as per books of accounts? The cost is 100, the sale price is 280. Therefore, 180 rupees will be the gain as per books of accounts into 10,000 shares. That is 1,80,000 will be reduced from your PGBP income. Okay. Then while going to capital gains, you have to be very careful. You have to follow the grandfathering clause. Step 1, cost of acquisition. Step 2, lower of sale consideration compared with FMV on 31st Jan 2018. Then compare with step 1, whichever is higher, and that will become what? Long-term capital gains. Okay, be very careful. Next one, some additional information. As I've told you earlier also, whenever there is an additional information, it means it is not debited or credited to P&L account. Additional information contains what? The first additional information, depreciation as per income tax, reduce that. Okay. Second, you are purchasing some machinery on 15th of November. So claim normal depreciation on that. Additional depreciation will not be allowed because under 115 BAB it is not allowed. Okay. And last but not least, the SSC hiring some employees. First of all, 51 employees were hired on 1st April. Regular employees, 23,000 is the emolument. So you can claim 80 JJAA even under 115 BAB. SSC going for 115 BAB can also claim 80 JJAA. Now, second employee will not get because the emolument is greater than 25,000 rupees. In third case, it is not allowed because the emolument is again greater than 25,000 rupees. In fourth case, it is not allowed because the employees are hired for less than 240 days from 1st September to 31st March. It is less than 240 days. Okay. Now we need to compute the tax. On house property income, 22% tax will be charged. On PGBP income, 15% tax will be charged. On capital gains income, 1,70,112A, 1 lakh exempt, 70,000 will be charged at 10%. Another source income, 22% tax will be charged. Okay. And then 10% surcharge is always applicable in 115 BAB and 4% cess will be applicable. Okay. Now next question is a question on MAT with Ind AS. You need to be very careful with the provision of MAT with Ind AS. There is an Indian company who is following MAT with Ind AS. So we need to follow the MAT with Ind AS concept over here. Now what is the book profit? The book profit after making the adjustment is 97,54,000 rupees. Now there are some OCI items which are given to you, other comprehensive items which are given to you that will not be classified to the statement of P&L account. So some items which will never be classified to the statement of P&L account, you need to adjust that in the book profit. Like for example, deferred cost of hedging, if it is never going to be classified to the P&L account, so you have to classify that right now. So if I classify that right now, I have to debit that right now, and if I debit that right now, I have to reduce 2.8 lakh rupees from here. Okay. Now changes in the value of fair equity, changes in the fair value of equity instrument. This is an exception. This should not be adjusted. This should be adjusted in the year of sale only. This should not be adjusted right now. It will be adjusted in the year of sale. Similarly, revaluation surplus of the assets. Again, it will not be adjusted now. It will be adjusted again in the year of sale only. Remember, there are 2-3 items which I told you, which will not be adjusted now. It will be adjusted in the year of sale. Out of that, 2 items are given over here. Okay. You can open that page of MAT with Ind AS and compare with what I am trying to say. Next, deferred gain, which is credited to P&L and which is credited to OCI, and it will never be classified to P&L. It will never go to P&L. So add that. And last point also, add that. Okay. You need to add these 2 things. Apart from that, the SSC is also going bankrupt and SSC is going for insolvency and bankruptcy code. Remember, generally under MAT, you get either the deduction of loss or UAD, whichever is lower as per books of accounts. But in some exceptional cases, like where you are bankrupt and you are going for what? You are making an application to insolvency and bankruptcy code, then you are allowed both the things. So here you can claim both the things. That is, you can claim the unabsorbed depreciation also of both the years, and you can also claim the brought forward loss also of both the years as per the books of accounts. Okay. Now, one last thing is there in this question. There is some transition amount also, which is to the extent of 68 lakh rupees. What has to be done with transition amount? The transition amount has to be added to the book profit in ratio of 1/5. That is 1/5 in 5 years. You have to add it to the book profit. So how will I add back? But in that transition amount, again there are some exceptions which you should not take in the transition amount. Like capital reserve shall not form part of transition amount. Similarly, adjustments claim relating to differences in foreign operations shall not form part of what? Transition amount. Okay. Now after that you have to compute the book profit. Then they have also given you the normal provision income. The normal provision income tax comes to 12.8 lakhs, and then you have to compare whichever is higher, and then we need to compute the MAT credit if possible. Okay. This is what this question is all about. Next question is a simple question. There is an institution who is solely registered for educational purpose and solely for hospital purpose, and the gross receipt from both of them is 3 crores each. Therefore, the aggregate gross receipt is more than 5 crore rupees. 3 crore from hospital, 3 crore from education. Therefore, the aggregate gross receipt is more than 5 crore. Therefore, it has to obtain the approval from commissioner. The assessee is saying that there is no need to obtain any approval because my individual receipt is less than 5 crore rupees. We do not see the individual receipts. We see the aggregate receipts. Therefore, it will not be covered over here. Okay. Therefore, the assessee is liable for what? For making an application for an approval from commissioner. Second, the assessee wants to set off its excess application of last year in the current year. Not allowed. If you have made an excess application in the last year, there is a loss. If you wish to set off in the current year, it is not available for charitable trust. Third, the assessee has borrowed 40 lakh rupees and it has incurred some expenditure. Now, whenever you take a loan and incur an expenditure, it is not allowed as reduction. But in fact, it is allowed as reduction in the year in which the installment is first paid. Whenever the installment will be paid, whenever the loan will be repaid, in that year it will be allowed. So 5 lakh rupees which is repaid to SBI, that will be allowed as a deduction. Okay. Next one is the e-commerce operator section 194O. There is an e-commerce operator like Amazon. It is selling some goods through a seller, that is a resident seller of 84 lakh rupees. Okay. So Amazon is selling some goods through a seller of 84 lakh rupees. So Amazon should deduct TDS at the rate of 194O at the rate of 1%. But if the seller does not give a PAN or Aadhaar, then the Amazon will deduct TDS at the rate of 5%. So here the seller is not giving PAN and Aadhaar. Therefore, Amazon will deduct TDS at the rate of how much? At the rate of 5%. I hope it is clear to all of you. Okay. Now the next question is again a beautiful question on non-resident taxation. There is a foreign company, that is the company incorporated outside India, foreign company, and the poem is also outside India. Therefore, the assessee is non-resident. Now, the very first thing with the assessee is earning is technical know-how. The assessee is providing some services to MNO Limited, an Indian company, and earning some technical know-how. Okay. Now, the consideration is given by the Indian company in the form of debentures of 30 lakhs. So, the foreign company, the non-resident is providing me services. I am giving debentures of 30 lakhs. So, how much, at what rate this debenture, this FTS will be taxable? This FTS will not be covered in 115A. Why it will not be covered in 115A? Because there is no agreement between both of them which is approved by central government. If you want to cover FTS and royalty under 115A, there has to be an agreement between both of them and it should be approved by central government. And because there is no agreement, this will be taxable at 40%. Now, on these debentures, the foreign company will also earn interest. So, foreign company has earned an interest of 2,85,000 rupees. On that interest also, the foreign company will be liable to pay tax at the rate of 40%. Again, that interest will not be covered in 115A. It cannot be taxed at 20% because it is in Indian currency. The loan given by the foreign company is in Indian currency. It is not in foreign currency. Therefore, it will be chargeable also at 40%. Second one, GDR. You are earning some dividends from GDR. Remember, dividend from GDR is taxable at 10% under 115 AC. Then you are earning some dividend from Indian companies. Remember, dividend from Indian companies will be taxable at 20% under 115A. Now, the next one is also very, very important. The foreign company has received some royalty. Now, this royalty is approved by central government. There is an agreement. Therefore, this can come in 115A. But don't make a mistake of writing 12,56,470 as the income of the assessee. No, this amount is received by the assessee. Now, because this amount is received by the assessee, you have to gross it up. Because this is received. This is not income of the assessee. This is the receipt amount of the assessee. Now, what is received by an assessee? What is received by an assessee is always after TDS. Therefore, 12,56,470 is after 20.8 TDS, 20.8%, 20% tax plus 4% cess. That is, it is 79.2%. Therefore, 100 is how much? You have to make a backward calculation. Then, business income will be taxable at 40%. And then, long-term capital gains, there is a mistake made by ICI. In the income, they are writing 132. In the tax, they are writing 232. Remember, long-term capital gain on transfer of unlisted shares, the assessee has two options. Without indexation, then the tax will be 10%. And with tax will be, with indexation, tax will be 20%. Without indexation, tax will be 10%. Whatever the assessee wants to take, assessee can take as an option over here to compute its tax. One last question in this RTP is on DTAA, which is a very simple question. Nothing great I have to say. In DTAA questions, I cannot say anything great. If any unique kind of question comes, then I will speak on that. Otherwise, it doesn't make any sense to waste time on DTAA question. Still, I will say once that this is a resident assessee, aged 52 years. He is earning some income from India. So, this income will be added to the income statement. Then, share of profit is exempt. So, you will not add this. Okay. Then, agriculture income of $40,000 from country G. So, this you will add also in the income statement, because if you earn from country G, then that is definitely taxable. Okay. Then this loss is there. This loss you can set off against the income of what? Business in Pune. In country G it is not allowed, but in India it is definitely allowed. Okay. Then dividend income from country M 30,000, that you will add it back. Rental income 52,000. Then rental income, out of rental income you are also paying 6,000 rupees municipal tax. You can also claim 30% standard deduction from rental income. All those things are allowed. You are following old regime, be very careful. Then you can claim ATC, PPF 1,50,000, and then you can claim 25,000 premium deduction under ATD. You will not get 28,000. You will get only 25,000 rupees deduction. 28,000 is not allowed. 28,000 will be allowed. Up to 50,000 is allowed to resident senior citizens, and for other than senior citizens it is only 25,000 rupees. So after that you have to compute the average rate in India, and then you have to compare with the average rate in foreign country. You need to find out the doubly taxed income, and then you need to take the relief under section 91. I hope it is clear to all of you. Nothing great as such. So let us go ahead with the next RTP, that is RTP November 2022. The very first question over here is on computation of total income of a partnership firm and tax payable by the partnership firm. Now, this is a question of partnership firm where we have to compute the tax payable as per the normal provision as well as the tax payable as per the alternate minimum tax, because the assessee is a partnership firm and it is a 3-star hotel claiming deduction under 3580. So let us first of all compute the net profit of the assessee, and let us compute the PGBP income of the assessee. Okay, so the firm consists of 2 partners, equal partners. Net profit is 26 lakhs, therefore the profit is 26 lakhs. The very first thing is depreciation as per books of accounts, so you will add back the depreciation as per books of accounts. Then there is an interest at the rate of 15%, therefore 15% will not be allowed. Total interest is 50 lakhs, 3% has to be added back. Only 12% is allowed to a partnership firm as per 40B, therefore 10 lakhs will be added back. Further, you have made some payment of 6 lakhs to a resident without deduction of TDS, so 30% of that will be disallowed under the income tax law. Now, you have purchased some motor car of 7 lakh rupees and it is also capitalized in the books of accounts on the date of commencement of the business, therefore you can claim 7 lakh as a deduction under 3580. Further, you have incurred 2 crore rupees capital expenditure, out of which 1.5 crore is land will not be allowed, therefore out of 2 crore only for 50 lakhs will be allowed as a deduction. Okay, then further you have also purchased some air condition for the purpose of your hotel of 3,20,000, that will also be allowed as a deduction under the income tax law. After doing all these things, you are going to get your profit, and then that profit, in fact you are getting a loss. Then this loss will be adjusted against what? Against your another hotel of 4-star, because 3580 loss can set off only against what? Only against 3580 income. So you can set off this loss against your another hotel profit, and then you can pay tax on the differential amount. Okay, now you will compute the tax as per normal provision at 30% plus 4% says that will be your tax. Okay, now we need to compute the AMT also, because if a partnership firm claims 10 AA, ATIA, ATIB, etc., or a partnership firm claims what? Claims 3580, then the provisions of AMT will be applicable. To compute AMT, we need to compute the adjusted total income. What is adjusted total income? It is nothing but whatever is the total income, add all the deductions under 3580, but then you have to compute the depreciation on all these items. We need to compute depreciation on all these items. So on motor car you will claim 15% depreciation. On air condition you will claim what? You will claim again 15% depreciation. But on this, on all the 3 things you are going to claim 15% depreciation in all 3 of cases. Okay. So on building you are going to claim what? 10% depreciation. Okay. Because this is how you compute the adjusted total income. That is, the deduction under 3580 will be added back, but the depreciation will be reduced. Now, whatever the adjusted total income comes, you will take 18.5% adjusted total income AMT, 4% cess, and then you will check with your normal tax, whichever is higher will be liable for tax, and the differential amount will be considered to be what? As your AMT credit. So it's a simple question, nothing great as such. It's an easy question. Now, coming to the next question, question number 24. Pay attention, please. It's a beautiful question now. Now, this question is also based on a manufacturing assessee, and the manufacturing assessee is also claiming deduction under section 115 BAA. And once an assessee claims deduction under 115 BAA, once an assessee opts for 115 BAA, then the turnover is of no use to determine the tax rate, because the tax rate is directly 22%. Okay, we don't have to see the turnover to determine the tax rate. Now, the very first thing is the net profit. Net profit is 9 crore 50 lakhs. The first thing is depreciation as per accounts, that will be added back. Then you are giving some donation to political party, that is not allowed under 115 BAA. It is not allowed. ATGGB is not allowed under 115 BAA. Okay. Then you are making some payment for research institution, then that is also not allowed. Scientific research deductions are not allowed under 115 BAA. You are receiving some dividend from foreign company, reduce from PGBP and show under IFOS. Okay. Then you are also earning some long-term capital gains on sale of equity shares on which STT is paid. So reduce from capital gains, and while taxing it, if 1 lakh will be exempt under 112A, balance will be taxed at 10%. Okay. Now the next adjustment is a good adjustment. You are purchasing some machinery. For that you have taken a loan of 4 crore 20 lakh rupees. 10% is the rate of interest. Now on 1st June 2023, you have taken the loan and the machinery is put to use. Machinery is put to use on 1st of Jan 2023. So for 7 months, the machinery was not put to use. So 7 months interest will be what? Added to the cost of the asset. I hope it is clear to all of you. So what are you going to do? First of all, you will add back the entire interest. They have debited the entire interest to P&L. So entire interest comes to 10 months interest come to 35 lakhs that you will add back to the P&L. Okay. And then the 7-month interest, that is pre-acquisition interest, that will be added back to what? That will be added back to the cost of the asset. So be very careful. From 1st June to 31st March, the total interest comes to 35 lakhs. But from 1st June to 1st Jan interest, you will capitalize, and the next 2 months interest will be disallowed. Why it will be disallowed? Because it is paid on 1st of December after the due date of filing of return. It is disallowed. Always remember, what is disallowed is only revenue expenditure. What is disallowed is not capitalization of interest. Capitalization of interest to an asset is not disallowed because of non-payment. You have to capitalize to the asset whether you have paid or not. Yes, to claim it as a revenue expenditure, you have to do what? You have to make the payment on or before the due date of filing of return. Next, you are making some sale of plot of land to your 100% subsidiary, and the subsidiary is an Indian company, then that is exempt under section 47. So reduce from here and exempt under section 47. You have paid some foreign technician salary for installation of machinery. So add that to PGBP, and then you have to claim that depreciation on that particular asset also, because this is for installation of the machinery. Therefore, you can claim depreciation on that. Next one is the beautiful adjustment. 22 lakh rupees goods you have sold, out of which 12 lakhs you have written off. So now how much is receivable? 10 lakh is receivable. 22 lakh you have sold, 12 lakh is written off. So 10 lakh is receivable. But fortunately you received 11 lakh rupees and you credited the entire amount to the statement of P&L account. Okay. Now entire amount is credited to the statement of P&L account. Now already you have credited 22 lakh rupees P&L account. Okay. Listen carefully. 22 lakh rupees first you have credited, 12 lakh rupees you debited, you write off. So 10 lakh rupees is receivable. Now fortunately you received 1 lakh extra. Okay. You received 11 lakh rupees. Now you credited entire 11 lakh rupees to the P&L account. Now only 1 lakh will be extra, na? That 10 lakh is already included in this 22 lakh rupees. Why I will pay tax on again 11 lakh rupees? Therefore 10 lakh rupees should be reduced from your PGBP income. Okay. Because that is already included in 22 lakh rupees. You have already paid tax on that 22 lakh rupees. Okay. So as simple as that. Next one is depreciation as per tax. You have to reduce it. On office building you will claim 5% depreciation because it is put to use for less than 180 days. Computer you will claim full 40% depreciation because it is put to use not 5%, 40%. That is wrong. Okay. And plant and machinery, 5 crore is the value of plant and machinery. 100 lakhs will be the value of foreign technician salary, and 24.5 lakhs will be coming to what? Will be coming to your pre-acquisition interest, which will be added to the cost of asset, and you will claim depreciation on that at the rate of 7.5% because it is put to use in Jan 2024. Okay. Now you are also declaring some dividend on of 12 lakh rupees, so you can claim that deduction under ATM. ATM is allowed under the income tax law. Okay. Under 115BAA also ATM is allowed. Now while computing the tax, long-term capital gains of 4 lakh minus 1 lakh, that is 3 lakh will be taxed at 10%, and remaining income will be taxable at 22% tax and 10% surcharge. I hope it is clear to all of you. And health and education says at the rate of 4%. Now let us move on to the next question. Question number 25. It's a beautiful question. There is a person, Mr. Rajesh, who is a unit holder of PQR. What is PQR? PQR is an alternative investment fund and is also a unit holder of Shipra. What is Shipra? Shipra is a REIT. Okay. And in both the companies, in both the entities, he holds 10% shares, 10% units since 2021. Okay. And since 2021, in both the entity, he is holding 10% units. Okay. Now, GPL Limited does not exercise the option of 115BAA, and Shipra and PQR distribute 90% of its income to the unit holder. Now remember, in case of Shipra, which is REIT, in case of REIT, only that much income will be taxable in the hands of unit holder, which is actually distributed, and not the entire income. But in case of AIF, there is a concept of deemed credit. In case of AIF, even if 90% is distributed, 100% will be taxable in the hands of investor. So we need to find out which income is taxable in the hands of Mr. Rajesh. First of all, dividend. Dividend from REIT, dividend from SPV is exempt in the hands of REIT, and in the hands of investor also it is exempt if the SPV has not opted for 115BAA. If the SPV would have opted for 115BAA, then the investor would have paid the tax. But in this case, SPV has not opted for 115BAA, therefore investor is not liable to pay tax on this particular 2 crore rupees. Okay. Next, interest from GPL. Yes, on this 3 crore rupees, investor will pay tax. On how much amount investor will pay tax? Investor will get 10% of that because his share is only 10%. Out of that, only 90% is distributed. So 10% of 90% will be taxable in the hands of investor. Short-term capital gains, REIT will pay tax. REIT will pay tax on short-term capital gains. Okay. Now let's come to PQR AIF. In case of AIF, business income, AIF pay tax, investor is exempt from business income. Okay. Long-term capital loss will be attributed to Mr. Rajesh. Why it will be attributed to Mr. Rajesh? Because Mr. Rajesh is holding the unit for more than 12 months. If an investor is holding for the units for more than 12 months, then the other losses will be attributed to the investor. Go and check the provisions of the AIF. And this 52 lakh rupees will be taxable in the hands of Mr. Rajesh at the rate of 10%. 10% will be what? 10% will be taxable income because that much is the investment of Mr. Rajesh. In case of AIF, you don't have to see how much is distributed. In case of AIF, you are supposed to see how much is earned by the AIF. Okay. Then after that, last thing, it is also said that compute tax as per 115 BAC subsection 1A. So therefore, the total income of Mr. Rajesh come to 32,20,000. You will apply the slab rates as per the new regime and then you will compute the tax. Okay. One more important thing, in the question they are asking tax payable. Whenever they are asking you compute tax liability, then compute tax and leave it. But if they are asking you tax payable, then you have to find out the tax payable by the assessee by reducing the TDS which is deducted by the respective person. So assessee's TDS is deducted at the rate of 10% and the rate of 10% under 194 LBA and 194 LBB. How much, sir? On interest 10% TDS is deducted and also on this particular 2,70,000 will come on this interest income and this 5,20,000 will come on this interest income. In both the case, the Shipra and PQR would have deducted the TDS of the assessee. Therefore, you have to reduce the TDS and find out the net amount payable by the assessee. Okay. Now, coming to the next question, which is a small question on but an important question on TDS. The first question is, Mr. Devansh is there, who is an Indian citizen, he is staying in New York. Therefore, he is non-resident. Now, he has come to India on a visit. And he has purchased a tour operator. He has purchased a tour through a tour operator. Okay. He has purchased an overseas tour package and program. So remember, generally, if you purchase an overseas tour package and program up to 7 lakh rupees from 1st October 2023, then it is subject to 5% TCS, and above 7 lakh, it is subject to 20% TCS. Okay. But, if a non-resident comes to India on a visit and if he books a tour, then the provision of 2061G is not applicable to the non-resident. Be very careful. Okay. This is what this question is all about. Next question. XYZ was incorporated on 1/4/2023. It means XYZ is incorporated in the current year. Its turnover for the current year is 12 crore rupees. And it purchases the following goods. It means XYZ is not liable for 194Q because the last year turnover of XYZ is 0. Therefore, 194Q is not applicable on XYZ. Okay. I hope it is clear to all of you. But, what is the turnover of the seller of the last year? The turnover of the seller of the last year is 11 crore rupees. Therefore, the seller will be liable for 2061H, that is TCS under 2061H on receipt basis. Remember, the TCS under 2061H is on receipt basis, is not on receipt or debit, whichever is earlier. It is on receipt basis. Therefore, on first 25 lakhs, TCS will not be collected because it is less than 50 lakhs. On next 30 lakhs, yes, on 5 lakh rupees, TCS will be collected on 15th October. Why 15th October? 15th September is the date of purchase, date of sale, and 1 month after that, payment is made. Therefore, on receipt basis, TCS is collected. Therefore, receipt is done on after 1 month. Therefore, the TCS will also be collected after 1 month. And next, on 15th of December, the goods are sold, but the receipt is done on 15th of Jan. So, on 15th of Jan, on this 15 lakh rupees, 0.1% TCS will be collected by the seller. Okay. Buyer is not liable to deduct TDS in this section because the buyer's last year turnover is less than 10 crore rupees because the buyer is incorporated in the current year only. Okay. Now, the next question number 27 is also a beautiful question. Mr. Ravi Prakash, he is a resident Indian, 52 years. He has gifted 30 lakh rupees to his wife, Mrs. Sudha. Now, what Mrs. Sudha did with this 50 lakh rupees? She purchased a car of 29,52,000 rupees, which includes certain charges like RTO charges, insurance charges, 25,000 rupees warranty, accessory. Now the question is, what is the ex-showroom price of this car? So remove all these extra charges, you will get the ex-showroom price of this car, which is 26,24,710. Remember, If Mrs. Sudha has bought an ex-showroom car of 26,24,710, which is more than 10 lakh rupees, the dealer would have deducted TCS or not at the rate of 1% for selling the car. Therefore, approximately 26,247 rupees would have been the TCS, which would have been deducted in the name of Miss Sudha. Now, Miss Sudha is saying that I am furnishing my Aadhaar number to the dealer, and she is saying that I don't have any other income except some rental income of 25,000 rupees per month, and she is not required to file the return as her income does not exceed the basic exemption limit. It is wrong. Her income might not be exceeding the basic exemption limit. I agree to that. But Mrs. Sudha's TDS is deducted to the extent of 25,000 rupees or more. Remember, if any individual's TDS is deducted to the extent of 25,000 rupees or more, then in that case, he is liable to file the income tax return. So because of the TDS deduction, Mrs. Sudha is liable for what? Deduction of TDS. Liable for what? Filing of income tax return. I hope it is clear to all of you. Question number 28. Let us read this question, which is on Dispute Resolution Committee. There is an assessee who has filed a return of income and declaring an income of 28 lakh rupees. And the assessment is done and AO has increased the income by 5 lakh rupees. How much the AO has increased the income? By 5 lakh rupees. Now, the assessee wants to file an application to DRC. There is no order of detention against assessee. There is no prosecution against assessee. There is just one penalty which is imposed under the income tax law under 271D. Can Mr. Vijay file an application before DRC? Remember, to file an application before DRC, your income to be declared in the ITR should not be greater than 50 lakhs. So that is not greater than 50 lakhs. Again, the variation by AO should not be greater than 10 lakh. So that is also not greater than 10 lakh. There should not be any order of detention. There should not be any prosecution under income tax. There can be a penalty. Penalty is okay. There is no harm in imposing penalty. So therefore, Mr. Vijay can file an application. Second, by when he should file an application? He should file an application within 1 month from the date of receipt of this order. So whenever this order is received, within 1 month. So within 1 month will come to 25th December. Now, if he is not agreed, if he is not happy with the order passed by DRC, can he file an appeal? Can he challenge the DRC's order? DRC's order is not appealable. And the last thing, would your answer be different if the assessment order of AO is based on the information received under DTAA with country X? Yes. If the AO has passed an order by receiving an information under DTAA from country X, then it is not possible for the assessee to go for DRC, because that is an also exclusion covered under 245 MA, which says that if the AO has passed an order by receiving an information under DTAA from foreign country, then the assessee cannot go for DRC. DRC doors are closed for the assessee. Now the next question is a beautiful question. You have to be very careful with this question. Beautiful question. There is an Indian company over here. There is a foreign company over here, which is an e-commerce operator. Okay. There is an Indian company. There is a foreign company, which is an e-commerce operator. So again, I am saying it's a beautiful question. There is an Indian company over here and there is a foreign company .inc, which is an e-commerce operator. Now the question over here is whether this e-commerce operator will be liable for equalization levy or not of section 165A, which is a 2020 equalization levy, whether equalization levy will be applicable in this case or not. So there are a lot of questions that we need to answer. The very first thing that we need to see over here, first of all, for applying the 2020 equalization levy, the turnover of that foreign company, of that e-commerce operator, should be at least 2 crore rupees. It should not be less than 2 crore rupees. Okay. Therefore, the turnover is at least 2 crore rupees. Secondly, that person has to be non-resident. Yes, that person is non-resident. Thirdly, that person should not have any branch. That person should not have any permanent establishment in India. Fourthly, and the most important point over here, the service which is given by that person to an Indian company, to a resident in India, should not be in the form of royalty. If it is in the form of royalty and FTS, then equalization levy is not applicable. That service should not be in the form of royalty and FTS. Now the question over here is, what kind of service he is giving? He is giving a service of what? Of some online web platform through which it provides end user computer software through an end user license agreement. So again, I am saying, if equalization levy is to apply to that e-commerce operator, that e-commerce operator turnover should be 2 crore. That e-commerce operator should be non-resident. That e-commerce operator should not have any PE in India, and that e-commerce operator should not provide services in the nature of royalty and FTS. Now the question is, he is providing end user license agreement. Now the Supreme Court in the case of Engineering Excellence Limited has said that if any person is providing services in the nature of end user license agreement, then that is not a royalty. And if that is not a royalty, then equalization levy can apply in this case. I hope it is clear to all of you. Because the services which are given by him is in the nature of end user license agreement, therefore it is not a royalty. And because it is not a royalty, then equalization levy may be applied over here. Therefore 2% of the entire turnover will be subject to to equalization levy under section 165A over here. I hope it is clear to all of you. Remember the 4 points which I have told you over here. Next question is a routine question of DTAA. I'm not wasting much time on DTAA questions. If there is some unique points in DTAA question, I will be repeating that. Otherwise, I'm not wasting much time on what? DTAA questions at least here, please. Now the next question is based on OECD's most favored nation clause, MFN clause. Now what has happened over here? We are entering into a DTAA with one country, country X. Listen carefully, it's a very logical and common sense wala question. We are entering into DTAA with country X and we are saying that if any person of this country will come to India and earn dividend, then will charge the tax at how much? 15%. Okay, how much tax will charge? 15%. So we are entering into a DTAA with country X and we are saying that dividend will be taxed at 15%. Now this country is our DTAA member and it is also a member of what? Of OECD. That country X is also a member of OECD, okay, and there is an MFN clause applicable to this country. Now listen carefully, it's a very simple concept. We are entering into DTAA with country X, and country X people are liable for what? 15% tax on dividend, and country X is a member of OECD. Now after a few months or after a few years, we are entering DTAA with country Y now. Now with country Y, when we are entering DTAA now, at that time we are saying that at that country people, country Y people, that is the second country people, will be liable for tax at the rate of 10%. And the second country is also an OECD country and we are also part of the OECD. Now listen carefully please. Now the first country people will be very angry. They will say that we have entered into DTAA with you first, then also you are charging us 15%, and the country with which you are entering DTAA later, you are charging 10% in that case. Here comes the most favored nation clause. The most favored nation clause says that if you enter into a DTAA with a particular country at a higher rate, and later on if you enter into a DTAA with second country at a lower rate, then you have to apply the lower rate to the first country also, okay? So you have to apply the lower rate of 10% DTAA to the first country also, which you are applying to the second country. But the condition over here is when you are entering into a DTAA with second country, you already had entered into a DTAA, and that particular first country is also already a member of what? Already a member of OECD. For example, when we enter the DTAA initially, at that time that member was not a member of OECD, right? When we entered the DTAA with the second country, after that he became the member of the OECD, then we will not provide the benefit of what? Most favored nation clause. This is what this RTP is all about. So let's move ahead with the next RTP, and the next RTP that we are taking up as of now is November 23 RTP. After this, we will take the May 23 RTP also. Okay. So the first question over here is assessee is a manufacturer and assessee wants to follow 115BAA. So you have to answer the question according to 115BAA. Okay. Now the very first adjustment over here is the assessee is supposed to pay some interest of 24 lakh rupees, but instead of paying that interest, the assessee is issuing 8% debenture to the party. So whether that will amount to actual payment, and the answer is no. Actual payment means actual payment. Only conversion of outstanding interest into a new loan or into a new security bond or any other financial security or into a new debenture does not amount to actual payment, and therefore this will be disallowed as per section 43B. Okay. Next one, the assessee assessment is done, and therefore the assessee is raised. Assessee is asked to pay some demand of 5,80,000 rupees, in which there is a surcharge of 57,000 rupees, 50,700, and cess of 22,308. It doesn't matter. When we disallow the income tax, we disallow the tax also, we disallow the surcharge also, and we disallow the cess also. So everything will be disallowed under section 40 small a subclause 2. Okay. Next, the provision for payment of gratuity is 180 lakhs. Remember, always provision for payment of gratuity is disallowed, but if any gratuity is actually paid, that will be allowed as a deduction, and therefore 105 lakhs is actually paid, that will be allowed as a deduction, and the provision will be disallowed under 40A7. Next one, there are some directors in the company who are going for foreign travel for the purpose of business. So they have incurred some foreign expenses, some travel expenses. Whether that will be allowed as a deduction? Definitely the answer is yes, that will be allowed as a deduction because it is for business purpose. Next, you are purchasing 82,000 rupees raw material on 26 Jan and the payment is made in cash. It is disallowed under section 40A3. Don't make emotional excuses by saying that it is on 26 Jan, bank was closed. It doesn't matter. Even if the bank is closed, you have to make the payment by online only of more than 10,000 rupees. Next, you are making some payment to a Japanese company of online advertisement services, and that Japanese company does not have a P in India. Therefore, if the non-resident does not have a P in India, and if you make the payment of more than 1 lakh rupees to that non-resident for online advertisement, you are supposed to deduct and pay equalization levy. The assessee has not done that. Therefore, this 11 lakh will be disallowed under the income tax law. Next one, corporate social responsibility expenses are disallowed as per explanation 2 to section 37.1. Next one is a routine adjustment. You are selling some land to a wholly owned subsidiary, okay? And therefore, that profit is credited to the P&L account. So you will reduce from P&L account, because if you sell something to your wholly owned subsidiary, then capital gain is exempt under section 47. So you will reduce from here, and then you will show as an exemption under section 47. Next one, donation to a scientific research association. Not allowed, not allowed, not allowed under 115BAA. Under 115BAA, donation to scientific research is not allowed. It doesn't matter whether the payment is made in banking account or whether the payment is made in cash. It doesn't matter. Next, the company has paid an interim dividend of 65 lakh rupees, but the company has received a dividend of 36 lakh rupees. So first of all, I will tell you the effect of this dividend. You will reduce this 36 lakh rupees from PGBP and show under IFOS. And while claiming a deduction under ATM, you will get deduction of lower of the two. Only 36 lakhs will be allowed as deduction under ATM, and you also have to disallow this 65 lakhs to PGBP, because this 65 lakhs is also debited to PNL. Okay, so you have to disallow that 65 lakhs, and while claiming deduction under ATM, you will claim only 36, because it is whichever is lower. You have to compare the dividend distributed with your dividend earned. Okay, next one is the company is contributing some 60 lakh rupees to employees pension scheme, and the contribution is 15%. How much is allowed? If an employer contributes to employees pension scheme, ATC, CD, etc., then only 10% is allowed. Therefore, 5% you have to add back, and 5% amounts to how much? Amounts to 20 lakh rupees. Sir, where it is written? It is written in section 36, subsection 1, clause 4A. Next one, very big question it is. Depreciation, you will add back. Donation to political party, not allowed under 115BAA. Sir, ATM is allowed under 115BAA. Yes, ATM is allowed under 115BAA. Normal depreciation, yes, you can claim. Additional depreciation, not allowed. Brought forward UAD, yes. If the UAD is out of normal depreciation, then it is allowed under 115BAA. But if the UAD is out of additional depreciation, then that is also not allowed under 115BAA. After all this, you have to apply tax, that is 22% flat tax, 10% surcharge, and 4% cess. This is the tax that the company has to pay who has opted for 115BAA. Okay. Now the next question is on TDS. A beautiful question, TDS and TCS. There is a company by the name called as Delta Company, which was incorporated in 2013, and it has purchased some coal from Fee Limited, another company, for 75 lakh rupees. Okay. Now remember, if somebody sells coal, then that person should collect TCS under section 206C subsection 1, right? Seller of coal is liable to collect TCS under section 206 subsection 1. With that logic, Fee Limited should collect TCS. But if the buyer, that is Delta Limited, has given a declaration that I am using this particular coal for manufacturing or power generation, then the seller will not collect TCS. Therefore, in this question, 206C subsection 1, TCS is not applicable. But we need to check one more thing. If TCS is not applicable under 206C subsection 1, a CBCD circular says that if the seller is not liable to collect TCS because the buyer is giving declaration, then the buyer has to see whether 194Q is applicable for him or not. Then the buyer should deduct TDS. Now the 194Q is not applicable to the buyer. Why? Because the buyer is incorporated in the current year 2023-24. Therefore, the last year turnover of the buyer is 0. And because in 194Q it is very clearly written that 194Q is applicable only if your last year turnover is greater than, business turnover is greater than 10 crore rupees. Therefore, in this case also, Delta Limited is not liable to deduct TDS also. Last question over here. Would your answer change? If Delta was incorporated in the last year and the last year turnover was exact 10 crore, then also my answer would not change, because then also my last year turnover should not be 10 crore. It should be greater than 10 crore. If it is exact 10 crore, 194Q is not applicable. So it's a beautiful question, just so I see it. Okay. Seller will not collect TCS because the buyer is giving declaration. Buyer will also not deduct TDS because buyer's last year turnover is not exceeding 10 crore rupees. Next question is also a beautiful question of Sigma Limited. Sigma Limited is a car manufacturer. It is selling some car to car dealers. Now remember, if a car manufacturer sell cars to car dealers, then the provision of 206C1F is not applicable. CBDT has given a clarification in the form of FAQ that car manufacturer selling the cars to car dealer, 1F is not applicable. If 1F is not applicable, now we need to see some other aspects. Okay. Then now if 1F is not applicable, then we need to see 206C1H and 194Q. Now let's see what Sigma is selling to Epsilon. Sigma is selling 10 cars to Epsilon of rupees 12 lakhs each. Okay. Of rupees 12 lakhs each. Sigma is selling to Epsilon of rupees 12 lakhs each. Now whether Epsilon, who is a buyer, is liable to deduct TDS. Remember, Sigma is not supposed to collect the TCS, but is the buyer liable to deduct? Is the buyer liable to collect TCS or not? Is the buyer liable to deduct TDS or not? Let's see. Let's see whether the Epsilon's last year turnover is greater than 10 crore or not. Yes, the Epsilon's last year turnover is 14 crore. Therefore, Epsilon will deduct TDS. If Sigma is not collecting TCS, forget it. Epsilon will deduct TDS on how much? On 120 lakhs minus 50 lakhs, that is on 70 lakhs, epsilon will deduct TDS at the rate of how much? At the rate of 0.1%. I hope you are clear. So again I am saying, when a manufacturer like Sigma sells car to car dealers, then 1F is not applicable. Okay, so in case of epsilon, 1F is not applicable. But epsilon is buying cars of more than 50 lakh rupees, so epsilon will deduct TDS. Now let's talk about Sigma and Omega. Sigma is selling cars of 10 lakh rupees each to whom? To Omega. Whether Sigma will collect TDS under will collect TCS under 1F. Sigma will not collect TCS under 1F. 1F is not applicable because again it is a car dealer. Okay, they are selling to car dealer. 1F is not applicable. Now we need to see whether Omega is liable to deduct TDS under 1H. TDS under 194Q. So what is the turnover of Omega of last year? It is only 9 crore. Because the turnover of the buyer of the last year is only 9 crore, buyer is not liable to deduct TDS under 194Q. Now you need to again come to Sigma and see if buyer is not liable to deduct TDS under 194Q, whether Sigma is liable to deduct TDS, whether Sigma is liable to collect TCS in under section 206C1H, because here the value of car is what? Is not exceeding 10 lakh rupees. Therefore, Sigma will collect TCS under 206C1H at the rate of 1%. Again, I am saying in both the cases, Sigma will not collect TCS under 1F. 1F is not applicable because both of them are dealers. Okay. In case of epsilon, epsilon will deduct TDS. Why? Because between 194Q and 206C1H, you have to give preference to 194Q. Before excellence last because epsilon's last year turnover is greater than 10 crore, therefore epsilon will deduct TDS. In case of Sigma and Omega, Omega is a buyer, Sigma is a seller. Sigma will not collect TCS under 1F because it is selling to dealer. Omega will not deduct TDS because Omega's last year turnover is less than 10 crore. Therefore, the liability will again go back to whom? Sigma, and Sigma is liable to collect the TCS. I hope it is clear to all of you. Now, the next question is based on a case law which I have already uploaded in the case law lecture. But again, I would like to say it's a Singapore Airlines judgment where the question was whether the TDS will be deducted on the normal commission, that is the standard commission, as well as on the supplementary commission. And the answer is yes. The 194H says that, the Supreme Court says that TDS will be deducted on both the commission. Standard commission is a percentage of some year ticket, and the supplementary commission is a difference of the price at which it is sold and the price which is fixed by the airline authority. Okay. So on both the commission, TDS will be deducted. This is what this case law wants to say. And obviously this case law I have also discussed in the case law lecture. You can go and check over there. Okay. The next question number 35. Is about updated return. There was an assessee, Mr. Ram, who gets his account audited under 44AB for filing his original return. And for original return, he has filed for AY 2021 on 28 December 2020, and he has declared an income of 12 lakhs rupees. And in case of AY 21-22, he has declared a loss of 5 lakh rupees. Okay. Now, he wants to file an updated return for the second year and declare an income of 7 lakh rupees. Can he do so? Now, for second year, what was the loss earlier? For second year, earlier he has declared a loss of 5 lakh rupees. Now he wants to declare a profit of 12 lakh rupees. Can he do so? Yes, he can. If there is a loss return and if you want to convert that into an income, then you can file an updated return. If there is a loss return and if you file an updated return also with a loss, then it is not allowed to file an updated return. If a loss is converted into an income, then you can file an updated return. Therefore, he can file an updated return. Second, what will be the time limit to complete an assessment? Now, this is an old question which is asked. Therefore, the time limits are also as per the old limits. For AY 2021, the time limit was 18 months on the end of relevant AY, and from AY 21-22, it was for AY 21. Now, remember, for AY 2021, you need to file a normal return. Okay. So, if you are filing a normal return, the time limit will also be as per normal provision, 18 months on the end of the relevant AY. For AY 21-22, you are filing an updated return. And for updated return, the time limit is also different. It is 9 months from the end of the financial year in which the updated return is furnished. Now that 9 months is also changed by Finance Act 2023 to 12 months. Now because it is an old question, so we are writing in the solution the old time limit only. But if the question comes for AY 24-25, then you have to say 12 months from the end of the financial year in which the return, that is updated return, was furnished by the assessee. I hope it is clear to all of you. Next question is a simple question. There was a search which was conducted on assessee and there was some undisclosed cash which was found. Now the question is, can assessee set off its UAD and loss against this undisclosed cash? And the answer is no. There is one section 79A, which clearly says that if any income is found in search and seizure or survey, then any loss or unabsorbed depreciation cannot be set off against such income. Okay, it has to be directly taxable. The next question is again on case law of SAP Labs India Private Limited. If you see the case law lecture, you will find out this question also in the case law lecture. Let me explain you the facts of the case. What is exactly happening over here? The question over here is whether the High Court has the power to determine the arm's length price in case of transfer pricing. Remember, determination of arm's length is generally a question of fact, and you might be knowing that High Court cannot entertain question of fact. High Court can only entertain question of law. The last fact finding authority is the tribunal, and therefore High Court cannot get into all these things. Therefore, the question over here is, can High Court interfere in determination of arm's length price? The matter went to the Supreme Court, and the Supreme Court said that yes, High Court can determine the arm's length price subject to some condition, and that is High Court. I am not saying High Court will start to compute the arm's length price. No. High Court will just check whether all the provisions of the income tax law are properly followed or not. High Court will check whether the arm's length price is determined as per section 92C and its rules or not. If it is not determined as per that, High Court can direct the AO to change the arm's length price also. Okay, I am not saying High Court will sit and change the arm's length price, or High Court will ask the questions on the facts. No. But High Court can definitely interpret the law and can say the assessee that you have not computed the arm's length price as per the law. I am interpreting law. How much is the arm's length price? I am not interested. But the way you have computed, that is not as per the law. That is something which High Court can definitely do. Okay. Now the next question is a DTAA. Very simple question. Nothing great as such. You have to compute the DTAA. I am not repeating again and again these kind of questions. Important points I am saying. There is a basic salary. You have to take 62,000 into 12. Then DA is there. After that, from the DA, you are going to take 50,000 standard deduction. Then some royalties there. Expenses from royalties there. Rental income is there. You can take standard deduction from there also. Dividend is there. Then there is some property which you have purchased on which you have paid 1% stamp duty. Now this is an important point that I would like to highlight. So stamp duty, if you pay to purchase a property, that is allowed as a deduction under 80C. Okay. And then you are paying some health insurance for yourself, 26,000. Your age is 45 years. Therefore, you will get 25,000 for yourself and 50,000 for your non-resident parent. So if you make payment for your non-resident parent, there also you are going to get only 25,000, not 50,000. If the parent would have been resident and senior citizen, then 50,000 would have been given to you. Okay. Therefore, your 25,000 and your parents 25,000, total will come to 50,000 rupees. Okay. Next one more thing which you need to keep it in mind, that is 80 QQB section is applicable over here for royalty on books. 3 lakh rupees deduction you are going to get under 80 QQB. Apart from this is a very routine question. Okay. Now question number 39, that is the last question of this RTP, which is a beautiful question. There is a foreign company, Aster Inc., which is in Canada, and it owns a digital platform, that is, it is an e-commerce operator, and it sells some e-readers of different brands globally. Okay. Now we need to identify in this question whether equalization levy is applicable or not. If yes, of which year? Whether 2016 equalization levy is applicable or 2020 equalization levy is applicable in these two cases. First of all, there is a website, Aster Inc., through which people are selling their goods. There is a seller, ABC Limited, an Indian company engaged in designing, manufacturing and selling e-readers. Whether this seller who is selling the goods through what? Through an e-commerce operator of non-resident nature, that is of what? Of Aster Inc., whether the equalization levy will apply or not. Let me talk about 2016 equalization levy. 2016 equalization levy is not possible because 2016 equalization levy is only applicable for online advertisement. Whether 2020 equalization levy is applicable, that is also not applicable because there is one condition that if the seller who is selling the goods through the e-commerce operator is in Indian, if the seller has a P in India, then equalization levy is not applicable. Very minute point. If the seller has a permanent establishment in India, now this seller is an Indian company only, definitely it has a permanent establishment in India. Therefore, that seller will not be subject to what? Equalization levy. So in this case, equalization levy is not applicable. In the second case, yes, it is applicable. The seller is a non-resident and the seller does not have a P in India and they are selling some goods, that is e-readers in India. Again, 2016 equalization levy will not apply. Why it will not apply? Because this is not a case of online advertisement. 2016 equalization levy applies only in case of online advertisement. This is the case of sale of goods through an e-commerce operator. Therefore, 2020 equalization levy will apply. How much it is sold? First, it is sold to Indian customers. Yes, it is covered. Second, it is sold to what? Outside customers, but they are using IP address located in India. Yes, that is also covered. Now, how will you compute the total turnover? One more thing you need to keep it in mind, that Aster Inc. does not have a P in India. If Aster Inc. has a P in India, then also equalization levy is not applicable. Aster Inc. does not have a P in India is a very important line. One more thing we need to apply. Again, 2016 equalization levy is not applicable. Only 2020 equalization levy is applicable. For that purpose also we need to check the turnover of the Indian from India should be at least 2 crore rupees. Therefore, 2000 e-readers into 12,000 plus 1000 e-readers into $150 into 80 rupees per dollar. This comes to 3.6 crore rupees if you total it. Now, because it is greater than 2 crore rupees, 2020 equalization levy under 165A will be applicable at the rate of 2%. Apart from this, they are doing some more transactions also. ABC Limited, that is this company, an Indian company, is making a payment of 25,000 to Aster Inc., who is a foreign company, who is a non-resident, who does not have a P for hosting advertisement. Whether equalization levy will apply in this case? Yes, equalization levy is applicable in this case, because the online advertisement is provided by a non-resident who does not have a P in India to a resident who is doing business, and the online advertisement payment is more than 1 lakh rupees. Therefore, 2016 equalization levy is applicable in this case. In second case, XYZ had paid 32 lakh rupees now to Aster Inc. Whether in this case equalization levy of 2016 will apply? 2016 equalization levy cannot apply, because 2016 equalization levy is applicable if the person who is in India has to be resident, or if the person who is in India has to be non-resident with a P in India. Only if a resident is there in India and making payment of online advertisement, or if a non-resident having a P in India making a payment out of India for online advertisement, then only 2016 equalization levy is applicable. In this case, the XINC is non-resident, but it does not have a P in India. Therefore, 2016 equalization levy is not applicable. And where 2016 equalization levy is not applicable, there you have to apply 2020 equalization levy. First, always you have to check 16 implication. If 16 is not possible, then you have to go for 2020 equalization levy. So in second case, 2020 equalization levy will be applicable at the rate of 2%. I hope it is clear to all of you, and this is what this RTP is all about. So let's move on to the RTP May 2023, and in this RTP the first 15 questions are MCQ, which I have already discussed and put on YouTube. You can check in full English also. So I'm interested in explaining and revising the descriptive questions over here. First question is question number 16, which is a question which is based on Finance Act 2022 amendment. If you realize that this is an amendment, there is an amendment which came in Finance Act 2022 which says that if you have taken a loan from someone and if you are not able to explain the source of the loan in the hands of the lender, then it will be taxable in your hand in the form of cash credit. So in this case, a partnership firm has taken a loan from what? Its partner. Now it is the duty of the partnership firm to explain the nature and the source in the hands of the partner also. If the firm is not able to explain the nature and source in the hands of partner, then the firm will be liable for tax under section 115 BBE, and 115 BBE is liable for how much tax? 78% tax, and therefore the assessing officer is attracting 78% tax because the partnership firm is not able to explain the source in the hands of the partners, from where the partner has got the money to give the money to the firm. Okay, so this is what this first question is all about. Let's move on to the second question. Question number 17. This is also based on what? Finance Act 2022 amendment. Very important amendment. It is very clearly written in the provision of section 43B, which says that if you take a loan from a financial institution and if there is an outstanding interest, then that outstanding interest is not allowed as deduction unless and until you make the actual payment. Now, can I convert that outstanding interest into a new loan and take the deduction? The answer is no. Can I convert that outstanding interest into a debenture or any other security and take the deduction? The answer is no. This is the amendment which is made by Finance Act 2022. So in this question, the SSC is taking a loan from a financial institution and converting the outstanding interest into a new debenture. That will not be allowed as deduction unless and until it is actually paid to the bank or financial institution. It will not be allowed as deduction. Okay, so this is what this question is all about. Now question number 18 has 5 different parts which says that you have to identify whether the SSC is liable to file the return or not. So let's see whether the SSC is liable to file the return or not. Mr. Albert is there. His age is 31 years and his total income is just 2 lakh rupees. So by default, he is not liable to file the return. But because his turnover of business is more than 60 lakh rupees, he is liable to file the return. Do you remember that there is a separate amendment made by Rule 12BA or something like that? A circular was introduced by CBDT. It is also given in our easy notes. You can go and check over there that if your business turnover is more than 60 lakhs, you are liable to file the return. So because of that, the SSC is liable to file the return. Second, Mr. Ashish, age at 42 years. Now he is liable to file the return by default because his PGBP income is 2.5 lakhs and his interest income is 4,50,000 rupees. So his gross total income is 7 lakh, and any person whose gross total income is 7 lakhs is liable to file the income tax return. Now the third and fourth case is also very simple. Third case, there is a partnership firm, and in fourth case, there is an XYZ private limited company. And we all know that for a partnership firm and for a company, it is always mandatory to file the return irrespective of the total income. So these two SSCs are liable to file the return. Now the fifth case is a very intelligent case. In this, there is a person, Mr. Balish, whose age is 58 years. He has deposited 50 lakhs in saving bank account. Do you remember that? If a person deposits 50 lakh rupees in saving bank account, then he is liable to file the return. If he is depositing 50 lakhs or more in the saving bank account, he is liable to file the return irrespective of whether his total income exceeds what? Exceeds 2,50,000 or not, it doesn't matter. Okay, so by that default, by that logic, he is liable to file the return. Is he liable to file the return under the normal provision? No. Under the normal provision, he is not liable to file the return because his total income is less than the basic exemption limit. But as per the special provision, he is liable to file the return. Okay, now next question, question number 19 is based on search and seizure, and it is a very, very, very intelligent question. On 17th of April 2022, there is a search, okay, and the assessing officer found for 16, 16, 17 PY 23 lakh shares, and for 17, 18 PY 25 lakh shares. Now, for how many years he can send the notice? He can send the notice 3 years from the end of the relevant AY in normal cases. In special cases where the escaped income is 50 lakh rupees or more and it is represented in the form of assets like shares, land and building, advances, deposits, then it can issue notice up to 10 years. So now this does not come in the special case. Why? Because the total income which he has found does not exceed what? Does not exceed 50 lakhs. It is only 48 lakhs. Therefore, he cannot issue notice beyond 3 years. Now, what if this 23 lakhs is not 23 but it is 30 lakhs? This is part 2. If this 23 lakhs is 30 lakhs, then his escaped income will be more than 50 lakhs. Then in that case, he can issue notice even beyond 3 years. Okay, he can issue notice up to 10 years. Next, part 3 says that what if the AO has found that there was some expenditure of 52 lakhs incurred on the marriage of the daughter in previous year 16-17? Can he issue notice up to 10 years in that case? Yes. If there is an expenses or if there is an entry in the books of account, this is also a very latest amendment which was made in the last year only, that if there is an asset or if there is an expense or if there is an entry in the books of account, in either of the case, if it is of 50 lakhs or more, you can issue notice up to 10 years, 10 years, 10 years. This is what this question is all about. Okay. Now, next question is a very intelligent question and there are multiple parts in this question. If you go and see the solution, you will go mad that there are so many parts in this question. Question number 20. Now, let me give you a synopsis of this question. This question is on cooperative society, and cooperative society is engaged in marketing of agricultural produce grown by its member. Therefore, it is eligible for what? ATP. And a cooperative society which is engaged in the marketing of agricultural produce is eligible for ATP. Now, there are multiple provisions which we have to follow. First thing is there is a 10 new employees are employed by cooperative society of 20,000 salary, so they will be eligible for 80 JJAA deduction. Okay, now all the employees are paid by account paycheck, therefore they are eligible for 80 JJAA. There is no issue in that. Apart from that, the profit from agricultural income is 60 lakhs and the interest on fixed deposit is 32 lakhs. Now be very careful. They have asked us to compute tax as per the normal provision, as per 115 BAD also. They have told us to do everything. So the first possibility is compute tax as per normal provision, and if you are computing tax as per normal provision, you also have to compute AMT. When you compute tax as per normal provision, the first thing which you will take is PGBP 60 lakhs, and second thing is interest on fixed deposit 32 lakhs. And what deduction you will get? You will get deduction under 80 JJAA and you will get deduction under ATP of 60 lakh rupees. Compute tax as per the normal provision. Okay, and as per the normal provision, the slab rates, you all know that up to 10,000 no tax, above 10,000 10%, then 20%, then 30%, so on and so forth. Okay, up to 10,000 10%, sorry, above 10% to above 10,000 20%, and above 20,000 it is 30%. Okay, now when you will compute the AMT, at the time of computing the AMT, you have to compute the adjusted total income. While computing the adjusted total income, you will add back 80 JJAA, but you will not add back ATP. Why? Because ATP is not liable for MAT. ATP incomes are not liable for MAT. Therefore, you will not add back ATP while computing AMT. One more thing to be kept in mind while computing AMT is now chargeable at 15% for cooperative society. By Finance Act 2022 amendment, cooperative society will be liable for AMT at how much rate? 15%. Be very careful. That is also an important issue over here. Okay. Next. Then you will compute tax as per 115 BAD. When you will compute tax as per 115 BAD, be very careful. You will not compute AMT because an assessee opting for 115 BAD are not liable for AMT. 115 BAD tax rate is 20%, 22%, 10% surcharge, 4% cess. Okay. Now, when you will compute tax as per what? 115 BAD. When you will compute income as per 115 BAD, in 115 BAD, you will get 80 JJAA, but ATP is not allowed. Only one chapter 6 deduction is allowed in 115 BAD, that is 80 JJAA. ATP is not allowed in 115 BAD. Now, the third possibility is we are supposed to assume that it is not an agricultural cooperative society, but it is a banking business. Suppose it is a banking business. That too, it is not an agricultural banking, not a primary agriculture credit society or primary cooperative. You are supposed to assume that it is not a banking company which is eligible for ATP. It is a normal banking company. So again, you have to make two computation. First as per normal provision and then AMT. When you will compute as per normal provision, you will take 80 JJAA. ATP is not now available only. Not available only. It is only available to primary credit society or for these kind of banking industries and not to others. Normal banking industries are not eligible for ATP. So compute normal computation. Take 60 lakhs, take 32 lakhs and take 80 JJAA. Do not take ATP. While computing AMT also, you will add back 80 JJAA. ATP is not there only. Anyways, it would have been then. Even then in AMT, we do not add ATP. ATP is not added back in AMT. Then compute your tax. Okay. Now, the fourth possibility, now assume it is 115 BAD. 115 BAD, when you will assume that, again you will add back only 80 JJAA because ATP is not there only, and you will compute 22% tax. And then you have to take a decision which is more beneficial. You can go through the solution. It's a very important question according to me. I say I can test on this question in your exam. Be very careful. Okay. Next question is based on 10AA. There is a limited liability partnership LLP, and this LLP has two units. Unit 1 is SEZ unit. Unit 2 is a domestic tariff area. Therefore, for unit 1, you will get deduction under 10AA. But
But while computing the tax liability, you have to compute the tax liability of the entire LLP. Now, therefore, the total income of LLP will be how much? Unit 1 has a profit of 710, Unit 2 has a profit of 840. Now, you have to disallow certain expenses because those are not as per the income tax law. So, in Unit 1, you have to disallow 41 lakhs, therefore profit will become 751, and in Unit 2, you have to disallow 55 lakhs, therefore profit will become 840 plus 55. This will be your total income. So, what will be your total income? 710 plus 41, 840 plus 55. This will become your total income. After you are computed with your total income, what are you supposed to do? You are supposed to take deduction under 10AA, and 10AA deduction is available how much? Profit into export turnover divided by total turnover. Now, what is the profit of Unit 1? Unit 1 profit is 710 plus 41, therefore Unit 1 profit is 751. But from profit, you have to remove two things because those two things cannot be part of profit. That is, duty drawback cannot be part of profit, and profit on sale of import entitlement license. We have done all these things in 10AA. You can go and check. You are not eligible for these two things. Okay. Then you have to compute the export turnover. Export turnover includes only those turnover which has received in India in convertible foreign currency. How much is received? 1600 is received. Now, out of 1600, 180 rupees is what? 180 rupees is what? 180 rupees is with respect to what? Out of 1600, 180 rupees is with respect to insurance and freight, and therefore insurance and freight will not form part of what? Export turnover. So out of 1600, I am removing 180, therefore my export turnover is 1420. Similarly, my total turnover is how much? Export turnover is 1800, domestic turnover is 300, total turnover is 2100. Again, out of total turnover, you are not supposed to take what? You are not supposed to take freight and insurance. Therefore, freight and insurance in total turnover is how much? It is 300. So I am removing 300 from here. Therefore, my total turnover is 1800. If I multiply this, I will get my deduction as 525.4. I will take the deduction, I will compute tax at 30%, and then I will apply surcharge also if applicable, because surcharge is applicable according to me over here because the income is more than 1 crore. Now I will also compute AMT now. While computing the AMT, what am I supposed to do? I will add back 525.4 to get the adjusted total income, and then I will apply 18.5% plus surcharge if applicable and cess of 4%. Okay. So this is what this question is all about. Now next question is based on computation of total income and tax liability, that too as per 115BAA. We have to follow 115BAA over here, but in this is the manufacturer assessee, but in 115BAA, even if you are manufacturer, you are not going to get the benefit of what? Additional depreciation. So let's see one by one all the adjustments, assuming that we are supposed to do the question based on 115BAA, not as per the regular provisions of income tax. First thing is the income tax. The opening stock is overvalued by 10%. It means the opening stock is 110%. So divide by 110% and add back to the pre-P&L account. And the closing stock is undervalued by 10%. It means the closing stock is 90%. So divide by 90% and add back closing stock also. So adjust this in your net profit. Okay. Next is you are buying some intangible assets of 65 lakhs on 15th October. So you have to add back this intangible asset and you have to take 25% depreciation on that. That too you have to take what? 50% of that because it is used for less than 180 days. Intangible assets are subject to depreciation. They cannot be directly deducted from P&L account. Okay. So that's what I'm doing over here. Next one is 112A. You have purchased and shares for 85 rupees and then on 31st Jan the value of the shares is 195. This is the case of what? Listed shares. 112A will be applicable over here, long-term shares. And then when you are selling for 220. So you have to suppose to find out the grandfathering has to be applied over here. So first you will compare the FMV as on 31st Jan 2018 with selling price whichever is lower, and then you will compare with the actual cost whichever is higher, and therefore the cost will come to 195. The cost is 195, the sale consideration is 220, and if I compute the capital gains will come to 55,000. Now because the capital gains is less than 1 lakh rupees, it is not liable to tax because in 112A you get an exemption up to 1 lakh rupees. Okay. Next, electricity charges of February and March is not paid. It doesn't matter. Electricity charges are not covered in 43B. It will be allowed based on what? Accrual basis also. There is no need to make any payment. Next, there is an hedging loss on purchase of raw material. It will be allowed as a PGBP expense, and PGBP deduction will be allowed on that. Depreciation has to be added back as per books of account. Then dividend from foreign company has to be reduced from PGBP and show under IFOS. Then non-compete fees which you have received is a part of PGBP. Let it be part of PGBP. Non-compete fees is a PGBP income only. Next, you have forfeited some amount on sale of land, on negotiation of transfer of capital asset. You have forfeited some amount. Do you remember that? If the amount is forfeited after 1/4/2000 on or after 1/4/2014, then that is considered to be IFOS. So reduce from PGBP and show under IFOS. And if it is forfeited before 31st March 2014, then you have to reduce from the cost of acquisition. Now, in case of unlisted shares, I'll talk about that in a while. Next, you have purchased some machinery of 70 lakhs and you have put to use in the month of November. And there is also a loss of foreign currency on that machinery. That machinery is imported. So if there is an imported machinery, imported asset on which there is a foreign currency loss, that has to be adjusted in the block of asset as per section 43A. So 70 lakhs is the cost of machinery, 2 lakhs is the exchange loss, and therefore the cost will become 72 lakhs. On that that you will take 50% depreciation, 7.5%, because the machinery is put to use in the month of November, and no additional depreciation will be allowed. Depreciation as per the normal provision will come to 35 lakhs. And then the next one is just an information. The next one is 80JJAA. Do you get 80JJAA in 115BAA? By default, you would have by hearted with this particular thing that in alternative tax regime, you get the benefit of 80JJAA. There are 59 employees, out of which 36 are employed from 1st June 2022 and at 15,000. So they will be eligible. But out of this 36 also, 10 employees are not eligible because their salary is paid by bearer check. If the salary is paid by bearer check, it is not eligible. Therefore, only 26 employees are eligible. The rest of the employees are not eligible. Either their emoluments is more than 25,000 or they are employed for less than 240 days. So only 26 employees are eligible out of 36 employees. Rest of the employees are not eligible only for the purpose of 80JJAA. Next, unlisted shares were acquired at 80 lakhs. Now be very careful. Unlisted shares are acquired at 80 lakhs and you have a profit on sale of 18 lakhs. Therefore, profit is 18 lakhs and purchase price is 80 lakhs. Therefore, the sale consideration will be 98 lakhs. Okay, this is how you have to compute. Backward, you have to go and compute the sale consideration, and then you have to index the cost of acquisition. The cost of acquisition is 80 lakhs. You have to index that, and that will be chargeable at 20% tax. Okay, and the rest of the income will be chargeable at 22% tax, plus all entire tax will be subject to 10% surcharge and 4% cess as per 115BAA. Next one is the same question which we have done earlier. You can go and check the chapter. Which chapter? Not chapter, one of the RTPs we have done in this session only. You can go and check that it is exactly the same question. I am not interested in doing this question again and again. You also don't do this question now for the second time before the day of exam, because it's a repetition of the entire provision. Okay, now the next question is question number 24. Question number 24 talks about what? The transfer pricing. There is a non-resident with whom we are doing some transaction. Okay, now that non-resident who gives us a guarantee of at least 12%. So if one entity gives a guarantee of loan of 10% or more, then both of them are deemed to be associate enterprise. Therefore, this transaction is what is deemed to be international transaction. Why? Because one of the entity is non-resident and the transaction is in the nature of purchase, sale, service, etc., etc., and that one entity is giving guarantee of 12% to the other entity. Therefore, both of them are deemed to be associated. Therefore, transfer pricing is applicable in this transaction. Now, the second part is saying that suppose if the primary adjustment of 310 lakhs is made by the assessing officer on 1/4/2022, then and the assessee has not repatriated that money till 31st March 2023, then what are the possible options that are there with the assessee? The first option is there, he has to pay interest. Secondary adjustment will be applicable, because if on 1st April 2022 AO is doing primary adjustment, assessee should have brought back that money within 90 days from 1st April 2022 in India. If he is not bringing that money, he will be chargeable for interest from 1st April only. For the entire year, interest will be charged at how much percentage? Because the transaction is in INR, SBI marginal cost of lending rate plus 3.5%. Therefore, the interest rate will come to 9 plus 3.5. That will come to 12.25%. Therefore, on 310 lakhs primary adjustment, you will be liable for 12.25% interest. Pay that. Second option is what? For the entire year, because the interest will be counted from the date of order and the order is passed on the very first day. The second option which you have is pay additional tax at the rate of 20.9664. That is 18% plus 12% surcharge, 4% cess, and you will be relieved from tax interest. You will be relieved from secondary adjustment from the date of payment of additional tax. Okay. And one last question is over here. This will complete all the RTP. This is based on what? DTAA question. Don't see that. That is a very simple question, a repetition of what we have done earlier in the previous paper. Now, a lot of things will repeat. Whatever will repeat, we are not going to do that. Neither I am going to do that, nor you are going to do that. Okay. It doesn't make sense to repeat the thing, because on the day of exam, we are short of time. Okay.
So now let us move ahead with our last RTP, that is RTP May 2024, and what is there exactly. The first question over here is of which is with respect to MCQ. So ignore this particular question. The RTP starts from question number 14. So let us start this question. It's a very beautiful question. This is a question again on PGPP income, total income, but there are multiple things that we need to do over here. Let us read the last line of the question. We are supposed to compute total income and tax liability of the assessee in the most beneficial manner. So therefore, we are going to compute the multiple things over here. First of all, we are going to compute tax as per the normal provision. Then we will compute the tax as per MAT. Then whichever is higher will be applicable for the assessee. Then this is the first set of calculation. The second set of calculation that we are going to do in this particular question is, that is, we are going to, because it is asked to compute in the most beneficial manner. Therefore, the second time we are going to solve as per 115BAA. And when we solve as per 115BAA, we don't have to compute MAT liability at that time, because the assessee opting for 115BAA, they are not liable for MAT under the income tax law. The MAT is exempt for them. Okay. I hope it is clear to all of you. So now be very careful. Let us start with the question. First of all, we are solving as per the normal provision. That is not MAT, not 115BAA, a normal question. Okay. Manufacturing assessee is there. 900 lakh is the profit. Therefore, that will be written in the statement. Then the assessee is making some payment for obtaining some know-how. So that is disallowed, and you will get 25% depreciation as a depreciation on intangible asset. Then there are some electricity charges which are not paid. So don't worry. Electricity charges are allowed on accrual basis. It is not covered in 43B. Okay. Next one, you are doing some hedging contract for import of raw material, and on which there is a loss. So you are doing some hedging contract on some trading item, that is raw material, on which there is a loss. So it's a trading loss. It shall be allowed as a business expense. Okay. So trading losses which are incidental to the business are allowed as a expense. It is allowed as a deduction, but capital losses are not allowed as a deduction. Next, depreciation which is charged to P&L, add back. Okay. The next one is a good adjustment. You are buying some imported machinery on which there is some foreign currency loss. So if there is an imported machinery and then there is a foreign currency loss, you have to add to the cost of the asset. Remember that as per section 43A. First of all, what you will do, you will add to the cost of asset. You will also add to PGBP income because that is debited to P&L. So add to PGBP income and then add to the cost of the machinery. The cost of the machinery 65 lakhs and loss on foreign currency will be 2 lakh rupees. On this, you will get 50% depreciation because the asset is used for less than 180 days. The asset is put to use on 23rd in December 2023. Therefore, you will get normal depreciation and you will also get additional depreciation. But now, this is the only difference. You will get normal depreciation as well as additional depreciation. But when you follow 115BAA, you are not going to get the additional depreciation. That is the only difference between this calculation and 115BAA. Be very careful. Okay. Next, you are receiving some 20 lakh rupees for non-compete fees. So that is also a PGBP income. Let it be part of PGBP income. It is there in PGBP. Let it be part of PGBP. Next, you have received some advance in respect of sale of your property. So in respect of your sale of property, you have received some advance and the other person, that is the buyer, has not paid you the money, balance money. So you forfeited this 20 lakh rupees. So do you remember, if you forfeit any amount in case of negotiation of capital asset, in case of negotiation of transfer of capital asset, if you forfeit that on or after 1st April 2014, then it is income from other source. So reduce from PGBP and show under income from other source. I hope it is clear to all of you. Next one is, you are selling some unlisted shares and there is an excess of 15 lakh rupees. That excess is nothing but your accounting profit. You have to reduce that accounting profit from the PGBP and you have to compute the tax profit. The tax profit is how much? The cost is 80 lakhs and the excess is 15 lakhs. Therefore, the selling price will be 95 lakh rupees. On that, you will take indexation because unlisted shares become long term after 24 months. You purchase in March 2021 and you are selling in February 2024. So you are selling for more than 24 months old. Therefore, you have to take index cost of acquisition and this will be taxable at how much? 20% as per section 112. I hope it is clear to all of you. Then you will claim some additional information is given over here. Claim normal depreciation and claim 35 lakh rupees normal depreciation. And this is what this question is all about. Okay. Now you're going to compute the MAT liability. After that, you will compute the tax of the SSE. The tax of the SSE will be 25% tax because the turnover of last to last year is only how much? It is is only less than 400 crore rupees. It is up to 400 crore rupees. Therefore, the tax liability as per the normal provision will be 25% plus surcharge will be applicable if it is exceeding the income. I think so. The income is exceeding 1 crore rupees. Therefore, surcharge will apply. Okay, and cess will apply. 405 crore rupees is of no use. You don't see the turnover of last year. You see the turnover of last to last year. Now, this is a normal provision tax. Now, you will compute book profit. Book profit is fortunately directly given in the question as 1520 lakhs. So directly compute tax on that, 15% tax, and because the income is more than 10 crore rupees, 12% surcharge now and 4% cess. And then you take the MAT credit to the extent of the difference of the two. Okay, this is your tax calculation number one. Now the second tax calculation, 115BAA. In 115BAA, nothing extra should be done. Only one thing has to be done is whatever is your total income as per the normal provision, add additional depreciation and you will get the income as per what? As per 115BAA. On that, apply 22% tax, apply 10% surcharge, apply 4% cess, and then check whichever is more beneficial. The tax as per the normal provision is more beneficial or the tax as per 115BAA is more beneficial. Whichever is more beneficial will be applicable to the assessee. I hope it is clear to all of you. Okay. The next question is based on some sale of mutual fund by the assessee. The assessee is a resident Indian aged 55 years and he wants to sell his entire mutual fund portfolio and he wants to buy some villa in what? In Lonavala. Okay. So he wants to buy some villa in Lonavala and he's planning to sell all his mutual funds. Now there are 4 types of mutual funds which are there in front of us. You need to be very careful. BLR Growth Fund, ABC Strategic Fund, the third one is ABC Mid Cap Fund and the fourth one is Growth Fund. Okay, SBA Growth Fund. Now let me talk about all of them, what kind of fund it is. The first and the second fund are those funds in which we have invested 30% in the domestic company's equity shares. Therefore, 70% is in the dead. So only 30% is in the domestic companies of the equity share and therefore 70% is in the dead. Therefore, the first 2 funds are the dead mutual fund. And the next 2 funds have invested 70% in equity shares because it is written in the law. If you invest more than 65% in the equity shares, then only it becomes equity oriented mutual fund. Therefore, these 2 are equity oriented mutual fund. Now, we need to compute the tax. All of them are paying STT at the time of purchase and sale also. They are also giving us what? Some capital gains information over here, that is of CII, etc., cost inflation index. So remember, the first 2 funds are debt mutual fund The next two funds are the equity mutual fund. Now let's talk about all of them one by one. First one is BLR Growth Fund. This is the debt mutual fund which was purchased in 2020 and it is sold in June 2023. So it is sold after 36 months. Therefore, this is long term, and if it is long term, you will also get indexation. So the new provision which has come 50 AA, that is not applicable. The debt mutual fund will always be short term. No. That is applicable only if the mutual fund is issued on or after 1st April 2023. This mutual fund was issued on 3rd April 2020. Therefore, the new amendment is not applicable. So here, the mutual fund will be long term. The indexation will be available to the assessee. Okay. Second is purchased in May 2023 and sold in February 2024. Now, this is always deemed to be short term. Anyways, this is short term only. You are selling within 12 months. It is short term only. But anyways, even if it would have been long term, it would have been short term only, because here the new provision of section 50 AA will apply over here. Be very careful. 50 AA will apply over here, and 50 minus 46 will be directly your what? Capital gains, short term capital gains. Okay. So the first one is a long term capital gains. The second one is a short term capital gains. Now the third one, which is equity oriented, and the fourth is also equity oriented. The third is purchased in December 2022 and it is sold in July 2023. Therefore, it is short term capital gains and it will be covered in 111A tax at the rate of 15%. The fourth one is sold after 12 months, and the equity oriented mutual funds become long term after how many months? Equity oriented mutual fund becomes long term after 12 months, and therefore this is sold after 12 months, and therefore this is what? This is long term, and 112A will apply, and therefore because this is long term, there are out of the four funds, two are long term, two are short term. Okay, which one is long term? The last one is long term and the first one is long term, and against these two long term funds you will get the benefit of 54F. Okay, remember 54F is available only against long term funds. It is not available against short term capital gains. So where you sell all the long term assets except residential house property, and if you buy another residential house property within 2 years and construct within 3 years, then you will get an exemption. So you have to invest how much? Here there is one more catch which you need to keep it in mind. That is, you have to invest the entire consideration. Remember or not? Entire consideration has to be invested. Then only you will be having the advantage of this particular section. If you don't invest the entire consideration, then you will not have an advantage of this section. Therefore, let me talk about long term SBA. Let me talk about this one. What is the gain over here? The gain over here is 10 lakh rupees. How you got 120 lakhs minus 100 lakhs, 110 lakhs? It is 10 lakhs. Okay. Now what is the consideration? How much you are investing? You are investing 1.2 crore rupees divided by what is the consideration? The consideration over here is 1.2 crore. Okay. Why I am taking 1.2 crore? I said we are investing how much? 2 crore. But we need to segregate that 2 crore into two assets now. So 120 crore, 120 lakhs we are segregating here, and remaining 80 lakhs we are segregating in the second asset. Okay. This is how we are going to proportionally take the exemption. Be very careful. What is the formula? The formula is gain into amount invested divided by net consideration. So in first case, I am taking the full amount, and in the second case, I am taking the balancing amount. I hope it is clear to all of you. Next question is a simple question. It's a theory question. That is, there is a commissioner of income tax who has issued some notice. To the assessing officer, and to the assessee that he wants to revise your order under section 263. Now, after sending the notice, after a few months he is sending another notice, and the content of the first notice is different from the content of the second notice. Okay, so remember, the CIT is sending a notice to you. Obviously in the notice he will send you on what reasons he is sending the notice, why he wants to revise your order, okay, which is prejudicial and erroneous by the assessing officer. So he is sending you a notice. First notice he is sending you, is writing all the details over there. Now after a few months he is sending another notice. The content of the second notice is different from the first notice. He is altogether changing the content. Therefore, is it allowed for him? It is not allowed for him. He cannot change the content like this in between. Okay, this is what this particular question wants to tell us. Now the next question is also a very beautiful question. These are all big questions. You have to be very careful with these questions. All beautiful questions are put in May 2024 RTP. So there is one person, Mr. Naksh, in whose case who is engaged in the export of fabrics. In whose case the CBDT there is a risk management strategy formulated by CBDT like SFT, AIS, etc., where the information is flagged for AY 2021, 21-22, 22-23 and 23-24. Now the AO wants to issue notice in April 2024. Remember, for how many years? In case of Naksh, the AO wants to issue notice in 2024, and also is it necessary to provide him with an opportunity of being heard? All these questions are asked to us. In case of Naksh, now the AO can send notice generally only up to 3 years. Now in this case, 3 years is expired. For 2020-21, 3 years is expired. For 2020-21, 3 years will expire when? It will expire on 31st of March 2024, and the AO wants to issue notice after 31st March 2024. That is in April 2024. So for 2020-21, AO cannot issue the notice. What about AY 21-22? Yes, he can issue. For 22-23, yes, he can issue. For 23-24, yes, he can issue. He has time to send the notice in April 2024, if he wished to send a notice, he can send for 21-22, 22-23 and 23-24. Now, is he supposed to conduct an inquiry? Yes. Some set of procedures have to be followed by the assessing officer. He need to conduct an inquiry under 148A. He need to give an opportunity of being heard to the assessee. Then AO will decide with an approval with higher authority that whether it is a fit case for assessment or not under 147. And then he will send a notice under section 148 for the assessee to file the income tax return. This is the entire procedure that the one has to follow over here. Now his friend is also there. In his friend's case, there is a search which is initiated. Dangerous point. In his friend's case, the AO has initiated some kind of search in April 2024. And AO has found some income pertaining to PY 2017-18 of 28 lakhs and 18-19 of what? Of 21 lakhs. So in case of his friend, can the AO issue notice? The AO cannot issue the notice. Why AO cannot issue the notice? Because 3 years have expired for AY 17-18. That is AY 18-19, for PY 17-18, AY 18-19. The time limit will expire on 31st of March 2022. And for this, the time limit will expire on 31st of March 2023 for previous year 18-19. Assessment year 19-20. The time limit will 3 years will expire on 31st March 2023. AO wishes to send in what? In April 2024. He cannot send that. Because he can send the notice beyond 3 years only if the escaped income is 50 lakh rupees or more. So he cannot send in this case. But the question says that, will your answer change? If that was 30 lakhs instead of 28 lakhs. Yes, if that is 30 lakhs instead of 28 lakhs, then the escaped income will come to how much? 51 lakhs. In that case, the escaped income is greater than 50 lakhs. Then for now, the AO wants to issue the notice. He can issue it. In this case, he can issue the notice. He has the power to issue the notice in such case, obviously beyond 3 years, up to 10 years, as the income escaped is 50 lakh rupees or more. I hope it is clear to all of you. Now the next question is a beautiful question on a very new topic added by Institute in your new course, and that is your black money law. Mr. Rohit is there. He is an Indian citizen. He returned to India in March 2023 to work in an Indian company. Okay. And he served in the Indian company from April 2013 to 31st March 2020. Till that time he was in India. Okay. Prior to 2013, he was in USA, and he again went to USA in 2020. So between 2013 to 2020, he was in India. Okay. And after 2020, he used to come to India only for 1 month every year. Okay. Now, he has acquired some wealth in India in different years. He has purchased some shares of listed company in 2012 and one apartment in London in 2015. One leather business is there from which he is earning some income in 2020. Okay. Apart from that, he is also taking some commission, etc. Now, the AO has issued notice under black money law to Mr. Rohit. Is the notice of the AO tenable for all these things, for this one item, second item, third item, and this commission, fourth item? For all these things, the AO has sent a notice to the assessee, and whether the notice is valid or not, that is what we are trying to say over here. Okay. Now listen carefully. You need to understand the provisions of the black money law. First of all, 30% income tax will be chargeable under the black money law. For 30% tax will be charged for undisclosed foreign income and assets. Okay. And in case of asset, the tax will be chargeable. In case of undisclosed foreign asset, remember, the tax will be chargeable in the year in which the AO notices such asset. Okay. So in whichever year the AO comes to know about that particular asset, in that year the AO will charge 30% tax on that particular asset. Okay. Now we need to understand the definition of assessee over here. The entire question is based on definition of assessee. Who is an assessee? An assessee means who is a resident. Any person who is a resident in the current year is an assessee. Okay. Or any person who is a non-resident in the current year. Listen, remember, if you are resident in 23-24, then you are an assessee. Or if you are a non-resident or not ordinary resident in previous year 23-24, but when you have purchased that property or when you have earned that income, in that year you were what? You were resident. Then also this section is applicable. Okay. This law is applicable. Today you are non-resident. Today you are not ordinary resident. But the year in which you have earned the income or the year in which you have purchased the asset, in that year you were resident. Therefore, we need to find out in the current year what is the status of Mr. Rohit. In the current year 23-24, Mr. Rohit is non-resident because he stays in India only for 1 month. In 2020, he has gone back to USA. Okay, so he is non-resident. Now, we need to understand in the year in which he has purchased the asset, in the years in which he has purchased the asset, what was the status of Mr. Rohit. So, in the year 2012, that is in 2012-13, Mr. Rohit was non-resident. Therefore, this listed company share will not be subject to black money law. In the year 2015, Mr. Rohit was in India from 2013 to 2020. Therefore, this will be subject to black money law because he was resident in 2015. Third one, leather business is in April 2020. Now, he left in India in March 2020. He is left India, and therefore Therefore, because he left India in March 2020, therefore in April 2020, he was not a resident in India. Therefore, he will not be liable to pay tax on this particular income, okay, on this particular asset. As far as the commission is considered, the commission will be subject to tax, but only after previous year 1516 to 1920. Why, sir? Why not before 1516? Because the black money law was not applicable only before 1516. Black money law is applicable to income only if it is earned from 1516 or onwards. Black money law is not applicable to income earned before 1516. But for assets every time applicable. Even if in 1980 if you have purchased an asset, and in that year if you are resident and now you are non-resident, you will be liable for black money law in that particular asset. For asset there is no criteria of when the law was started, but for income there is a criteria of when the law was started. I hope it is clear to all of you. Now let's move on to the next question. It's a beautiful question of DTAA provision. It is not on unilateral relief. It is on bilateral relief, section 90. Okay. Mr. Mahesh is there, aged 50 years. He wants to follow the new regime. By default, everybody will follow new regime. Only 115 BSc is following. He's following the new regime. Accordingly, you need to answer. Okay. Now he's 50 years old. He's a CEO of a particular company, Silver Limited. Salary is 23 lakhs. You will take 50,000 standard deduction. Interest on self-occupied property not allowed in new regime. Be very careful. Not allowed in new regime. And then income from other source, interest from bank deposits, 1,60,000. That will go in IFOS. Now, foreign income, what is earning? Country A is earning some income. He's earning from business in country A $25,000. So you need to convert that into rupees as per rule 115. You need to convert that as per rule 115. And for business income, you have to take TTBR on the last day of the financial year. And the TTBR on the last day of the financial year on 31st March 2025 is whatever it is, 31st March 2024, TTBR is 71 rupees. You have to convert as per that. Now, rent from house property is 4,500. From that, you will take municipal taxes deduction for 450 rupees, and then you will take 30% standard deduction also. In India, everything is allowed. Even if it is written, it is not allowed in country A. In country A, it might not be allowed, but in India, it is allowed. Okay. So you will take 4,500 minus 450 minus 30% standard deduction. Again, for house property, for converting that income into INR, you have to take TTBR on the last day of the financial year. Okay. Then comes the dividend income. For dividend income, whenever it is earned, you have to take TTBR on the last day of the preceding month. So it is earned in March. So now you will take not the last day of the financial year. For dividend, it is last day of the preceding month. Again, you have to see rule 115. Okay. So in March, if it is earned, you will take the last day of the preceding month. That is on 29th of Feb 2024. For short-term capital gains also $5,000. You will again see the last day of the preceding month. It was earned in March. So it will take TTBR on 29th of Feb 2024. After doing all these things, you will compute the total income in India and you will compute tax in India, and then you will take average rate in India. Okay. Average rate in India, and then you will apply that on doubly taxed income. How much is doubly taxed income in India? So you have to take this income, that is the rental income which you have computed as per rupees. Then you have to take dividend income which is as per rupees, and short-term capital gains income as per rupees. As per rupees, you are going to take whatever you have taken in the income statement. You have to take the total of that multiplied by whatever is the average rate. That is the DTAA rate. That is the average rate in India. Now you need to see the average rate in foreign country. The average rate in foreign country is 20%. And what is the income which is taxed in foreign country? The income which is taxed in foreign country is $4,500 directly. Now 450 rupees should not be reduced. Okay. So 4,500 directly, and then $10,000 directly, and then $5,000 directly. Take the total of that, and whatever total, and one more income is there, 25,000 directly. If you take the total of that, you will get 44,500. Now multiply that with what? 20% tax rate, and then you have to convert that issue into rupees. That FTC will be converted into rupees as per rule 128. Remember, to convert your foreign income into Indian income, you have to apply rule 115. But to convert your foreign tax into Indian tax while taking the FTC, you have to apply rule 128. And now for that, you need to see when the tax was paid. The tax was paid in May 2024. So as per rule 28, rule 128, you have to take TTBR as on 30th of April 2024. So be very careful. It's a beautiful question. When you compute the Indian tax, you will take the Indian rupees income. Okay. When you compute the foreign tax, where you will take all the foreign income, and then you will multiply by what? Rule 128. Whatever the rule 128 says, that is the TTBR on the preceding month in which the tax was paid. Tax was paid in May, so you will take the preceding month. Then whichever is lower, that will be allowed as an FTC to you. Okay. And the balance will be paid out of the pocket, or it might be 0 rupees. Okay. Now, one last question over here that will complete all the compilations that we are supposed to do with respect to the revision test papers. Okay. Pay attention, please, all of you. Question number 20, which is again a beautiful question on your advance pricing agreement and rollback provision. The SSE is a company who is situated at Bangalore and exporting some goods and services, some electronic goods to its associate enterprise. Okay. Now, the SSE has made an application on 15th of Feb 2023 for advance pricing agreement, which was signed on 5th of May 2023. And you might be knowing an advance pricing agreement is generally signed for a period of 5 years. So now it will be applicable from previous year 23-24 onwards for 5 years. Okay. So previous year 23-24, 24-25 and 5 years like this. Okay. Now the SSE also wants to apply for the rollback provisions, and which was also signed in Jan 2024. Now the rollback years will be the last 4 years. Okay. Now the question which are asked as follows. We need to answer, discuss the applicability of the rollback agreement for various assessment years. Can you go for rollback for all these years? That is what the question is all about. Now for AY 18-19, you cannot go for rollback because this comes beyond the 4 years period. Because in rollback, you can only roll back for past 4 years. Okay, past consecutive 4 years. So AY 18-19 goes beyond 4 years. So you cannot roll back for that. For AY 19-20, that also goes beyond 4 years. Okay, AY 18-19 is nothing but PY 19-20 is nothing but PY 18-19, and PY 18-19 is beyond 4 years. Again, you cannot go for rollback for this year also. Now, what about AY 21-22? Yes, for this year rollback is possible, but sir, assessment is completed. It doesn't matter. Even if assessment is completed, there is no harm. You can go for rollback and AO will modify your assessment. Okay, AO will change your assessment. What about 21-22, sir? This is a very good point. Pay attention, please. For 21-22, the assessment for 21-22 was completed by the AO by making a reference to the TPO, and TPO has enhanced the income by 500 lakhs. Suppose originally the income was, as per return, as per the assessee's return, the income was 100 lakhs. So the TPO increased the income by 500 lakhs. Therefore, it becomes 600 lakhs. Okay. Now the question is, if I go for arm's length price, if I go for advanced pricing agreement, that is rollback provision, now they are saying that it will come down to 300. So if it comes down to 300, will it be okay? The answer is yes. If it comes down to 300, then the total income will come to 400. The law says that the arm's length price can come down, but it shall not come down below the return income. It shall not come below the return income. So it is not coming below the return income. If it becomes from 500, it becomes 300. Then still it is more than return income only. Therefore, the rollback provision is possible for AY 21-22 also. Okay. So this is what this point wants to tell us. Next one is also a very intelligent point. For AY 22-23, the tribunal has passed an order for a fresh assessment by the assessing officer. See, the tribunal has not completed the assessment. The tribunal has passed the order. The law says what you know. If the order is passed by tribunal and it is concluded by the tribunal itself, tribunal has passed the order at itself and closed the matter, then you cannot go for rollback. Your tribunal has not closed the matter. The tribunal has referred the matter to whom? Or to the assessing officer for fresh assessment. I have told you all these things in the class. You can go and check in the class also. You have done all these things in your class. Okay. So therefore, in this case also, it is possible to go for rollback. In last case, it is impossible because you have filed the return late. One of the conditions to go for rollback is you should have filed the return on time of the rollback years. If the return was not filed for the rollback years on time, it is belated return, then rollback is not possible. Okay. So in this case, rollback is not possible under the income tax law. I hope it is clear to all of you. So this is what the compilation of 8 RTPs from November 2020 to May 2024 is all about. So hello all my dearest students of South India. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we have come up over here for another video, which is going to be a very important video for your examination. That is the compilation of past 7 attempts exam paper in a span of around 1.5 hours to 2 hours. Just a week before, I have put a compilation for you all in full English for the past 8 RTPs, including the May 2024. In the same way, we are going to put a compilation of the past 7 attempt papers for CA Final Direct Tax relevant for May 24 and November 24 exams. Okay. So without wasting any further time, let us start with the first paper, and that is the Jan 2021 paper is going to be the first paper that we are going to discuss over here. And the very first question over here is a PGBP question, total income question. Assessee is a manufacturer and you have to solve this question as per the normal provision. You are not supposed to opt 115 BAA. You are not supposed to follow MAT. Solve as per normal provision, and therefore if you solve as per normal provision, the turnover of last to last year is greater than 400 crore. Therefore the tax rate of the assessee will be 30%. Okay. Now you have to compute the total income as per the normal provision, and then we'll compute the tax also as per the normal provision. Okay. Now very first adjustment over here, the first thing which we have written over there over here is the assessee is a manufacturing assessee. Now the net profit of the assessee is 75 lakhs. And it is after debit and credit of the following items. Now the very first item over here is there is some interest cost till last year what used to happen and what is happening in the current year. Let me give you a brief idea about it. Till last year, interest was taken as a part of stock. Okay. the company was used to take interest as a part of opening stock and closing stock, which is wrong. The accounting standard says that interest cannot be part of opening and closing stock. Even the ICDS says that interest cannot be part of opening and closing stock. So that mistake which the company was doing till the last year, that is 22-23, the company rectified that mistake in the current year. The company has also given the effect of that in the P&L, and because of that, the profit of the company is decreased by 13.5 lakhs. Now the question is, if everything is done correctly by the company in the current year, why the hell I'm going to give any effect? So in adjustment number 1, because everything is done correctly by the company, you are not going to give any effect in adjustment number 1 over here. Okay. Second adjustment is a routine adjustment. There is a provision for payment of gratuity. Now whatever provision is made as per actuary, that is disallowed as per section 47. So you will disallow 5 lakh rupees, and whatever is actually paid is 1,20,000, that will be allowed under the income tax law. Okay. Now the third adjustment is the company has paid some one-time license franchise fee of 20 lakh rupees, and that is debited to the P&L. Now my question to you all is that franchise fee and all is an intangible asset. Why the hell the company is debiting that to P&L? So therefore you have to disallow that 20 lakh rupees, and then you have to claim 25% depreciation on that. Full depreciation will be allowed because it is purchased on 16th of August. Therefore it is put to use for more than or equal to 180 days. Therefore you can claim full depreciation. Okay. Next adjustment is a very simple adjustment. There was some cash which is lost because of the theft of 12 lakh rupees. Now if the cash is lost by theft, that is allowed as a revenue loss. The Supreme Court has held in the case of Badridas Daga versus CIT, that is the trading losses which are incidental to the business of the SSE shall be allowed as deduction. Therefore, this being a trading loss, it will be allowed as a deduction. There is nothing wrong in this. Okay. The next adjustment is a beautiful adjustment. On 1st December 2023, the company has paid a royalty of 3 lakh rupees to Mr. Roser, a non-resident. Okay. Now, the company has done what? The company has deducted the TDS, but unfortunately, the company has not deposited the TDS till the due date of filing of return. The company has deducted the TDS, but the company has not deposited the TDS. So the company has made the default of not paying the TDS on time. Therefore, this 3 lakh rupees will be what? It will be disallowed. And entire 100% will be disallowed because it is paid to a non-resident. And if you pay to non-resident and if you do not deduct the TDS, entire 100% is disallowed under the income tax law. Now, the question over here is, you would say that, sir, if the other person that Mr. Roser has submitted the return, sir, he has also included that income in the 3 lakh rupees in his return of income, sir. So, sir, in that case, it is deemed na, sir, that the person who has paid, he has deducted, he has paid. No, it's not like that. When I can say that I have deducted and I have paid, when 3 conditions are fulfilled by Mr. Roser. First, Mr. Roser has to include that 3 lakh in his income. He has done that. Second, Mr. Roser has to file the return. He has filed that. Third, Mr. Roser has to pay tax on that. Mr. Roser is not paying tax on that. In fact, Mr. Roser is claiming refund of 20,000 rupees by claiming some expenses. He is claiming a refund. Therefore, I cannot claim that what? That Mr. Roser has done the things correctly. Therefore, I can claim the deduction. Even if Mr. Roser would have deducted the tax, even if Mr. Roser would have paid the tax, then also I could not get the deduction in the current year, because in that case, the kharcha, the expenditure is disallowed in the current year and it is only allowed in the next year, because it is deemed that Mr. Roser has paid the tax. Mr. Roser has paid the tax on the date of filing of return. In that case, I will not, even if Mr. Roser would have paid the tax instead of getting the refund, I would have not got the deduction in the current year. I would have got the deduction in the subsequent year also. We have done sufficient adjustments based on this. So this is a beautiful adjustment. Adjustment number 5, mark it down please. Next one is a very routine adjustment. You are selling some plot of land, 100% holding subsidiary are selling some plot of land, then it is exempt. If there is a transfer of capital asset by 100% holding to a subsidiary or 100% subsidiary to a holding, it is exempt. The only condition is the recipient, the transferee should be an Indian company. Here the transferee is an Indian company, therefore it is exempt under section 47. Okay. Next one, the company has obtained a loan of 5 lakh rupees from a textile company, that is a private company, and this company, that is the SSC, holds what? 68% voting rights in that company. Now that company is a closely held company. Manu Textile Private Limited is a closely held company, and if any person holds 10% or more of the voting rights of any closely held company, and if that closely held company gives a loan to the shareholder, then it is deemed dividend. But deemed dividend cannot be more than the accumulated profits. Therefore, this company has given a loan of 5 lakhs, but the accumulated profit is only 2 lakhs. Therefore, 2 lakhs will be deemed dividend under income from other source in the hands of the SSC. Okay. Next one is again a very important adjustment. The company has purchased a motor car on 23rd of August 2019. Do you remember something important about this date? If any person, if any SSC has purchased and put to use a motor vehicle from 23rd of August 2019 to 31st of March 2020, then you will get 15% extra depreciation. Do you remember that or not? So you can claim 15% extra depreciation on that. And why you should claim? Because it is not debited to P&L. This vehicle's depreciation is not debited to P&L, and therefore you will claim 15% extra depreciation on this particular vehicle. Okay. So you can claim 30% depreciation on 12,80,000 in this current year. Okay. Now last adjustment over here is which is on 80 JJAA. The number of employees at the beginning of the year were 480. Then company hired 120 employees, and then the company fired 70 employees, and therefore the overall strength is what? 530. Remember, 80 JJAA is available only if your overall strength is increasing. If your overall strength is not increasing, 80 JJAA will not be available. In this case, the overall strength is increasing, therefore the company will get the deduction. How much deduction the company will get? 120 employees are hired on 1st of July at an emolument of less than 25,000 rupees. So therefore it is less than up to 25,000. Therefore it is eligible. If the emolument is more than 25,000, then the assessee is not eligible. Therefore here how much deduction will be available? 120 employees are newly hired. 9 months they will be working in the company. 15,000 is their emolument, multiplied by 30%. That much will be the deduction that the company will be getting under 80 JJAA. Okay. I hope it is clear to all of you. Then you have to compute your total income, and then you have to compute your tax payable. Okay. Tax payable is 30%, as I have told you at the beginning of the question itself, because the turnover of last to last year is greater than 400 crore. Therefore the tax payable is what? Tax payable will be 30%. I hope it is clear to all of you. Okay. Surcharge is not applicable because the total income is less than 1 crore. Therefore surcharge will not be applicable in this case. Okay. Let's move on to the next question. Question number 2, part number A. What is there in this question? It's a very simple question. There is an LLP who is claiming some deduction under 10AA of SEZ. Okay. Apart from that, the assessee is also claiming some deduction of warehousing of agricultural produce. Therefore, the assessee is also engaged in 35AD business. So the assessee is claiming 10AA. The assessee is also claiming 35AD. For the purpose of 35AD, the assessee has incurred a capital expenditure of 75 lakhs, out of which land is 10 lakh rupees. Okay. Let me read the question first. Now, we need to compute the income tax of the assessee, including the AMT under 115JC. So now, for a partnership firm, you have to compute 2 tax. One as per the normal provision, one as per 115JC, alternate minimum tax. Now let me compute as per normal provision. As per normal provision, what will be the tax calculation? First of all, profit from SEZ, 50 lakhs. Okay. Now whatever is the profit from SEZ, we have to write down that. From that, we will take the deduction of SEZ. How much deduction of SEZ? Export profit into profit from export into export turnover divided by total turnover. How much is the profit from export? Profit from export is 50 lakh rupees. What is the total turnover? The total turnover is 1 crore, 80 plus 20. What is the export turnover? Export turnover is 80 lakhs. So multiply by 80, divide by 100, that will give me the 10AA deduction. Okay. Then what is the deduction for 35AD? The profit from 35AD business is 1 crore 5 lakhs. Out of which you have incurred an expenditure of 75 lakhs, but land is not allowed as a deduction. Therefore 65 lakhs will be allowed as a deduction to you under the income tax law. Okay. So 1 crore 5 lakhs minus 65 lakhs. This will give you your net profit as per 35AD. Then you compute tax as per 30% for the tax rate for the partnership firm is 30% plus surcharge says whatever is there, you apply that. Okay. Now the big question over here is, pay attention please. Now we will come to 115JC. In 115JC, what the assessee has to do? The assessee has to compute the adjusted total income. What is adjusted total income? Whatever is the total income as per the normal provision, add what? Add 2 things. That is, first add 10AA deduction. Whatever deduction you have claimed over here, you have to add back that. Then you have to add the deduction claim under 35AD, add 65 lakhs, and then you have to reduce the depreciation on that 65 lakhs. Suppose this is a building, so you have to reduce 10% depreciation on that. For 35AD, you have to add 35AD deduction, and then you also have to reduce the depreciation on that particular asset. That will give you adjusted total income. Then 18.5% tax. If surcharge is applicable, apply surcharge also. If the income exceeds 1 crore, 12% surcharge and 4% cess. Then compare both the tax, whichever is higher. If AMT is higher, pay AMT, and the difference between the AMT and the normal tax will be considered as what? AMT credit. I hope it is clear to all of you. The next question is again a beautiful question. Question number 2B. Vioni Inc. is a non-resident and a foreign company. So how did you come to know it is a non-resident? First of all, it is incorporated in Japan. Therefore, it is a non-resident. Sir, it can become resident also because of poem also, na? No. Because of poem also, it is not resident. Sir, they are coming to India for some meeting. They are coming to India for meeting, not for the purpose of what? Making any commercial or management decision. They are coming to India for what? For sale of company. And remember, sale of company does not amount to what? Does not amount to commercial management and decision of the business. Therefore, what is poem? Poem means a place where key management and commercial decisions are taken. There is a CBDT circular which says that under the poem guideline, that if the company, if the shareholders are coming, if the company is taking decision to sell one of the parts of the company, that does not mean the company has poem in India. Therefore, this company is a non-resident. So you have to answer the question according to the non-resident status only. The very first question, the very first point over here is, the company has received a dividend declared by Miami Inc. That is a Japanese company which has declared a dividend of 54,000 rupees to the company. Now that Japanese company has 70% assets located in India. Okay. Now this is the classic case of Vodafone case law. CGP has substantial assets located in India. then in that case, if CGP sell the shares, then if you sell the shares of CGP, then capital gains is chargeable in India. But if CGP gives dividend to another company, then that is not taxable in India. Do you remember that or not? That the shares of CGP derive its value substantially from asset located in India. Yes, the shares of Miami derived its value substantially from asset located in India. I agree to that, but that is only applicable for capital gain taxation. That is not applicable for dividend taxation. Therefore, any dividend declared by Miami to Vioni will be exempt under the income tax law. That will not be subject to tax. Okay. Second, some assessee, the non-resident is providing some services to government of India, and government is utilizing that FTS outside India, that is in Nepal. Whether that FTS will be taxable in the hands of non-resident or not. Vioni is providing services to government, and Vioni is paying what? And government is paying what? Government is paying the FTS, but those services are utilized outside India, and the answer is yes. As per 917, it is deemed to accrue or rise in India. But you will make an argument, sir, but the services are not utilized in India. Array services should be utilized in India. That condition is applicable for residents. That condition is not applicable to government. If a government is taking any services and paying royalty, FTS or interest, then it is always deemed to accrue or rise in India, irrespective of where it is utilized. If it is utilized in India, or even if it is utilized outside India, it doesn't matter. In case of government, it is always deemed to accrue or rise in India. Okay. The third one. Vioni is giving some loan to a unit of an IFSC located in India. So Vioni is giving loan to IFSC unit, and IFSC unit is making some payment of interest. Then it is exempt under section 1015 if the loan is given on or after 1st September 2019. If a loan is given on or after 1st September 2019, then it is exempt under income tax law. And the fourth point is a very simple point, which is a grandfathering clause. I hope we have done sufficient examples on grandfathering. You can see that here. Whenever the market value of the shares on 31st Jan 2018 will be given, you have to apply grandfathering clause. And for that, how will you determine the cost? The cost will be the actual cost compared with lower of FMV on 31st Jan or sale price, and then whatever is higher, that will become your cost of acquisition. Okay. So I'm not wasting much time on this particular question. Okay. Now coming to the next question. The next question is a charitable trust question. So GNK charitable trust, which is following accrual system of accounting. I have no harm if they follow accrual system of accounting. They can follow accrual system of accounting. But last year Finance Act 2022 has made an amendment that if you want a deduction of your application, then the application must be paid. It will not be allowed. The deductions will not be allowed on accrual basis. The deductions will be allowed only on what basis? Payment basis. So accordingly, you have to answer this particular question. Okay. Now let us compute the total income and the tax payable of this particular tax liability of this particular trust. Okay. Now the very first thing is they are receiving some gross receipt of 24,41,000. Let's write down that first. Then they are receiving some voluntary donation. In that voluntary donation, there is an anonymous donation of 1,85,000. Therefore, how much is normal donation? Normal donation is 3,35,000. Let us write down that first. Okay. Now, what is the treatment of anonymous donation? Listen, anonymous donation is exempt subject to what? 1 lakh or 5% of total donation, whichever is higher. Therefore, 1 lakh or 5% of donation, whichever is higher, that will be exempt, and the balance will be taxable at how much? 30%. Be very careful. Okay. So out of 1,85,000, 1 lakh or 5% of total donation, whichever is higher, will be exempt, and balance will be taxable at what? Balance will be taxable at what? 30%. Now this 1 lakh also should be added to this which is getting exempt under 115 BBC. The anonymous donation which is getting exempt under 115 BBC should be added to the normal income statement, and this will be taxable at what? This will be taxable at this. You have to add to the normal income statement, and then you take 15%. You can apply that money, and then that will be taxable at slab rates. Okay. So you have to be very careful with this. Then dividend from Indian company, you have to add to the income statement. Income from mutual fund, you have to add to the income statement. Agriculture income is exempt even for the trust. For trust also, agriculture income is exempt. Then you take 15% exemption, that is section 11(1) exemption, and then you see what all application you have made. First, you are setting aside some amount for the next 4 years. Yes, you can claim an exemption under section 11 subsection 2. You can accumulate for 5 years, and you can take the deduction today itself. Second, you are making some payment to one of the trustee of 1,47,000. The market value is 2,50,000. So there is no harm. You are paying less only. You are not paying more. You are paying less. So it's okay. You can make the payment to trustee for the rent. You have taken something on rent, and you are paying on rent. You are paying the rent, and the rent is less than the market value. You are not paying excess rent. So that is allowed. Okay. You are making some payment to foreign teachers. Okay, it is allowed. 1,96,000, that will be allowed. That is again for the objects of the trust. And you are making some expenses for objects of the trust. Again, that is allowed. But assuming that all of them are paid, unless it is paid, it will not be allowed as a deduction. Okay. Now after doing all these things, you have to add this 85,000 at the end. At the end, you have to add this 85,000 rupees. Okay. This will be taxable at 30%, and the balance income will be taxable at slab rates. Okay. Slab rates, you can follow the old regime also. You can follow the new regime also. In this question, we are following the old regime. So according to old regime, we are solving this question. Okay. Now next question is a very simple DTAA question. I'm not going to waste much time on this particular question. The SSC, I'll tell you the important points of this question. The The assessee is a 65 years old person and he's a resident person. Therefore, you need to be careful with few things. Because he is a 65-year person, senior citizen and resident, he will be getting 80 TTB deduction of 50,000 rupees. You have to be very careful with this. And he will also be getting obviously 1,50,000 in PPF. And that is the only thing. Apart from this is a very routine and simple question, nothing great as such. So I'm not wasting much time on this. TTAA question, if something new comes, I will be definitely discussing with you all. Okay. Now, question number 4, which is on TDS. Okay. The assessee has made some bank guarantee commission to the bank. So assessee is making some payment of bank guarantee commission to the bank. So whether that will be subject to TDS, and the answer is no. If you make any payment to bank, then that is not subject to TDS. There is a CBDT notification also on the same. We have also done this discussion in the class. If you make any payment, we are no one to deduct the tax of the banking industry. Please, bank is a very organized sector. We cannot deduct tax of bank. Therefore, no TDS if you make the payment to bank. Okay. So in this case, there is no need to deduct any TDS. Next question, study card. Study card, an online education provider. Okay. It's an Indian entity. It's a trust in India. Now, Mr. Monty, a non-resident, has provided some web-based lecture. So Mr. Monty, who is a non-resident, it is providing some web-based lectures to whom? To study card. Whether that will be taxable in India. If it is taxable, we need to deduct TDS. If it is not taxable, we will not deduct the TDS. So there are two views which are taken by institute. Assuming that non-resident Monty, if it's providing the services, if it is a normal business, then it is not taxable. Why? Because for normal business, there has to be a permanent establishment in India. And Mr. Monty does not have a permanent establishment in India. Therefore, it is not taxable. And because it is not taxable, TDS is not applicable. But if it is not a normal business, the services which are provided by Mr. Monty comes under the definition of FTS, fees for technical service, then there is no need for any PE. Only you have to check the services are utilized in India. So if Monty, whatever Monty web-based lecture is providing, if it comes in the definition of FTS, then in that case, there is no need to have any permanent establishment. Only the services have to be utilized in India. And in that case, TDS has to be deducted under section 195 because in that case, FTS is deemed to accrue or arise in India. I hope it is clear to all of you. Now the third question, very simple question. Mr. Nitin's last year turnover is less than 1 crore rupees. Now if Mr. Nitin's last year turnover is less than 1 crore rupees, therefore 194C is not applicable to individual HUF. Individual HUF is liable for 194C only if the last year business turnover is greater than 1 crore or professional turnover is greater than 50 lakhs. Therefore Mr. Nitin is not liable for 194C. But Mr. Nitin is making a contract payment of 65 lakh rupees for repair of his office building. Whether 194M will be applicable? The answer is yes. Where 194C is not applicable, 194M is applicable for individual HUF. If the aggregate payment in the entire year exceeds 50 lakh rupees, here it is 65 lakhs, therefore 5% TDS has to be deducted. Okay. Next one is a very simple question. Again and again, 100 times we have seen. The airline company has paid 10 lakh rupees to Airport Authority of India for landing and parking charge. The TDS will be deducted under 194C at the rate of 2% because the Airport Authority of India is a company and TDS will not be deducted under 194I. It is not a rent, it is a service. Therefore, TDS will be deducted under 194C. I hope it is clear to all of you. Next question is a beautiful question on transfer pricing. There is a company, Vihan Limited, which is an Indian company, which has given a loan of 6 crore rupees to another company, which is a resident of Singapore. So one is resident, one is non-resident. Vihan is resident and Yuan is what? Yuan is non-resident. Now, one company has given a loan to another company to the extent of 150% of the book value of the asset. How much loan is given? 6 crore. What is the book value of the asset? 4 crore. Therefore, the loan is given to the extent of how much? 150% of the book value of the assets. Therefore, is Yuhan and Vihan deemed to be a source enterprise? Yes, they are deemed to be a source enterprise. Is transfer pricing applicable between both of them? Yes, if transfer pricing is applicable between both of them. Because the law says that if one entity provides 51% of the financing of the book value of the assets of the another entity, then both of them are deemed to be a source enterprise. Sir, but it is written that later on the assets have revalued and it is increased by 2. It doesn't matter. It doesn't matter at what value it is revalued. What is relevant is only book value. You have to check the book value with the loan amount. The book value of the asset is this much. The loan amount is this much. Compare that. It has to be at least 51%. If it is 51%, both of them are deemed to be a source enterprise. Okay. I hope it is clear to all of you. So the first question, would Vihan and Yuhan be treated as a source enterprise? Yes, because the one entity has given a finance of 51% of the book value of another asset, another entity, therefore both of them are deemed to be a source enterprise. Yes, they are a source enterprise. Second, calculate the arm's length price of Vihan, which sells the same equipment at 9,000 per unit to Y and 9,500 per unit to X. Now listen carefully, please. Very important point. Now, Vihan has also entered into an agreement with Yuhan to sell some equipment at 7,400 per unit. So I am selling equipment to my associate enterprise. 20,000 medical equipment I am selling at 7,400 per unit. Therefore, is the transfer pricing applicable? Yes, applicable. So I went to the market. I got two arm's length price. One I am selling at what? I am selling at 9,000. Another I am selling at 9,500. Now range concept is not applicable. Range concept is applicable. There has to be at least 6 items. I have only 2 items. So I have to take what if range concept is not applicable? If there are less than 6 items, what am I supposed to do? I have to take an arithmetic mean of those 2 prices. So the arithmetic mean of 9,000 and 9,500 will come to how much? It will come to 9250 rupees.
Now I have to check the difference between this price and this actual price. It has to be at least 3%. Remember, it has to be at least 3% for arm's length price to a price. Is the difference between 9250 and 7400 greater than 3%? Yes, it is actually 25%. Therefore, my arm's length price will be how much? It will be 9250, and I have to pay tax as per 9250. 9250 into 20,000 equipment, that will be my arm's length price. Okay. Now, what are the options available to Mr. Yuan? And if the transfer pricing, if in respect of such increase in transfer price, if Vihan accepts such transfer price, see, whatever additions are made will be called as primary adjustment. Now, first option which Vihan has, he has to bring back the money to India. He has to bring back the money to India within 90 days from the due date of filing of return. This is the first option. If it doesn't bring back, then it will be deemed loan and secondary adjustment will be applicable. The second option which is available, Mr. Yuhan, is he can pay one-time additional tax. 18% tax, 12% surcharge, 4% cess, and one-time additional tax, and he will be relieved from what? He will be relieved from the taxation. So this is what this question is all about. Next question is a very simple question, some practical questions based on what some case laws. The very first question over here is, can High Court recall its own order? High Court has passed an order. Now High Court feels that I have made some mistake. So can High Court recall the order and rectify the mistake? Rectify the apparent mistake, or can High Court recall the order and rectify the apparent mistake, or High Court recall the order and change its original decision? The Supreme Court of India has held that High Court can recall its own order or rectify what? An apparent mistake, and it can also review its own mistake. Okay, it can review the mistake and change the order. This power is there with the High Court. The High Court has been given this power. Okay, the next question is a case law which we have done a lot of time in the class of Ace Builders Limited. Now what has happened in this case? Listen carefully, please. This is also a case law of Dempo Limited, which is on 54EC for block of assets. Remember. If I am selling a long-term block of building, so there is a block of asset building in the business, which is long-term, which is 10 years old, whether I will get the capital gains exemption under 54EC. The law says that there has to be a transfer of long-term capital asset. The argument which was made by the assessing officer was the gain is short-term capital gains. But the assessee made an argument. The gain is short-term, but the asset is long-term. The asset which is there in the block is not short-term. It may be short-term, it may be long-term. If a building is 10 years old, then that building is obviously long-term. And 54EC does not comment on the nature of gain. 54EC comment on the nature of what? Asset. 54EC says that if any capital gains arising from transfer of long-term capital asset, so even in the block of asset, the asset is a long-term capital asset if it is held for more than 24 months. Therefore, 54EC exemption will be available even to block of assets if the assets are held for more than what? 24 months. If the building is held for more than 24 months, you will be eligible for 54EC exemption. I hope it is clear to all of you. Next question is a question on cooperative society. A very simple question. A cooperative society is engaged in providing credit facility to members. Therefore, it is eligible for deduction under ATP. ATP is available to the assessee. Now, the very first point over here is the assessee has received from interest from other cooperative society. Whether this is eligible for ATP? Yes, it is eligible for ATP. See, because if a cooperative society gives loan to another cooperative society, earns interest from there, then it is eligible for deduction under ATP. Okay. Then it received interest from members. Yes, if the cooperative society gives loan to members on interest from there, then that is also eligible for ATP. It doesn't matter whether it is for personal purpose of the member or for some other purpose of the member. It doesn't matter. Then the cooperative society has earned some rental income. That rental income will be subject to tax. Okay, that is not subject to what? Deduction under ATP. That is subject to tax. But from that rental income, you can take 30% standard deduction. There is no harm in that. Then the cooperative society is engaged in some agency business. That agency business will also be subject to tax. You have incurred some expenses also on agency business. You can claim that expense also against your income. There is no harm in that. Then the cooperative society has earned some interest from the idle funds from the members. Again, if you are earning anything from member, then that is also exempt over here. ATP, you will get the deduction of this 2,04,000. Then at the end, you have some losses. You can take the set off of that loss. And last but not least, you have to compute the total income and tax payable of the cooperative society. But before computing the total income, one last thing that you have to take, because this is not a consumer cooperative society, it's a normal cooperative society. Therefore, you will get a general deduction of how much? 50,000 rupees over here. Because it is a normal cooperative society, you will get what? A general deduction of 50,000 rupees over here. And so you claim 50,000 rupees general deduction. I hope it is clear to all of you. Last but not least, you have to compute the tax over here. What is the tax rate for cooperative society? Up to 10,000, no tax. Above 10,000, sorry, up to 10,000, 10%. Above 10,000, up to 20,000, 20%, and above 20,000, it is 30%. Now, for cooperative society also, there are new regimes, 115 BAD and 115 BAE, but Institute has not considered this over here because this is an old paper, and at that time, the cooperative society's alternative tax regimes were not introduced. So, therefore, we are not considering that over here, but you can also follow 115 BAD and BAE over here, okay, if you are a resident cooperative society. Now, one last question over here in this particular question, in this particular paper, that is question number 6, part A. There is an assessee, Mr. Mahesh. He received the draft order as per 115, as per 144C. Now, who receives a draft order as per 144C? If you are non-resident, if you are a foreign company, or if you are
if there is a TPO who has passed an order which is prejudicial to you and you have got the order which is against you, you can go for what? Dispute resolution panel. You have an option to go for dispute resolution panel. But is it mandatory that I have to go for dispute resolution panel? I did not go for the dispute resolution panel. I want to go for the CIT appeal later on. Can I do so? And the answer is yes. Assessee preferred to file an appeal to CIT appeal instead of going to dispute resolution panel. Therefore, the assessee can do so. The question over here is, can Mr. Mahesh do so? Is the contentions of Mr. Mahesh tenable? Yes, the contentions of Mr. Mahesh are very much tenable. Mr. Mahesh can directly go for what? Mr. Mahesh can directly go for what? CIT appeal instead of routing through what? Dispute resolution panel. Let the assessing officer pass the order, and after that I will go for what? After that I will go for directly to the CIT appeal. And one last question over here. The AO has initiated a penalty proceeding under 270A for and also initiated what? Prosecution under 276C. Now, I am filing an application for immunity from penalty and prosecution. Is the application filed? Is he entitled to file an application? See, if the AO is imposing penalty under 270A and if the AO is imposing prosecution under 276C, you have only one option, that is 270AA. You can go for 270AA. First of all, you have to file an application within 30 days from the date of receipt of what? From the date of you have to file an application within 1 month. Then you have to pay the tax. You have to pay the interest. You cannot file an appeal against the assessment order. And then AO will pass the final order. And then there is one very important thing, that the AO will only waive your penalty, which is 50% penalty. He will not waive your 200% penalty. In this case, only 50% penalty is waived. 200% penalty is not waived. I hope it is clear to all of you. This is what this first paper is all about. So let's move on to the next paper, that is July 2021. The very first question over here is on total income of a company. Let's see the last line, what exactly they are asking. They have asked total income, and we are not supposed to follow MAT. We are not supposed to follow 115BAA also. We are just supposed to compute the total income. We are not supposed to compute even tax in this question. Just compute total income as per the normal provision. Okay. So now the very first thing over here, the assessee is engaged in manufacturing business. Therefore, you need to be very careful whenever the word manufacturing comes in the exam. Okay. So the profit of the assessee is 1000 lakhs. The very first adjustment is depreciation as per the books of account. Therefore, you have to add back that depreciation. The second adjustment is the assessee has paid 50 lakh rupees for a scientific research. It is a donation for scientific research institution. So the assessee will get deduction under section 35 subsection 1 clause 2. Now when one very important line which is given in the last line in point number F, that after the assessee has given the donation, subsequently the approval is withdrawn by the central government. So will that affect my deduction? The answer is no. There is a specific provision in the law which says that when you make the payment of donation, at that time the approval is there, and if subsequently the approval is withdrawn by the central government, your deduction will not be denied. It will be allowed to you. Don't worry about it. Okay. So there will be no effect on your deduction. Okay. Now the next one is you have taken a loan of 350 lakhs. This similar adjustment we have already done under RTP also. But again, I will say you have taken a loan of 350 lakhs on 1st of May 2023 for purchase of machinery. So if you have taken the loan on 1st of May 2023 for machinery, it means you have taken a loan for, you have paid interest for 11 months. Okay. So if I take the interest of 11 months, it comes to 350 lakhs into 8% into 11 by 12. It will come to 25.67 lakhs. Okay. This is the total interest that the assessee has to pay in the current year. This is the total accrued interest. But has the assessee paid? The assessee has paid the interest on 1st of November 2024. That is after the due date of filing of return. Now we need to identify where the company has used this particular loan. This company has used to purchase a machinery. Out of that, how much is used to purchase a machinery? Pay attention over here, please. The machinery is purchase of 500 lakhs and it is put to use on 1st of Feb 2024. So from 1st of May till 31st of Jan, you can say that much interest will be capitalized to the cost of asset, right? So how many months interest will be capitalized to the cost of asset? Because till the time the asset is not put to use, you have to capitalize the interest to the cost of asset. So 9 months interest. So out of this 25.67 lakhs, this is 11th month interest. So 9-month interest will be added to the cost of asset, and 2-month interest should be allowed as a revenue expense. So I am telling you the ultimate treatment. What is the ultimate treatment? This 9-month interest, first of all, will be added to PGBP. It is not allowed as a reduction, and you have to add that to the cost of asset and claim normal and additional depreciation. What about the 2-month interest? 2-month interest also you have to add back to PGBP, and you cannot get the revenue expense deduction over here as per 43B because you are making the payment after the due date of filing of return. You cannot claim this deduction also under the income tax law. Okay. Sir, for this also, sir, capitalization is allowed if it is not paid. Yes, I have told you earlier also, for capitalization, there is no need to make the payment on time. For only taking that as a revenue expense, you need to make the payment on time. Okay. So for capitalization, there is no need to take no need to make the payment before the due date of filing of return. You can capitalize even without that. Next one, you have paid some salary of 100 lakh rupees to foreign technician for installation of machinery without deduction of TDS. No harm. Add that to net profit. You have to add that to PGBP and add to the machinery and claim depreciation. For claiming depreciation, there is no need to deduct TDS. If you want to claim that as a revenue expense, then there is a need to deduct TDS and pay TDS. Okay, you need to be very careful about it. Now, so this 100 lakhs will also be added to the cost of machinery. Now, then you have paid some 35 lakhs rupees as a general expense towards bringing some water to the factory. So that is a very normal thing. Without bringing the water to the factory, how can you run the factory? Therefore, it will be allowed as a revenue expense under section 37(1). There is no harm in that. Okay. Next, you are giving some donation to a political party. It will be disallowed under PGBP, and under 80 GGB chapter 6A, you can claim that as a reduction. You have to write a note that we are assuming that it is other than cash, because if it is in cash, then it is not allowed as a deduction. I hope it is clear. Next one, the SSC has incurred some expenditure of 25 lakhs towards purchase of coal, but unfortunately, the SSC does not have a direct evidence of invoice available against that purchase. But the SSC has indirect evidences like GIR is there, goods inward report. The SSC has payment details. The SSC has other details. Auditors have also made a remark that in this particular case, whether this expenditure will be allowed or not. Now, it depends upon the views of the assessing officer. ICI has taken both the views. If the assessing officer is satisfied with you, he will allow you. If the assessing officer is not satisfied with your evidences, he will disallow the expense. ICI has taken both the views in this particular question, so be very careful about it. Next adjustment, also similar adjustment we have done earlier in RTP also. Let me tell you what is happening. First of all, you are making a sale of 20 lakh rupees to a person, and then 10 lakhs rupees you are writing it off. So you are making a sale of 20 lakhs, I am crediting to the PNL, and then 10 lakhs you are writing it off, I am debiting to the PNL. Okay. Now, the debtor is now dead. He has demised. He has expired. So you are able to collect only 7 lakh rupees now. Now, after you collected the 7 lakh, you have what? Credited that 7 lakh to the PNL. First of all, why the hell you have credited that 7 lakh to the PNL? You have already credited 20 lakh to the PNL earlier. You are getting 7 lakh out of that only now. So you have to reduce that 7 lakh first of all. It's very clear. See, it's very common sense. You have credited 20 lakh rupees sales earlier. 10 lakh is not receivable. So you have written it off. Now 10 lakh, remaining 10 lakh is receivable. Now the person is dead. You received only 7 lakh. So why will you again credit that to PNL? That 10 lakh is, that 7 lakh is also credited in the PNL in the form of 20 lakh. So reduce that 7 lakh first of all. Then reduce further 3 lakhs, because 3 lakhs has become your actual bad debts out of the balance 10 lakhs. 10 lakh is receivable. Okay. Out of that 3 lakh, you have received only 7 lakh. So 3 lakh has become actually bad. So that much also you should be reducing from the PNL account. Okay. Next, some written down value of the assets are given at the beginning of the year. For building, you will take 10% depreciation. For computer, you will take 40%. For office appliance, you will take 15%. For tractors, see very carefully, it's an important point. Tractors which are used within the factory. These tractors are used within the factory. There is some importance in this in the subsequent line. You will take 15% as it is a plant and machinery. Plant and machinery, you will take 15% depreciation. Okay. Now, you have made some additions during the year. So, accordingly, you see when you have made the addition, are you using for more than 180 days or less than 180 days? Factory building, you are putting to use on 1st November, therefore only 5% less than 180 days. Computer, 1st May, full depreciation. 40% depreciation you can claim. Now, tractor, 15 lakh tractor you have purchased on 1st of August. What kind of tractor it is? It is used inside the factory. So if a tractor is used inside the factory, it is not used on the road. It is not used on commercial road. It is used inside the factory. So it is like a forklift trucks. And remember, in this case, you will get normal depreciation also and additional depreciation also. Do you remember that? A forklift trucks is a specially designed vehicle which runs inside the factory, that is eligible for what? Additional depreciation. Therefore, this tractor is also eligible for what? This tractor is also eligible for additional depreciation under the income tax law. So 15% normal depreciation, 20% additional depreciation you are going to claim. Another tractor you have purchased on 1st of Feb 2024. So if you have purchased for less than 180 days, put to use for less than 180 days. On this case, you will get 7.5% normal depreciation and 10% additional depreciation. Okay. Then machinery, 500 lakh is the cost. Then apart from that, 100 lakhs foreign technician salary you have to add back, and 21 lakh you have to add the interest. And on that machinery, you are going to claim what? 50% depreciation, that is 7.5%, because it is put to use again in Feb 2024. So 7.5% depreciation and 10% additional depreciation also you are going to claim on that particular machinery. Okay. Last but not least, expenditure is incurred on ISO 9000 certificate rupees 10 lakhs. So the CBDT has said that it is not treated as an intangible asset. Treat it as what? Treat it as a revenue expense. Remember, whatever is the additional information now, that is not debited or credited to PNL. Only these items are debited and credited to PNL. So accordingly, you have to give the effect in the examination. You have to be very careful with that. Okay. Now let's move on to the next question. Question number 2. In question number 2, there are multiple parts. The first part has become redundant. That's the reason. Just strike it off. It is not relevant in today's time, because this is based on some section which has now become outdated. It is based on section 170, old section. Now a new section 170 has come. You can go and check the chapter of miscellaneous amendments in our color book number 2. Last chapters are there. You will see over there a new 270A, absolutely in green color, made by Finance Act 2023. Therefore, this question will become redundant now. So don't focus on this question. Now, the second question is a very good question. There are 3 views taken over here in this question. What is the first view? There is an assessee who has filed the return, and after the return was filed, his case was selected for scrutiny by the assessing officer. and the assessing officer is saying three things. First, the assessing officer is disallowing 50 lakh rupees and saying that you cannot prove the bad debts, therefore I am disallowing the bad debts. Now the question is the assessing officer correct? Am I supposed to prove to the assessing officer that my debt has become bad? And the answer is no. It is not necessary to prove that the debt has become bad. I used to say in the class also, there is a provision in the law which says that it is not necessary to establish that the debt has become bad. You need to just write it off in the books of accounts and that's it. You can claim the deduction. Therefore, the assessing officer is wrong in this case. You don't have to prove that the debt has become bad. Okay? You have to just write it off in the books of account. The second thing which the assessing officer has done, he has disallowed some repairs and maintenance on the ground that I have booked the repairs and maintenance on an estimated basis. Okay. So why is he disallowing? He is disallowing because he is saying that I have claimed the repairs and maintenance on the basis of what estimation. So can the AO disallow the repairs and maintenance on the basis of estimation? Again, it depends upon AO's view. If it is a current repair, you have to prove it to the assessing officer that this expenditure of repair and maintenance is a current repair, it's a current year repair, it's a revenue repair, it's a current year repair. Therefore, you have to prove it to the assessing officer it is a current repair, he will allow you. But if you are not able to prove to the assessing officer that it is a current repair, that he will not allow you the deduction of that particular repair and maintenance under the income tax law. Okay. So it depends upon whether you are able to prove it or not. Okay. And the third one and the last one, this partnership firm A and company, in this there is another partnership firm who is becoming a partner in this partnership firm. So a partnership firm has one of the partner as a partner in the partnership firm. So therefore the AO said that it is not a legal entity. Therefore the AO changed the status of the partnership firm to AOPBY. I am a partnership firm and another partnership firm is a partner in my firm. So the AO said that this is not possible. Therefore I am changing the status of the firm as what? AOPBY. Is the contention of the assessing officer correct? And the answer is yes. The court has said that yes. Why, sir? Why? A partnership firm cannot become a partner in a firm. No, a partnership firm cannot become a partner in a firm. Sir, why? Who can become a partner in a firm? Only a person who is a legal person can become a partner in a firm. Individual is a legal person. Company is a legal person. These are legal persons as per the law. Therefore, these people can become partner in a partnership firm. As per Indian law and even as per the global laws, many countries' law, partnership firm is not considered to be a legal person. Therefore, if you are not a legal person only, how can you become a partner in a partnership firm? Moral of the story is very simple, that a partnership firm cannot become a partner in a partnership firm. If it becomes a partner in a partnership firm, then that partnership firm will be treated as a association of person by the assessing officer, and the assessing officer is correct in this particular case. Okay. Now, let's move on to the next question. This is a beautiful question on DTAA, and out of the world question on DTAA. Altogether a different type of question. When it came for the very first time, the students were not able to understand what exactly the ICI wants to ask over here. Now, let me brief it up exactly what is happening over here. There is one person, Mr. Ram, a citizen of USA. He used to stay in San Jose in USA since 2007 and is a non-resident since 2007-8. Now, he works for a foreign company, XINC, a US-based company. Now, he came to India on 10th of Jan 2023 to visit his aged parents. Okay. Now, he could return back from India only on 31st of Jan 2024. So, he came on 10 Jan 2023 and he returned back on 31st of Jan 2024 from India. Okay. Now, he was permitted to work from home in India. So, when he came to India, he was working in India on behalf of his employer. Okay. So, this is a very important detail which is there in front of us. Now, then you have the monthly salary which is there in front of us. Then he has earned some fixed deposit in USA, etc. Blah, 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 blah. We are supposed to follow 115 BSE subsection 1A. That is the new regime. And we are also supposed to find out the foreign tax credit. Now, we need to go very slowly in this particular question. We need to go step by step. The very first thing that I would like to find out is the residential status of Mr. Ram. Mr. Ram is staying in India for how many days? Now, he came to India on 10th Jan 2023 and he returned back on 31st of Jan. So, if I count his number of days in the current year 23-24, from 1st April to 31st Jan 2024, he was in India. So, from 1st April to 31st Jan, if I count, it comes to 306 days. So, therefore, he is definitely a resident. He is a resident. But is he an ordinary resident? The answer is no. Why is not an ordinary resident? Because his stay in India for the last 7 years is not 730 days. It is less than 730 days and he is not resident in last 2 years out of the last 10 years. He is not fulfilling the additional condition. Therefore, he is not ordinary resident. Now, which incomes of a not ordinary residents are taxable in India? If you are a resident but not ordinary resident, which incomes are taxable? Income has to be either accrued in India or deemed to accrue in India or receive in India or deemed to receive in India. Only these incomes are taxable. And if there is a PGBP outside India and if it is controlled from India or if there is a profession outside India but it is set up in India, only these incomes are taxable. Otherwise, if an income is accrued outside India and received outside India, that income is not taxable in the hands of not ordinary resident. Now, he is earning some salary. He is earning some salary. He is in India and he is working from home in India. Is that salary income accrued in India? The answer is yes. Because he is working in India, because he is providing, he is rendering services in India, therefore the salary is deemed to accrue or rise in India, therefore it is taxable. So from which month to which month you will take? You will take from April to Jan month, salary will be taxable in India. Now the salary fortunately is same in every month, $6250. Now you need to convert that into INR. How will you convert that into INR? You have to convert that into INR as per Rule 115. You have to apply Rule 115 to convert that into INR. What does Rule 115 says to convert salary? You have to take TTBR of the last day of the preceding month. So for April, you will take TTBR of March. For May, you will take TTBR of April. For June, you will take TTBR of May. But fortunately, what is happening over here? The salary of all the month is same and the TTBR also of all the month is same. So I can directly do one thing, that is 6,250 into 10 months from April to Jan. It is how many months? It is 10 months into 72. If I directly do this, I will get the salary of this particular person. Okay, so that is the salary of this person is 6250 into 72 into 10 months. That comes to 45 lakhs in rupees. Okay, now will I get standard deduction? Yes, even in 115 BSc from Finance Act 2023, you get standard deduction. Therefore, my salary will be 44,50,000 rupees. I hope it is clear to all of you. Now, apart from that, is he earning any other income? Yes, he is earning some fixed deposit in USA. Will that be accrued in India? The answer is no, because it is accrued outside India. It is received outside India and the assessee is not ordinary resident. Therefore, for him, this income will not be taxable. Okay. Now, after that, I am going to apply what? The slab rates as per the new regime. So, this interest will not be taxable. Then I will apply the new regime and I will compute the tax, and the tax is coming to 10,76,400 rupees. Okay. Now, be very careful. Now, the real game starts. Now, he is paying some taxes outside India also. As per Article 2 of DTAA, the taxes covered for credit are federal income tax imposed by the Internal Revenue Code. What is Internal Revenue Code? That is the taxation law of United States, but excluding Social Security tax. So he will get the FTC. He will get the foreign tax credit of what? Foreign tax credit of federal tax, but he will not get the foreign tax credit of Social Security tax. Okay, so he will get the credit of this. He will not get the credit of this amount. Now there are two assumptions which are made by the institute. ICI has made two assumptions. Assumption number one is this include this tax. If this include this tax also, you have to reduce this from this particular column. Okay. And second assumption which ICI has made, this federal tax does not include Social Security tax. If it does not include Social Security tax, then 1600 is the amount of which you are going to get the credit. Okay. But if this includes Social Security tax also, then you have to reduce this 420 rupees every month from your total tax. Okay. Because the law is only, Article 2 is only giving you the credit of for federal tax excluding Social Security tax. Okay. Now, how much credit is available? Whatever is the tax in India and whatever is the foreign tax, whichever is lower, that much credit is available as per Rule 128, as per the income tax law. Now listen carefully. Let's make first assumption. Assuming that, let's make the first assumption that Social Security tax is not included in the federal tax. If it is not included in the federal tax, then it will come to 1600. The entire federal tax will be federal tax only. There is no Social Security tax into 10 months into 72. That will come to 1152. Okay. And how much tax he has paid in India? He has paid tax of 10,76,400. Therefore, whichever is lower, how much FTC will be available? He will be available with 10,76,400 FTC. In second case, it is 1600 minus what? Minus 420. Minus 420. Why? Because here we are making assumption that SST, Social Security tax, is included in the federal tax. So that much we have to reduce it. Okay. So that much we are reducing. So 1600 minus 420, 1180 into 10 months into 72. How you are taking 72, sir? That is as per Rule 128. If I want to convert my foreign tax into Indian tax, then I have to take TTBR of the last day of the preceding month. That's what I am doing. Fortunately, here every month's TTBR is same only. So there is no problem over here. If the TTBR would have been changed in every month, then I would have to take different TTBR for different months. Okay. So accordingly, here my FTC comes to 849. Therefore, if my FTC is 849, my total tax is 1076. I have to pay some amount, that is 2,26,800 from my pocket. In first case, there is no tax payable because my FTC is more than my tax. Okay. Therefore, there is no tax payable. Therefore, in the first case, even if I file the late return, no interest will be payable under 234A. But in the second case, if I am filing a late return, there is a tax payable of 226,800. Therefore, I am supposed to pay interest at the rate of 1%. If I am filing the return in August, I am supposed to file in July. I am filing in August. I have to pay interest at the rate of 1% for 1 month. Okay. So this is what this dangerous question is all about. One last thing over here is, we need to also say some procedure that you need to fill one form 67, and you need to just change it. There is a due date of this is changed. Earlier it was by the due date of filing of return. Now it is before the end of the relevant day in which the income is offered. So you can file this till 31st of May, 31st of March 2025. You need to file a statement in form 67 if you want to take the FTC. Without filing the statement, you are not going to get the deduction of FTC. Okay, so just change this date. This is not changed. This is the old date. There is an amendment made by last Finance Act. We need to change this in our book. Okay, so just change that. Now let's move on to question number 3. Now there is an investment fund, and it has 20 resident unit holders. How many resident unit holders? 20. All of them are holding 5 units each. So therefore total 100 units are there, out of which 16 unit holders are holding for more than 12 months. So out of 20, if 16 unit holders are holding for more than 12 months, it means 80% unit holders are holding for more than 12 months and 20% unit holders are holding for less than 12 months. What is the importance of this? You will come to know in a while. Okay. Now the very first thing we need to identify what income is taxable in whose hands. How much income is taxable in the hands of fund and how much income is taxable in the hands of the unit holder. We need to answer that. First of all, business income is taxable in the hands of the fund and investor is not liable to pay tax. For investor, it is exempt under section 10. Okay. Second, long-term capital loss. Long-term capital loss, first of all, it has to set off against fund's income. But there is no income against which the fund can set off. Fund cannot set off long-term capital loss against PGBP or IFO's income. Long-term capital loss can set off only against long-term capital gains. So if that is not possible, then you can attribute that to the investor, but only to those investors who have been more than 12 months older. So how many investors are more than 12 months older? 80% investors are older than 12 months. Therefore, 80% of 30 lakhs will come to how much? 24 lakhs. Therefore, 24 lakhs you can pass on to the investors and remaining 6 lakhs the fund can keep it with itself. Okay. So 24 lakhs the investors will set off against their LTCG and the remaining 6 lakhs the fund will set off against their LTCG in future years. Okay. Third one, other sources who will pay tax. Other sources also fund investor will pay tax, fund will not pay tax. So this 40 lakhs rupees will be passed on to the investors. Okay. Every investor will get this 40 lakhs and this 40 lakhs investor will pay the tax. Last question, what would be your implication? Will your answer change? If the fund distributes only 80% and not 100%, it doesn't matter. In case of investment fund, whatever is earned by the fund, that has to be taxable in the hands of the investor. It doesn't matter how much is distributed. Even if 80% is distributed, the investor has to pay tax on the entire 100%. I hope it is clear to all of you. Okay. Now the next question is a routine question. We have done a similar question earlier also, but still I would repeat it once again. Henceforth, if it comes, if a similar question comes, I am not going to repeat. There is a non-resident German company. First of all, this is earning some dividend from an Indian company. Therefore, it is taxable at 20% as per 115A. Second, this non-resident is providing some technical know-how and in return, the Indian company is giving debentures, not money. The Indian company is giving what? Debentures rather than what? Money. Therefore, this particular thing will be taxable under income tax law in the hands of the foreign company and it will be taxable at how much rate? It will be taxable at 40%. Why? Because there is no agreement between both of them which is approved by central government. If you want to tax under 115A, there has to be an agreement between both the party and it has to be taxed. It has to be approved by the central government. There is no agreement which is approved by. Further, because the debentures are issued, interest on debentures will also be taxable in the hands of the foreign company and it will be also taxable at 40%. Why 40%, sir? Why not 115A? Because in Indian currency, it is not in foreign currency. Because it is in Indian currency, that will also be taxable at 40% only. Third case, they are the foreign company is receiving some dividend of 5,50,000 on GDR. So this will be also taxable in the hands of the foreign company. But remember, it will be taxable at 115 AC at the rate of 10%. But you have to gross it up. Why gross it up? Because the word used over here is received. Foreign company has received 5,50,000. So if they have received 5,50,000, it has to be after the TDS only. Therefore, you have to say that if the tax rate is 10.4% and if it is received 5,50,000, therefore 5,50,000 is what? It is 89.6%. Therefore, 100 is how much? You have to cross it up and write down the grossed up income. Okay. Next one, business income will be taxable at 40% and royalty. There is an agreement. It is not covered in 44DA. There is an agreement which is approved by central government. So this will come in 115A. Again, it is received. DTSAA says that royalty is taxable at 24%. Therefore, you will tax the royalty at 20% because as per 115A, it is DTAA or 115A 20% rate, whichever is lower. Therefore, 20% tax will be at 20.8. Again, you have to gross it up. If it is 20.8, then you have to gross it up at 79.2%. If 10 lakh is 79.2%, then 100 is how much? Gross it up and tax it. Okay. So this is what a similar question we have already done earlier. I don't think so. This is now very difficult for you all. Question number 4, which is on TDS. There is an infrastructure debt fund who are making some payment to some foreign company. How much TDS they will deduct? They will deduct TDS at the rate of 5% plus 4% says 5.2% under section 194 LB. If an infrastructure debt fund pays interest to a foreign company or non-resident, it will deduct TDS at the rate of 5%. What about if that foreign company or non-resident is located in NJA? If that foreign company or non-resident is located in NJA, then it is taxable at, then the TDS will be deductible at 30% plus 4% cess, that is 31.2%. Okay. Further, no deduction of any expenses will be allowed out of the income. It is directly taxable at 5% or 30% as the case may be. If normal case 5%, in NJ case it is what? It is 30%. I hope it is clear to all of you. The next is a very simple adjustment, that is whether TDS is applicable on retention of commission. If a commission is retained by any person, if a consignee is retaining a commission, whether TDS is applicable in that case also, and the answer is yes, 194H is applicable in that case also, where the commission is retained by the consignee. I hope it is clear to all of you. The third one is a very, very good point. Mr. Harsh is an employee. He has joined the company in 2020 and in 2024 he is leaving the company. So he is retiring in the company. He is retiring from the company within 4 years. So remember, if you retire from the company, if you leave the company within 5 years, and if you withdraw any money from PF, then that is taxable. And if you withdraw more than or equal to 50,000 rupees, then even TDS will be deducted under 192A. So how much TDS will be deducted? 10% TDS will be deducted because you are retiring within 5 years and the amount paid to you is greater than equal to 50,000 rupees. Therefore, 10% TDS will be deducted under 194A. What would be your answer? His PAN is available. What would be your answer if his PAN is not available? If his PAN is not available, then you will deduct 20%. Earlier it was MMR, but Finance Act 2023 has made an amendment that in such cases it will be taxable at how much? It will be taxable at 20% only. Don't deduct at MMR, please. Okay. Now, the next person is Mr. Money, has purchased a flat of 48 lakh rupees. Apart from 48 lakh rupees, he is paying some maintenance charges of 5,000 per month for 2 years. So that amounts to what? 1,20,000 rupees. Further, he has paid some advance of 2 lakh rupees for car parking, 1 lakh for club membership. What would be, whether the TDS will be deducted in this case or not? If yes, how? Yes, TDS will be deducted. You have to see all the charges inclusive. If it is 50 lakhs or more, then TDS is deducted at the rate of 1% on the consideration or stamp duty value, whichever is higher. In this case question, if I sum up all the charges, it is greater than 50 lakh rupees. So if it is 50 lakhs or more, TDS has to be deducted in this case. Okay. Therefore, in this case, TDS is deducted. If stamp duty value would have been given, then TDS would have been deducted at higher of the two. Okay. In this question, stamp duty value is not given, so ignore that. Okay. One last question in this particular paper, that is Paras Limited is an Indian company and it is a manufacturing company and it has taken a loan of 60 crore rupees. Okay. Now, Saksham is a German company and it has purchased from Paras. Paras is selling to Saksham some goods of 2,000 rupees per unit. To other dealers, Paras sell at 2,100. But to Saksham, Paras sell at 2,000 rupees. Okay. Now, both of them are what? Associate enterprise. How did you come to know that both of them are associate enterprise? Because Paras has taken a loan of 60 crore rupees, out of which Saksham has given 9 crore guarantee. So if one entity gives guarantee to the other entity of loan of 10% or more, then both of them are deemed to be associate enterprise. Do you remember that or not? If one entity gives 10% guarantee of the loan to another entity, then both of them are deemed to be associate enterprise. Now it's a very, very simple question. See, I am Paras. I am selling goods to my associate enterprise at how much? At 2,000. To others, I am selling at 2,100. Now it is very simple. To others, to Saksham, I am giving a credit of 3 months. Whereas to others, I am giving a credit of 1 month. Okay. So it's a very simple question, nothing great as such. First of all, what is the unrelated price? You need to follow cup method over here. Cup method, what is first step? Price at which you sell to other person. To other person, you are selling at how much? 2,100. Okay. 2,100 is the price at which you are selling to other person. Now, what is the functional difference between both of them? See, to others, you are giving a credit of how much? 1 month. But to Saksham, you are giving a credit of 3 months. Therefore, you are giving 2 months extra credit to Saksham. And the cost of credit, cost of capital is 12%. So 2 months extra cost you will add to Saksham. Okay. Therefore, 2,100 into 12% into 2 by 12, that extra cost you have to recover from the Saksham na. Because to Saksham you are giving 2 months extra credit. So for 2 months extra credit you will recover extra cost or not. So that extra cost has to be added over here. If I add that, my arm's length price comes to 2142. Okay. After that I will multiply by 5 lakh unit. I will get the arm's length price. Okay. And this is the amount which has to be adjusted to the what? Arm's length price. I hope it is clear to all of you. Now listen carefully please. There are a lot of questions which are asked over here. Are Paras and Saksham associate enterprise? Yes, associate enterprise because of what? 10% guarantee. What you need to compute the arm's length price. Arm's length price is very simple. 2,100 plus 2 months extra cost of capital I have to add back. That is arm's length price. Okay. And then you have to multiply by 5 lakh units. That will give you the amount to be added back to the total income. Okay. Now, if these adjustments are made suo moto by Paras, okay, what is the time limit to repatriate the money? It's a very simple question. You have to repatriate that money back to India within 90 days on the due date of filing of return. If you don't repatriate that money within 90 days on the due date of filing of return, on that much amount will be called as deemed income, deemed loan. Secondary adjustment will be applied on that much amount. and you have to take SBI's MCLR plus 3.25% as on 1st April 2024, and whatever is the interest that has to be added back over here, including the 90 days period. Interest will be counted from 1st December only, including the 90 days period till 31st March. Whatever the interest will be added back. Another option is there with the law says that if you pay one-time additional tax at the rate of 18% tax, 12% surcharge, and 4% cess, and then you will be relieved from your secondary adjustment from the next day onwards. Okay, so this is the second option which is given in the answer also. You can check it once, and this is what this paper is all about. Now let's move ahead with the next paper, that is December 2021. Now one thing you might be thinking that why the attempts are so strange, Jan 21, July 21, December 2021. That is all because of COVID. During that time COVID was there, and therefore ICAI was taking exams whenever it was possible for them to take the exams. Okay, so that's the reason the attempts are very strange in this particular case, in that financial year, especially in that calendar year 2021. Now let's move ahead with the first question over here. The first question over here is of total income. Assessee is a manufacturing assessee, and we are supposed to solve this question as per 115 BAB. Okay, 115 BAB, we have to solve this question as per, and we have to not consider MAT. Obviously, if the assessee follows 115 BAB, then MAT is not applicable. So let us start with the question. The very first thing over here is manufacturing company. So accordingly, you have to react over there, and then there is a leather product. Whenever there is a leather product or an apparel business or a footwear business in the question, then there can be an implication of 80 JJAA, where you need to employ the employee only for 150 days, not for 240 days. Remember that generally if you want 80 JJAA, you have to employ the employee for 240 days, but in these three businesses you have to employ only for 150 days. So that is a very important factor over here. Now the profit is 1 crore 20 lakh rupees. The very first adjustment over here is the assessee has made some mistake in the P&L account. They have overvalued the opening stock by 10%, and they have undervalued the closing stock by 10%. Overvalued the opening stock means they have taken more deduction. Undervalued the closing stock means they have shown less profit. Okay, therefore if they have overvalued the closing stock and the closing stock is 55 lakhs, it means closing stock is 110%. So do backward calculation and add the differential amount. Okay, similarly for closing stock, it is undervalued. It means closing stock is 90%. It is not 110% because it is undervalued by 10%. Therefore 54 lakhs divided by 90%, add back that much closing stock profit to the P&L account. Okay, so undervalued, overvaluation of closing stock will also be added back, and undervaluation of closing stock, overvaluation of opening stock will also be added back, and undervaluation of closing stock will also be added back to the profit. Okay, next one, you are making some payment of 10 lakh rupees as sales commission to a foreign agent who is procuring orders from outside India. Are you liable to deduct TDS in such case? The answer is no. If an agent is outside India and he is procuring orders outside India, then the income of the agent is accrued or deemed to accrue outside India. Then there is no question of deducting TDS. Okay, and if there is no question of deducting TDS, why the hell the expenditure will be disallowed? My case. Therefore, in this case, there will not be any disallowance to you. Okay, don't worry about it. Next, you have paid 45,000 rupees in cash to one of your employees at the time of retirement. Will you disallow that because it is more than 10,000 rupees? The answer is no. In Rule 6DD, it is very clearly written that if you can, Rule 6DD, which is an exception of 40A3, it is very clearly written over there that if you make a payment to an employee on retirement, like gratuity, like PF, like pension, like you can say VRS, etc., retrenchment compensation. If you make the payment on retirement, you can make the payment up to 50,000 in cash. So the limit has been increased for retirement payment up to 50,000 in cash. Therefore, 45,000 is allowed. Okay. Next one, 31st Jan 2018. Whenever 31st Jan 2018 will come, you will apply grandfathering clause. I'm not speaking much on grandfathering clause. I have spoken sufficient earlier also on grandfathering clause, how to determine the cost in case of grandfathering clause. Okay. Next one, you are deriving some STCG from a capital asset which is non-depreciable capital asset. Maybe it is a land. Okay. So reduce from PGBP, show under capital gains, and while charging the tax, you will be charging this at 22%. Why 22%? Because it is taxed at general rate. Okay. If it was a part of block, if it would have been a depreciable asset, short-term capital gains, I would have charged 15% as per 115 BAB. You have to remember the rates of 115 BAB. There are multiple rates in 115 BAB. Next is a very routine adjustment. You are selling some land, etc., to your 100% holding subsidiary, and the recipient is an Indian company. So then in that case, it is exempt under income tax law under section 47. So reduce from here and show exempt under section 47. So nothing great as such. Next is a very beautiful adjustment. You are receiving some dividend of 50,000 rupees from a domestic company. Now remember, you will reduce this from PGBP. That is a very simple adjustment. Dividend is covered under IFOs. So reduce from PGBP, but when you go to IFOS, you have to gross it up. Why, sir? Why gross it up? Because it is received, it is dividend received. It means it would have been received after net of TDS under section 194, and under section 194 TDS of residents are deducted at 10%. Therefore 50,000 is 90%, so 100% is how much? 55,555. So this is a very important adjustment that you have to keep it in your mind. Next one, you are making some payment of 20,000 rupees for inauguration of new branch. Obviously, for expanding the business, that is nothing but it is for business. It is for business and profession. Therefore, it shall be allowed as a business expense. There is nothing wrong in that. Okay. Next one, you are making some payment of penalty to government for failure to perform in contract, and there was a delay of 4 months. So it's a compensatory penalty. Compensatory penalty is allowed. Delay in contract is all these things happens in business, and therefore it's a compensatory penalty. It is allowed under the income tax law. A penal penalty is not allowed under the income tax law. Next one, you are making some payment of VRS of 5 lakh rupees. The VRS is allowed under 35 DDA, not directly, but 1/5 in 5 years. Therefore, 4/5 you have to disallow in the current year. Okay. Next one, you have taken some deposit from a non-resident. What you have taken? You have taken a deposit from a non-resident and you are using that money in India for manufacturing purpose. Now you are paying interest to that non-resident. Whether that interest will be accrued in India or not? Definitely. If you take a loan from a non-resident and if you use that money in India for business and profession, and when you pay the interest, that is deemed to accrue or rise in India as per section 915. Therefore, you should deduct the TDS. Now you have not deducted the TDS. You have not deducted the TDS. Therefore, this 75,000 interest will be what? Disallowed under the income tax law. I hope it is clear to all of you. Now, the next adjustment is a very critical one for all of us, and it is a clarificatory adjustment for all of us. So, please be careful over here. There are 56 employees which we are hiring. Okay. All of them are contributing to Provident Fund. So, now this adjustment pertains to 80JJAA. 80JJAA, which talks about 30% of the additional employee cost will be allowed as deduction. Now, out of the 56 employees, now they have given the bifurcation. 39 employees were hired on 1st June at a salary of 15,000 rupees per month. Will they be covered? Yes, they will be covered, because their emoluments is up to 25,000 rupees and they are hired for more than 150 days. In this question, 150 days is sufficient because the SSC is engaged in leather business. Next. But out of those 9 employees, out of that 9 employees were settled by bearer check. So all those who are settled by bearer check, they will not be allowed deduction under 80JJAA, because in case of an existing company, you cannot make the payment other than the 4 modes. If you are making the payment by bearer check or cash, then it is not allowed under 80JJAA. Therefore, out of 39, 9 employees are out of question. Only 30 employees will be eligible for deduction. So 30 employees into 10 months into 15,000 into 30%, this much will be allowed as deduction. Let's talk about the other employees. 14 employees will not be eligible because their emolument is 45,700. It is more than 25,000. And 3 employees who are joined on 1st of November, their emolument is 22,000 rupees. They will be eligible because if I take from 1st November to 31st March, it is coming to around 151, 152 days. It is greater than 150 days. In this case, 150 days is sufficient. Therefore, these 3 employees also, you will be getting the deduction under 80JJAA. Okay. I hope it is clear. Now coming to very important clarification, which I would like to make over here. The very important clarification that I would like to make over here. Sir, 9 employees to whom you are paying the by bearer check, you have not taken 80JJAA. But why the hell, sir, you have not disallowed that under PGBP? Because if you are making the payment by bearer check of more than 10,000 rupees, you have to disallow the salary also under PGBP. Yes, absolutely correct. This is what ICI has not done in its RTP, and ICI has done in its exam paper. And they have given both the views. They have given 2 views, which I feel one is correct, one is incorrect. One view, they have said that 9 employees, whatever salary you are paying, you have to disallow that in 48(3) also under PGBP. Second view, they are saying that this data which is given over here, assume that this is only for 80JJAA. It is only for 80JJAA, and whatever 9 employees salary which is given in cash, that we have already disallowed and given you the revised profit over here of 1 crore 20 lakh rupees. So they have taken both the views. If you have not understood, rewind back and listen once again. So you can do both the thing. You can disallow 9 employee salary, or you can ignore 9 employee salary disallowance, and you can write a note that this might have already been done by the question in the profit. It would have been already given the effect as, and therefore we are not doing anything in that particular case. Okay. I hope it is clear to all of you. And last but not least, the SSC is making a payment of 1,20,000 to National Fund for Rural Development. This deduction is allowable under 35 CCA, and is 35 CCA allowable under 115 BAB? The answer is yes. 35 CCA is not disallowed under 115 BAB. Therefore, you can claim this deduction. And after that, you will compute what? You will compute the tax of the SSC on long-term capital gains of stock market, 1 lakh exempt, balance 10% tax, on 75,000 STCG 22% tax, as I have told you, on dividend income also 22% tax, and on manufacturing business income, you will be liable to pay tax at the rate of 15% only. 10% surcharge always imposable under 115 BAB, and 4% cess. I hope it is clear to all of you. Let's move on to question number 2A, subpart 1. There is one company, CMA Impex Limited. This is an amalgamating company, and there is another company, Delhi Impex Limited, which is an amalgamated company. Now, Delhi company is taking over this company, and this company is bringing all these losses. So, which all losses will be given to the amalgamated company? That's what we are supposed to see, and we are supposed to compute the total income of the amalgamated company. Okay. Now, the profit of the amalgamated company is 175 lakhs. It is before setting off the losses. The profit of the amalgamated company is 175 lakhs. It is before setting off these losses, but it is after providing depreciation at the rate of 15% on 160 lakhs. Now we'll talk about depreciation sometime later. Let's talk about the losses first of all. Which all losses will be allowed out of 175 lakhs? Out of 175 lakhs, the very first loss is speculative loss. Is speculative loss allowed to carry forward and set off under section 72A? The answer is no. Remember, under section 72A, only a business loss which is non-speculation loss under section 72 can be carried forward, and only unabsorbed depreciation can be carried forward. Nothing else can be carried forward. Okay. And apart from that, whatever is related to unabsorbed depreciation, like unabsorbed capital expenditure of family planning, like unabsorbed capital expenditure of scientific research, which is related to unabsorbed depreciation, all of them can be carried forward. Therefore, speculative loss not allowed. Unabsorbed depreciation, yes, you can carry forward and set off that. Therefore, I am reducing that. Unabsorbed capital expenditure of scientific research, yes, you can carry forward that and set off that. Therefore, I am setting off that also 2 lakh rupees. Okay. Then business loss, yes, that is also allowed. I am setting off that also. Now, we are also taking some assets from the amalgamating company. What is the worth of the assets? The worth of the assets is 160 lakhs. Okay. This is the value at which we have taken. But this is not the value at which we depreciate. As per explanation 7 to section 43(1), you have to depreciate at WDV of the amalgamating company. Therefore, I have done it wrong. I have depreciated, I have made this mistake of depreciating the asset at the original value. So therefore, 160 lakhs into 15%, which will come to 24 lakhs. I have depreciated 24 lakhs, which is wrong. So I'm adding 24 lakhs back and I'm depreciating the correct value. That is, the WDV of the asset is 100 lakh. So I'm depreciating at 100 lakh. Check it please. And therefore, my total income and profit will come to 39 lakh rupees. I hope it is clear to all of you. Now, next question number 2, which is a question on capital gains compulsory acquisition. The government has compulsorily acquired your land in April 2019. Therefore, you will compute the indexation till April 2019, and you will also compute your period of holding to determine whether the asset is long term or short term till April 2019. Okay. You have received the compensation in June 2020. Therefore, capital gains will be chargeable in the year June 2020, but indexation will be taken till April 2019. Be very careful. Okay. Now, the land was acquired in 2003 for 12 lakh rupees, and you have also incurred some expenses of 30,000 rupees to sell the land. Okay. Therefore, it is very simple. Your sale consideration is 20 lakhs minus 30,000 is your expenses on transfer, and then minus your index cost of acquisition. You will take indexation of which year? 1920, the year in which it was compulsorily acquired, divided by year in which it was purchased. Okay. If you do this, you will get a loss. Now, you will get a loss. That will be a long-term capital loss. Now, after some time, you also received 18 lakh rupees as an additional compensation. This is also taxable. To earn this additional compensation, you have incurred some expenses of 1 lakh rupees. So you can reduce that 1 lakh rupees, and there is 17 lakh rupees capital gains in your hands. Now, the loss at the time of original capital gains, whatever was the loss, you can set off that loss for 8 years against the enhanced compensation, and you can set off that loss. There is no harm in that. Okay. Now, the next question is on transfer pricing, and this question is on transactional net margin method. In transactional net margin method, what happens? In transactional net margin method, you need to find out the net profit margin. And what is the net profit margin? The net profit margin of your transaction with associate enterprise and of unrelated transaction also, of uncontrolled transaction also. Now, what is net profit margin? Net profit margin is nothing but net profit upon relevant base. Now, what is that relevant base? That can be sales, that can be cost, depending upon the factor. I have told you, I have given you hint in the class. When you sell something, when you export something, then you have to take in the denominator cost, and when you import something, then you have to take in the denominator sales. Okay. When you sell, you take cost. When you purchase, you take sales. Okay. You have to be very careful with that. First of all, we need to see whether the two associates are associate enterprise or not. We need to check that first of all. Alpha Inc. is a foreign company, and Alpha Limited is an Indian company, and one entity has given a loan of 1,50,000 Singapore dollar to another entity, and the another entity has a book value of assets of 120 lakhs. Now, this is rupees, this is dollar. So let's convert the dollar also in rupees. That is $1,50,000 into 55 rupees per rate is the dollar. Therefore, that comes to 82.5 lakhs. Therefore, one entity is giving a loan of 82.5 lakhs to another entity who is having a book value of assets of 120 lakhs. Therefore, this amounts to 68.75%. Therefore, both of them are deemed to be associate enterprise. Okay. There is no harm. There is no question about being an associate enterprise. Therefore, this transaction is an international transaction. Transfer pricing is applicable. Now, what is Alpha Limited doing? Alpha Limited is selling. It is exporting. It is providing software. Okay. Now, therefore, the profit margin should be computed as follows. Net profit, because we are selling, we are providing services. Therefore, the denominator has to be cost. Therefore, I will take the net profit margin as net profit upon cost. So, what is the net profit margin with respect to associate enterprise? It is how much? I am selling at how much? I am selling at 85. My cost is 80. Therefore, my profit is 5. Therefore, net profit upon cost will be 5 upon 80. I have to take cost in the denominator because I am selling. Why? I have told you the logic in the class. You can go and listen to the lectures. Divided by what? 80. This will come to 6.25%. This is my margin with my associate enterprise. Now, what is the margin with unrelated party? What is the arm's length margin? The arm's length margin is, this is my total cost. Okay. This is my total cost. This is my profit. So, 100 divided by 600, 16.67 is my profit margin. Okay. Now, this is the arm's length margin that I have to apply on my cost. What is my cost? My cost is 30,000 hours I am providing. I am providing 30,000 hours and 80 rupees is the per hour dollar rate and multiply by 55 rupees is the dollar rate. This is my cost. On this cost, I will apply the arm's length margin and I will get my arm's length price. Then I will compare with my original price, whatever is the differential amount that I'm going to add it back. Okay. It is as simple as that in this question. So I need to find out the arm's length margin and that arm's length margin I will apply on my cost. I will get the arm's length price. Okay. I hope it is clear to all of you. Now, question number 3, beautiful question, which is on taxation of trust, which is on exit tax. In 2006, a trust was formed. In 2010, the trust was registered. Okay. So remember, when the trust was formed in 2006 till 2010, whatever assets were purchased by the trust, whatever liabilities are incurred by the trust, that will not come in exit tax. Okay. In exit tax, only those assets and liabilities will come which has been taken or which has been borrowed after the trust has got registration. Okay. So these assets and liabilities will not be forming part of your trust calculation, exit tax calculation. In 2023, the trust got dissolved. Now we need to find out the exit tax. What is exit tax? It is accredited income into 34.944% tax. Okay. Now how to compute the accredited income? You have to take the value of all assets minus value of all liabilities, and some assets and liabilities are not included in that. So that's what we are going to do the calculation as now. Okay. First of all, land and building. Land and building, the book value is 12 lakhs. We don't take book value of land and building. We only take FMV of land and building or stamp duty of land and building, whichever is higher. In this question, stamp duty value is not given. Therefore, we are taking FMV of land and building. Now, the FMV of land and building is what? It is 50 lakh rupees. Now, you have to be very careful with this adjustment. A lot of students ask me a lot of doubts over here. It is written in the question. It is written in the question in adjustment number 4 that land and building is acquired out of agricultural income. Now, it is very clear now. You have purchased a land and building of 12 lakh rupees. Out of which you have taken a loan of 9 lakh rupees to purchase land and building. Can you see that? So out of 12 lakh, if 9 lakh has come out of loan, it means agricultural income has been used to the extent of only 3 lakh rupees, correct? If to purchase a land of 12 lakh, 9 lakh is coming out of loan only. So agricultural income is used to the extent of only how much? 3 lakh rupees. It means agricultural income is extended to the extent of what? 1/4 of the asset. Okay. Because out of 12 lakhs, 9 lakh is coming from loan. Therefore, only 3 lakh is coming from agricultural income. Therefore, agricultural income composition in the asset is only 1/4 of the total asset. Therefore, whatever asset is purchased from agricultural income, that does not come in the what? In the accredited income. Therefore, this is the FMV of the asset. 1/4, I will say, is purchased from the agricultural income. Therefore, I will take only how much? Only 3/4 of the asset in the calculation. I hope you understood. Because 1/4 is purchased from agricultural income. Therefore, only 3/4 should be taken in the value of accredited income. I hope it is clear to all of you. For equity shares which are quoted, that is listed equity shares, you are supposed to take the market value of the asset, and the market value of the asset is given as 18 lakh rupees. Okay, it is as simple as that. For unquoted shares, you have to make a lot of calculation. Now listen carefully. The unquoted share of Z Limited, you have to make a lot of calculation. You need to value the unquoted shares of Z Limited, and then you have to multiply by how much percentage you hold in that particular company. Okay, now how to value that? You have been given all the data. The book value of all the assets are given 60 lakhs. Then market value of bullion etc is given is 30 lakhs. Then net assets is what? Minus 35 lakhs is the liabilities. Therefore, the net assets of that Z Limited is 55 lakh. Out of that, we hold only 15%. So how did you come to know that we hold only 15%? See, we hold how much? We hold 1,50,000. Out of which, what is the total equity capital of Z Limited? 1 lakh equity into 10. Therefore, for 10 lakh paid up capital, we hold 1.5 lakhs. Therefore, we hold how much? Only 15%. Therefore, the total worth of the company is 55 lakhs, out of which our worth is how much? Only 15%. In that also, I will take only 50%. Why? Because 50% of the assets, 50% of the unquoted shares were purchased in 2007-8. Because it was purchased before the registration, that asset will not form part of accredited income. Therefore, only 50% of the assets which is purchased after the registration. Registration happened in 2010. Only that much asset will form part of what? Accredited income. Therefore, asset which is purchased before 2007, before 2010 will not form part of accredited income. So this is how we are making the calculation. 55 lakhs is the total worth of Z Limited, out of which only 15% is our stake. Out of that, 50% is purchased before 2010. Therefore, only 50% of that will come over here as a value of the asset. Okay. Next, cash you will take entirely 1 lakh. Bank you will take 50,000. Then loan you will take 9 lakh rupees fully over here. This loan you are not going to take because this loan is taken before 2010. Any asset and liability which was acquired or borrowed before 2010 will not be considered over here because it is before registration. After that, you will get the accredited income. That's it. There is nothing great in that. One last thing, you have also distributed 80 lakh rupees of asset to another trust before the specified time. So that much you can reduce from here. Okay. So that much you have the opportunity. You are not going to take that. Okay. Because that asset, because the law says that if there is a dissolution and if you transfer the asset to another trust within 12 months, then that much asset should not be form part of what? Accredited income. So this shall not form part of accredited income. Okay. Now the next question is a very simple question, but only thing important in this question is this is going to be followed as per the 115 BSc subsection 1A. That is, you have to follow the new regime. So because of the new regime, this question becomes very important. Okay. Because from this year onwards, the by default regime is going to be the new regime, and accordingly the DTAA questions will also be impacted because of that. Now the very first thing over here is the SSC is 62 years age. He is a resident individual. and he's earning some income. So I'll just make the computation for you all. Very simple. I'm not going to solve the entire question. Obviously, it's a very simple question. Gross salary 4,50,000 standard deduction. Then profession income from Brazil, dividend income from Brazil, rent 1,80,000, 30% standard deduction. Do you get in new regime? The answer is yes. In new regime, you get 30% standard deduction. Then FD from Pune branch. Then self-occupied interest not allowed under new regime. Self-occupied interest 2 lakh rupees not allowed. House property self-occupied interest not allowed under new regime. Then PPF not allowed. PPF ATC not allowed. Mediclaim not allowed. 80D not allowed under new regime. So accordingly, you have to compute the income, and then you have to compute the average rate, and then you have to compute what? After computing the average rate, you have to compute you have to compare with the foreign countries rate, and whichever is lower, that will be allowed as a relief on the doubly taxed income. Okay, so it's a very simple question after that. Now coming to the next question, question number 4, part A, which is on TDS. Very, very beautiful question. Mr. Z is a resident. What is he doing? He is selling some goods of worth of 60 lakh rupees through ABC e-commerce operator. So Mr. Z is a resident seller who is selling some goods through ABC e-commerce operator, that is through Amazon, etc. So Amazon has to deduct TDS under 194.0 at the rate of 1% on the time of credit or at the time of payment, whichever is earlier. So how Amazon is making the payment of credit? On 31st December, Amazon is making the credit of 20 lakh rupees. On that, Amazon will deduct 1%. On 28th Feb, Amazon is again making payment of 15 lakh rupees. So on that, Amazon will deduct 1%. Then the customers have directly paid to the seller. Customers have directly paid 10 lakh rupees to the seller. Will that also be subject to TDS? The answer is yes. Do you remember that? If the customer does not pay to Amazon, but the customer directly pay to the seller, then it is deemed to be credited by Amazon. Then that case also, this 10 lakh will be subject to TDS. Okay. And the balance amount is how much? 15 lakhs. Out of 60 lakhs, 35 lakhs gone here, 10 lakhs gone here, 45 lakhs gone. Then 15 lakh balance is credited on 31st March. So on 31st March, balance 1% will be subject to what? Will be subject to TDS. Okay. This is how in 4 steps the TDS will be deducted by what? By Amazon. That is by ABC company in this question. Next question is also a beautiful question. Pay attention, please, all of you. Raghav Motors Limited. What is happening in this case? This associate is engaged in what? He has a turnover of 9.8 crore in the last year from sale of cars and 60 lakhs from service station. So the total turnover of this associate in the last year is greater than 10 crore rupees. It is a very important data for us. Okay. Now it is selling the following things to the customers. First, it is selling a Maruti car of 37 lakhs to a customer. Whether TCS will be collected by the assessee or not. Yes, if you sell a car of more than 10 lakh rupees, then 2061F will be applicable. 1% TCS will be applicable to the seller. Okay. Then again a Maruti car of 19 lakh rupees. Again it is more than 10 lakh rupees. 1% TCS will be collected under 2061F. The third one is a Ford car of only 8 lakh rupees. 2061F will not be applicable because the value of the car is less than 10 lakh rupees. Therefore, 2061F is not applicable. We'll talk about the Ford car in a while, what has to be done in that case. Okay. Then again a Maruti car of 12 lakh rupees. Again, it is more than 10 lakh rupees. Therefore, 2061F will be applicable at the rate of 1% in this case. Okay. So for the first car, second car and the fourth car, because the value of the car is more than 10 lakh rupees, the seller is supposed to collect TCS at the rate of 1% under section 2061F. What about this Ford car? For this Ford car, do you remember that all those cars which do not come in 1F will come in 1H if provided you fulfill the conditions of 1H, because 1H full condition says what? Your last year business turnover has to be greater than 10 crore. Is the last year business turnover greater than 10 crore? The answer is yes. The second condition 1H says that you should sell the car in the current year of more than 50 lakh rupees. Is the assessee selling the car of more than 50 lakh rupees? Now there are two views taken over here by the ICI. If we see all the cars taking together is greater than 50 lakhs. All the cars means which comes in 1F and which comes in 1H. All the cars means all 4 cars if I take together, it is greater than 50 lakhs. So the one view taken by ICI is that because all the cars taken together is greater than 50 lakhs, so you collect TCS on 8 lakh rupees. Second view ICI takes that because the car which is covered in 1H, only the car which is covered in 1H that does not exceed 50 lakh rupees, therefore you should not collect TCS in that case. So both the cases are covered over here, because in one case they have said that consider all the cars, in one case they have said that don't consider all the cars. Okay, so both the views are taken by ICI in this particular question. You can see the solution later on. Next one is a question on chapter 12A. There is a non-resident and a person of Indian origin, therefore he is an NRI, and we have to opt for what ICI has said, that find the tax payable or refundable with special provision applicable to non-resident. It means you have to follow chapter 12A only. You don't have option to follow any other provision over here. Okay. Now what does chapter 12A says? That if an NRI, that is non-resident Indian, purchases certain specified assets, then in that case long-term capital gains will be chargeable at 10%. Then the interest income, dividend income will be taxable at 10%, at 20%, and you will also be getting some exemption if you invest in the specified assets within 6 months. Okay, you will get some exemption under 5115F if you invest in specified assets within 6 months. Okay, now the very first thing, there is a long-term capital gains on specified foreign exchange asset. Is it covered in chapter 12A? The answer is yes. You are also incurring some expenses with respect to such transfer. of 30,000, therefore 8,20,000 rupees will be taxable at 10%. But you are also investing in the shares of Indian Public Limited on 31st December. Within 6 months, if you are investing, then you get an exemption. But in this case, you are selling on 31st May, you are investing on 31st December, therefore you are not investing within 6 months. Therefore, this will not be subject to what? This will not be subject to exemption to you. Okay. If this would have been invested within 6 months, you would have got an exemption from 8,20,000 rupees. Then, apart from that, you are earning some interest on deposit from private company. Is it covered in 115? Is it covered in chapter 12A? No. Interest on deposit from public companies covered, from private companies not covered in chapter 12A. Therefore, this will be taxable at slab rate. Okay. Then interest on government security, ICAI has taken two view. If it is in forex, then it will be covered in chapter 12A. If it is not in forex, then you have to apply what? Then you have to apply slab rates. Okay. So these are the two views which are taken by the ICAI in the solution. You can check, because in front of interest on security, it is not written whether in forex, whether in Indian rupees. If it is invested in forex, then you follow the chapter 12A. If it is not invested in forex, then you follow the slab rates. Okay. Then you also have short-term capital gains, which will be chargeable at 15%, triple 1A. Then you are making some investments in notified NSC, that is National Savings Certificates. Then that will be subject to ATC deduction. If you follow old regime, if you follow the new regime, then you are not eligible for ATC. Okay. So after that, you are supposed to compute your tax payable. For computing the tax payable or refund, you have to also reduce your TDS, which is deducted. That is 1,55,000 rupees TDS, which is deducted in your case. You have to deduct that and find out what is the tax payable in this case. Okay. Now let's move on to the next question. The next question is a case law question. There are some case laws over here which I need to address all of them one by one. The very first case over here is on an issue that can a CIT revise an intimation under 143(1) under section 264. We all know that CIT has the power to revise an order under section 264. CIT does not have a power to revise an intimation under section 264. An intimation is not an order, but this is the contradictory judgment. In exceptional cases, the court has said that CIT can revise even an intimation under section 143(1). This case law is also there in our case law lecture. You can go and see the case law lecture also. You can go and see the case law book also, which is there in our color book number 2, chapter number 75 or 76. I don't know. You can just check it over there. Okay. Therefore, you have to be very careful with this that if a CIT revises an intimation, then that is also allowed now as per this judgment. Okay. Now, the next question is, there is an assessee firm over here, and the assessee firm has given a transport contract to a transporter. Now, this contractor doesn't have any truck and all, any car, etc. He doesn't have any vehicle. He has used the services of some other person. Okay. Now, whether I am liable to deduct the TDS? My question over here is, I am making the payment to a person who does not own any vehicle, but he has taken a vehicle from somebody else and he has provided me the services. Am I supposed to deduct TDS under 194C? The answer is yes. 194C is very clear that the transporter can be a contractor. The transporter can also be a subcontractor. In this case, the transporter is what? The transporter is a subcontractor. He has taken the truck from someone and he has given you. And therefore, whether the transporter is a contractor or subcontractor, this doesn't matter. You have to deduct TDS in both the cases. Therefore, 194C is applicable. If you do not deduct the TDS, 40A1A, 30% expenditure will be disallowed under the income tax law. Okay. Next one, there was some order which was passed by the assessing officer in case of buyback of shares. So, assessing officer passed an order. Now, what did assessee do? Assessee, instead of going to a legal remedy to go to CIT appeal, he directly went to the High Court and filed a writ petition. My question to all of you is, can you directly go to a writ petition when you have a remedy under the income tax law? When the law says that if you are not happy with the order of the AO, you can go to CIT appeal. But can you skip that particular thing and directly go to the High Court for writ petition? The answer is no. Remember, I used to say in the class, a writ petition is only possible if there is no remedy in the law. If there is a remedy in the law, then you should not file a writ petition. You should go as per the law. Therefore, in this case, the assessee cannot go for the writ petition. Okay. I hope it is clear to all of you. Next one is a 2020 equalization levy. There is an assessee, Mrs. XYZ. It is an e-commerce operator. Now, remember, for 2020 equalization levy, what are the conditions? The assessee has to be an e-commerce operator. The assessee should not have a PE in India. The assessee should be non-resident. It is incorporated in China. It is non-resident, and it should sell goods or provide services in India of at least 2 crore rupees. Then equalization levy is applicable. So all these conditions are fulfilled over here. It is selling goods of rupees 1.2 crore to Indian resident. So this will come in the 2 crore. Secondly, it is providing online sale of advertisement where if the amount does not exceed 1 lakh rupees. If the amount exceeds 1 lakh rupees for online advertisement, then 2016 equalization levy is applicable. But if the amount does not exceed 1 lakh rupees for online advertisement, both the options are possible. For online advertisement, if the payment is more than 1 lakh, then 16 equalization levy. If the payment is less than 1 lakh, then 20 equalization levy. Here it is less than 1 lakh. So this amounts to total of 70 lakh rupees. So 1.2 crore plus 70, it comes to 190 lakhs. Then you are also providing some services to non-resident. advertisement for sale of advertisement that targets Indian customer. This also comes in the scope of equalization levy. This is also 20 lakh. Therefore, the total comes to 2.1 crore. On that, 2% equalization levy will be charged and it will be paid by messxyz.com. Okay. I hope it is clear to all of you. One last question over here. Pay attention, please. One last question over here is of GAR. Okay. There is a company, Messrs. Highway Drive Limited, and which incorporates a wholly owned subsidiary, Messrs. Highway Roads Limited, etc., etc., etc. Okay. Now, we know that if you are engaged in some infrastructure, you are eligible for deduction under ATIA. Now, Highway Drive Limited derives income other than income from infrastructure. Derives income from other than infrastructure, but tries to claim the benefit under ATIA. So, if you are not doing infrastructure activity, still you are claiming deduction under ATIA, it's a clear case of tax evasion. And in case of tax evasion, GAR is not applicable. GAR is not applicable in case of tax evasion or tax planning. GAR is applicable in case of tax avoidance. That too, if that avoidance is not specifically covered over here. If there is a SAR somewhere, specific anti-avoidance of a rule, then GAR will not be applicable in this case. This is a clear case of tax evasion. The question of GAR does not arise. Okay. The second case is a very simple case. You can go through it. It's a case of domestic transfer pricing. There is one entity which is eligible for ATIA, another entity not eligible for ATIA. You are selling some goods at a lesser price to evade tax. Therefore, domestic transfer pricing will apply in this case. And because domestic transfer pricing will apply, GAR will not apply because there is a specific anti-avoidance rule in this case. Okay. Now, one last question is a theory question, but this is a very important question. A lot of time ICAI has asked this question, which is about provisional attachment. When a provisional attachment is made by the officer, can you revoke that provisional attachment? Can the officer revoke the provisional attachment? The answer is yes. What has to be done? I will show you directly from the solution what exactly you have to do in case of what? Provisional attachment revokement. Okay. The assessing officer, suppose assessing officer has what? Provisionally attach your property. Can he revoke your property? Can he revoke your property and give your property back? Yes, he can give you your property back subject to some condition. He will pass an order in writing, revoke the provisional attachment provided you furnish a bank guarantee to the officer. You have to furnish what? A bank guarantee to the officer of how much? From a scheduled bank. You have to take a bank guarantee from the scheduled bank of not less than the fair market value of the asset. Okay. Whatever is the fair market value of the asset, that much bank guarantee you have to give it to the officer. Okay. Now, can bank guarantee liquidate? Can officer liquidate that bank guarantee? Can officer invoke bank guarantee? Invoke bank guarantee means liquidate bank guarantee. The answer is yes. Suppose if there is a notice of demand on you and you have failed to pay the demand within the time, wholly or partly. If you are not paying your demand wholly or partly on time, the officer can what? Liquidate your bank guarantee. Or officer can also liquidate your bank guarantee when you fail to renew the bank guarantee. Suppose the bank guarantee is expiring and 15 days are left for expiring the bank guarantee and still you are not revoked the bank guarantee. Still you are not what? Still you have not what? Renew the bank guarantee, and therefore in that case the AO can what? Liquidate your bank guarantee. So this is what this beautiful question paper is all about. Okay. So let's move ahead with the next paper, that is May 2022. The very first question over here is to be solved as per the 115BAA. Okay. So let's start solving as per 115BAA. The SSC is a manufacturing company. The profit is 850 lakhs. Depreciation will be added back. Employer contribution and employee contribution both are paid by 20th of May. Will it be allowed? Now listen, employer contribution can be paid till the due date of filing of return, but employee contribution has to be paid by 15th of the following month. With that logic, employer contribution paid till 20th May will be allowed. Employee contribution has to be paid by 15th of April. Because it is paid till 20th May, it is not allowed. Employee contribution will be disallowed. Okay. Next one, GST penalty is disallowed because it is penal in nature, and GST interest will be allowed because it is compensatory in nature. It is allowed as reduction. Next, 10 lakh rupees you have incurred for some notified skill development project under 35 CCD. So 35 CCD is not allowed in 115BAA. If you see 115BAA, 35 CCD is disallowed under that section. Then an old machinery has caught some fire. Because of that, there is a loss of 20 lakh rupees on fire of machinery. That will be added back because that is a capital loss, and you have also received 5 lakh rupees as a scrap value. You will reduce that from what? Reduce that from the PGBP income. This will have an effect in the WDV of the block of asset. Okay. Next one is a very important adjustment. You are receiving some dividend from foreign company of 15 lakh rupees. So reduce from here, show under IFOS. Now you are also incurring some expenses of 50 lakh rupees, 50,000 rupees, sorry. So you have to add back that interest to PGBP and you can claim that as a deduction under IFOS if you assume that it is an interest, because only interest is allowed as a deduction from dividend income, that too up to 20% of the total dividend, not more than 20% of total dividend. Therefore, the net dividend taxable under IFOS will be 15 lakhs minus 50,000, that is 14 lakh 50,000 rupees. Next one is a very routine adjustment. You can go through it. I'm not interested in that adjustment. Next one is again a routine adjustment. Normal depreciation, you have to reduce it. Next one is in the last year you have purchased some new plant and machinery on 10th of Jan. So you would have got additional depreciation of 10% in the last year, that is 50% of 20%. So in the last year you would have claimed 10% additional depreciation, can you get the balance depreciation of additional depreciation in the current year? The answer is no. Why, sir? Because I am following 115BAA, and assessee opting for 115BAA is not eligible for additional depreciation, therefore that will not be allowed to you in the current year. Similarly, in the last year, you have paid some money to a contractor and for which the TDS is paid in the current year. So if the payment was made in the last year, but the TDS is paid in the current year, in the last year 30% would have been disallowed, but since the TDS is paid in the current year in December 2023, that payment of 30% will be allowed as deduction in the current year. Okay, I hope it is clear to all of you. And one last adjustment over here is you are declaring and distributing dividend of 20 lakh rupees, so you can get deduction under ATM, but ATM is subject to dividend received minus dividend paid, whichever is lower. How much dividend is received by you? It is 14.5 lakhs net dividend. And how much dividend is paid by you? 20 lakhs. Therefore, only 14.5 lakhs will be allowed as deduction under ATM, and therefore now you will compute your tax under 115BAA. The tax rate is 22%, surcharge is 10%, and health and education cess of 4%. Surcharge of 10% is always applicable under 115BAA. Question number 2, it's on real estate investment trust. There is a REIT and there is an SPV. HATS Limited is an SPV, and there is an investor, Mr. Vijay, who holds 70% of the units of the REIT. Now we need to explain the taxability and compute the total income and tax payable in the hands of what? In the hands of the REIT also, and in the hands of the investor also. So let's talk about one by one all of them. First of all, the REIT is earning some income of interest. Interest income is earned from whom? From SPV. That is exempt in the hands of REIT and taxable in the hands of the investor. But remember, in the hands of Mr. Vijay, only 70% will be taxable, because Mr. Vijay is 70% owner of the REIT. He is holds 70% units of the REIT. Okay, so accordingly only 70% will be taxable in the hands of Mr. Vijay. Second, dividend income from REIT, dividend income from SPV is always exempt in the hands of REIT. In the hands of REIT, it is always exempt. In the hands of investor, it depends. It is exempt if the SPV has not followed 115BAA. But if SPV has followed 115BAA, then investor has to pay tax on what? On the dividend income. In this question, it is written that HATS Limited, which is an SPV, follows 115BAA. Therefore, dividend income will be taxable in the hands of the investor. I hope it is clear to all of you. Short-term capital gain is taxable in the hands of the REIT at MMR 42.744% and exempt in the hands of the investor. Similarly, interest from investment in unlisted debenture, it is taxable in the hands of the REIT and exempt in the hands of the investor. And last but not least, rent from directly owned properties. It is exempt in the hands of the REIT and taxable in the hands of the investor. Okay. Now remember, investor has to pay tax only on 70% of its income, because only 70% is held by Mr. Vijay in the REIT. We are making one more assumption that the REIT has distributed 100% income to the investor, because in case of REIT, only that much income is taxable in the hands of the investor, which is distributed. If nothing is distributed, then that income will not be taxable in the hands of the investor. Unlike AIF and securitization trust, where there is a concept of deemed credit, here there is no concept of deemed credit. One more important thing which you need to follow over here is the SSC is following 115BAC subsection 1A. It means it is following the new regime, and therefore in new regime the maximum surcharge is how much? It is 25%. If you compute the total income of Mr. Vijay, it goes beyond 10 crore. But Mr. Vijay will not be subject to 37% surcharge, because in the new regime the maximum surcharge is only 25%. I hope it is clear to all of you. The next question is also a very good question. Small question, simple question, but a good question. Black and Brown, it's a foreign company incorporated in country X. Now they have appointed one agent, Mr. Lal, to habitually maintain in India stock of goods, regularly deliver the goods on behalf of the non-resident. Now do you remember that if a non-resident or a foreign company appoints an agent in India, dependent agent in India, who habitually supply goods in India, who habitually maintain goods in India, deliver goods in India, secures orders in India, or habitually enter into a contract with any party in India on behalf of the non-resident, then it is a business connection in India. Do you remember that or not? It is covered under 911. Now what all incomes is earned by BNB? BNB has earned the following income. First, BNB has earned an income from delivery of goods by Mr. Lal. That is, the agent has delivered some goods. From that, BNB has earned income. This will be taxable in India, and it will be taxable at 40%, because the tax rate of foreign company is 40%. Next point is very important. The BNB has also earned, the foreign company has also earned foreign FTS of 55 lakh rupees after deducting 6 lakhs as an expense. Now remember, here the ICAI has taken two views. First view, the ICAI has said that assume that this is an FTS as per 115A. If it is an FTS as per 115A, then this will be taxable at 20%, but then you will not get the deduction of 6 lakh rupees. Your income will be 61 lakh rupees. Okay, that is 55 plus net of expense. Now it is, so you have to add back the expense. But if you assume that it is not as per 115A, it is a normal FTS, it is not covered in 115A, then you will be taxable at 55%, 55 lakhs at 40% tax rate. Whichever view you want to take, you can take. Both the views are correct. Next, long-term capital gain on unlisted shares of an Indian company. It is taxable at 10% for non-residents under section 112. And then BNB has paid some tax in his own country. So what will we have to do with that? We have nothing to do with that. If BNB has paid some tax in its own country, we cannot give FTC to BNB. We will give foreign tax credit to whom? We will give DTAA relief to whom? Or unilateral relief to whom? Our residents, not residents of country X. So this is just given for the sake of confusion to the students. Okay. So ignore this particular point. This is not relevant for us. Now coming to the third question. The third question, part A. In part A, there are questions which are with respect to taxation of trust. There is a trust who has received some corpus donation. Now the trust is saying that because I have received corpus donation, this is exempt because this is for a specific direction. Can I directly say it is exempt? The answer is no. If a trust wants to exempt its corpus donation, it has to invest in the mode specified in 11.5. Otherwise, it cannot be exempt. Similarly, a trust has taken a loan of 20 lakh rupees and has incurred 18 lakh rupees on construction of building. Whether that can be considered as an application? No. If a trust takes a loan and apply that money, that is not considered as an application because the law says that you have to repay the loan. If you repay the loan, then it is allowed as an exemption. Otherwise, it is not allowed as an exemption under the income tax law. Next one, Smile Foundation. It's an institution, not for profit institution, runs a secondary school. It has received 30 lakh rupees of grant from private people and from government also. And the trust says that is it necessary to get an approval to claim exemption? Now remember, if a trust is substantially financed by government, then it is not required to receive any approval from any person. What do I mean by substantially financed by government? It means more than 50% of the grant is received from the government. Now this trust, this institution has received a grant of 30 lakh rupees, out of which how much is received from government? 16 lakh is received from government. Therefore 53.33% is received from government. Therefore such kind of institutions for education or a medical purpose are not supposed to get an approval. They can directly claim exemption. There is no harm in that. And one last thing over here, in this particular part, there is a trust who is registered under 2LAB. And at the same time, the trust also got an approval under 1023C. Now the trust wants to enjoy both 2LAB and 1023C. Is it possible to enjoy both of them? And the answer is no. A trust cannot enjoy both 2LAB and 1023C at the same time. It is not allowed. It is written in section 11, subsection 7, that you can enjoy either 2LAB or 1023C, not both at the same time. Okay. Now next question is a beautiful question. Mr. Chetan is an Indian citizen. He is 51 years old. He left India in 2020 to settle in country Y. Now, because of some reason, he came back to India permanently on 1st June 2020. So, on 1st June 2023, if he's coming back to India, so from 1st June 2023 to 31st March 2024, he stayed in India for 305 days. Therefore, he is definitely a resident in India. Now, is he an ordinary resident? The answer is yes. Sir, how can you say that? Because in the last 10 years, definitely he is staying in India for 2 years. For 2 years, he is definitely a resident because he left India in 2020. Before that, for the last 7 years, he was in India only. Therefore, he will definitely fulfill both the additional condition of 730 days as well, the residential status in 2 out of 10 years. Therefore, he is ordinary resident. Therefore, his world income is taxable. The first income which he is earning is, he is earning some rental from a country property in country Y. 25,000 is the rental, $25,000 is the rental income. Now, you have to convert that into rupees. So, if a person is earning dollars, then income in dollars, then house property will be converted into rupees as per what? As per Rule 115. Rule 115 says that the house property income should be converted as per what? As per the TTBR as on the last day of the financial year. So what is the TTBR as on the last day of the financial year? It is 75 rupees. You can check over here. So you should multiply $25,000 into 75 and then you will take 30% standard deduction that is allowed to you. Okay. Take 30% standard deduction. Apart from that, he is earning some business income in India, 5 lakh that you have to add. He has also received some dividend from an Indian company. Now you have to be very careful. From an Indian company, if you receive a dividend, then the Indian company would have deducted the TDS of 10%. Therefore, this 1,25,000 you have to gross it up. This 1,25,000 is 90%. So therefore, 100 is how much? Gross it up and show. You have to be very careful with that. Then interest from saving bank of 11,500. From that you can claim 80 TTA. Assessee does not offer 115 BAC. He is going for old regime. Therefore, 10,000 you can claim as a deduction under 80 TTA also. Okay. Now, after doing all those things, you have to compute the tax normally, and whatever the tax comes, that comes to 3 lakh, that is 4,14,302, and that 4,14,302 divided by the total income, you will get the average rate in India. Now, I want to compute the average rate in foreign country. What is the average rate in foreign country which he has paid? He is paying tax only on one income in foreign country, and that is house property income. That is on this $25,000. But is he really paying tax on $25,000? The answer is no. He is paying 20% tax definitely on after taking a basic exemption limit of 8,000 in that country. Therefore, he is paying 25,000. He is paying 20% tax on $25,000 minus $8,000. Therefore, he is paying tax on $17,000 20%. That is, he is paying $3,400 as a tax. Therefore, what is the average rate in foreign country? salary, it is $3,400 divided by $25,000. That is 13.6% is the average rate in India. Therefore, what will be the relief given to him? It will be the average rate in India, average rate in foreign country, whichever is less, that will be allowed on his house property income, which is doubly taxed income. Okay, I hope it is clear to all of you. So it's a beautiful question. You can go through it once. It can repeat in the examination also. The next question is based on TDS. The next three questions is based on TDS or either TCS. Question number 1, 4A subpart 1. There is a Mr. Person, Mr. Rajat, 79 years age. He is retired resident. He is earning some income from saving bank interest, FD interest, and he is also earning some pension. Now for him, section 194P will be applicable. Do you remember? If there is an individual who is resident, who is 75 years or more, and he is earning income from what? Interest or on bank, and also pension from the same bank, then he is not liable to file the return if the bank has deducted the TDS. Okay. So for this, the bank will compute the income. 75,100 saving bank interest. 55,000 into 12 minus 50,000 standard deduction. He is following old regime. So in the old regime, new regime, in both the regimes, standard deduction is allowed now. And 1,20,000 FD interest. From that, he will claim 80 TTB because he is following old regime. He will get 80 TTB. Whatever is the tax, that will be deducted by the bank. And then Mr. Rajat is not liable to file what? The income tax return. The next question is on 194 IC. Do you remember that? If we give our property to any builder and the builder redevelops the property on that and gives us some money, so builder is giving us two things. He is giving us cash portion and he is also giving us some extra immovable property, new flats in the new building. Therefore, whatever cash portion he is giving me, whatever money portion he is giving me, he will deduct TDS under 194 IC. So in this question, he is giving me a consideration of 6 crore rupees in cash, in money portion. So that will be subject to 10% TDS under 194 IC if I am a resident. If I am a non-resident, then 194 IC is not applicable. Okay. The next question is a beautiful question. Mrs. Aryan is a domestic company whose last year turnover is more than 10 crore rupees. Now, Mr. Aryan has purchased goods of 85 lakhs. Therefore, Mr. Aryan is definitely liable to deduct TDS under 194Q. Why? Because Mr. Aryan is a buyer whose business turnover of last year is greater than 10 crore rupees and is purchasing more than 50 lakh rupees goods. Therefore, Mr. Aryan is liable to, Aryan Limited is liable to deduct TDS under 194Q in excess of 50 lakh rupees. Now listen carefully. First purchase is made on 25th of May. So on 30 lakhs, no TDS because it is not exceeding 50 lakhs. Next purchase is made on 28th of June. On 25 lakhs, he will deduct TDS on 5 lakh rupees 0.1%. Okay. Only on 5 lakh rupees 0.1% TDS will be deducted because 5 lakh is exceeding 50 lakh rupees. Next purchase is made in December 2022. 20 lakh rupees you will deduct because already 50 lakh threshold is crossed. 20 lakh rupees you will deduct TDS at the rate of 0.1%. Okay. I hope it is clear. Now, out of this 20 lakh, you have returned 5 lakh rupees goods because you did not like the product. So you returned back and you took the refund. Now what happens? Now there is a CBDT circular which says that if you have deducted the TDS and then you return the goods and you take the refund, then whatever refund you have taken on that much amount TDS, you can adjust against the same seller on the next purchase. Okay. So next time when you purchase of any amount more than 5 lakh rupees, you are not supposed to deduct TDS on 5 lakh rupees. So next purchase I am making in Feb 2023 of 10 lakh rupees. So at that time, I will deduct TDS only on 5 lakh rupees, 0.1%. I hope it is clear to all of you. And the fourth and the last question is state, there are two transactions in this fourth question. State government of Telangana is leasing some coal mine to XYZ Company Limited. So if any person leases a coal mine or a parking lot, etc., there are some 3-4 points. Then the person who leases is liable to collect TCS at the rate of 2% under section 206C subsection 1C. So I am leasing a coal mine. I am supposed to collect TCS at the rate of 2%. Okay. Now this message XYZ is selling a coal. So if a person is selling a coal, then that person is liable to collect TCS at the rate of 1% under section 206C subsection 1. Okay. I hope it is clear to all of you. So there are two transactions in this particular question. Next question is a question on equalization levy. Equalization levy, there is a Shine INC, which is a foreign company, and this company does not have a permanent establishment in India, and this company is providing some online advertisements in India, and we are making the payment of more than 1 lakh rupees. Therefore, equalization levy of 2016 will be applicable in this case. Now, in this case, we are making the payment of advertisement on 15th of March, and we have deducted the equalization levy on 15th of March. So if we have deducted the equalization on 15th of March, what is our duty? Our duty is to pay by 7th of April. Now, if we are not paying by 7th of April, then there will be an interest at the rate of 1% per month or part thereof. We are paying on 15th of April. Therefore, there will be an interest of 1% for 1 month. Okay. Now, how much is the equalization levy? On 5 lakhs, 6% will come to 30,000. 30,000 is the equalization levy. On that 1% interest will be charged at the rate of 1%. 1 month, it will come to 300 rupees. I have to pay as an interest. Will there be any penalty? Yes, there can be also penalty imposed by the assessing officer for not paying the equalization levy on time. Can I get some waiver from that penalty? Under what circumstances penalty cannot be imposed? It's a very simple line. If you prove to the AO that there was a reasonable cause for delay, then the AO will not impose the penalty. Otherwise, he will impose the penalty. Last but not least, if AO imposes the penalty, then what is the remedy with you? Then what is the remedy with you? You have to go and appeal to CIT appeal within 30 days from the date of receipt of an order. Okay. I hope it is clear to all of you. One last question over here in this paper, you need to identify this in these 4 cases, whether it is tax planning, tax management or tax evasion. In first case, you are purchasing some Sukanya Samriddhi scheme to reduce your scheme. It is allowed as per ATC. Therefore, it is tax planning. Okay. In second case, you are taking from customers some form number 60 because the customers are not giving the PAN. They do not have a PAN. So instead of PAN, if the other person does not have a PAN, you have to take what? Form 60. So it is a tax management case. Okay. You are managing your tax in a proper manner. Third case, you have bought a refrigerator which is kept at home, but you are claiming depreciation on that by showing it in office. It's a clear case of tax evasion. Therefore, it is a tax evasion. Okay. Next, you are paying some 4 lakh rupees salary to your wife, but you are deliberately increasing the salary to 5 lakh rupees so that the company should get more deduction. And the wife is anyways exempt up to 5 lakh rupees because you are increasing from 4 lakh to 5 lakhs. Company will get 1 lakh extra deduction. But anyways, wife is exempt from tax. Therefore, this is a tax evasion case. Therefore, this will be called as tax evasion. And the last question over here is a theory question. You can go through it. Nothing great as said, not important also. That's why I'm not reading that. Okay. So this is what this paper is all about. So let's go ahead with the next paper, that is November 2022. Now we need to solve this question. Normally we are not supposed to follow any 115 BAA or something like that. A normal question, we have to compute the total income of the assessee. Now one very important thing in this question is the assessee is a company in which public are not substantially interested. It means it is a closely held company. And remember, whenever there is a closely held company, there are certain important provisions which can be applicable in the exam. That is section 79, that is section 5627B and section 68. These are the 3 very important sections which are applicable to closely held company only. And some of them are there in this question also. Now, the very first thing, the assessee is a manufacturing assessee. So accordingly, you have to need to answer the question. One-time license is paid for 12 lakh rupees. Now, what is the treatment that we generally give for this? You have to add back this license because this is an intangible asset. So add 12 lakhs and take 25% intangible asset depreciation under section 32. But unfortunately, in this question, ICI has taken 2 views. One is the view which I have told you. The second view which ICI has taken that you add 12 lakh rupees, but do not reduce 25%. They are assuming that the depreciation which they are giving to us over here of 14,50,000 rupees, that already includes what? That already includes the amount of what? Depreciation on the intangible asset. But this treatment was not given by ICI in the earlier questions. So you can do any of the 2, whatever ICI has done in this question. In this question also ICI has taken both the views. So you can take accordingly both the views. Okay. Then you are incurring some expenses for issue of convertible debenture, that is allowed as reduction. Convertible debenture does not amount to permanent capital base in the company. Therefore, the expenditure incurred to issue convertible debentures are revenue in nature. You can claim that expenditure. Okay. The next one is a very intelligent adjustment, very new adjustment. Pay attention, please. You are paying some money to share broker for purchasing some shares and some money to commodity broker for purchasing some commodity. And in both the transactions, you have not deducted the TDS. Now, in this case, the ICI has taken 2 views. The first view is the ICI has taken the first view as the assessee is a trader in share or trader in commodity. If the assessee is a trader in share and trader in commodity, then the deduction will be available under PGBP. But deduction will be available when? In case of shares, there is no need to deduct TDS. Go and see section 194H. It is very clearly written. In case of share broking, you don't have to deduct TDS. But in case of commodity broking, you have to deduct TDS. So therefore, in case of share broking, because you are not deducting TDS, your expenditure will be disallowed to the extent of, in case of share broking, no disallowance, because in share broking, there is no need to deduct TDS. But in case of commodity broking, there is a need to deduct TDS. Therefore, you need to disallow 30% of that. The second view which ICI has taken is they are not dealer in share, they are not dealer in commodity. If they are not dealer in share, not dealer in commodity, then the question of deduction does not arise. Both the cases, it will be disallowed. Okay. Next one is a very simple adjustment, but an important one. The company is paying 15% of the basic salary to the pension account, which is allowed as deduction under section 36(1)(4)(a). But how much is allowed as reduction? Only 10% of the salary and basic salary and DA in terms. Only 10% of basic salary and DA in terms is allowed as deduction. But how much is company contributing? Company is contributing 15% of the basic salary. Now, what is the basic salary of the employee? It is 6 lakh rupees. What will be 15% of that? 90,000. So company is contributing 90,000 rupees. But out of that, how much will be allowed? Only 10% of basic and DA in terms. Now, the basic is 6 lakh rupees. What is DA? DA is 30%. So 30% of 6 lakhs will come to 1,80,000. Out of that, only 50% is DA in terms. So therefore, out of 1,80,000, only 90,000 is DA in terms. Therefore, basic plus DA in terms is how much? 6 lakhs plus 90,000, 6,90,000. The deduction is allowed 10% of 6,90,000. Therefore, deduction will be 10% of 6,90,000. That is 69,000. How much you have actually paid? Actually, 90,000 you have paid. Therefore, 21,000 will be disallowed under the income tax law. Okay. Next one, you are making some payment of 7 lakh rupees to as a freebie to medical practitioner. That is disallowed as per explanation 1 to section 37(1). Explanation 1 to 37(1) clearly says that any freebie to medical practitioners will be disallowed under the income tax law. Next, you are incurring some expenses on feasibility study for enhancing your existing business, but the project was abandoned unfortunately. So because the project is abandoned, there is no asset created. Therefore, this expense will be allowed as a revenue expense. Don't worry about it. Depreciation will be disallowed. Next is employees provident fund has to be paid by 15th of the following month. You are paying on 17th of May. Therefore, it is disallowed. Employer contribution can be paid up to the due date of filing of return. You are paying before the due date of filing of return. Therefore, it is allowed under the income tax law. Donation to Swachh Bharat Abhiyan allowed. Here you have to, in PGBP you have to add back. In chapter 6 you can claim, but you have to write a note that it is other than cash, because in cash if you pay more than 2,000, then deduction under 80G is not allowed. Industrial tariff concession you are receiving from central government. Any kind of concession received from central government is an income under section 224(18). If you remember, we have done it in PGBP. Next one, you have made a mistake of including interest and borrowing cost in opening and closing stock. So rectify that mistake. In opening stock, you are including the interest of 6,85,000. So you have to add back that much opening stock in the P&L account, and in closing stock, you are including 5,65,000 as interest. So you have to reduce that from the P&L account, that much interest. Okay, I hope it is clear to all of you. Next adjustment, you have purchased some warehouse for agriculture purpose, that is for storage of sugar. Now this is covered under 3580, and 10 lakh is your profit from that. How much is the capital expenditure that you have incurred? That is given in the last point. 35 lakhs is the capital expenditure you have incurred, out of which 10 lakh, 20 lakh is land. Therefore, land will not be allowed. Therefore, 35 lakhs, land exclude. Therefore, only 15 lakhs will be allowed as deduction under 3580. What is your income under 3580? 10 lakhs. What is your expenditure under 3580? 15 lakhs. Therefore, 5 lakh rupees loss. It cannot be set off against other profits. It can set off only against PGBP. It can set off only against 3580 income. It cannot be set off against other incomes. Okay. Next adjustments are some additional information. You are receiving some 14 lakh rupees as GST from the customer, and then you have remitted that GST to the government. So therefore, receive 14 lakhs, paid 14 lakhs, knocked off. It is allowed as a reduction. Then you file an appeal to the court, and the court gave you refund of 5 lakh rupees. So the court gave you refund, and you refunded back to the customer only 3 lakh rupees. So you received 5 lakh from the government, and you repaid only 3 lakhs. Therefore, 2 lakhs should be added to the P&L account as an income. Whenever it will be paid, it will be allowed as reduction. Okay. Next one is a very important adjustment. Now this is the target of this question 5627B, because this company is a closely held company. So for a closely held company, section 5627B is applicable, angel taxation, if you remember. So in 5627B, you cannot raise money more than the fair market value of the share. The fair market value of the share is 19. You are raising the price, you're raising the fund at 22. Therefore, the differential amount will be considered as income from other source. 3 rupees is income from other source into 2 lakh shares. Therefore, 6 lakh rupees should be added to the income from other source. Similarly, the next point is about section 79. What does section 79 says? That is the year in which you incur loss, and the year in which you want to set off the loss, at least 51% of the shareholders have to be same. And section 79 is also applicable only to what? Only to a closely held company. So in this case, in the year 2021-22, when the loss was incurred, 55% shares were held by Mr. X, and in the year in which you want to set off, it is sold to Mr. Y. Therefore, 51% of the shareholders are not same. Therefore, this loss cannot be carried forward and set off. And the last is 14,50,000. You will claim as a depreciation. Okay, under the income tax law. After that, the tax rate over here will be what? The tax rate over here will be. They have not asked the tax rate, so don't compute the tax rate. That's it. Okay. Let's move on to the next question. Question number 2 over here. This question is on LLP, and there are a lot of things over here. Whenever there is a question on LLP or partnership firm, you need to always be careful about what? You need to always be careful about the book profit first of all. You need to compute the book profit, and then the remuneration, and then the total income, and then the tax liability, and then the adjusted total income as per AMT, if there are 10AA, etc. in this particular question. In this question, there is 10AA also. So therefore, there are a lot of things which we need to compute over here. We need to compute the income tax. We need to compute the AMT. Lot of things have to be computed. We will compute all of them one by one. First of all, we will compute the book profit. How to compute book profit? Book profit is nothing but PGBP only. PGBP, add remuneration. Whatever comes in PGBP, add remuneration, that will give you book profit. Therefore, the net profit as per PNL is 65 lakh. The very first thing is profit from sale of import entitlement license. Yes, it is a part of book profit. It is covered in section 28. Whatever comes from section 28 to 44 will be part of book profit. Okay. Next one, you are giving some remuneration to working partner. You have to add back to the profit to get the book profit. Okay. Next, you are giving 16% interest to partners. Therefore, 4% will be disallowed under the income tax law. Next one, donation to political party. That is covered under section 80. Therefore, this will be disallowed while computing computing the book profit. Next one is depreciation. Therefore, it will be disallowed, and the account taxation depreciation will be allowed to the extent of 26 lakh rupees. Okay. Next one. Will you reduce the brought forward loss to compute book profit? No. Brought forward losses are not covered under section 28 to 43. It is covered under section 70 to 80. Therefore, brought forward loss will not be adjusted now. It will be adjusted later while computing the total income. Will you adjust the unabsorbed depreciation? The answer is yes. Once I do this, I have done all the adjustments, and now I will get the book profit as 87 lakh rupees. On 87 lakhs, how to compute the book, how to compute the remuneration? On first 3 lakhs, 90%, and on the balance 84 lakhs, it is 60%. Answer comes to 53 lakh 10,000. My actual remuneration in the question is 58 lakh. Therefore, I will be getting the deduction of only 53 lakh 10,000 rupees. 33 lakh 90,000 will be my profit, and after this profit, I will reduce what? My losses. My losses, brought forward losses of 4 lakh rupees, I will reduce after this. And after this, there is one 10AA deduction that I need to take care of it. Okay. Now, what is 10AA? How to compute 10AA? It is profit from export into export turnover divided by total turnover. Now, for taking the profit, what is the profit? The profit over here is 29 lakh 90,000 rupees is my profit. But ICI has taken two view. In one case, ICI has taken the profit as 33 lakh 90,000, which is before setting of loss, and in another case, ICI has taken the profit as 29 lakh 90,000, which is after setting of the loss. Both the answers are correct. Whatever you want to do, the answers will differ, but both the answers are correct. Don't worry about it. Okay. Now, what is export turnover? What comes in export turnover? The total export turnover is 45 lakh rupees. Okay, 45 crore rupees. Out of it, only 38 crore is received in India. So remember, in export turnover, you only take that much turnover which is received in India within 6 months. If it is not received in India in convertible foreign exchange within 6 months, you do not take that turnover in the export turnover. Therefore, only 38 crore will come. Out of 38 crore also, 2 crore is your telecommunication charges. So, export turnover has to be an FOB price. It cannot be CIF price. Do not include insurance, freight and other charges in the export turnover. Only the FOB price has to be there. Only cost has to be there. Therefore, 38 crore is received in India. Out of that, 2 crore is telecommunication charges. Therefore, export turnover is 36 crore. What is the total turnover? Total turnover is 45 crore. Out of which only reduce what? The charges. Even total turnover is your FOB price. It is not a CIF price. So in total turnover, there is 5 crore rupees of what? Telecommunication charges. So remove that. So therefore, total turnover will come to 40 crore. Therefore, profit into 36 crore divided by 40 crore will give you what? Will give you the deduction over here. And profit has to be two profits. One is before loss, one is after loss. Both the answers are correct. After that, you need to compute the deduction under 80 GGC. 80 GGC, why sir? Because you are giving donation to political party. That is allowed as deduction under 80 GGC. And after that, you will compute the tax liability. The tax liability of the firm is 30%. Now you will compute what? AMT. For computing AMT, you need to compute the adjusted total income. What is adjusted total income? It is nothing but your total income. That is 4,49,000 rupees. And then you have to add what? Add the deduction claimed under 10AA. Whatever is the deduction claimed under 10AA, that you will add back. After that, you will apply 18.5% tax, 4% cess, no surcharge, because adjusted total income does not exceed 51 crore rupees. Otherwise, you would have applied surcharge also of 12%. In this case, no surcharge. After that, you will compare with your original tax. Whichever is higher will be paid. And if the AMT is higher, then you will also get AMT credit over here. Okay. So this is how this question will be solved. It's a beautiful question. Let's move ahead with the third question. The third question is on a trust question. There is a trust which is engaged in promotion of yoga. Is an associate engaged in promotion of yoga eligible for charitable purpose? Yes, an associate engaged in promotion of yoga is a charitable purpose as per section 215. Now, this trust has received a donation of 125 lakhs as a corpus donation, and they have invested that in Blend and Blend Private Limited Company shares. Can you get the exemption? The answer is no. You have to. If a trust want exemption of corpus donation, they have to invest in the mode specified in 11.5. And 11.5 does not include shares of private company. Therefore, it will be taxable. The second trust, the second case, they have received 125 lakhs, 95 lakhs from voluntary donation, 60 lakhs from one, some providing fees. So this is normal income and you can take 15% exemption out of it. There is no harm in that. Okay. The next question is very critical. Pay attention, please, all of you. There is a founder of a trust. Mr. Nagaraj, who is running a charitable trust. That is, he is running an hospital, and in his hospital, his son was admitted. His son was admitted due to COVID, and therefore he paid what? Only 3 lakh rupees against 5 lakh rupees. So he is giving benefit to his son. How much benefit? 2 lakh rupees. To other people, they charge 5 lakh. To trustee's son, they are charging only 3 lakh rupees. This is wrong. The trustee's son, that is relative of trustee, comes under the specified person under section 13 subsection 3. The answer of this question in the solution is slightly wrong, because it is as per the old provision. As per the new provision, multiple provisions will apply now, because the trust is providing undue advantage to the relative of the specified person. Therefore, the trust will be liable for a penalty under 271 AAE. 100% of the benefit provided in case of first mistake, in case of subsequent mistake, 200% of the benefit provided. Similarly, the trust will also be liable for tax at the rate of 30% under 115 BBI, and even the receiver of the gift, the receiver will be liable for gift taxation to the extent of 2 lakh rupees. That is the son's, that is the trust relative, that is the trustee's son will be liable to pay tax on 2 lakh rupees under income from other source. I hope it is clear to all of you. Now the next question is again a beautiful question. There is a person, Mr. Ritesh. He is an individual, he is a resident, and his age is 42 years. Now he is earning income from multiple countries. He is earning income first of all from business in India. So 4,85,000 you will write in the income statement. Then he is earning royalty of 7,80,000 rupees from country N, and it says written in the DTAA between India and country N that this will be taxable in the source country. It means it will be taxable in country N. Therefore this 7,80,000 will not be written in the income statement. So don't write in the income statement because this royalty is taxable in the source country and the source country is country N. Therefore it is not taxable in India. Similarly, interest from country Y he is earning $9,500. Now this interest from country Y is taxable in both the country as per DTAA between India and country Y. It is written that it is taxable in both the states, that is, and India will give the credit on that particular amount on doubly taxed income. Whatever is the doubly taxed income, on that much amount India will give the credit. Now this is the most important part of this question. First of all, this is taxable in India, this is taxable in country Y also, and India will give DTAA relief because he is a resident of India. Now $9,500 he is earning. How will I convert that into rupees? You have to convert that into rupees as per rule 115. When you want to convert a foreign income into Indian income, you need to convert as per rule 115. Now it is not clear which interest it is. It is normal interest or it is interest on security. We are assuming it to be other than interest on security, because in case of interest on security, you have to take the TTBR of the preceding month. In case of other than interest of security, you have to take TTBR of the last day of the financial year. So we are assuming this interest to be, because it is not clear which interest it is, we are assuming this interest to be other than interest on security. So I am taking TTBR as on the last day of the financial year, that is 80 rupees, 31st March 2024. This will be my income. Okay. Now, what is the next income? Agriculture income in country M. So in country M it is exempt, but in India it is not exempt. So in country M it might not be taxed, but in India we have to tax 1,09,000 rupees. It will be added to the income statement in India. Now after that, very simple, 4,85,000 PGBP income, royalty will not come because it is taxable in the source country, not in India. Interest will come as per 9,500 into TTBR also on 31st March, and 1,09,000 agriculture income taxable in India, exempt in country M. Okay. After that, you compute tax as per normal provision. That is whatever is the old regime. We are following old regime over here to follow as per the old regime. Okay. Now that is coming to 2,27,448. Now we need to give him relief. Relief under which section? Relief under section 90. Why 90? Because there is a DTAA between India and the other country. Now, will we get relief in case of royalty? In case of royalty, there is no double taxation. So why relief will be there? Royalty is only taxable in the source country. Therefore, no relief. Will we get relief in case of agriculture income? In case of agriculture income also, there is no double taxation. Only taxable in India, not taxable in foreign country. Therefore, no relief. Will we get relief in case of country by interest? Yes. In that case, we are going to get relief. Now, how much tax we have paid in foreign country and how much tax we have paid in India? Whichever is lower, that will be allowed as a relief. Okay. Now, how much tax we have paid in foreign country? Let's try to find out that. $9,500 is our income and $950 we have paid as a tax. Now, on which date we have paid the tax? On 21st of February 2024, we have paid the tax. So now we need to convert that into INR. Now, how to convert the foreign tax into INR for claiming FTC? You have to take TTBR of the last day of the preceding month. Now, what is the TTBR of the last day of the preceding month? It is 78. $950 into 78, 74,100 rupees will be the tax which is paid in the foreign country. Now, how much is the average tax paid in the Indian country? For that, we need to find out average rate in India. The tax paid in India is 2,27,448 and the total income is 13,54,000. Therefore, the average tax paid in India is 16.7498%. Okay. Now, listen carefully. And what is the tax paid in foreign country? 74,100. Therefore, how much is the doubly taxed income? The doubly taxed income is only this income, 7,60,000. So, on this doubly taxed income, if I apply the Indian average rate, it is coming to 1,27,000. Therefore, 1,27,000 is the tax paid on that doubly taxed income in India, and 74,100 is the tax paid on that doubly taxed income in foreign country. Therefore, whichever is lower will be allowed as relief, and therefore 74,100 will be allowed as relief under section 90. I hope it is clear to all of you. It's a beautiful question. Let's move ahead with the next question, which is a question on TDS. Next question is, the SSC has imported some computer software for reselling it to the end user. Remember, when you purchase some computer software for end use or for reselling it, it is not a royalty, because as per Supreme Court, in the case of Analysis Engineering Excellence Private Limited, it is not royalty. When you purchase the computer software for reselling it or for end use of it, it is not a royalty, and because it is not a royalty, then TDS is also not applicable in this particular case. Second case, a public sector company is paying some 20 crore rupees to an organization for providing some services with respect to ATM network to the bank as a commission. whether TDS will be deducted under 194H or 194J. First of all, 194H is not applicable. When we went to the facts and circumstance of this case, we come to know that both of them, that the bank and the organizations are working on a principal basis. They are not working on a principal agent basis. Both of them are working on a principal basis. Therefore, 194H is not applicable. Now, whether 194J will be applicable, 194J is applicable in case of professional services, whereas where there has to be some kind of manual or human intervention, the court said that there is no manual and human intervention between both of them. Therefore, it cannot be deducted under 194J also. Okay. The next question is also a beautiful question. I am PQR Limited, you are Mr. A. Okay. I am PQR Limited, you are Mr. A, and there is my related party Fashion Limited over here. Okay. Now, I have told you that I want some shirts from you. Okay. So, you asked me from where will I get the cloth? I said that Fashion Limited, my related party will provide you the shirt, and then you will stitch the shirt and give it to me. Whether I am liable to deduct the TDS or not, the answer is yes. The law says under 194C, if the material is provided by the assessee or the related party, then the TDS has to be deducted by me. Now, on how much amount TDS should be deducted, that depends upon how the invoice is formed by you. If you form a consolidated invoice of labor and material both together, then I will deduct TDS on the entire amount. But if you give the breakup, then I will deduct TDS only on the service portion. But unfortunately, you have given a consolidated invoice. Therefore, I will deduct TDS on the entire amount over here of entire 40 lakh rupees. I hope it is clear to all of you. And the last one is a very simple question on TDS. There is a foreign, there is a non-resident and a Canadian citizen, a sportsman who is coming to India for playing some matches. That will be taxable under 115 BBA. TDS will be deducted under 194E at 20% plus 4% cess. Plus, he is also contributing some article in a sports magazine. That is also taxable at 20% plus 4% cess. I hope it is clear to all of you. Now, the next question is also a beautiful question of transfer pricing, which is on cost plus method. Now, what happens in cost plus method? The step number 1 in cost plus method is when you provide services to your associate enterprise, what is your direct and indirect cost? And then you have to find out the arm's length margin. Whatever is the arm's length margin that you will apply on what? Apply on your cost, and then you will get the arm's length price. Now, first of all, let us try to understand the relationship between different people over here. MNO Limited is in India and MNO INC is a subsidiary company. Therefore, both of them are what? Associate enterprise. There is also another company, HTY Limited, which is a third party, okay, with whom we are going to compare the transactions. I hope it is clear to all of you. Now, the billing per month to MNO is $85,000 and billing per month to third party is $92,000. And the cost is given in point number 4 and point number 5. First of all, step number 1. What is the cost to associate enterprise? The cost to associate enterprise is very simple. We provide services at the rate of the direct cost is $120 and indirect cost is $210 per hour. Okay? Per hour it is $120 and $210 per hour. Now, MNO provides services to MNC. MNO provide to MNO INC for 9 hours per day for 18 days. So $330 is the total cost. Direct and indirect cost 220 plus 120 into 9 hours per day. We provide services to whom? MNO INC, to our associate enterprise, and we provide that for 18 days. Therefore, our cost is 53,460. This is how I will determine my cost. Okay. Now I need to find out the arm's length margin. For that, I want the cost and the sales and the profit of HTY Limited. So for HTY, you provide services for 18 days, but only 8 hours. Okay. You provide services for 18 days for only 8 hours. So I'm finding the GP margin of HTY. For HTY, the direct cost is 120 into 8 into 18 days. Indirect cost is 210 into 8 into 18 days. This is my total cost. Okay. But unfortunately, this is not my total cost. There is one more cost when I provide services to HTY. That is, I provide warranty of 2 years to HTY. Okay. I provide warranty of 2 years to HTY, which amounts to 1.5% of the direct cost. Will I not include that also in my cost? Definitely, I will include that also in my cost. So, I am providing the warranty, which is 1.5% of my direct cost. Therefore, that also I will add to my cost. That will make my cost 47,779.20. This is my total cost. Okay. When I provide services to HTY, what is my billing to HTY? My billings to HTY is 92,000. Therefore, this is my profit. Therefore, my arm's length margin to HTY. When I provide services to HTY, my margin is 92.55%. Now coming to my cost. Is my cost 53,460? No. I have one additional cost. What is that additional cost? I take a loan from MNO. When I take a loan from MNO, I have to pay interest to MNO. How much loan I have taken? $1,20,000 I have taken into 4% into 1 by 12. 1 by 12, why sir? Every data over here is monthly. Therefore, I am taking 1 by 12. Therefore, my total cost is how much? My total cost is not 53,460. This is my direct and indirect cost. Apart from that, I am also taking loan from MNO INC. That is also my additional cost. So that I have to add. Once I add that, I will get my total cost. And then I will apply this arm's length margin to my cost, and then I will get the arm's length price over here. I hope it is clear to all of you. Now let's move on to the next question. The next question is on case law. The first question over here is on Pepsi Foods Limited case law, which is on the power of tribunal. Remember, but when a tribunal passes an order, what is the time limit to pass an order by a tribunal? It is generally 4 years from the end of the financial year in which the order was received, in which the appeal was filed. Okay, tribunal has to file the pass an order within 4 years. But in some cases, tribunal has to pass the order within 180 days. When the assessee has asked for a stay, if the assessee has asked for a stay, then the tribunal should pass an order within 180 days. Can it be extended beyond 180 days? Now listen carefully. Yes, it can be extended beyond 180 days up to 365 days if there is a mistake of tribunal. If there is a mistake of tribunal, it can be extended. If there is a mistake of assessee, it cannot be extended. If the delay is because of tribunal, then the tribunal has to extend. What about after 365 days? After 365 days, income tax law says that it cannot be extended because of anybody's reason. Even if it is assessee's mistake or tribunal mistake, if the delay is attributable to assessee or if the delay is attributable to the tribunal, it cannot be extended beyond 365 days. Here came the Supreme Court of India in the case of Pepsi Foods India Limited. The Pepsi Foods India Limited Supreme Court said that no. Even after 365, if the delay is attributable to the tribunal has to extend the time period and has to extend the stay, has to extend the appeal period. Okay, this is what this case law wants to say. Ultimately, this case law wants to say the tribunal has to extend the period beyond 365 days if it is because of their mistake. Okay, next one, the assessee search was happened on assessee's premises on 31st of December. His business premise was searched, his residential premise was searched, and some gold bar was seized by the income tax department. Okay, now generally there is a proviso under section 132B which says that if the department has seized anything in search and seizure, then you have to go to the department within 30 days from the end of the month in which the search was done. So within 30 days of the end of the month in which the search was done, you can go to the department, you can explain the nature and the source of the particular gold which is seized, and then the department will do what? Department will reduce their existing tax liability and will give you the balance amount. Okay, now that 30 days period is gone. After that, few months after that, the assessee is going to department and saying that I am telling you my rough tax liability, this much will be my rough tax liability, this much will be my estimated tax liability, and take that much the gold from that and give me the remaining gold. Will the department do that? And the answer is no. Now the department will not do anything till the time the assessment is not completed. Once the assessment is completed, they will determine the tax liability, they will recover from the gold, and balance they will give you. They will not give you anything before that. You had a time of 30 days from the end of the month in which the search was conducted. That is gone now. Now you cannot come voluntarily in between and determine your tax liability. Estimated tax liability will come to this much. You have to wait for the final order to pass. Okay, I hope it is clear to all of you. The next question, you need to identify whether the following statements are correct or not. There is a person, Mr. Ricky, a resident. It is aggrieved by the order of the board for advance ruling. Now, if you are aggrieved by the board for advance ruling order, what is the remedy available with you? You have to appeal to High Court within 60 days on the date of receipt of the order. So whenever you receive the order, within 60 days on the date of that day, you have to go to appeal to the High Court, and the High Court might give you some kind of relief. Second question over here is, there is an Indian public sector company, whose matter is already pending before ITAT. They want to ask whether they can go for board for advance ruling or not. Now, generally, if the matter is pending in front of any authority, you cannot go for board for advance ruling. But for public sector company, there is a relaxation that if their matter is pending before ITAT or income tax authority, then also they can go for what? Board for advance ruling. If that matter is pending in front of ITAT and income tax authority, they can go for board for advance ruling. But if that matter is pending before High Court and Supreme Court, they cannot go for board for advance ruling. The next question is a very simple question of 2020 equalization levy. There is a non-resident, count the conditions with me. There is a non-resident who does not have a P in India. The turnover of that non-resident from India is more than or equal to 2 crore rupees, and that non-resident is providing online some services, online shopping services. Therefore, 2020 equalization levy is applicable. Why it is applicable? Because the goods are sold to residents in India or goods are sold to person residents in India. Those are covered, and the total turnover is also 2 crore or more than that. Therefore, 2020 equalization levy is applicable. It's a very simple question of equalization levy. We have done much better question than this earlier. Okay. Now, there are 4 parts over here which ask us the following question: whether GAR will be applicable in these cases or not. First of all, an Indian company is making losses, therefore it gets amalgamated with another company. Whether GAR will apply? Why GAR will apply? It is a tax planning. If there are losses, you are getting amalgamated with another company to transfer the losses. It is allowed. It is allowed as per court also. It is allowed as per the income tax law also. Therefore, GAR will not apply. Okay. In second case, you have to make one change. You have to just change this to 2016 rather than 2018. Okay. Otherwise, the entire answer will change. The assessee has purchased some shares of a company listed since 2016. Okay. Then there are some mistakes which are done by assessee trying to do some manipulation in the law, and therefore whether GAR will apply or not, GAR will not apply. The simple logic over here is GAR is applicable only if the transaction is entered on or after 1st April 2017. Any transaction entered before 1st April 2017, GAR will not be applicable in that case. Therefore, in this case, GAR is not applicable. Okay. In third case, a company is there in India. It deliberately forms a subsidiary company in country B, and then through that, it gives loan to what? C Limited. Rather than directly giving loan to C Limited,
A can directly give loan to C Limited in India, but they are making one subsidiary in company B, country B, and that country B is giving loan to a C Limited. This is the proper case of GAR. You are trying to avoid tax by playing with the words of the law. Therefore, GAR will apply in this case. In fourth case, very simple. You are setting up a unit in SEZ, therefore to claim 100% deduction. Therefore, GAR will not apply. It is a case of tax planning. In case of tax planning, GAR will not apply under the income tax law. Okay. And one last question over here is who can be called as an agent of a non-resident in India? Who can be called as an agent of a non-resident in India? For that, let's see the provision of section 163. 163 says that if a non-resident has employed any person in India, any person is employed in India on behalf of non-resident in the current year, then that person can be agent. Or if non-resident sells any asset to another resident or non-resident in India. So if non-resident sells any assets to any resident in India or sells any assets to any non-resident in India, then it can be called as an agent of non-resident. Okay. In first case, Mr. Albert is a non-resident. Now, Mr. Albert has a house in Goa. Now, during the financial year, he has sold that house to another non-resident, Mr. D'Souza. Whether Mr. D'Souza can be called as his agent? The answer is yes. If a non-resident sells transfer capital asset to another non-resident in India, then it can be called as what? That purchaser will be called as an agent of that non-resident. Okay. Second, Mr. Albert has employed Mr. Rakesh in 2022. But in 2023, Rakesh left the company and went away. Whether Rakesh can be called as an agent of Mr. Albert? The answer is no. Because Rakesh is not an employee of Albert in the current year. If he would have been employee of Rakesh, if Rakesh would have been employee of Albert in the current year, then he could have been called as what? As an agent of Mr. Albert. In this case, it is not called because he has left the company. So this is what this paper is all about.
So let us start with the first question of May 2023 paper. It's a long paper. It will take some time to discuss this paper, but nevertheless, we'll try to complete as fast as possible. First of all, the question number 1 is on total income. The SSC is a manufacturer, and therefore we need to see if 115BAA or BAB is applicable. No, we are not supposed to follow 115BAA and BAB. You are supposed to just compute total income as per the normal provision. Okay. Therefore, the very first adjustment is you are paying some excess amount to your sister concern, and the fair market value is only 52,000, but you are paying 1,60,000 in cash. So you are doing violation of 48(2) also, and you are doing violation of 48(3) also. So first of all, I have also always told you this in class that if the provisions of 48(2) as well as 48(3), both of them are violated, then you have to apply first 48(2). Therefore, apply 48(2) and disallow the excess amount, and then apply 48(3) and disallow what? The excess amount of, if the balance amount is more than 10,000 rupees. Okay. So first of all, disallow 48(2), and then if the balance is more than 10,000, you have to disallow 48(3). Okay. Next, there are some repairs which you are doing for plant and machinery for replacing the worn out parts of the machinery. So will that be allowed as a revenue expenditure under section 31? Yes, it is allowed as a revenue expenditure because this does not bring any existence of any new asset. If you do such a repair which is leading to a new asset, which brings existence of new asset, then in that case, it is not allowed as a deduction. Okay. Next one, till last year, the company used to include interest as a part of its stock. But from this year onwards, they have changed this particular thing and they have excluded interest from the stock valuation, opening and closing stock. So actually speaking, you should not include interest as a part of your stock. Interest should never form part of the stock. So in the current year, the company is doing the things correctly, and they have given the effect also of that particular thing in the P&L account. So if everything is done correctly, why we have to do anything effect over here? Why will we give any effect over here? Because the company is correcting its mistake in the current year, and they are reflecting that particular thing in the P&L account also. Therefore, there is no need to do anything over here. There is one of the employee of the company, that is one executive of the company, who went on a business trip and he died because of some reason on a business trip. And therefore, the company, as a measure of humanitarian ground, the company is helping his family by paying some voluntary amount to his family. Therefore, that will be allowed as a business expense under section 37(1) because the employee was on business trip. Okay. Next one, there is some capital expenditure of family planning which is incurred by the company. Therefore, capital expenditure of family planning is only allowed 1/5. Therefore, 4/5 will be added back to the PGBP income. Okay. Next one, there is some retrenchment compensation which are paid to some of the employees for closing down of one of the unit of the company. So that is allowed as a PGBP expense under section 37(1). Don't worry about it. Okay. Next one is a very, very intelligent point. There is a cooperative bank. Okay. There is a cooperative bank from whom we have taken some loan. Now, that bank is waiving that loan for me. I have taken that loan for what purpose? You have taken that loan for working capital requirement. So I have taken a loan of 4 lakh rupees from a cooperative bank for working capital requirement. Now bank is waiving that loan. Now this will be deemed income under section 41 subsection 1. Why? Because it is a remission and cessation of a trading liability. Because I am taking the loan for working capital purpose. Therefore it is deemed income. Now apart from that, they are also waiving interest of 1 lakh rupees which is outstanding. Now this will not be taxable. Why? This will not be taxable. Why? Because this 1 lakh rupees, was it allowed as a deduction earlier? The answer is no, because as per 43B, this 1 lakh rupees will be allowed as an expense under PGBP only if it is paid, and this was not paid because it is outstanding. Therefore, When it is waived off, it cannot be taxable, because when it was accrued, it was not allowed as deduction. So when it was waived out, at that time also it should not be taxable. Therefore, you will remove this 1 lakh rupees from your PGBP income. Okay. Next one, you are contributing some, the employer is contributing some amount to the employee's pension scheme. Now that is allowed as a PGBP expense, but only to the extent of 10% of the salary. Salary means basic plus DA in terms. Therefore, here you are paying 12% of the salary. You will not be allowed 12%. You will be only allowed 10%. Therefore, 2% will be disallowed. 2% will come to how much? 50,000 rupees if you make a backward calculation. Next one, mark to market loss is allowed as a reduction provided it is computed as per ICDS. Now ICDS says that if you incur mark to market loss for unsettled derivative contract, it is not allowed. Therefore, because ICDS 1 says that unsettled derivative contract is not allowed as a deduction as per ICDS, therefore this mark to market loss will be disallowed under the income tax law. Next one is a very routine adjustment whereby the actuarial valuation is 4 lakh rupees. So the provision for a gratuity will be added back, and the actual gratuity which is paid to the employee will be allowed as a deduction under PGBP. Next one is also a very simple adjustment. There is a company in which another company has 16% voting rights. That is, one company holds more than or equal to 10% of the voting rights of the other company, and both the companies are closely held company. So if I invest in a closely held company, and if I receive if I receive a loan from that closely held company, then in that case it is deemed dividend under section 222E. But the deemed dividend cannot exceed how much? The accumulated profits. Therefore, even though I am receiving loan of 4 lakh rupees, my deemed dividend cannot exceed how much? 1 lakh. Therefore, deemed dividend will be how much? 1 lakh rupees. Next, I am giving some benefit or perquisites to some of my customers or to some of my distributors, so on and so forth, as a matter of what? Business promotion expenses. Therefore, what I am giving? I am giving some phones. I am giving 5 sets of phone to 5 I am giving phones to 5 different distributors, and each of them costing 60,000 rupees. Therefore, total perquisites and benefit which I am giving is around 3 lakh rupees. Now, on that, I should have deducted TDS under section 194R at the rate of 10%, a very recent amendment. But I have not deducted the TDS as it is written in the question. Therefore, 30% of this 3 lakh rupees will be disallowed under the PGBP for not deducting the TDS. Okay. Last but not least, I am making some payment of what? A donation to certain electoral trust which is made by RTGS, and therefore it will be allowed as a deduction under 80 GGB. You can check it over here. So it was a simple question except 1 or 2 adjustments which was slightly tricky. Apart from that, most of the things were very simple in this question. Now pay attention please. Let's move on to the next question. The next question is also very simple question. Mr. A is aged 34 years. He is a salaried employee. Okay. Now, he is earning a salary of 23 lakhs. So, from that, first of all, he will get 50,000 standard deduction because he is not following 115 BAC. You can check it over here. Now, he has a business loss of 4,50,000 that he cannot set off against this. Therefore, he has to carry forward. He has a capital gain loss of 3,60,000 that also he cannot set off against salary. Therefore, he has to carry forward. Apart from that, he is also selling some bitcoins, or you can say virtual digital asset. Therefore, the selling price of virtual digital asset is 1,300 and the cost of the virtual digital asset is 1,000. So, 300 rupees is the profit multiplied by 1,000 quantity. No deduction of transfer expenses is allowed for virtual digital asset as per section 115. Therefore, here you are not going to get what? Any deduction of what? Virtual digital expenses on transfer. Only cost of acquisition is allowed. Therefore, 1,300 minus 1,300 is directly taxable at 30%. Sir, can I set off these losses against this income? Not allowed, not allowed, not allowed. That is directly taxable at 30%. These losses you cannot set off against salary also. These losses you cannot set off against the Bitcoin income also. Both of them have to be directly paid as a tax. Okay, just check it once. Let's move on to the next question. The next question is on section 9B and section 45.4, both of them combined together. There are 3 partners, L, M and N, and one of the partner, that is L, is retiring on 27th of July, and when he is retiring, his capital account is showing a balance of 20 lakh. There is no revaluation of asset in the books of accounts at any time when the L joined as a partner. Okay. Now, what is L getting on retirement? L is getting some cash payment of 1 lakh, some stock in trade, and then he is also getting some land at quota. Okay. Now, first of all, we'll apply section 9B. When is 9B applicable? 9B is applicable if the firm gives to partner stock in trade, or if the firm gives to partner what? A capital asset. Okay. So, first of all, the firm is giving to partner stock in trade. The stock in trade is how much? The value of the stock in trade is 2 lakh. You have to take the fair market value of the stock in trade, compare with the cost of the stock in trade, which is 1,20,000. Therefore, 80,000 will be what? The PGBP income, which will be subject to 31.2% tax in the hands of the firm. Okay, be very careful. The second thing is, which the firm is giving to the partner as an asset, is a capital asset, land at quota. Now, the FMV of the land, the FMV of the land is 17 lakhs. So you will take that as a sale consideration. Then the cost will be the actual cost or FMV as on 1/4/2001, whichever is higher. Therefore, you will take whichever is higher multiplied by current year indexation divided by 100. That comes to 13,35,900. And this is long term, and on long term capital gains, you are going to pay 20.8% tax. So these are the two taxes which you are going to pay under what? Under section 9B, one for stock in trade, one for capital gains. Now coming to what? 45.4. What is 45.4? 45.4 speaks about reconstitution of the firm, and it is applicable if the partnership firm give to the partner money or capital asset. Therefore, B is money, C is capital asset, and D is the capital account of the retired partner. So B is money. How much money the firm is giving? The firm is giving 1 lakh rupees. Therefore, you will take 1 lakh in B. C is the fair market value of the asset which is received by the partner. Therefore, how much is the capital asset which is received by the partner? Only capital asset is covered in what? Now 45.4. 45.4 does not talk about what? Stock in trade. Therefore, here you are going to take 17 lakh as its what? Capital asset. Now, what is D? Now, the most important point over here is D. Before computing D, whatever profit you have earned, whatever book profit you have earned under 9B, you have to allocate that book profit after tax to all the partners. That is a very important step that you are not going to forget. Okay. First of all, what is the book profit? What is the accounting profit on transfer of land? Now, the transfer of land, there will be no accounting profit because the land in the books was 17 lakhs and the land market value was also 17 lakhs. Therefore, there will be no profit in the accounts on land, but there will be a profit on SIT in the books of accounts. How much? The SIT was 1.2 lakhs. It was recorded at cost of 1.2 lakhs. But when you transfer, you are transferring at 2 lakh rupees. Therefore, there is an accounting profit of 80,000 rupees in your books of accounts. Therefore, your accounting profit is increasing by 80,000. But at the same time, you are paying two taxes. One is on this 80,000, you are paying 31.2% tax as per 9B. So that you will take 24,960. And another, you are paying 20% tax over here on the capital gains of that quota land. That you will minus this. After I do this, I will get a loss over here instead of profit. So you will divide this loss between all of them in equal share, assuming that the share of profit of all the partners are equal. In the question, the share of profit is missing, so you can assume that all the partners are having equal share. Therefore, 74,276 goes to this retiring partner. What is the capital account of this retiring partner? 20 lakhs. What is the share he is getting? Loss of 74,276. So I will reduce this, I will get D, and then I will get the capital gains which is chargeable under what? Under section 45.4. It's a very, very, very intelligent question. Next question is a very, very simple question. It's a repetitive question which has come many times in the exam, which we have done earlier also in a lot of papers. That is, there is a foreign company which is entering into an agreement with an Indian company to provide some assistance with respect to a power plant in Gujarat. What kind of assistance? They are providing some FTS services to Indian entity. FTS services, one is offshore service, another is onshore service. Offshore means they are providing the services from outside India with respect to Indian project. Onshore service means they are coming to India and providing services in India. It doesn't matter, yeah. In case of FTS, FTS is deemed to accrue or arise as per 917, whether or not you provide the services in India. It doesn't matter. Whether or not you provide, whether you have a business connection in India. It doesn't matter. The question is saying that foreign company does not have a business connection. It is not required for FTS. For FTS, for interest, for royalty, all these things are not relevant. Only thing is relevant is that services has to be utilized in India. Therefore, this 2 crore will also be taxable. This 3 crore will also be taxable. Now, how the consideration is discharged? This 3 crore is discharged to the other person through a bank account. Therefore, this 3 crore will be taxable as per 917. It is deemed to accrue or rise in India. How this 2 crore is discharged? This 2 crore is not discharged in monetary terms. In fact, we are giving them debentures worth rupees 2 crore. Therefore, that will also be taxable. We have done similar adjustments earlier also. Okay. Now, there is one hidden adjustment over here. On this 2 crore rupees, now the foreign company will also earn interest for 7 months. From September to March, they will also earn interest. Now, that interest will also be what? Deemed to accrue or rise in India. And you have to take that interest also in India and you have to pay tax on that also. Check it, please. Now, let's talk about the next question. Question number 3 is part 1. Now, this is the first question which is on charitable trust. There is a charitable trust who are giving some interest-free loans to employees. Now, the question is, if a charitable trust gives some interest-free loans to the employees, are employees covered in the specified person mentioned under 13.3? The answer is no. A specified person does not include employees. It does not include relatives of the employees. It does not include all these people. It includes author of the trust, founder of the trust, substantial contributor, etc., etc. These people are covered in what? In specified person. Therefore, if the trust is giving some interest-free loan to employees, it is not a violation of the provisions of the trust and the AO cannot withdraw the exemptions of the trust. Okay, check it, please. Next one is a very routine question which we have done so many times in our discussion. That is, there is one educational institution and there is one hospital. The annual receipt of educational institution is 2.4 crore and annual receipts of hospital is 2.5 crore. The aggregate receipt does not exceed 5 crore rupees. Therefore, there is no need to take any kind of approval for the purpose of claiming exemption. If the annual receipts, aggregate annual receipts is up to 5 crore rupees, there is no need to take what? Any kind of approval for the purpose of claiming exemption. Okay. Now, the next question is a very, very intelligent question. And in this question, you have to make some assumptions now. There are two assumptions that you are making. According to that, the answers will change drastically. The first assumption which we are making that this person is coming to India on 1st July 2022 permanently. Now, He is a resident. Definitely, if he's coming in July, he is a resident because from July to March, he'll be staying for 182 days. But we don't have the data of the past year. Assuming that in the past years also, he has come to India and his stay in the last 10 years, in the last 7 years is 730 days. And out of the last 10 years, he's resident in at least 2 years. Therefore, we can make an assumption that he is a resident and ordinary resident. Let us answer according to that first. If a resident and ordinary resident, then world income will be taxable. First of all, his salary income of the first 3 months. First 3 months, he was staying outside India. April, May, June, he was staying outside India. From 1st July, he came to India. Because of his mother who was not well, so he came to India. He planned to shift it to India. Okay. Now, if he is resident and ordinary resident, then world income is taxable. This 3 month salary will be taxable. Yes, it is taxable. So 3 month salary 3250 into whatever is the average rate, 23 rupees will be converted. Okay. Then he has also rented some house property over there from July. From July, his property was rented, so his rental income will also come over here. So his salary is 9500. Sorry, his rental is 3250. On that rental, he will get deduction of standard deduction of 30% also. Apart from that, profit from business will come. A bank interest come from country S, that will also come in the income statement. Income from saving bank interest from SBI will come in the income statement. Then dividend income from India. These are all income which are accrued in India. All these things you will do. After that, you will also take chapter 6 deduction. 25,000 mediclaim you will take under 80D for himself because he is not a senior citizen, and for his parent also he will take only 25,000 because his parent is non-resident. Okay, if parent would have been resident, he would have taken 50,000 rupees. Because the parent is resident, non-resident, sorry, therefore he will get only 25,000 rupees. After doing that, he will also take deduction of 80 TTA, 10,000 rupees, and then he will compute the average tax rate in India, and then he will compare with the average tax rate of foreign country, whichever is lower, that much will be allowed as a relief. Now, another assumption which we can make is he is a resident. Is definitely a resident. There is no doubt about his residential status. He is definitely a resident, but the question is, we don't have the data of the past year. So we are assuming that he is resident, but he is not ordinary resident. If he is resident, but he is not ordinary resident, then all his income cannot be subject to tax in India. Then which income will not be subject to tax in India? The income which is accrued outside India, that is salary income, will not be subject to tax. HP income will not be subject to tax. And similarly, this FD income outside India will also not be subject to tax in India because these incomes are accrued outside India. In case of NOR, only incomes which are accrued or deemed to accrue or receive or deemed to receive in India are taxable. Or if the PGBP is done outside India and controlled from India, then only it is taxable. Otherwise, foreign incomes are not taxable in case of what? NOR. Accordingly, both the solutions are correct. Whatever solutions you will feel correct, you can do. You are not supposed to do both of them. Anyways, you don't have that much time in exam to complete the paper. Okay. Now, next question, we'll go ahead. Which is question number 4, which is on TDS. Now, it's a very, very good question. We have done this question earlier also. Mr. A is purchasing some scrap. Now, if you are purchasing some scrap, the seller will collect TCS. But if you give a declaration that I'm going to use this scrap for the purpose of what? Manufacturing or power generation, the seller will not collect TCS. So, you are giving an excuse that I'm going to use this scrap for what purpose? For manufacturing purpose. Therefore, here in this case, the TCS will not be collected. But you are exempted from TCS. The seller is exempted from TCS. But is the buyer liable for TDS under 194Q if the last year business turnover is greater than 10 crore? And Mr. A's last year business turnover is greater than 10 crore. Therefore, buyer will be liable for what? The TDS under 194Q because the sale purchase is also exceeding what? 50 lakh rupees. Okay. So, on 5 lakh rupees, 0.1% TDS will be deducted by the buyer. TCS is exempted, but TDS will not be exempted. If TCS would have not been exempted, then TDS would have not been applicable. But if TCS is exempted, you have to deduct TDS under 194Q. There is a CBDT circular on the same, okay, which we have done it in class. Next is, there is one person, Mr. P, who is providing some services to client, technical service, and on technical service, we know that we need to deduct TDS at the rate of 2% under 194J. But the client is giving a certificate under 197, lower deduction certificate, and saying that please deduct 1%. So I said that yes, I will deduct 1%. But unfortunately, later on, I came to know that the assessee is not filing the return of the last 2 years. And the assessee's TDS is also more than 1 lakh rupees. Now, do you remember that? If the payee is not filing the return for the last 2 years and the payee's TDS is also 50,000 rupees or more, then in that case, I am liable to deduct TDS as per 206AB. Now, what does 206AB says? 206AB says that twice the rate or 5%, whichever is higher. Now, what is the rate over here? The rate is the concession rate is 1%. Twice of that will come to 2%. Compared with 5%, whichever is higher, will be liable for deduction at TDS. Therefore, I will deduct TDS at how much percentage? I will deduct TDS at 5%. It's a very, very intelligent question. Now, the third question is a very simple question. You are buying some house property. The price of the house property is 60 lakhs, whereas the stamp duty value of the house property is 82 lakhs. Therefore, TDS will be deducted at the rate of 1% on how much? On 82 lakh rupees. Check it, please. Okay. So, this is what this question is all about. Now the next question is a transfer pricing question. It's an easy question, nothing great as such. There is a domestic company and there is a foreign company, CMA and both of them are associate enterprise. Sir, how did you come to know that both of them are associate enterprise? One entity is wholly dependent on the raw material of another entity. Now, if one entity is dependent on the raw material of another entity for 90% or more, if I am dependent on you for 90% or more of the raw material, then we both are what? Associate enterprise. Therefore, both of them are associate enterprise. Now, Shahi Private Limited is purchasing some goods of 30 crore rupees from its associate enterprise. Now, we need to find out the arm's length price of this 30 crore. Now, Sumi is charging us 20% margin, whereas Sumi is charging other unrelated party only 10%. So, they should charge us also 10%. Okay. So, what I am doing? First of all, I am removing the margin of 20%. I am removing the margin of 20% on cost. So if it is 20% on cost, therefore it is 1/6 on sales. So I am removing 5 crore rupees or 5 lakh rupees, whatever it is from here. If I remove the margin, 20%, my margin, then I will get my cost. Then I will add what? Add the margin, which is arm's length margin. The arm's length margin is 10%, so I am adding 10%. Okay. So first of all, I am removing the entire margin, making it at cost, and then I am adding what? The genuine margin. The genuine margin is 10%, so I will get the actual price. Okay. After that, the Sumi is also providing me some additional services for which the Sumi is allowing me to use the brand name of Sumi INC. So for that, Sumi will charge me extra amount here. How much extra they are charging? They are extra charging 0.9 crores, that is 90 lakhs. So I will add that also to my cost. Therefore, effectively, my cost will come to how much? My arm's length price will come to 28.4. Whereas I am purchasing at how much? At 30 lakh rupees. So I am paying extra 1.6 lakhs. This will be added back to the income statement. Okay. Now the second question: if the TPO enhance the income, by 2 crore rupees, can I claim deduction of 10AA on that 2 crore rupees? No, not allowed. As per first proviso to section 92C subsection 4, if the assessing officer increases or the TPO increases your income, then on that increased income, you are not eligible to claim 10AA or chapter 6A deduction. You are not allowed to do that. Okay. Next, if there is an underreporting of income because of the transfer pricing officer, will I be liable for penalty? Yes. If you do not report your income properly in the income statement, then the TPO will impose what? The TPO will impose 270A penalty, that is misreporting. 200% penalty will be imposed on the assessee. Okay. So this is what this question is all about. Next question is on case law. There are 3 case laws over here, which I will address you one by one, all of them. There was an assessee on which there was some genuine hardship because his money was stuck with debtors. His large funds were stuck with debtors, and some of the funds were also stuck with the income tax department in the form of refund. Now, what mistake assessee did? Assessee, while making the payment to one of the party, deducted the TDS but did not pay the TDS on time. But assessee, after some time, deliberately paid the TDS along with the interest before he received the notice from the income tax department. So assessee has done everything correct before receiving the notice. Is it justified to put the assessee under jail? Is it justified to put prosecution proceedings on the assessee? And the court said that the answer is no. There was a genuine reason for not paying the TDS on time because the assessee's funds were stuck. The assessee's funds were stuck with the debtors, stuck with the income tax department, and assessee has paid the tax before the department sent the notice. Assessee has so much to pay the interest also before the department sent them the notice. Therefore, there is no reason to charge what? Prosecution proceedings on the assessee. Okay. Next question is on Reliance Telecom Limited, whereby the powers of the tribunal order is discussed over here. Does tribunal has the power to, after passing the order, to call back the order and re-hear the entire order? The answer is no. The tribunal does not have the power to call back the order and re-hear the entire order. The tribunal has the only power to bring the order, to call back the order and rectify an apparent mistake if there is an apparent mistake within the time limit. That too within the time limit. The tribunal cannot bring back the order, call back the order and re-hear the entire appeal once again by reconsidering the entire matter once again. That is not possible. Okay. Next, last but not least, there was an assessee on whom there was some MAP proceedings which were pending. What is MAP proceeding? MAP is a mutual agreement procedure which is pending at international level between 2 countries. Now, because the MAP proceeding is pending, the assessee is saying that the department should waive my interest. Waive my interest under section 220A. Is it justified to waive the interest under 220A just because a MAP proceeding is pending at international level? The court has said in the case of Pioneer Incorporation, USA, that it is not justified to waive your interest under 220A just because a MAP proceeding is pending against you. Just because a MAP proceeding is pending, that does not give you the right to tell the department that waive my what? Interest. That is absolutely a bullshit point, because then everybody will do what? Everybody will initiate a MAP proceeding with higher authority, with international authority. And once you initiate that, deliberately you will initiate that MAP proceeding. Once you do that, then the department will be forced to what? Forced to waive the interest. Everybody will use this as a tool. Therefore, the department said that that is not allowed. The court said that that is not allowed. Okay. Now, the next question is a very intelligent question where ICI has again taken 2 different alternatives. First of all, they are solving this question as per equalization levy. Secondly, they are solving this question as per income tax act. Sir, which one is correct according to you? According to me, the second one is correct, because the question is very clear, which is saying that you should solve as per income tax act, not as per equalization levy. Okay. but they have done it as per both the cases. Now, there is one company, Kiwi Inc., which is a company which is based in USA. They are engaged in manufacturing and selling of mobile phones globally. There is another company, Alpha Inc., which is engaged in managing a website. It is working like Amazon. Okay, they are also engaged in hosting advertisement. There is another company, Gamma LLC, which is incorporated in UK, and they are engaged in manufacturing and selling printers. Now, we are talking about Kiwi Inc. First of all, Kiwi Inc. is selling 80,000 mobile phones. So, first of all, I am discussing the point as per equalization levy, the way ICAI has done. Now, in first case, equalization levy is applicable because you are selling to persons resident in India. Therefore, 2% equalization levy will be applicable as per Finance Act 2020. 15,000 into $2,000 into 80 rupees is the price of dollar over here. You have to multiply that. If this amount is exceeding 2 crore rupees, equalization levy is applicable, and it is exceeding 2 crore, you can check it over there. Okay. Second thing, in second case, equalization levy will not apply because you are not selling to persons resident in India. The primary condition is that you should either sell to person resident in India or to person non-resident in India in certain specified circumstance, or to any other person using IP address in India. These are the three circumstances in which equalization levy of 2020 is applicable. In third case also, equalization levy will be applicable because you are again selling to the resident of India, and if you multiply 7,000 into 2,000 into 80, you will get more than 2 crore rupees. Therefore, again equalization levy is applicable. In the fourth case, it is not applicable because again you are not selling to the residents in India. You are selling to the residents in UK. In the fifth case also, it is not applicable because the sale itself is done outside India, because the physical store is outside India. The physical store is not in India. The sale is done outside India. Okay. Apart from that, there are two more transactions which are over here which we need to talk about. First is there is some transaction of 50,000 rupees which you have paid for hosting advertisement for targeting Indian customers. Is this covered in 2016 equalization levy? 2016 equalization levy will not apply. The reason is very simple. Because for 2016 equalization levy to apply, the payer who is in India has to be resident or a non-resident who should have a P in India. Either of the two has to be there in India. Here, the person who is paying the amount is not a non-resident who is having a P in India. The person who is paying the amount does not have a P in India. Therefore, 2016 equalization levy is not applicable. 2020 equalization levy will be applicable. The reason is because they are targeting the Indian customer. In second case, even 2020 equalization levy will not be applicable because there they are targeting the UK customer. If you are targeting UK customer, equalization levy cannot be made applicable. This is the one of the way to solve this question. Another way in which institute has solved this question is by considering this as what? As a business connection. We know that there is an amendment which is made under business connection, which is applicable from AY 22-23, which says that if there is a significant economic presence in India, then it is also what? Subject to business connection, and income is deemed to accrue or rise in India. And what is significant economic presence? If a non-resident is entering into a transaction with a resident for sale of goods, for services, for download of data, etc., and the payment is more than 2 crore rupees, then significant economic presence is attracted. So the condition is the non-resident should enter into a transaction with a resident, and there has to be a more than 2 crore rupees payment. Therefore, in the first case, there is a significant economic presence because the transaction is with resident and the payment is also more than 2 crore. Significant economic presence is applicable. In second case, it is not applicable because you are entering into a transaction with non-resident. In third case, it is applicable because you are entering into a transaction with resident and there is a more than 2 crore rupees payment. In fourth and fifth case, also not applicable because in fourth case, you are entering into a transaction with non-resident, and in fifth case, you are entering into a transaction which is done outside India that has nothing to do with income which is accrued in India. That is just absolutely done outside a physical store outside India. That is never going to be accrued in India. Okay. Last but not least, do you remember that in business connection also there was an amendment that if there is a sale of advertisement by one person to another person by targeting customers in India, then that is also taxable in India. That is also deemed to accrue as in India. Therefore, this 50,000 will also be deemed to accrue as in India under section 911. But this $20,000 will not be accrued in India because here we are not targeting the Indian customer. Okay. So this is what this question is all about. You can solve by either of the way. You can go through the solution once at your end if you want. Okay. Last but not least, one last question is there over here, which is on SFT. So whether SFT is liable to be filed by the reporting person or not, we need to decide that as per 285BA. One person, Mr. A, is going to a State Bank of India and buying 5 FD of 3 lakh each through his current account. SFT not applicable. Yes, if you buy an FD of more than 10 lakh rupees in cash, then SFT is applicable. Here the person is buying FD bank draft in what? In through current account. Therefore, SFT will not be applicable here. Okay. Next question. There is one person who is going to Canara Bank and buying an FD. Time deposit means FD or RD. He is buying a time deposit of 7 lakh rupees and is renewing a time deposit of 5 lakh rupees. Therefore, SFT is not applicable. Why, sir? What is the provision? The provision says that if any person goes to a bank and buys a fixed deposit, recurring deposits of more than 10 lakh rupees in a financial year, other than renewal, the renewal point will not come over here. Therefore, other than renewal is how much? Other than renewal is only 7 lakh rupees, which is less than 10 lakh. Therefore, here also the SFT provisions are not applicable by the Canara Bank. Okay. Next one, for credit card. For credit card, when credit card companies are liable for SFT, they are liable if the aggregate credit card payment by a person in the entire year is more than what? Is more than 10 lakh. Or if the cash payment in the entire year is more than 1 lakh. Now in this case, if I do the aggregate cash payment, first and the third transaction, this and this will be multiplied by 4, this will be multiplied by 3, because this is for 4 months, this is for 3 months. So the cash payment is exceeding 1 lakh rupees definitely. So therefore, in the first transaction and the third transaction, I am liable for what? I am liable for the SFT reporting. But for the second transaction, I am not liable because that is made through bank. And if I am making the payment through bank, then the aggregate limit should exceed how much? It should exceed 10 lakh rupees. And that is not exceeding. Therefore, in the second case, there is no reporting requirement. But in the first and the third case, there is a need for reporting. Last but not least, every person who is liable for tax audit, and if they receive more than 2 lakh rupees in cash, if I am liable for tax audit and if I receive more than 2 lakh rupees in cash, then I am liable for what? I am liable for what? SFT reporting. But in this case, I am liable for tax audit, but I am receiving exactly 2 lakh rupees in cash. Therefore, in this case, there is no need for what? SFT reporting in my case. After this, whatever question is there, that is a theory question. You can go through it once if you want.
So let's move on with one last paper, that is November 2023 paper, which is there in front of us. Let us go ahead with the first question. The first question is on, again, a total income question. You're not supposed to follow 115BAA or BAB. You're supposed to compute total income and tax payable as per the normal provision. Okay. Now let's see the first adjustment over here. Assessee is a manufacturer, so it can have some importance in the question. 79,50,000 is the profit of the assessee. The first adjustment, depreciation add back. Second adjustment, destruction of old machinery, and old machinery has caught fire, because of which there is a loss of 25 lakhs. So you have to add it back. That is a capital loss. And you have also received some scrap of 7,80,000. That will also be reduced. This is a similar adjustment we have done earlier also. Okay. So add back the loss and reduce the scrap value. Okay. Now income tax assessment has done. You have paid 5,70,000 as tax, which includes surcharge of 60,000 and cess of 24,000. It doesn't matter. Surcharge is also disallowed under income tax law. Cess is also disallowed under income tax law. Therefore, entire income tax law will be disallowed here. Okay. Next, you have received some power subsidy from the central government. It's a revenue subsidy. Therefore, it shall be added to the income statement. You have already credited that to the P&L. Therefore, ignore this particular thing in the adjustment. Okay. Because it is already credited to the P&L, you don't have to consider any effect of that because it is already credited to the P&L. Okay. Next one, you want to carry some business. For that purpose, you have obtained a bank guarantee and you have deposited money in the bank. So for the purpose of business, you have deposited money in the bank so that you get a bank guarantee from the bank, and on that deposited money, you are earning some interest. So this interest is inextricably linked with the activity of business. Therefore, it will be chargeable under PGBP. Since it is already credited to the P&L, you are going to ignore this over here. Okay. Next, you have purchased some raw material for in-house research and development. Therefore, that will be allowed as reduction. You have also paid GST of 2,75,000 on which ITC is not claimed. Because ITC is not claimed, you have not claimed the benefit under the income in the GST law. Therefore, under the income tax law, you can take the benefit of that as a deduction. If you would have claimed ITC, you would have not got the deduction under PGBP. Okay. Next, there is a Chinese company who does not have a P in India, and you are making some payment of 12 lakh rupees as an online advertisement service. So if there is a non-resident who does not have a P in India, and if you make a payment of more than 1 lakh rupees for online advertisement service, then it is subject to equalization levy at the rate of 6% as per 2016 equalization levy. But you have not deducted the equalization levy. Therefore, this expenditure of 12 lakh will be disallowed in your hands. Okay. Next one, you are receiving some dividend from a foreign company. So reduce that from PGBP, show under IFOS. Okay. And then you have also incurred some 15,000 rupees as an expense, which is not in the nature of interest. It is other than interest. So disallow under PGBP, and under IFOS, you cannot get the deduction, because in IFOS, you get the deduction of only interest expense from dividend income, that to up to 20% of total dividend. And this is not interest. Therefore, you cannot get a deduction of this 15,000. So disallow in PGBP, do not reduce from IFOS. One important point that I would like to say over here, generally when the word received is written, we try to gross up that with TDS. Okay. But ICI is following a trend. I don't know why they are following a trend. They are following a trend for the purpose of ease, I guess, for the purpose of easiness, I guess. The trend which ICI is following over here is whenever the dividend is received from foreign company, they are not grossing up. When the dividend is received from Indian company, they are grossing up. So be very careful. When you receive dividend from foreign company, don't gross up. Okay. Next one, you are making some payment of interest by settling the interest by issuing debentures. Can it amount to actual payment? No. Conversion of outstanding interest into a new loan or into a new debenture or into a new security or new bond does not amount to actual payment as per 43B. Therefore, it will be disallowed under the income tax law. After this, depreciation will be taken as a deduction. This is as per income tax. Air compressor which you are purchasing on 1st of May, you will claim 15% normal depreciation and 20% additional, because Assessee is a manufacturer. Air pollution control equipment, 40% normal depreciation, 20% additional depreciation, because again Assessee is a manufacturer. Now purchases after 30th October will be subject to 50% depreciation. Transportation for lorries for transporting goods, 95 lakh. tax, 7.5% depreciation. Why 7.5? Less than 180 days. Why not additional depreciation? Additional depreciation is not available on motor vehicle. Okay. Then a machinery is purchased which is installed in the next year. So because it is installed in the next year, you will not get the depreciation in the current year. Now the turnover of the company for last to last year is 415 crore. Therefore the tax rate of the company will be 30%, not 25%. Then you apply the surcharge if surcharge is applicable and cess and whatever is there, that will be your total income and tax. Okay. Now coming to the next question, question number 2, which is a question on minimum alternate tax. In this question, we are supposed to compute the book profit first and then we are supposed to compute the minimum alternate tax. Let's see what is the net profit of the company. It is 89. And then there are some items which are debited to P&L and some items which are credited to P&L. We need to find out the book profit and after that we need to find out what? The income tax as per the 115 JB, that is a MAT. Okay. Now the expenditure in relation to 10AA, it is not added back in MAT. Okay. Depreciation, you have to add it back and then you reduce the depreciation other than revaluation. In this question, there is no revaluation of depreciation. Therefore, because there is no revaluation of asset, the entire depreciation of 34 lakhs will be called as other than revaluation depreciation. Therefore, entire 34 lakhs you can reduce it. Okay. Interest not paid, doesn't matter. It is not added back in MAT. Penalty, it is not added back in MAT. Proposed dividend, income tax and general reserve, all of them will be added back in MAT as per explanation 1 to section 115 JB. Next, ATIA expenditure, it is not added back to MAT. Okay. Next one is a very important adjustment, amount withdrawn from reserves. But this profit was not increased by such reserves earlier. So in such case, you are not going to reduce it from the book profit. If book profit of earlier year was increased by such reserve, then you would have received this, then you would have reduced this reserve. Because the book profit of earlier year was not increased by such reserve, you cannot reduce this reserves also from your book profit. Next, 10AA, ATIA, all these profits will be part of book profit. You have to pay MAT on that. And then deferred tax credit, you have to reduce. Then there is some income tax depreciation. It's of no use now. Income tax depreciation is of no use now. What is the use of income tax depreciation? That is useful under the normal provision, not under the MAT. The only thing which is useful over here is the loss as per the books of accounts and the UAD as per the books of accounts. Whichever is lower will be allowed as deduction. Unfortunately, the lower is nil. Therefore, nil will be allowed as deduction. Nothing will be allowed as deduction. Okay. This is what this computation will be. After that, you will compute your MAT. That is 15% tax, 4% cess. I hope it is clear to all of you. Now, next question, question number B1 is on section 44. BBA, non-resident airline business. Okay. Now, there's a non-resident Mrs. XY airline company who operate from India to USA and vice versa. Okay. Now, they have collected 90 lakhs for carriage of passengers from Delhi to New York and vice versa, out of which 40 lakhs is received in New York, and the flight has also left from New York. So, out of 90 lakhs, 40 lakhs will not be subject to tax in India. Why? Because the flight has left from New York, it is accrued outside India and the money is also received outside India. Therefore, it is not taxable. Therefore, only 50 lakh will be taxable. The redeemed income will be 5% of 50 lakh. Second, another 70 lakh is received for carriage of passengers and cargo from Mumbai to New York. Now, in this also, 30 lakh is received out of 70 lakhs. 30 lakh is received in New York for booking from New York to Mumbai. Again, this 30 lakh will not be deemed to accrue or rise in India. It is not received also in India. Therefore, out of 70 lakh, 30 lakh will be reduced. Only 40 lakh will be taxable. Therefore, 50 plus 40 comes to 90. On 90 lakh, 5% will be deemed income. Sir, what about this expenses of 170 lakhs? It is not allowed under 44 BBA. 44 BBA overrides section 28 to 43. Therefore, all the PCPP provisions will be overridden over here. Next question is a very good question. Mr. Adi, a non-resident Indian. He is an NRI. Now, remember for NRI, which provision is applicable? An optional provision is applicable. Chapter 12A, 115C2I. Now, he is purchasing some unlisted shares, equity shares of an Indian company for 6 lakh rupees. Now, these are sold by him for 9 lakh rupees. He has incurred some expenses of what? 15,000 on brokerage, and he has purchased some few specified assets on 31st March of 3,50,000. We need to compute his capital gain. Remember, it is not clear in the question whether the shares which he has purchased, is he purchasing in foreign currency or Indian currency? Let us assume if he purchased the shares in foreign currency, then the provisions of chapter 12A is applicable. But he does not purchase the shares in foreign currency, then chapter 12A is not applicable. Let us assume that he has purchased the shares in foreign currency. So let's compute his income. 9 lakh full value of consideration, 15,000 expenses or transfer, 6 lakhs cost of acquisition, indexation is not available under chapter 12A. Then 2 lakh 85 will be his long-term capital gains. Now, to save his long-term capital gains, he has to invest in the specified assets within 6 months as per 115F. Now, is he investing in specified assets within 6 months? Yes. He is not investing the full consideration, but he is investing 3,85,000 at least. Therefore, he will get exemption under 115F, that is long-term capital gains into the amount invested divided by net consideration. This much exemption, this is one of the advantage of chapter 12A. Now, let us assume, ICAI has given both the answer. Let us assume if he is not purchasing the shares in foreign currency, then chapter 12A is not applicable. And if chapter 12A is not applicable, how the answer will change? First of all, he will get the indexation of the cost. For cost of 6 lakh rupees, he can take the indexation, and 115F exemption will not be available to him if he follows what? If he follows if he takes an assumption that the asset was not purchased in foreign currency. I hope it is clear to all of you. Let's move on to the next question. which is on charitable trust. Question number 3A. A charitable institution is registered under 12AB on 1st August 2021. It is engaged in preservation of forest. Is preservation of forest covered in charitable purpose? Yes, it is covered. Okay. Now, we need to answer whether all these items will be allowed or not allowed as a deduction, or whether it will be taxable or not taxable under the income tax law. First of all, the trust is following mercantile system, and therefore the electricity expense of the current year is 22-23. It is 1 lakh rupees. But they have paid the electricity expense in the next year. So when the deduction of this electricity expense will be allowed to the trust? Remember, for trust, the deductions are allowed only on actual payment basis. The application of income is allowed only on actual payment. Now, because this 1 lakh is paid on April 2023, it will be allowed in 2023-24. It will not be allowed in 2022-23. Okay. Next one. The trust is earning some agriculture income of 12 lakh rupees, which is exempt under section 10(1). Can trust claim exemption under section 10(1)? Yes. As per section 11 subsection 7, the trust can claim the income, agriculture income, which is exempt under section 10(1). That exemption is eligible for trust. Apart from that, no other exemption under section 10 will be allowed to a trust. Okay. Third one, a trust has earned a rental income of 3 lakh rupees. Okay. Out of which 2 lakh rupees is received in the current year and 1 lakh rupees is not received. For that, the trust has exercised the relevant option. What is the relevant option? If you do not receive the money, you can tell the assessing officer that whenever I will be receiving, I will apply in that year. Okay. So you will get the exemption in the current year. So you will get the exemption of 1 lakh rupees, which is not received in the current year, but you have to apply in the year in which you receive it. Now, by when I am supposed to apply? The law says that you have to apply in the year of receipt or the year following of receipt. I am receiving in 2023-24, so I can apply in 23-24. I also have an option to apply in 24-25. If I do not apply till 24-25, it will be deemed income of 24-25 and not 22-23 or 23-24. Okay. Next one, the trust has borrowed 45 lakhs and purchased a building. Whether it will get a deduction of what? No. If you take a loan and apply in the trust, it is not allowed. It will be allowed in the year in which it is repaid. Therefore, 6 lakh rupees when repaid will be allowed as deduction. Till then, it will not be allowed as a deduction to the trust. Next question is a simple question on DTAA. I'm not interested in speaking much about it. I'll just speak about some important points of this question. First of all, there is a loss of house property. You can set off to the extent of 2 lakh rupees. You cannot set off more than 2 lakh. You can set off against the business income. Apart from this, there is a business income, there is an FD, there is a saving bank interest. Saving bank interest, you can claim 80 TTB. Why 80 TTB? Because the assessee is a resident and senior citizen, you can claim 80 TTB. Okay. Then ATC you can claim. For minor son, for married son, you are buying what? You are buying some PPF. So you can claim PPF if you purchase for yourself or your spouse or your children. Minor, major doesn't matter. Okay. Married, unmarried doesn't matter. You get ATC exemptions. Then interest on PPF is exempt under section 10(11), and then it is a normal sum. You can do it at your end. I'm not much interested in this question. I'm moving ahead with the next question where we need to answer whether TDS or TCS will be applicable or not. So the first question is a good question. Mr. Ron has taken a loan of 10 lakh rupees from his employer. Why he has taken? He has taken a loan to remit for the studies of his child outside India. Okay. Now, whether Mr. Ron will be eligible for that concessional rate of 0.5% and up to 7 lakh no tax and above 7 lakh 0.5%. No. That is only applicable. I agree that is applicable for education loan, but that is applicable only if you take the loan from a financial institution in India. Mr. Ron is taking a loan from what? Loan from a private person, that is his employer. Therefore, that a concessional rate will not be available. Which rate will be available for Mr. Ron? For Mr. Ron, 7 lakh will be exempt, and on balance, he has to pay 5% TCS. Okay? Because education other than loan from financial institution, and medical is covered at the rate of 5% only. 20% TCS is not applicable even in the current year. Now the answers over here would be as per the last year, because this is last year's RTP, and this cannot have I have not got the time to update this RTP. I have put as it is there on the ICI website. Therefore, it is not updated, but I am telling you the answers which are updated answers. Okay. Apart from that, he is also sent 4,75,000 for pursuing studies outside India for the out-of-pocket expenses of his child. Now, if his child is going outside India for studying, he had a lot of expenses like stay expenses, food expenses. He has to travel from one place to another. All those expenses are also required now. So for that purpose, also if you transfer money outside India, that is also education only as per the CBDT latest FAQ. Go and check our book. CBDT has given an FAQ of 7 questions where it is written that all these things, out-of-pocket expenses, will also be part of what? Education only. Therefore, this will also be subject to only 5% TCS. So 4,75,000 into 5% TCS will be chargeable on you. Okay? I hope it is clear. Now, Mr. Mandeep, whose last year turnover is 12 crore rupees and he was covered by 44AB tax audit. Okay? Now, Mr. Mandeep has purchased a house of 5 crore rupees. Is he liable to deduct TDS? The answer is yes.
194 IA, he is liable to deduct TDS at the rate of 1% on purchase of immovable property of 50 lakhs or more. He has to purchase 1% TDS on that. Apart from that, he has also paid 12% commission on that particular house. So 12% commission comes to how much? 60 lakhs. Whether 194H he will deduct TDS? The answer is yes, because Mr. who is Mr. Mandeep is an individual and his last year turnover is greater than 1 crore rupees. Therefore 194H is applicable, and 194H is applicable if you make the payment of commission of more than 15,000 rupees. He is making payment of 60 lakh rupees. Therefore 5% TDS will be deducted on 60 lakh rupees. I hope it is clear to all of you. Now the next question is, the person is depositing some money with the High Court as a litigation fees. Okay. Now High Court, what does High Court do that? If you deposit some money with the High Court put that money in the fixed deposit in the bank. Okay. Now the bank pays interest to the High Court. Whether TDS will be deducted on that case? In that case, the court has said that TDS is not applicable, not applicable, not applicable. I hope it is clear to all of you. Now the next question is exactly the same question which we have done earlier. You can go and check the past paper or past RTP. Somewhere we have done definitely same question with same numbers also. Okay. And the same item also, blanket only were there. There also it was blanket. Here also it is blanket. The same item, the same question we have already done. So I'm not interested in speaking on that question once again. Okay. Now I'm moving ahead with the next question, question number 5, which is a beautiful question on case laws. The first case law, Mr. Surajit has filed his return on July 21st, total income 11,75,000. In the return, he has claimed 2 exemptions. One, interest from PPF exempt and long-term capital gains under 1037 exempt. And he has disclosed that in the exempt income. Okay. Now, after some time, he came to know that he failed to claim one business loss in the return of 4,50,000. So, business loss he failed to claim. Okay. Now, in the meanwhile, the return got processed. And when the return got processed, the return disallowed these 2 items. These 2 exemptions were disallowed in the return, and intimation was sent and demand was raised on the assessee. And therefore, the assessee filed a revised return. But unfortunately, assessee was not able to e-verify the return on time, and therefore it can be called as an invalid return. Definitely, you have to e-verify the return within 30 days. If you do not e-verify the return within 30 days, then it is an invalid return. Now the assessee went for rectification. Whether the AO is bound to accept the request for rectification, remember, what is rectification under 154? AO can rectify your mistake apparent from record. AO can rectify only those mistakes which are there in the intimation. Okay. Now, intimation has made which mistake? Intimation has made a mistake of not allowing these 2 exemptions. Okay. So, therefore, that AO will accept, the AO is bound to accept. What about this mistake of 4,50,000? That is not made by the department. That is made by the assessee. He should have claimed in the return. He has not claimed in the return. When he filed the revised return, then he is not e-verifying the return on time. So this matter is not part of intimation only. Therefore, something which is not part of intimation, that cannot be rectified by the department. Therefore, the first 2 items will be rectified by the department. AO is bound to rectify the first 2 items, and the third item, which is not part of income tax return only, that will not be rectified by the income tax department. Okay. So the AO will not rectify the third item. I hope it is clear to all of you. Next one, the assessee has taken a loan from someone. Now, when it came to repaying the loan, the assessee did not repay the loan by account pay check, account pay draft, ECS or such an electronic mode. In fact, assessee made a book adjustment with the other party, with the lender, and made the repayment. What kind of book adjustment? The lender was also supposed to give me some money and I am supposed to repay the loan. So we made a book adjustment. Now the AO said that no, you have not made the repayment by account pay check, account pay draft, ECS and such an electronic mode. Therefore, 269T will apply. 269T will apply and I will impose penalty under 271E on you. Now what kind of penalty we are imposing here? The matter went to the court. The court said that the joint commissioner is supposed to impose penalty under 271E only after listing the reasonable cause of the assessee. If the assessee is giving a bona fide and genuine reason for not repaying the loan, what? By account pay check. And if book entries are made, book entries are not made outside the books. It is within the books now. Everybody can see that particular transaction through the books. We are not trying to make any kind of tax evasion. Therefore, the court said that it should be allowed to the assessee. Okay. This was a Bombay High Court judgment in the case of Triumph International Finance India Limited, 2012 Bombay High Court judgment. Okay. Now, the third case law is also a very good case law. Assessee is engaged in a finance company and it is engaged in leasing and hiring of capital equipment. So, it is engaged in leasing and hire purchase of what? Say motor vehicle or some computer, furniture, assets, etc., etc., etc. So I am a leasing company. I lease you what? Capital assets. Okay. Now, to lease the capital asset, I have taken a foreign currency loan. I have taken a loan from foreign country. And when I repaid the loan, I have to incur some foreign currency loss, foreign exchange loss. Now, I claim that loss as a what? As a PGBP expense. But the department did not allow. Department said that you have to apply section 43A and you have to add that to the cost of the asset. Matter went to the court and the court said that no need to add to the cost of asset. Taking a loan is an independent transaction. Giving the asset on a lease is an independent transaction. Don't mix it up, both of them. If loan was taken specifically for that asset only, then you should have capitalized. But the loan is not specifically taken for that asset. Taking loan is an independent transaction at a different time of interval, and giving an asset on lease or hire purchase is a different time of interval. Therefore, both of them should not be mixed together, and therefore this loss on payment of loan, repayment of loan, foreign exchange loss on repayment of loan should be allowed as what? Should be allowed as a revenue expense. Okay, should be allowed as a loss under section 37(1). I hope it is clear to all of you. Next question is again a very small question but a beautiful question. ABC INC is a foreign company which is in USA. It does not have any permanent establishment in India. Now Mr. Raghu is an Indian company. Now Mr. Raghu has made a payment of 3 lakh rupees for online advertisement to ABC. Now of 3 lakh rupees. So if there is a non-resident who does not have a P in India and provide online advertisement service, and if we make the payment of more than 1 lakh rupees, then we have to apply 2016 equalization levy, right? And we have to deduct 6% equalization levy. Now 6% of 3 lakh will come to how much? It will come to 18,000 rupees. Now on 30th June the transaction has happened, so I have to deduct on 30th June and I have to pay by 7th of July. Why I did not pay on 7th of July? I in fact paid on 23rd of March. So how many months I am making a delay? From July to March, it comes to 9 months. Therefore, for 9 months, 18,000 into 1% interest per month into 9 months. For 9 months, I have to pay interest. I hope it is clear to all of you, right? I hope it is clear. 9-month interest I am supposed to pay. Now, Mr. Raghu has also made payment for another company. Another company, LMF INC, who has a permanent establishment for the same purpose. He is again making the payment of online advertisement. Now, Mr. Raghu is making a payment to a company who has a P in India. Therefore, equalization levy is not applicable. Now, that company has a permanent establishment in India. Therefore, the income of that company is deemed to accrue or rise in India. Therefore, now Mr. Raghu is liable to deduct TDS under section 195. And if it does not deduct the TDS under 195, his expenditure will be disallowed under PGBP. I hope it is clear to all of you. And one last question over here. Let us see that whether GAR will be applicable in this case or not. Let's see. There's a company X Limited which has 2 manufacturing units. It's a repetitive question. 100 times it has come. One unit is in SEZ. Another unit is in non-SEZ. So one is eligible for 10AA. Another is not eligible for 10AA. And you are trying to sell the units. You are trying to sell the goods at a significant lower price to take the advantage of 10AA benefit. Okay. Therefore, my question to all of you, whether GAR will apply, GAR will not apply. In such cases, specific anti-avoidance rules are there. Domestic transfer pricing will also apply in such case. Okay. Domestic transfer pricing will apply. GAR will not apply, because wherever there is a specific anti-avoidance rule applies, GAR will not apply in those cases. And one last question over here is, we need to say whether in these 2 cases the assessee is liable to file the income tax return or not. And Mr. A is an assessee who has incurred 2.4 lakh for the wife for travel to foreign country. His taxable income is 2.25 lakhs only. So because of his taxable income, he is not liable to file the return. But because of incurring more than 2 lakh rupees for foreign travel for himself or any other person, he is liable to file the income tax return. Remember, if any person incurs more than 2 lakh rupees for foreign travel for himself or any other person, he is liable to file the income tax return. Second, Mr. B's turnover is 73 lakhs. I don't want to read the question ahead. Any person's business turnover is greater than 60 lakhs is liable to file the income tax return. Any person's professional turnover is greater than 10 lakh rupees is liable to file what? Income tax return. So by that logic, he is liable to file the income tax return. And after that, this question is a theory question. You can just go through it once and read it. This question is also a theory question. I'm not much interested in a theory question, especially over here. Okay. So this is what the compilation of 7 past papers along with 8 RTPs. Total 15 papers we have done. So hello all my dearest students of South India. I hope you all are doing good and I hope your studies are going on great for your upcoming examination. So today we are going to start with our third target after RTPs and past paper. That is, we are going to compile today mock test papers of past papers and also of May 2024, both the series. Okay. So let us start, and that too in full English, especially for my dearest students of South India. So the very first question over here in the MTP Series 1 November 2022 is on obviously total income. The first question is generally on total income only. So there is an assessee who is engaged in some civil construction business. The assessee wants to compute the total income tax liability, but as per the provisions of 115BAA. So accordingly, you have to be very careful. 115BAA you have to follow over here. Okay. Now the very first thing is the net profit. The net profit is 85 lakhs. Now the first adjustment over here after debiting and crediting of the following items. There is some interest of 3 lakh rupees which is not paid till the due date of filing of return. It is paid after the due date of filing of return. Therefore, this interest will be what? This interest will be disallowed because the loan is taken from a public financial institution. Okay, it is disallowed under 43B. Secondly, you have made some payment to a non-resident towards fees for technical services, but you have not deducted the TDS. You have deducted and paid the TDS in the next year. Again, you have made a mistake. So your 100% expenditure will be disallowed over here under section 40 clause of clause 1. Third one is you have paid some 15 lakh rupees as a damages to the government for doing some defect in construction of the flyover. You have got some contract from the government to make a flyover, but you are not able to make it properly. So the government is charging some damages. So it is a penalty, but it is a compensatory penalty. It is not a penal penalty. Remember, compensatory penalty is allowed under the income tax law. Therefore, this is allowed. Next, depreciation you will disallow. Next one is an important adjustment. Mark to market loss. Mark to market loss is generally allowed under section 36 subsection 1 clause 18, but it has to be as per the ICDS. But if it is not as per ICDS, then it is disallowed. Therefore, in this ICDS, it is written that if there is a mark-to-market loss of unsettled derivative contract, then it is not allowed. Therefore, because this mark-to-market loss is of unsettled derivative,
contract, therefore it will not be allowed under the income tax law. Next one, you are selling some land to your 100% subsidiary, but unfortunately that subsidiary is what? Is a foreign company. Then you will not get the exemption. Exemption under section 47 is available only if you transfer a capital asset to your 100% subsidiary or 100% holding where the recipient is an Indian company. Here it is not Indian company, here it is a foreign company, therefore it is taxable under capital gain. How will you compute the capital gains? This is the profit. First of all, reduce this profit from PGBP. It is not chargeable under PGBP. And then you come to other information. It is written that you have acquired this land in 2015 for 30 lakh rupees. Okay. Now, on that you are making a profit of 10 lakh rupees. But therefore your sale consideration will come to 40 lakh rupees. 30 lakh rupees is your cost, 10 lakh is your profit, therefore sale consideration is 40 lakhs. But your stamp duty value is 50 lakhs. And the difference between the 40 lakhs and 50 lakhs, that is the sale consideration and the stamp duty value, is more than 110%. Therefore, you will take as per section 50C, 50 lakhs as your sale consideration. And your cost as 30 lakhs, you index that cost, indexation is given to you and compute that. And on that long-term capital gains, you will be chargeable at 20% tax under section 112. Okay. Next one is you are getting some retention money in respect of your contract. Okay. Now, in case of a construction company, they have to follow percentage of completion method. And as per percentage of completion method, retention money is taxable today only. Whenever it is retained, it is taxable under the income tax law. Therefore, it is taxable under PGBP. Don't make any effect of this. Just write a note that retention money is taxable today only as per the percentage completion method. Okay. Next one, you are earning some interest on fixed deposit. Generally, if you earn interest on fixed deposit, it goes under IFOS. But here the objective is not to earn interest. The objective is to get a contract. And for that purpose, you have given a bank guarantee to the government. And because you have given the bank guarantee to the government, you have to make a fixed deposit. And in that fixed deposit, you are getting some interest. Therefore, here the interest is linked to your business activity. I used to say in the class, the interest is inextricably linked to the activity of business. Therefore, this interest will be chargeable under PGBP. Therefore, do not give any effect. It is chargeable under PGBP only. Okay. Next one, the assessee has invested some money in real estate investment trust. From there, the assessee is getting two portions. First, assessee is getting short-term capital gains. On that short-term capital gains, assessee will not pay tax because on short-term capital gains, REIT pays tax. So, REIT will pay tax on that at MMR. Next, the assessee is also getting some rental income. On rental income, REIT does not pay tax. It is exempt in the hands of REIT, but it is taxable in the hands of the investor. Now, the question is, under which head it is taxable in the hands of investor? It is taxable under PGBP, remember, because the REIT's activity is to buy and sell property. The REIT's activity is real estate. Therefore, for REIT, the rental income is a PGBP income. And whatever is the nature of income in the hands of REIT, that same is the nature of income in the hands of the investor as per the income tax law. Therefore, this 4 lakh rupees will be chargeable as PGBP income of the investor and not HP income. Be very careful. Okay. Next, depreciation you can reduce. And last but not least, 80 JJAA you can claim for first employee, 15 employees which were employed on 1st April. Regular employees participate in the recognized provident fund. Remember, it is important that if you want 80 JJAA, your employees should participate in the recognized provident fund. Otherwise, you will not get 80 JJAA deduction. And plus, the emolument has to be up to 25,000 rupees. And plus, they should be employed for at least 240 days in a financial year. Therefore, the first category of employees will be eligible for that because they are employed on 1st April. 240 days criteria will be full. Regular employees, they are participating in what? In the recognized provident fund, and 24,000 is less than 25,000. Therefore, they are eligible. Therefore, how will you compute? 15 into 24,000 into 12 months into 30%. The second category of employees not eligible because their emolument is more than 25,000. The third category also not eligible because the employees are casual. They are not participating in recognized provident fund. And the fourth category also not eligible because they are employed on 1st September. Therefore, they will not be able to fulfill 240 days criteria. This is how you are going to compute. Now, what is the tax rate under 115BAA? It is 22% tax plus 10% surcharge and 4% cess, and on long-term capital gains it will be 20% tax. Okay, it will be 20% tax directly. Okay, I hope it is clear to all of you. This is how you are going to compute the total income and tax liability of this particular assessee. Next question is a very simple question, nothing great as such. There is a company HE Private Limited which is a closely held company. Now remember, when any shareholder holds 10% or more in the closely held company and that company gives you a loan that amounts to deemed dividend. Do you remember that or not? So therefore, HE Private Limited is a closely held company and Priyanshu is an MD who holds 72% of the equity in that company, and now that company is giving a loan of how much? A loan of 5.5 crore rupees to Mr. Priyanshu. Okay, to Mr. Priyanshu. Now that will be deemed dividend in the hands of Mr. Priyanshu, but the deemed dividend as per section 222E cannot be more than the accumulated reserve. Now what is the reserve with the company? The reserve is 8 lakhs and the loan is 5.5 lakhs. Therefore, deemed dividend will be only 5.5 lakhs. Now they have made you some emotional effect over here. That is, in turn, he has in turn given this loan to somebody else. It doesn't matter all those things, okay? It doesn't matter. Once you have taken the loan, then you have repaid, you have given it to someone, all those things are bullshit. It is of no use. It is taxable in your hand as deemed dividend, okay? I hope it is clear to all of you. Now the next question is a very simple question on DTAA. We have done much better questions on DTAA, so therefore DTAA questions I'm not going to speak much unless and until something unique comes. It's a very simple question. You can go through it. Very simple question. I'm not interested in that question much here, please. Now, question number 3. Now, remember in mock test paper, because we have already done with 15 papers, 8 RTPs and 7 exam papers, 15 papers are already done. So, in mock test paper, there are a lot of questions which are going to be repeated now. So, any question which is exactly repeating, not partially repeating. If it is exactly repeating, I'm not going to do that question. If it is partially repeating, I will definitely do that. Therefore, this question is exactly repeating like I made a reference also. Same as earlier RTP, question number 12. This question also exactly repeating as same as question number 14 of RTP discussion. You can go and check. That's the reason I've given the reference also. So if something is exactly repeating, I'm not going to repeat that. If something is partially repeating, still I will repeat that. Don't worry. Okay. Now, the next question. Question number 4, part A is about TDS. Now, there is a bank. Remember, when does the bank deduct TDS under section 194A? The bank will deduct TDS under section 194A on the date of credit or date of payment, whichever is earlier. Now, the bank has a policy of computing interest on a daily basis. The bank computes interest on a daily basis, and after computing, they credit that amount to a separate account for macro monitoring purpose. So, whomsoever is the customer, there are lakhs of customers, they will compute interest on a daily basis and they will credit to a separate account. And they will pay to the customers on a quarterly basis, half yearly basis, yearly basis. So, the question is, when the bank is computing interest on a daily basis for macro monitoring purpose and they are crediting that interest cumulatively to a separate account, are they liable to deduct TDS? The court has said that no, they are not liable to deduct TDS, and therefore the interest of the bank should not be disallowed. The AO has disallowed the interest to the extent of 30% by saying that the bank has not deducted the TDS on time. Therefore, this is wrong. The next question is on equalization levy. There is a foreign company, Messrs. ITEX, which is incorporated in Japan. If that company does not have a PE, now that company is providing us an online advertisement service. Okay, they are providing us an online advertisement service, but the payment of that online advertisement service does not exceed 1 lakh rupees. Remember, a non-resident who does not have a PE providing online advertisement services to a resident, and we are paying less than 1 lakh rupees, not more than 1 lakh rupees, then 2016 equalization levy cannot be made applicable. 2016 equalization levy is applicable only if the payment made is more than 1 lakh rupees. Therefore, here 2020 equalization levy will be applicable, and as per 2020 equalization levy, one more criteria has to be checked, that whether the services which are provided of online advertisement has to be at least 2 crore or more. Yes, the services is of 2 crore, 2.1 crore. Therefore, 2020 equalization levy will apply 2% at 2.1 crore. This is how we are going to approach this. If this would have been more than 1 lakh rupees, then we would have applied 2016 equalization levy. I hope it is clear to all of you. Okay. Now, the next question is again a theory question. There was a search conducted under section 132 in the premise of Mr. X on 30th of April 2023, and the officer found some undisclosed money, undisclosed jewelry. Now, we are asked that whether any penalty will be imposed on the assessee. The answer is yes. There is a specific penalty for search and seizure, if you remember, under section 271 AAB. But to understand 271 AAB, you need to understand two terms first of all. That is specified previous year and specified date. Sir, what is specified previous year? In specified previous year, there are 2 points. First is a year prior to the year of search. A year prior to the year of search for which the due date of filing of return has not come and you have also not filed the return. That previous year, that preceding year will be called as what? Specified previous year. Second point in specified previous year is the year of search. That is 23-24. So one is 22-23, second is 23-24. Now what is specified date? For last year, the specified date is date as per section notice of section 148. Whatever is the time limit given to file the return under section 148, that will be the specified date for last year. And for current year, the specified date will be the due date as per section 139, subsection 1 of the Income Tax Act. You have to determine these 2 dates first of all. That is specified previous year and specified date. After that, what am I supposed to do? After that, you are supposed to compute what? After that, you are supposed to read the provisions of 271 AAB. Now, the law says that if any undisclosed money, bullion, jewelry, etc. is found, and if you are able to explain the nature and source by giving a statement under section 132 subsection 4 before the end of the search, during the course of the search, till the time the search is completed, if you are able to explain the nature and the source, and if you pay the tax on or before the specified date, you file the return on or before the specified date, you pay interest on or before the specified date, then in that case, we will impose 30% of the undisclosed income as penalty. 30% of undisclosed income of the penalty will still be imposed even if you explain during the course of search. But if you are not able to explain during the course of search, or if you are not able to pay the tax or interest on time, or file the ITR on time, then we will impose 60% of the undisclosed income as what? As your penalty. This is what this theory question is all about. You can go through it. The next question, question number 6, say the first one is a theory question. You can read it through at your end.
The second question is a question on GAR. It's a beautiful question. Listen carefully. IPSE is an Indian company, okay, and there is another company, then company which is in X country X, okay. IPSE in India and then is in country X. Now deliberately then opens one subsidiary in country Y which is known as Zen, and then holds 100% shares of that particular company, okay. Now IPSE enters into a joint venture with REN Limited, and in this REN Limited 51% of the shares is of IPSE and 49% of the shares is of Zen Limited. Now why they have done so? What is the objective behind it? What is the rationale behind it? Let me tell you the rationale behind it. India and country X DTAA says that there is a capital gain tax which will be charged, okay. So if there is any transaction between India and country X, capital gains will be charged, but India and country Y DTAA says that there is no capital gain tax, okay. So what then has done, rather than directly holding the shares in REN, then has made one subsidiary in a country in which there is no tax, and then through that subsidiary he has purchased the shares of REN Limited, and now Zen is transferring the shares of REN Limited and saying that India and country by DTAA says that capital gain should not be chargeable. There is no other activity done by Zen except to buy these shares and then later on to sell these shares. Therefore, it's a clear case of what? It's a clear case of GAR. Why? Because there is no commercial substance in making this particular entity. Why the hell you have made this entity Zen? Only to obtain tax benefit. Why the hell you have made this company Zen? This does not have any commercial substance. This lacks commercial substance. Therefore, GAR will be imposed in this case if the tax benefit is more than what? More than 3 crore rupees. Otherwise, GAR is not applicable. GAR is only applicable if the tax benefit is more than 3 crore rupees to the SSE. So this is what this question is all about. One last question over here is Flex Limited. It's a foreign company. It has earned the following incomes. The very first thing it has earned is it has earned dividend of 8,50,000 from GDR. Now this is taxable at the rate of 10% under section 115 BAC. Similarly, they have also earned some dividend on the equity shares of Indian company. This is taxable at 20% under section 115A. Okay. Now the third one is a very critical point. They have received now some royalty. It is not earned. In the first 2 points it was earned. So it was an income. In the third point it is received. So here you have to gross it up because it is received and you receive after deduction of TDS. Okay. So 8,76,000 you have received as a royalty. Okay. In respect of which in pursuance of an agreement between Flip and Flag. But the agreement is not approved by central government. Therefore, you cannot apply 115A. For 115A to apply, the agreement has to be approved between two parties. Here, the agreement is not approved. Therefore, 115A cannot be applied. Therefore, how much, at what rate this will be taxable? This will be taxable at normal rate, not at 115A rate. That is 8,76,000 will be taxable at 40% plus 4% says 41.6%. But you have to gross it up. Okay. You have to gross it up. How you will gross it up? You will say that 8,76,000 is 59.4%. Therefore, 100 is how much? Cross multiply and gross it up because it is written the word received. Okay. You have to be very careful. Business income will be taxable at 40%. Okay. And the last adjustment, we have done similar adjustment earlier also. That is that now there is an agreement between both the party which is approved by central government and you are providing some technical services. Therefore, it will be taxable under 115A. Okay. Now, but the foreign company is providing you technical services and in return you are giving what? You are not giving money, you are giving debentures. So this 32 lakhs will be taxable at 115A 20%. Why? Because there is an agreement which is approved by central government. But on this debenture they are also earning some interest of 2,88,000. It will be taxable at 40%. Why not at 115A 20%, sir? Because in 115A 20%, the loan has to be given in foreign currency. And here the loan is not given in foreign currency, it is in Indian currency. Therefore, it will be taxable at 40% only. Therefore, interest will be taxable at 40% and FTS will be taxable at 20% as per 115A. Okay. And interest will be taxable as per general rate. So this is what this MTP is all about. So now let's move on to the next MTP, that is MTP Series 2, November 2022. That is the first question again on PGBP. The SSC is a manufacturer. You are not going to follow over here MAT or 115BAA. You are just supposed to compute the business income of the SSC, no tax liability also. Okay. Now the very first adjustment over here. The net profit is 560 lakhs. The depreciation as per books of account 52 lakhs which will be added back. Then you are receiving some concession, power tariff concession from Uttar Pradesh government. That is an income under section 224(18). Any concession, any relief from government will be taxable under PGBP. Therefore, let it be part of PGBP. It is already credited to the PNL. You don't have to do anything. Okay. Then you are making some contribution to National Laboratory of 2.5 lakhs. It is allowed as deduction under section 35(2AA). It is already debited. Therefore, ignore it. Okay. Next, you are selling some plot of land. You are transferring some plot of land to a domestic company, 100% holding subsidiary, and the recipient is an Indian company. Unlike the previous question where the recipient was a foreign company, here it is Indian company, therefore it is exempt. Therefore, reduce from here, write a note that it is exempt under section 47. There is no need to pay tax on that. Okay. The next one is a very good adjustment. You are making some payment of 3.5 lakhs to a transporter who is a partnership firm, but on that particular amount you have not deducted TDS under 194C. The transporter is giving a declaration that he is following 44AE. He is giving a declaration and there is a permanent account number, no TDS. Do you remember that? If the transporter is following 44AE, that is if the transporter does not have more than 10 trucks during any time during the previous year, and he gives a declaration to you and he also gives a PAN with the declaration, then 194C is not applicable in that case. Therefore, in this case, 194C is not applicable. Okay. Now, you have paid some interest of 15 lakhs on loan taken specifically for purchase of second-hand plant and machinery. Out of that, 5 lakh is for the period till the machinery was installed. Okay. So, till the time the machinery is not installed, that interest will be capitalized to the cost of the machinery. Okay. So, therefore, 5 lakhs will be disallowed here. And on that 5 lakhs, you will claim normal depreciation. Additional depreciation will not be claimed because it is a second-hand plant and machinery. Okay. Total 15 lakh interest is there. 10 lakh will be allowed to you because it is paid and it is post period of usage. After you have used, after the usage of the machinery, you have put to use and then you have paid an interest of 10 lakh rupees. But before you have put to use, you have paid an interest of 5 lakh rupees. Add to the PGBP income, it is not allowed as a PGBP expense. And on that 5 lakh rupees, you will be getting what? Normal depreciation, additional depreciation not allowed. Okay. Then there is some bad debts. There is a bad debts which is written off by you. It will be allowed as deduction under section 3617. Then you have got some additional compensation from state government in respect of a compulsory acquisition through an interim order. Remember, if you receive anything to an interim order, then that is not taxable now. That is taxable in the year in which the final order is passed. Therefore, reduce from here and write a note that interim order money will be taxable in the year in which the final order will be passed by the court. Okay. Right now, it is not taxable. Then there is some concept of equalization levy. There is a foreign company who does not have a PE in India, and that foreign company is giving us services of online advertisement services, and we are also making the payment of more than 1 lakh, that is 5 lakh rupees. Then we should have deducted equalization levy. We have failed to deduct equalization levy. Therefore, this expenditure will be disallowed under the income tax law. Then we have incurred some 2 lakh rupees on foreign travel of 2 directors for some collaboration of new construction project, but the collaboration did not work out. The collaboration did not work, and therefore the project was abandoned. Therefore, whatever expenditure you have incurred for this particular foreign travel, it will be disallowed as it is a capital expenditure. Okay. Next one, normal depreciation of 71 lakhs, you can claim as a deduction. Next one, you have issued some debentures at a discount of 3%. Total value of debentures is 1500 lakhs. So on that 3%, whatever is that will be allowed as deduction over the life of the debenture. So whatever that 3% comes to, it will be allowed over the period of 5 years. You have to divide that by 5 and then that will be apportioned over 5 years. Next one, you have received some bill of 3 lakh rupees for the month of March, but you failed to record that in the month of March. You recorded in the month of April. That is wrong. You should record in the month of March. You have purchased that particular inventory in March, so you should record that in the March and therefore take deduction in the month of March only, take deduction in the current year itself. Okay. And one last thing, you have purchased some cotton bales from your related party, that is directors, at a price higher than the normal price. The normal price is 4,600. You have purchased at 5,000. Therefore, 400 rupees will be added as an excess payment to related party, 48 into 1,000 bales. Okay. This is how you are going to compute this question. Very simple question. Nothing great as such. Okay. Let's move on to the next question. The next question is on book profit and your minimum alternate tax. How to compute book profit? Let's see. Your book profit will be computed as follows. Net profit as per P&L. And then there are some items which are credited, some items which are debited. Let's see which all items have to be adjusted and which all items have to be ignored. The first item is profit from ATIA. ATIA profits are not adjusted. Let it be part of book profit. Dividend from investment in Indian companies. Dividend from Indian companies are also not adjusted. Let it be part of book profit. Agriculture income will be reduced because on section 10 income, MAT is not applicable. Then depreciation you will add back and then you will reduce depreciation other than revaluation. Okay. So 10 lakhs you will add back and other than revaluation you will reduce. How much is other than revaluation? 1,90,000 is revaluation on asset depreciation. Okay. Depreciation on 1,90,000 is on revaluation of asset. Therefore, other than revaluation will be out of 10 lakh, reduce 1,90,000, 8,10,000 will be other than revaluation. Okay. Penalty is not disallowed under the MAT provisions. Provision for GST is not disallowed under the MAT provision. Provision for doubtful debts, yes, it is disallowed under the MAT provision. Then interest, even if it is paid or unpaid, it doesn't matter. It is not disallowed under the MAT provision. And last but not least, provision for what transfer to reserves. If you transfer to any reserves, then it is disallowed under the MAT provisions. Okay. Then they have given some extra information to us, that is depreciation of as per income tax rules, not relevant in MAT, that is relevant under the normal provision. Then they have said that the company has not debited some interest on borrowed capital in the P&L account. Forget about it. Whatever P&L is given to you, you have to accept that. You cannot make changes in the P&L as per the Supreme Court judgment of Apollo Tyres Limited. Remember or not? You have no right, being an assessing officer, you have no right to change the P&L account. Okay. Therefore, don't make any changes in the P&L account. GST remitted before the, I am not interested. Whether GST is remitted or not remitted, under MAT provision, it is of no use. Under the normal income tax provision, if GST is not remitted on or before the due date of filing of return, it is disallowed as per section 43B. But in MAT, it is of no use. Okay. Now let's move on to the next question. we need to answer whether transfer pricing will apply in these cases or not. Okay, very good question. There is a company ABC Inc. which holds 32% shares of Alpha Limited. Whether transfer pricing will apply between these two? The answer is yes. Then there is an Alpha Limited which holds 75% in Beta Limited. Whether transfer pricing will apply? Yes, 26% or more. That is not the question. Whether transfer pricing will apply between ABC Inc. in Beta or not? That is the question. So for that purpose, we need to see ABC holds how much in Alpha? ABC holds 32% in Alpha, and in return Alpha holds 75% in Beta. Therefore indirectly ABC holds how much percent in Beta? ABC holds 75% का 32%. ABC hold 75% का 32% in Beta, which comes to 24%. Check. 75% of 32%, which comes to 24%, which is less than 26%. Therefore, it will not be subject to what? Transfer pricing provision. I hope it is clear to all of you. Next one is a question on domestic transfer pricing. Always remember, whenever there is a question on development of highway project, etc., always remember ATIA is applicable. So one entity is eligible for ATIA, another entity is not eligible for ATIA. Is domestic transfer pricing applicable between both of them? Yes, it is applicable, because one entity is eligible unit, another entity is non-eligible unit. Domestic transfer pricing may apply, but here in this case it is not applied, because if we consider the value of transaction, it is less than 20 crore. Remember, for domestic transfer pricing to apply, the value of domestic transaction should exceed 20 crore rupees. Otherwise, domestic transfer pricing is not applicable in the SSC's case. Next one is a very, very intelligent question. A Limited is a power generation SSC opting for 115 BAB. Remember, if one unit is opting for 115 BAB and another unit is not opting for 115 BAB, and if they enter into a transaction, then also domestic transfer pricing is applicable. Again, the value of transaction should exceed 20 crore. In this case, if you do the multiplication 10,000 metric ton into 23,000 per metric ton, it exceeds 20 crore rupees. Therefore, here transfer pricing is applicable. In second case, it is not applicable because it is less than 20 crore rupees. I hope it is clear to all of you. It's a beautiful question. Okay. Now, the next question is a simple question on DTAA. Mrs. Radha, 39 years, citizen of India, resident of India. Very simple question. One important point to be kept in mind over here is she has paid some 35,000 rupees to ensure the health of her mother who is non-resident. Now, because the mother is non-resident and 63 years, you will only get 25,000 rupees deduction. You will not get 50,000 deduction. If the mother would have been resident, you would have got 50,000 deduction. This is the only thing that you have to keep it in mind. Okay. Apart from that, you need to follow the old regime in this question. You need to be very careful in May 2024 and November 2024 with old regime and new regime, because new regime has become the by default regime and old regime has become an optional regime. You have to be very careful with that particular aspect in the examination. Okay. Now the next question is on TDS. Again, a beautiful question. One, Mr. Aryan, TDS and TCS both. Okay. Mr. Aryan, an Indian citizen, he came to India on a visit on 25th of Feb 2024. Therefore, he is definitely a non-resident. Okay. So because if somebody comes on 25th of Feb 2024, he hardly stayed in India for 1 month, 1.5 months. Okay. So therefore, he is a non-resident. Now, he came to India and he booked the tour for Malaysia of 5.2 lakh rupees. Remember, if you book a tour for outside India, overseas tour package program, you are liable for what? TCS. But in this case, the CBDT has given a notification that if a non-resident comes to India for a visit and if he books a tour operation, etc., or sends money outside India, then the provisions of 2061G is not applicable. This is a non-resident who is coming to India for a visit, then provisions of 2061G is not applicable, not applicable, not applicable. Next question. Srishti was incorporated in the current year. That is 23-24, Srishti was incorporated. This is the first year of Srishti Limited. And the turnover of Srishti in the current year is 14.5 lakh. It is purchasing some goods from Mrs. Philip Company, and the Philip Company is an old company. The Philip Company's last year turnover was 11 crore. Philip Company's current year turnover is 9.7 crore. So I am Srishti, I am buyer. You are Philip, you are seller. I am first year. This is my first year. Therefore, for me, 194Q will not apply. For 194Q to apply, the buyer should have a business turnover of more than 10 crore rupees in the last year. And in this case, the buyer does not have any business in the last year. Therefore, if 194Q is not applied, then whether seller will be liable for 2061H? Yes, seller will be liable for 2061H. On what basis? On the turnover of last year is more than 10 crore rupees. The seller's last year turnover is 11 crore. And seller is selling goods of more than what? More than 50 lakh rupees. Now seller will collect TCS, but in 2061H, remember, TCS is collected on receipt basis, not on receipt or debit, whichever is earlier. So whenever the amount is received, at that time it will be collected. And in the question it is written that the receipt is done after 1 month. Whenever the goods are sold, after 1 month of that, the payment is received. Therefore, on first 32 lakhs, no TCS, because TCS is applicable only on more than 50 lakhs. Next 31 lakhs, yes, TCS will be applicable on excess amount of 50 lakhs. 32 plus 31 comes to 61 lakhs, 63 lakhs, sorry. So what is more than 50 lakhs? 13 lakhs is more than 50 lakhs. 0.1% TCS will be applicable. But after 1 month, 18 September you have sold, So 18 October it will be, TCS will be collected on the date of receipt. Okay. Similarly on this 18 lakhs also, it will be applicable on 18 December, not on 18 November. 18 November it is sold. And payment is received on 18th of December. So TCS under 206C1H is applicable on receipt basis, not on receipt or debit, whichever is earlier. Okay, be very, very careful about it. Next one is on 194O. It's a company like Amazon. Amazon is there and Amazon is selling some goods of 52 lakh rupees to a seller, through a seller, that is e-commerce participant. But the seller unfortunately is not giving PAN and Aadhaar. So in 194O, generally we deduct TDS at 1%. But if the seller does not give PAN and Aadhaar, then what to do? Then we have to deduct TDS at the rate of 5%, not 20%. Remember, there are two sections under TDS where if the payee does not give the PAN or Aadhaar, then you have to deduct TDS only at 5%. One is 194O, another is 194Q. These are the two sections where the TDS will be not deducted at 20%, but only at 5%. Okay. The next question is again on equalization levy, but a beautiful question. There is one company, Turnip Inc., and another company, Sam Inc. Now, Sam is providing online advertisement to Turnip. Now, we need to make three assumptions over here. How much receipt is there of Sam? Sam is having a receipt of 4.2 crore rupees. And how much Turnip is paying? Turnip is paying 5 lakh rupees to Sam. Okay. So, one entity is providing online advertisement service to another entity. The total turnover is 4.2 crore rupees. And they are providing, and the person who is receiving the services is making a payment of 5 lakh rupees. Now we need to make three assumptions. Assumption one, both Turnip and Sam has no permanent establishment. So Sam does not have permanent establishment, even Turnip does not have permanent establishment. Remember, now we will need to always start with 2016 equalization levy. Whether 2016 equalization levy will apply? The answer is no. Why? Because in 2016 equalization levy, Turnip has to be either resident or Turnip should be a non-resident who has a P in India. Now Turnip is neither resident nor a non-resident who has a P in India. Therefore 2016 equalization levy is not applicable. Whether 2020 equalization levy will be applicable? The answer is yes. Because in that case, Sam is an e-commerce operator providing online advertisement services to another non-resident who is targeting Indian customers. See, to increase its shares in market in India. Okay. So because it is targeting Indian customer, 2020 equalization levy will apply. 2% equalization levy will apply because the limit is also more than or equal to 2 crore rupees. The turnover in India is more than equal to 2 crore. Therefore, 2% equalization levy will apply in this case. Second case, if Turnip has a permanent establishment, then it is a classic case of 2016 equalization levy. Why? Because Sam is a non-resident who does not have a PE providing online advertisement service. Turnip is a non-resident who has a PE and making a payment for online advertisement of more than 1 lakh rupees. Therefore, Turnip will be liable for what? Deducting the equalization levy as per section 165 2016 equalization levy 6%. If it does not deduct, the expenditure will be disallowed. Once it deducts and makes the payment, then Sam will not be liable to tax. Third case, both of them has a permanent establishment. If both has permanent establishment, Sam has permanent establishment in India, then the question of equalization levy will never arise. In that case, Sam will be liable for income tax because his income is deemed to accrue or rise in India as per section 911. If Sam's income is deemed to, Sam has a P in India, it is attracted under 911, his income is deemed to accrue as in India, therefore the question of equalization levy will not arise in this case. Okay, I hope it is clear to all of you. So it's a beautiful, beautiful question. Next question, Mr. Sanjay, he has filed a return of income and in the return he has declared an income of 52 lakh rupees. Okay, after that the AO has done an assessment and AO has increased the income by 3,20,000 rupees. Now the assessee wants to go for what? The assessee wants to go for what? Dispute resolution committee. Can assessee approach dispute resolution committee? The answer is no. Why, sir? The assessee is violating the condition. Which condition assessee is violating? One of the condition to go to dispute resolution committee is your returned income should not be more than 50 lakh rupees. Here the return income is 52 lakh rupees. Therefore, it is not possible to go to what? Dispute resolution committee. Therefore, what is other remedy available with the assessee? Assessee can go to CIT appeal within 30 days or joint commission appeal within 30 days from the date of receipt of notice of demand, or assessee can go for revision under 264. But the dispute resolution committee doors are closed for the assessee. Okay. Now, one last question over here, question number 6 in this particular MTP. First question, there is an Indian company who is engaged in some business and the turnover of last year is more than 50 crore rupees. Remember, any assessee who is doing a business, whose last year turnover is more than 50 crore rupees, they have to keep certain mode of payments in the business like debit card, RuPay, QR code, UPI as per section 269 SU. But this assessee is saying we only have cash, check, credit card and debit card. We don't have all these things. So is it allowed? It is a violation of 269 SU and therefore there will be a penalty of 271 DB imposed on you, which is 5,000 rupees per day till the time you install these mode of payment in your business. Okay. I hope it is clear to all of you. Next one is a question on whether GAR will apply or not. There is an assessee who has two manufacturing units. One is in SEZ and another is in non-SEZ. Now, the unit which is there in SEZ, that is not doing manufacturing. Manufacturing is done by non-SEZ unit and the SEZ unit is doing only packing. Only packing is done by SEZ unit and non-SEZ unit is doing what? Manufacturing. Therefore, this is a clear case of tax evasion. Then because it is a case of tax evasion, therefore GAR will not apply in this case. Okay. Second one is a very simple case. One unit is is in SEZ and another is in non-SEZ. So one is eligible for 10AA, another is not eligible for 10AA. If they enter into a transaction between both of them, then domestic transfer pricing will apply. Therefore, GAR will not apply because there is a specific SAR, specific anti-avoidance rule. Therefore, the GAR provisions will not be applicable in this case. Okay. And one last question over here is a beautiful question. XYZ Limited is a company in country P. They have entered into an agreement with G Limited and Y Limited, an Indian company. Okay. And for providing technical services to them, and which is approved by central government, and therefore there is an agreement. Therefore, the provisions of 115A will apply. Whenever there is an approved by central government written words is there in the examination, it means 115A or 44DA will apply. Now we need to solve this question in two ways. Assuming that the company does not have a P in India. If company does not have a P in India, then the provisions of 115A will apply. And if 115A will apply, how will we compute the income? First of all, this is 250 lakhs. The expenses will not be allowed in 115A. Another receipt is 302 lakhs. Again, expenses will not be allowed in 115A. Okay. All these expenses will not be allowed. So 265 plus 302, this is the receipt. On that 20% income tax will be charged. 2% surcharge will be charged because the income is more than 1 crore up to 10 crore. Therefore 2% surcharge on foreign company and 4% cess will be charged. Okay. Now if we assume that whether the assessee will be liable for filing return under 115A, no. If the assessee has only earned this income and the TDS is deducted as per section 115A, not lower than the rate specified in 115A, then there is no need to file the income tax return also. Okay. Now if we follow 44DA, then what will happen? Then assessee will get all the expenses deduction except some expenses which I am going to tell you now. Against 265, 35 lakhs will be allowed as deduction. Against 302, because this is directly related to that particular income. But an expense which is not wholly incurred for the Indian branch will not be allowed as deduction. Further, an expense which is not in the nature of reimbursement to HO, it will also not be allowed. Only reimbursement to HO will be allowed as deduction, not other expenses which is not in the nature of reimbursement. Yes, if you have taken some services from third party and your HO has paid that payment to third party, and if you are reimbursing them, then that will be allowed as a deduction under 44DA. In 44DA, you are supposed to maintain the books of account, you are supposed to conduct the tax audit, you are supposed to file the ROI also, return of income, and you are liable for tax rate at 40%, which is applicable to normal companies. Okay, so this is what this MTP is all about. So let's move on to the next MTP, that is MTP Series 1, May 2023. There is an assessee by the name called as Risk Hospitality Limited, 3-star category hotel is there. But unfortunately, we need to be very careful with the last line. Otherwise, you will read the entire question and don't read the last line. That the assessee is not eligible for 3580. Even though it is a 3-star hotel, don't claim 3580 deduction. Okay. Let's start with the adjustment. 152 lakh is the profit. 25,000 is paid to Mr. Raja, an agriculturist, for purchasing a corn in cash. Okay. So can you make the payment in cash? Can you make the payment in cash to purchase an agricultural product? Yes, you can. Therefore, this 25,000 will be allowed as deduction. Next 30,000 is made as payment to Mr. Khalid to purchase masala. Now, masala is not an agriculture product, corn is an agriculture product, masala is not an agriculture product. So only if you purchase an agriculture product from a farmer, then rule 6DD is applicable and you can make the payment of more than 10,000 rupees in cash. So for corn, it will be allowed. For masala, it will not be allowed. Okay. Next one is a pension. Employer is contributing some amount to pension of the employee. Now, how much deduction is allowed to the employer? Only up to 10% of basic salary and DN terms. Up to 10% of basic and DN terms. Now, how much the company is paying? Company is paying 3 lakh rupees and it is 12% of basic and DN terms. Okay. So, how much will be disallowed? 2% has to be disallowed. Therefore, 2% will come to 50,000. 50,000 should be disallowed under the income tax law. Okay. Only up to 10% of basic and DN terms is allowed as deduction. Now, the next adjustment is a similar adjustment which you have done in the previous paper also, that you have made a payment of 6.5 lakhs to a transporter without deduction of TDS, but the transporter is following 44AE. Therefore, transporter does not have more than 10 trucks. The transporter is giving declaration also. The transporter is giving PAN also. Therefore, no TDS under 194C. Okay. The next one is also a very simple adjustment. You are selling some land to a 100% subsidiary, which is a domestic company, which is an Indian company. So, if you transfer a capital asset to your 100% subsidiary, and if the subsidiary company is an Indian company, then in that case, provisions of capital gains are not applicable. It is exempt. So, reduce from here and write a note that it is exempt under section 47. Okay. Next one, you are making some payment of 2.5 lakh rupees to IIT, which is allowed as deduction under section 35 2AA. Next one, again a similar adjustment. 2 directors have went for foreign travel. The project was abandoned. Therefore, it is a capital expenditure. Therefore, it will not be allowed as deduction. Okay. Next, you have paid some 1 lakh rupees to directors, independent directors, for attending board meeting. So, whenever you make payment to directors over and above salary, then the TDS is deductible under 194J at the rate of 10%. Therefore, here you have not deducted the TDS, therefore 30% of the expenditure will be disallowed under the income tax law. Depreciation will be disallowed. Again, next one is a similar adjustment. You have received some amount as an additional compensation in pursuance of an interim order of an court. So whenever you receive any amount in pursuance of an interim order, it will be taxable in the year in which the final order is passed. So right now, reduce from here, it is not taxable as of now. Then you have received some dividend from foreign company of 5 lakh rupees. So reduce from here and show under IFOS. And you have distributed dividend of 7 lakh rupees to the shareholder on or before 1 month prior to the due date of filing of return. So you will get deduction under ATM. But you have received 5 lakh rupees and you have distributed 7 lakh. So you will get deduction of lower of the two, only 5 lakh rupees. Okay. I hope it is clear. Next adjustment, depreciation of 15 lakhs, which is as per income tax rules. You have to reduce that. Next adjustment, again, it is repeating. See, you have received some, you have purchased some goods in the month of March, but the bill was omitted to be recorded. So you recorded that in the month of April. You should not do that. You should record in the month of March only. So therefore, because the expenditure pertains to March, therefore you should record in March only, and you can take the deduction in March itself. Okay. This is how you are going to compute the total income of Pratik Hospitality Limited. A very simple question. The next question is exactly similar. We have done this question earlier. You can check it in your RTP or MTP. Somewhere we have done it. And MTP not, RTP or past paper we have definitely done it. Same question with same numbers. That's the reason I'm not repeating unnecessarily this question. You can check it once if you want. Okay. The next question is a simple question on DTAA, and simple question on DTAA doesn't make sense to repeat again and again. In DTAA, what you are supposed to do? First, you are supposed to compute income, take all the incomes, compute tax, find out the average rate. After that, find out how much is the doubly tax income and apply the foreign rate or Indian average rate, whichever is lower on doubly tax income, and take the relief under section 91. So it's a very simple question, nothing great as such. Okay. Now let's move on to the next question. Question number 3, part 1. There is an assessee who has gone to advanced ruling, and assessee is aggrieved by the advanced ruling. Now, is there any remedy available to the assessee? Yes. Assessee can go to High Court within 60 days. Assessee can go and appeal to High Court within 60 days. If there is a genuine cause, then assessee will also get a discussion. Assessee will also get a extension of 30 days more. This also we have done earlier, but still it is an important point. That's the reason I'm saying it once again. Okay. Next question is on equalization levy. Okay. There is a foreign company, XYZ INC, XYZ and company are non-resident. Now that company does not have a P in India. Now that company is having an e-website. That is, it is like an Amazon. It has a website. Okay. Now through that they are selling some goods manufactured by it. So therefore 2016 equalization levy is not possible. Why, sir? 2016 equalization levy is only applicable in case of online advertisement services. It is not applicable for sale of goods, or it is not applicable for provision of other services other than online advertisement service. Therefore 2016 equalization levy is not possible here. Only 2020 equalization levy is possible. For 2020 equalization levy, what is the condition? There has to be an e-commerce operator who should be non-resident. He should not have any PE in India, and the services and the goods sold in India should be at least of 2 crore rupees or more. Okay. Therefore, let's see how much. Is he a non-resident? Yes, he is a non-resident. Does it have an e-commerce website? Yes, it has an e-commerce website. Does it have a PE? No, it doesn't have a PE. Now we need to check only one thing, whether the services and the goods sold to India is at least of 2 crore or not. Therefore, 158 lakhs is sold to person resident in India, it will come. And 96 lakhs is sold to person not resident in India. But out of this 96 lakhs, 57 lakhs is sold to persons who are using IP address located in India. Therefore, out of this 96 lakhs, 57 lakhs will be considered in the turnover limit of 2 crore rupees. Okay. Therefore, 158 plus 57 comes to 215 lakhs. Of that, 2% equalization levy will be applicable in the hands of XYZ and company. I hope it is clear to all of you. Now, question number 4 is on TDS. We need to say whether TDS will be applicable or not. Okay. Now, Mr. X has made 3 separate transactions. First, he has purchased a house property of 90 lakh rupees. Okay. But the stamp duty value of that house property is 95 lakhs. So, is TDS applicable? The answer is yes. 194 IA will be applicable at the rate of 1% on higher of the sale consideration or stamp duty value, whichever is higher. Therefore, on 95 lakhs, Mr. X is liable to deduct TDS under section 195, 194 IA. Second, he has purchased an urban plot of 49,50,000 rupees, and the stamp duty value of that plot is 48 lakhs. Therefore, the stamp duty value as well as the sale consideration, both of them is less than 50 lakhs. Therefore, no TDS on this particular transaction. And third one is a rural agricultural land. Rural agricultural land is exempt under section 194 IA. 194 IA does not talk about deduction of TDS on rural agricultural land. Therefore, do not deduct TDS on that. Next one. Thus, TDS on commission retained by consignee is applicable? Yes, TDS is applicable even if the commission is retained by the consignee. For example, I tell my consignee that you sell the goods on my behalf, and whatever goods you will sell, out of that 10% you retain your commission and balance you give it to me. Okay, suppose you sell 1,50,000 rupees goods, 15,000 you retain and balance 1,35,000 you give to me. Then on that 15,000 which is retained by the consignee, on that also TDS is applicable under the income tax law. Be very careful. Next one is a salaried assessee. He is earning a salary of 55,000 rupees per month. Therefore 55,000 into 12 will be his salary. Plus he has also taken a house property which is on loan. On that he has paid an interest of 80,000 rupees. So 80,000 rupees SOP interest also he will get deduction. He is following old regime. So on that the assessee, the company will deduct TDS on slab rates. Okay, so we need to compute properly the tax of the assessee. 655,000 into 12 minus 50,000 standard deduction. Then whatever income will come less 80,000 rupees house property loss. Whatever income will come, on that they have to apply the tax rate. Okay, and then accordingly the company will deduct the TDS. One last thing over here in the question of TDS is Mr. Anand is an individual and the last year turnover of individual is more than 1 crore rupees. Last year turnover is 202 lakhs. Therefore 194I will be applicable on rental income. Okay, 194I is applicable to individual HUF when the last year business turnover is more than 1 crore or last year profession turnover is more than 50 lakh rupees. Here Mr. Anand is doing business, his last year business turnover is more than 1 crore, therefore 194I is applicable. And in 194I the limit of TDS threshold is 2,40,000, which is aggregate of everything, plant, machinery, equipment, furniture, land, building, everything taking together should exceed how much? Should exceed 2,40,000 rupees. Now the assessee has paid 15,000 rupees per month for office, therefore 15,000 into 12 will come to 1,80,000. On that the assessee will deduct 110% TDS, and the assessee has also taken furniture and fixture of 6,000 rupees, that is 72,000. Therefore 1,80,000 plus 72,000 we have to see aggregate. Under 194I we have to see aggregate, therefore it crosses 2,40,000 and therefore 10% TDS on both of them. Sir, furniture is also subject to 10% TDS? Yes. Land, building and furniture is subject to 10% TDS. Plant, machinery and equipment is subject to 2% TDS. So you have to be very careful with this particular part. Okay. Now the next question is a beautiful question. It's a very, very good question. So mark this down. It's a different kind of question as compared to the other question. There is an FII. Remember, whenever there is an FII, there are two sections which should be clicked to your mind. One is 194LD, which is covered under 115A. 194LD, which is covered under 115A, and second is 115AD. 115AD, which is a separate section. Okay. Therefore, these two sections should come to your mind whenever FII provisions come in the examination. First of all, rupee denominated bond of FII of Indian company is covered in 194LD. Go and check. In 194LD, if an FII buys a rupee denominated bond of an Indian company, the interest will be taxable at 5%, 5%, 5%. Dividend for all the non-residents will be taxable under 115A at 20%. Okay, and interest on securities, okay, will be taxable at 20% under 115AD, 17,32,000. No deduction of expenses will be allowed under 115AD. This is what I am saying from the provision. You will say, from where are you saying all this data? You open the book and check, you will get all these things in your respective books, okay, from whichever books you are reading. Now the assessee has also sold some security. First, the assessee has sold some bond which was purchased in 2017, sold in 2023. Therefore, it will be covered in 115AD. But in 115AD, even though it is long term, purchased in 17, sold in 23, even though it is long term, but indexation benefit will not be available. Therefore 47 lakhs minus 32 lakhs, 15 lakhs. And in 115AD, long-term capital gains, general long-term capital gains are taxable at 10%. Okay. Second is listed shares purchased in 2022 May, sold in February 2023. It is sold for less than 12 months and on which STT is paid. Therefore, this will be also covered in 115AD, and this is covered under 115AD, and therefore it will be taxable at 15% because it is the case of 111A because STT is paid on this. Okay. Third one is unlisted equity shares purchased in 2022, sold in 2023. Again, it is a short-term capital gains because the unlisted shares sold within 24 months are short-term capital gains. 8,40,000 minus 3,72,000 short-term capital gains. Normal short-term capital gains under 115AD is taxable at 30%. Remember, there are 4 capital gain rates given under 115AD. Normal long-term capital gain 10%. Normal short-term capital gains 30%. 111A short-term capital gains 15%. 112A long-term capital gains 10% subject to 1 lakh exemption. You have to be very careful with all these things. Okay. I hope it is clear to all of you. Now, coming to the next question. Question number 5. Question number 5 is a simple question. There is an assessee, Mrs. Srimati Kanti, who is engaged in growing, curing, roasting, grounding of coffee and has earned income of 6 lakh rupees. Therefore, how much will be taxable? Only 40% will be taxable and 60% will be exempt under the income tax law because there are specific rules which are applicable over here. Rule 7B. Therefore, 40% taxable is how much? 40% taxable comes to 2.4 lakhs. Now, because the taxable income is less than the basic exemption limit, which is just 2.4 lakh rupees, therefore the assessee is not liable to file the return. Because of this reason reason assessee is not liable to file the return. But they have given one more reason. The assessee has traveled to USA. For that purpose, the assessee has incurred more than 2 lakh rupees for the purpose of foreign travel. So if you incur more than 2 lakh rupees for the purpose of foreign travel, are you liable to file income tax return? Because of this reason now, 2.2 lakhs, the assessee is liable to file the income tax return. Next, some theory questions are there. The Commissioner of Income Tax Appeal has the power to enhance the assessment, plenary or quite wide. Yes, can the Commissioner of Income Tax enhance your assessment? See, the Commissioner of Income Tax has wide powers. The power of Commissioner of Income Tax is at co-terminus with the assessing officer. It means it is at par with the assessing officer. Okay. And the Commissioner of Income Tax can confirm the order of AO, can enhance the order of AO, can reduce the order of AO. All these powers are there with the Commissioner of Income Tax. Okay. Next one. At the time of hearing the rectification application, so when the rectification application is heard by the income tax tribunal, can they reappreciate the evidence produced before the appeal? The answer is no. I went to the ITAT for rectification under the income tax law for an apparent mistake, and the ITAT is altogether listening a new case. ITAT is altogether hearing altogether the new case. Can they do so? The answer is no. ITAT does not have the power to reappreciate the entire matter. ITAT can only rectify the apparent mistake which is there. It cannot rectify, it cannot reappreciate the entire matter. Okay. Next question. Question number 6 is a very, very simple question again. AY 22-23 order was passed by the assessing officer. Okay. But while making the order, the AO wrongly wrote as AY 21-22. Okay. So while making the assessment was of AY 22-23, but while making the order, the AO typological error. It was written as 21-22. So because of this reason, the assessee claimed that the entire assessment is what? Invalid. Can a typological error can make your assessment invalid? The answer is no. Section 292B is a section which protects such cases, which says that if there is any clerical mistake made by the income tax department, that cannot lead to what? Invalid assessment. The assessment will be invalid. The assessment will be valid, and it is absolutely correct in the eyes of the law. Okay. Now next few questions we need to answer, whether it is tax planning, tax management or tax evasion. The assessee is maintaining some register for TDS. It's a tax management. The assessee is obtaining some declaration from the lenders in form 15G, 15H, so that the department does not ask question to the assessee. It's a tax management. Third one, the assessee is purchasing some AC and putting in the residence of director, but showing that as what? As it is fit in the company, in the factory, and claiming depreciation. It's a clear case of tax evasion. Okay. Next, the assessee is paying 80,000 more brokerage to one of its director's son, so that the income of the director's son increases from 4,20,000 to 5 lakhs, and even on 4,20,000 there is no tax, even on 5 lakh there is no tax, but the company will get an advantage of deduction of 80,000 rupees. It's a tax evasion. And last one, the assessee makes a deposit of 1 lakh rupees in nationalized bank to save some tax. This is nothing but allowed under ATC, therefore it is a tax planning. Okay. And one last question over here is on transfer pricing, which is a very, very, very simple question. XC Limited is an Indian company and Zilla INC is a US company, and it holds 28%, and therefore if one entity holds 26% or more of voting power of another entity, then both of them are deemed to be associate enterprise. Now, XC Limited sold the t-shirts to Zilla at 2 per unit, whereas to unrelated party it sells at 3 per unit. So to unrelated party you are selling at higher price, to related party you are selling at lower price, therefore differential amount has to be added back. $1 per unit into 1 lakh units into 64 is the dollar rate. Okay. Similarly, XC Limited borrowed $2 lakh from foreign lender based on guarantee of Zilla, and it paid 10,000 as guarantee fee, whereas to unrelated party it pays a guarantee fee of $7,000. So to associate enterprise it pays a guarantee of $10,000. To other it pays a guarantee of only $7,000. So we are paying $3,000 more to associate enterprise. So $3,000 into 64 will be added back. Okay. Similarly, you are paying some extra amount for getting various potential customers, some kind of commission. 15,000 to associate enterprise, and to unrelated party you are paying lesser 10,000. So the differential amount has to be added back, 5,000 into 64. So therefore this much is the amount of income which will be added back in the form of what? Primary adjustment. Now the question over here is, please listen carefully. If these additions are made by AO, so if assessing officer make this addition, can we claim deduction under 10AA on these additions? The answer is no. So whenever the arm's length price is increased by the assessing officer, so whatever arm's length price is increased by the assessing officer, on that much amount you cannot claim deduction under 10AA. You cannot claim chapter 6 deduction as per section 92C subsection 4 first proviso. Okay, you cannot claim deduction on the amount which is increased by the assessing officer in the form of increase in arm's length price. No 10AA, no chapter 6A. I hope it is clear to all of you. This is what this MTP is all about. So let's move on to the next MTP, that is MTP Series 2 May 2023. The very first question is on PGBP income against XYZ Limited is a manufacturing assessee, and you're not supposed to follow MAD, you're not supposed to follow 115B AA, and the turnover of last year is 405 crore, which is more than 400 crore. Therefore, the tax rate will be 30%. of the SSC. Okay, so these are the few things that I would like to start with the question. First thing is depreciation, you will disallow, the profit is 700 lakhs. Second thing is employer contribution, you can make the payment till the due date of filing of return, that is allowed, but employee contribution you have to make the payment by 15th of the following month, therefore it is disallowed because it is paid after 15th of the following month. Okay, so employee contribution you cannot make the payment after 15th of the following month. Next one is the repeated adjustment, you have received some industrial tariff concession from the state government which is credited to the P&L. So any concession which is received from the state government is an income under section 224(18), therefore it will be chargeable under PGBP. The third adjustment is you are making some provision of 25 lakh rupees as a periodical wage revision which is on a fair estimation. So after every 3 years you see the performance of the employees, or you make some provision for wage revisions, and that is on a fair estimated basis, therefore it is allowed under the income tax law. Okay, next one, you have made some provision for bad debts. So provision for bad debts are not allowed under the income tax law, that is disallowed. Provision for bad debts is only allowed to a bank and to NBFCs. Next one, you have charged some 40 lakh rupees as actual bad debts. Now actual bad debts is allowed as deduction under the income tax law under section 36(1)(7). Provision for bad debts will not be allowed. Okay, next one, you have purchased some goods of 50 lakh rupees. Now your creditors is giving you discount of 75%. It means 75% will be treated as your deemed income, but you have already credited that to P&L, therefore ignore this, you don't have to give any effect to that. Okay, next is your opening stock and your closing stock is overvalued by 10%. So if your opening stock is overvalued by 10%, so divide that by 110%, find out how much it is overvalued, and you have to add back that. And if your closing stock is overvalued, it means your credit side of P&L is more, therefore reduce that much profit, 10% has to be reduced from your P&L. So in both the cases you have to divide by 110%, and opening stock you have to add back, and closing stock you have to reduce. Provision for payment of gratuity is disallowed under income tax law, so 500 lakhs will be disallowed, but whatever provision is actually paid to the employees, that will be allowed under the income tax law. Next one, you are making some payment for recovery agent for realizing of debt, and you have deducted the TDS, you have also remitted the payment, everything is done properly, therefore your expenditure will be allowed under the income tax law. There is nothing wrong in that. Okay, now you are purchasing something from your related party which is covered under 48(2). Directors are related party of the company, and you are making some excess payment, therefore excess payment will be disallowed under the income tax law. Okay, next one, there is an addition to plant and machinery of 50 lakh rupees which is used for more than 180 days, but unfortunately you have not provided for additional depreciation, and you are a manufacturing assessee, you are not following 115 BAA, therefore you are eligible for additional depreciation at the rate of 20%. Why 20%? Because it is put to use for more than 180 days. Okay, normal depreciation 80 lakhs, you can claim that as deduction, no issues in that. Next one, last year you have made a payment to contractor, last year 2023, last year you have made a payment to contractor, but the TDS of that is paid in the current year. Therefore, in the last year the TDS was not paid, therefore 30% of 10 lakh would have been disallowed in the last year, and that 30% of 10 lakh will be allowed as deduction in the current year. So in the current year profit you can reduce 3 lakh rupees. Okay, and last but not least, you have collected 7 lakh as GST from the customer, and after that you paid that to the government. So 7 lakh you collected, 7 lakh you paid, so it is knocked off. Then you made an appeal to the High Court, and the High Court has directed the government to give you refund of 3 lakh rupees. So you have got refund of 3 lakh rupees from the government. Now it is your duty to give that back to the customer, because GST ultimately belongs to the customer. Now, if CBDT is giving, CBIC is giving you some kind of a refund on GST, you should give it to the customer. So you received 3 lakh, but you paid only 2 lakh rupees to the customer. 1 lakh is still not paid, so 1 lakh you have to add it back. Okay. After that, you will compute your tax. Tax is very simple. 30% tax, as I have told you, last to last year turnover is more than 400 crore. 7% surcharge because the income is more than 1 crore rupees, and 4% cess will be imposed on you. Okay. Now coming to the next question, it's a beautiful question. Pay attention, please, all of you. This is the partnership firm whose gross total income is 300 lakh rupees. Okay. Now this firm has not done any international transaction or any specified domestic transaction. Therefore, this firm is not liable for transfer pricing. Okay. Now, in this 300 lakhs GTI, the firm has a profit of 200 lakhs from a business which is covered under 80IA. So 80IA is eligible for 100% deduction for first 5 years, and after 5 years the deduction reduces. Now this is the 5th year of business, therefore SSC will be eligible for 100% deduction. Now there is a problem over here. There are some gray areas in the taxation working, and the company is contemplating that they will file the return on 7th of December 2024 after seeking clarification from the expert. Advise the company what would be the total income and tax payable if they file the return on 31st October, which is on time, and if they file the return on 7th of December, which is late. Okay. So now we need to answer two things. If the company files the return on time, then what will happen? If the company files the return late, 31st October is the correct time, because partnership firm having 300 lakhs as gross total income, definitely liable for tax audit, and therefore liable for tax audit, then the due date is 31st October, not engage in any kinds of international transaction, therefore transfer pricing is not applicable, therefore 30th November is not possible. Now, let's assume that if the SSC files on 31st 31st October, then what will happen? If the assessee files on 31st October, believe me, then the assessee is eligible for deduction under ATIA. ATIA, ATIB, all profit link deductions including 10AA is allowed only if you file the return on time. If you file a late return, then it is not allowed. Therefore, if you want this deduction, you should file the return on time. Therefore, if the assessee files the return on 31st of October, assessee would be eligible for deduction. And how will the assessee be computing the income? Listen carefully. The gross total income is 300 lakhs. Out of that, 200 lakhs will be allowed as deduction. 100 lakhs will be the total income. On 100 lakhs, tax will be 30%, 4% cess. Surcharge will not be imposed on the assessee because surcharge is applicable to partnership firm if the total income exceeds 1 crore rupees. In this case, it is exactly 1 crore. Therefore, this is first calculation. But at the same time, it is a partnership firm and claiming deduction under ATIA. Therefore, it will also be applicable for what? AMT, 115JC. Therefore, we need to compute 115JC also now. How will we compute adjusted total income? Whatever is the total income, that is 1 crore, add back the ATIA deduction, that is 200 crore, 200 lakhs will be added back. Okay. Therefore, the assessee's adjusted total income will come to how much? It will come to 300 lakhs. On 300 lakhs, you will apply 18.5% tax plus 12% surcharge now because the adjusted total income is more than 1 crore and 4% cess. Okay. And down you will compare whichever is higher will be your tax liability. This will be your first tax calculation if you file the return on 31st October. Okay. Now, if you file the return on 7th of December, then you are not going to get the deduction of what? Deduction of ATIA. And if you are not going to get the deduction of ATIA, you are going to make only one calculation. That is normal provision. The concept of 115JC now will not arise because 115JC will be applicable only if you claim the profit link deduction. So if you file the return on December 7th, then in that case, 115JC is not applicable because you are not eligible to claim ATIA. Then your total income will be directly 300 lakhs. On that 30% tax, 12% surcharge, 4% cess. Obviously, the second case, if you file the late return, the tax liability will be more. You can go and check. Now, we need to give them some advice. The sincere advice that I can give them is you need to file the return. You please file the return on 31st October. And if you know that you will not be able to file correctly, then you can revise later on. But at least file the return on 31st of October and then you can revise the return later. Revised return steps into the shoes of the original return. It will be deemed to be considered as filed on time. Okay. So don't worry about it. I hope it is clear to all of you. Now, the next question is on POEM. There is a company which is incorporated in Singapore and 55% of its shares are held by an Indian company. Now, what is the question over here? We need to find out the residential status of this Singtel Limited. Okay. Now, to determine the POEM of and to determine the residential status of a company, we need to find out the active business is outside India or not. If active business is outside India, then the POEM is outside India, and if the POEM is outside India, then the company is non-resident. Now, to become active business outside India, there are 4 conditions which we need to follow. Plus one additional condition is there with respect to board of directors meeting. The first 4 conditions are monetary conditions where we need to compute some percentages. The very first condition is the passive income should be less than equal to 50% of total income. Now, for that purpose, we need to find out what all passive incomes are there. Now, the first income is passive income. You are purchasing from associate enterprise and selling to unrelated party. Is it passive income? No. Passive income includes when you purchase from associate enterprise and sell to associate enterprise, then it is a passive income. This is not a passive income. Second one is also not a passive income because you are purchasing from associate enterprise, selling to unassociate enterprise, not a passive income. Where both purchase and sales are from associate enterprise, then it is a passive income. Therefore, this is passive income, this is passive income, and interest, dividend, royalty, capital gains, and your one more item is there, and rent. These 5 incomes are also passive income. Therefore, interest and dividend is also passive income. Therefore, this 5 lakhs, this 10 lakhs, why it is passive? Because it is purchased from associated, sold to associated, therefore it is passive, and this 20 and 15 is also passive. So, to make a total of all of them and divided by the total income. What will include total income? Total income will include 25 lakhs, 50 lakhs, and then this 20 lakhs, and then 50 lakhs. Therefore, passive income is 50 lakhs. Total income is 110 lakhs. Therefore, your passive income is less than equal to 50% of total income. Condition number 1 is fulfilled. What is condition number 2? The assets in India should be less than 50% of total assets. What are the Indian assets? These are Indian assets. These 3 are Indian assets. What are the total assets? These are total assets. Therefore, Indian assets comes to 210 lakhs and total assets come to 610 lakhs. Again, it is less than 50% of the total assets. Okay. Third one, the Indian employees. The Indian employees should be less than the total employees, 50% less than the total employees. So therefore, Indian employees are 70, total employees are 160. Therefore, Indian employees are less than 50% of the total employees. And the expenditure, payroll expense on the Indian employees should also be less than 50% of the total expenditure. Therefore, the Indian expenses, the payroll is 80 and the total payroll expense is 20. Therefore, that is also less than 50%. That is 40%. Therefore, these 4 conditions are fulfilled. Now, one last thing has to be checked. Where are majority of the board meetings held? The majority of the board meetings should be held outside India. So, there are 8 board meetings held by the company, out of which majority 5 were held in Singapore, only 3 were held in India. Therefore, majority of the board meetings were held outside India. Therefore, with that
that logic, the assessee is a non-resident, non-resident and non-resident. I hope it is clear to all of you. So this is what this question is all about. Okay, let's go ahead with the next question, which is a very simple question on charitable trust. There is a charitable trust who is registered under 2LAB, and it has derived with income of 21 lakh rupees. How 21 lakh rupees is derived? 10 lakh rupees from property, 4 lakh rupees from business and 7 lakh rupees from public as a contribution. Therefore, you have to add all of them and you have to claim 15% exemption out of it. Okay, now whatever you have received from that, you will get 15% exemption if you are an eligible trust. Now, whatever you have applied 11.6 lakh rupees. But this includes loan taken for construction of construction of orphanage of 3.6 lakhs. Okay, but whenever you have taken the loan and at that time when you have incurred the expenditure, that was allowed as an application. So for example, 2-3 years back, you have taken a loan of 3.6 lakh rupees, and with that loan you have incurred an expenditure, and at that time you have claimed that deduction. Okay, therefore, that much amount will not be allowed as deduction in the current year. Okay, therefore, out of 11.6 lakhs, 3.6 lakhs is already claimed as deduction earlier. Therefore, only 8 lakhs will be allowed as deduction. So remove that, and then you can claim what? You can claim the differential amount will be taxable in the hands of the charitable trust. Okay, I hope it is clear. Why 3.6 lakh is not allowed to reduce? Because that is already allowed as deduction earlier year. Okay, and in earlier year it was allowed also. Now there is a rule of law which says that if you take a loan and incur an expenditure, then it is not allowed. It is only allowed on repayment. But earlier, before 2021, it was not like that. Before 2021, if we used to take a loan and if you used to incur an expenditure, then that expenditure was also allowed. There was no need to repay that loan. Okay, I hope it is clear to all of you. Next question is the advance ruling includes within its scope a determination of board for advance ruling in relation to a transaction undertaken by non-resident applicant. Is it true that only a non-resident can go for advance ruling? Wrong. A non-resident can go for advance ruling, but only a non-resident can go for advance ruling. It is not correct. A non-resident can go for advance ruling. Even a resident can go for advance ruling when it enters into a transaction with non-resident. Even a specified resident whose transaction value is 100 crore or more can also go for advance ruling. Even a public sector undertaking can go for advance ruling, and even a person who is engaging into any kind of GAR transactions which will be subject to GAR, they can also go for non-resident. They can also go for advance ruling. Okay, so it is wrong to say that only and only one person can go for advance ruling. Okay, let's move on to the next question. We need to identify whether the two enterprises are deemed to be associate enterprise or not for the purpose of transfer pricing. In first case, one entity has given a loan of 170 crore to another entity whose book value of assets is 300 crore. Now remember, if one entity finances 51% of the book value of the total assets of the other entity, then both of them are deemed to be associate enterprise. Market value is not relevant. What is relevant is book value, and how much is repaid in the current year in the form of loan, that is also not relevant. At any time during the previous year, if it is 51%, then both of them are deemed to be associate enterprise. The book value of asset is 170 crore. The loan is 170 crore. The book value of the asset is 300 crore. Therefore, it is more than 51%. Therefore, both of them are deemed to be associate enterprise. Next one is when one entity appoints more than half of the directors of the other entity, then both of them are deemed to be associate enterprise. In this case, you can check out of the 8 directors, the one entity is appointing 3 of the directors of another company. Therefore, it is not more than half of the directors. 3 out of 8 is not more than half. Therefore, both of them are not deemed to be associate enterprise. Third one, if one entity depends on the other entity for raw material of up to 90% or more. So if I am dependent on you for raw material of 90% or more, then we both are deemed to be associate enterprise. Now, I have purchased a total raw material of 900 crores, out of which you are giving me raw material of how much? 830 crore, which comes to 92.22%. Therefore, both of them are deemed to be associate enterprise. I hope it is clear to all of you. Next question is on search and seizure. A very important question. Cash is seized of 25 lakh rupees on 12th September 2023. So now there is a provision in the law which says that whenever the government seizes your any assets in search and seizure, you have an option under proviso to section 132 where you can go and explain the nature and source to the income tax department within 30 days from the end of the month. So if you go within 30 days from the end of September, that is still 30th October 2023, explain the nature and the source to the income tax department, and if they are satisfied with your explanation, they will reduce the existing liability and give you the remaining asset remaining money within 120 days from the date of search. So you went to the income tax department on 27th December for release of your assets, but the income tax department turned down your assets, turned down your application. It means they did not consider your application and they said that we will not give you anything. Can they do so? Can the department withhold the explained money? Yes, why not? They can withhold the explained money. Yes, you have gone to the department on time. Within 30 days from the end of the month in which the asset was seized. You should have gone till 30th October. You have gone on 27th October. You have gone before time. But it is at the discretion of the officer whether he will like your explanation or he does not like your explanation. If he does not like your explanation, he can turn down the application. It's all allowed. If yes, to what extent and up to what period? Yes, he can keep this money up to 120 days from the what? So first of all,
Can the department withhold the explained money? Yes, they can withhold the explained money. Yes. Up to which date? If it is explained, then they can withhold up to 120 days from the date of the search. Okay. I hope it is clear to all of you. Now, next question is again a very good question on section 292BB. Read with section 143 subsection 2, that is scrutiny notice. Thai Limited filed its return of income on 26 September. Now, if a person has filed the return of income, by when the department should serve the scrutiny notice? The scrutiny notice should be served within 3 months from the end of the financial year in which the return was furnished. So the return was furnished on 26 September 2023. So within 3 months from the end of this year. So within 3 months from the end of this year comes to which date? It comes to 30th June 2024. But the assessee was served the notice on 3rd July 2024. Okay. Now the question is, the assessee has received a late notice. Then what is the obligation of the assessee? The obligation of the assessee is to challenge the validity of the notice right now itself before the completion of assessment. But if the assessee challenges the validity of the notice after completion of the assessment, then in that case it will be called as what? It will be called as deemed to be valid. So if you get a late notice or an improper notice, you should challenge before passing of the assessment order, not after passing the assessment order. But if you cooperate and after that the assessment order is passed and now you are challenging, then the department is not going to accept your plea and they will say that it is deemed to be valid as per section 292BB. Next one is a theory question on tiebreaker rule. Very important theory question, but you go through at your end. It's a very, very simple question. Nothing great as such. Okay. Now question number 6A. There is an assessee who has received some cash loan from a particular person. Now the assessing officer says that, no, I do not believe the story of loan. This is not loan, but this is an income of 50,000 rupees from undisclosed source, and then the assessee imposing penalty under 271D of 60,000 rupees. Whether the assessing officer is correct. Assessing officer is incorrect at multiple places. First of all, when I am receiving the money, I am saying it is loan. Officer is saying no, it is not loan. It is undisclosed money. It is undisclosed income. Okay. If it is undisclosed income, then how can you impose 271D? 271D is imposed not on income. It is only imposed in case of 269SS. If there is a loan which is taken in cash. Now, if you are saying that this is not a loan, then you cannot impose 271D. Even if you impose 271D, 271D cannot be more than the amount of loan. The loan is 50,000 rupees and you are imposing 60,000 rupees. So there are multiple mistakes which are done by the assessing officer. Therefore, the assessing officer is not correct in this case. The next question, both of them we have already done earlier. Don't worry about it. And the next question also, it's a simple question on DTAA. You can go through it once. It's there are two countries over here instead of one country. Instead of one country, you have to compute DTAA for two countries. Apart from that, nothing else is there in this particular question. Okay. So I hope it is clear to all of you. So this is what this MTP is all about. So let's move on to the next MTP, that is MTP Series 1, November 2023. Now the very first question, which is on total income, is exactly similar to what we have done earlier. All the adjustments over here is exactly copy paste. You can check all of them if you want. Exactly copy paste. Not even a single adjustment is new. So let us not waste time on this. Let's move on to the next question, which is a very beautiful question. Question number 2, both the parts, there are two parts, part A and part B. Both of them are excellent part. Okay, let's complete the first part. First of all, that is, there is a cooperative society which is engaged in marketing of agricultural produce grown by its members, and they have earned a profit of 65 lakh rupees. Therefore, this cooperative society is eligible for what? Deduction under ATP. Okay. Now, any cooperative society which is engaged in marketing of agricultural produce grown by its member is eligible for section ATP. Apart from that, the cooperative society has also employed 10 employees with an emolument of 22,000 rupees, which is less than 25,000 rupees on 1st of May. Therefore, it is more than 240 days and it is paid by account paycheck. Therefore, it is also eligible for 80 JJAA deduction. The cooperative society is eligible for audit. Yes, it is mandatory that if you want 80 JJAA, then you should be eligible for audit. It also earns fixed deposit interest of 30 lakh rupees. Compute the tax liability and income of and advise whether it should opt for the special provision under 115 BAD. Now, we need to make two calculations over here. First calculation, as per option 1, we will do normal calculation. Option 2, we will do 115 BAD. In option 1, when we are doing normal calculation, in that also we have to do two calculation. One as per regular provision and one as per AMT. Now, let's compute in option 1 as per regular provision how we will compute the income. 65 lakhs is your profit from your ATP, and then another 30 lakhs you have earned from where? And you have earned from interest. Okay. Then you will get in regular provision, you will get ATP deduction, you will get 80 JJAA deduction also. Both the deduction will be available to you, and then you will compute your total income and tax liability. Tax liability as per regular provision will be up to 10,000, 10%, about 10,000, 20%, and about 20,000, it is 30% income tax will be imposed on you, and surcharge and cess, if applicable, will be imposed on you. Now, under the normal provision, the second calculation which you have to do is as per AMT. But remember, AMT is not applicable on ATP income.
So while computing the adjusted total income, you will only add ATJJAA, you will not add ATP. On ATP income, AMT is not applicable. Therefore, add ATJJAA, compute adjusted total income, take 18.5%, add not 18.5%, sorry, for cooperative society it is only 15%. So therefore, add 15, take 15%, and then surcharge if applicable and cess, and this whichever is higher will become your tax calculation number 1. Now tax calculation number 2 will be an alternative tax regime under 115 BAD. Under 115 BAD, remember, you will not get the deduction of ATP, but you will get the deduction of ATJJAA. In 115 BAD, ATP is not allowed. Therefore, here ATP will be added back and ATJJAA will be allowed to you, and then you will compute your tax as per 22% tax is applicable under 115 BAD. So remember, very, very dangerous. In AMT, ATP is allowed, but in 115 BAD, ATP is not allowed, and vice versa. Okay, and here ATJJAA is not allowed, and there ATJJAA is allowed. Then compute your tax, 22% tax, 10% surcharge, 4% cess. That will be your tax liability, and then see whichever is more beneficial. Okay, now the next question is also a beautiful question. Multiple incomes are earned by assessee. There is a person, Mr. Charles, who is a non-resident. He is a German citizen and non-resident as per the income tax law, and he is working in a German company. Now that German company has a PE in India. Now that German company has a PE in India, and they are sending this person, that is Mr. Charles, to India for some official work, and he has stayed in India for 85 days, and during this period he has earned a salary of 28 lakh rupees, and that German company has charged that 28 lakh rupees to Indian PE. It means they have taken deduction of that 28 lakh rupees in the Indian branch. So therefore, whether this German citizen will be exempt from salary income, whether he will get an exemption under section 1066. Do you remember that if a foreign citizen comes to India who used to work in foreign enterprise, and if he renders services in India and if he earns salary, then it is exempt subject to some condition. Condition number 1, he should stay in India for up to 90 days. Condition number 2, that foreign company should not have any branch, that should not have any trade or business in India, and that foreign company should not charge that expense as that foreign company should not take deduction of that expense in India. So therefore, the assessee is not fulfilling all the condition. The foreign company should not have any trade and business. This German company has a business in India. Therefore, this exemption is not available to the assessee. This 28 lakhs will be chargeable to tax. From that, you can claim 50% deduction, 50,000 deduction, standard deduction you can claim. This exemption under 1066 is not available. Okay, I hope it is clear to all of you. Next, with income which he is earning, he has purchased some shares of Indian company in foreign currency. He has remitted foreign currency. So now, whenever a non-resident purchases shares of Indian company in foreign currency, then the proviso to first proviso to section 48 will apply. Then you have to convert all the calculations into dollar, then again into rupees. How will you calculate? Sale consideration and expense on transfer will be converted based on average of TTBR and TTSR on the date of transfer, and cost of acquisition will be converted based on average of TTBR and TTSR based on date of purchase. And then whatever the long-term or short-term capital gains will come, that will be reconverted into INR as per TTBR on the date of purchase. Okay, TTBR on the date of sale. This is how we are going to calculate in this particular case. Okay, third case, third income which is earned by this particular person. Charles also holds some shares of a foreign company. Now this is a case of Vodafone case law. This foreign company Aribits GmbH, it is like CGP. Charles holds the shares of this CGP company like Aribits GmbH, and then these shares were acquired for 145, and now Charles is selling for 615 to another non-resident. Whether capital gains will be chargeable in India? The answer is no. The shares of AG, that is Aribits GmbH, does not derive its value substantially from asset located in India. Why so? How did you come to know? Because substantially derived from asset located in India means the assets in India has to be at least 10 crore rupees. Now this company only has an assets of 8 crore in India. Therefore, I am not checking the second condition also of 50%. There are two conditions we have to check. The Indian assets have to be at least 10 crore and it has to be 50% of the total assets. So 50% I am not checking only because first condition itself is violated. Therefore, the shares of this company is not liable to capital gains in India. Last but not least, Aribits, Mr. Charles has received a dividend from Aribits in India. Unfortunately, the dividend is received in India, therefore it will be taxable. If it would have been received outside India, then it would have not been taxable. Now, because it is received in India, it is taxable under the income tax law. So this is what this beautiful question is all about. Next question is a theory question. Advance rulings has the power of compelling the production of books of account? The answer is yes. Advance ruling has all the powers which are given under section 131, that the powers to issue summon, and under section 131, one of the power is to compel the production of books of accounts. That power is there with the advance ruling authority also. Okay. The next question is on equalization levy. There is a non-resident PQR INC. That non-resident does not have a P in India. There is another non-resident NR. This non-resident also does not have a P in India. and this first non-resident is giving to a second non-resident online advertisement service. Therefore, online advertisement service should be first tested under 2016 equalization levy, but in this case 2016 equalization levy is not applicable because the recipient has to be either resident or the recipient has to be non-resident who has a P in India. In this case, the recipient is a non-resident who does not have a P in India. We have done a similar question earlier. Therefore, 2016 equalization levy is not applicable. But whether 2020 equalization levy can be made applicable? Yes, it can be made applicable if the services in India are more than or equal to 2 crore rupees and it is to target Indian customers. Similar adjustment we have done earlier in case of Turnip and Sam INC, if you remember. So therefore, here PQR INC, who is a non-resident, it does not have a P in India, providing services of 3 crore rupees in India, which is more than equal to 2 crore rupees, and yeah, also providing services to what? For targeting Indian customers. Therefore, 2% equalization levy will be applicable on 5 lakh rupees because it is to target the Indian customers. I hope it is clear to all of you. Next question is a very simple question on TDS. Let's talk about that one by one. An Indian company is paying some salary, including allowances and monetary perquisites of 7,30,000 to the employee. So 7,30,000 will be added to the income. Apart from this, the company is also giving some perquisites of 1,20,000. So that will also be added to the income. So total will be 8,50,000. From that, the assessee will get 50,000 standard deduction, and then the company will deduct TDS as per the old regime, because it is written that the company manager is not opting, employee is not opting for 115 BSE. Therefore, follow the old regime, okay, and compute the tax. Next one is a very simple question once again of NR taxation. There is an infrastructure debt fund. Remember, if infrastructure debt fund takes a loan from a non-resident and pays an interest, then 194 LB is applicable, and as per 194 LB, the TDS will be deducted at 5.2%, 5% tax, and 4% cess, 5.2%. But if the other person is a person located in NJA, then section 94A will apply, and in case of NJA, I will deduct TDS at how much percentage? I will deduct TDS at 30%, okay? How much percentage? 30%. So in normal case, if the person is not located in NJ, I will deduct TDS as 5%. If the person is located in NJ, I will deduct TDS at 30% plus 4% cess. Okay. The next question is, I am telling a contractor that I want to make a product according to my specification and I will give you the goods. Okay. So I am telling you that you will make a shirt for me, you will stitch a shirt for me, and the cloth will be given by me. In that case, if you give me the breakup, 194C is applicable because you are providing me service, because you are purchasing the material from the customer itself. Okay. So in that case, 194C is applicable. Now there are two possibilities over here. If you give the breakup in the invoice that this much is this much is this, then I will deduct TDS only on the service portion. But if you don't give the breakup, then I will deduct TDS on the entire portion. Okay. If breakup is given, no breakup is given, these are two perspectives which are there. Next, last one over here. You are making some 5 lakh rupees payment to a commentator. Therefore, it is a professional service. Commentators come under professional service. Therefore, TDS will be deducted under 194J at the rate of 10%. Okay, 10% TDS will be deducted under 194J. I hope it is clear to all of you. Next question, question number 5A is a very good question. There is a CIT who issues notice to the assessee, to the AO, that I want to revise your order under 263. Therefore, the AO has passed an order under 143. Now the CIT wants to revise that order. Okay. Now, after some time, the survey was conducted in assessee premise. Listen carefully first. First of all, I am a CIT. You are an assessing officer. You have done some assessment. Now I am sending a notice to assessee and also to the AO that I want to do in revision under 263. Then after some time, there is a survey under section 133A. Now I am sending you second notice. The content of the second notice is far different from the content of the first notice. Is the Commissioner of Income Tax allowed to send a second notice where the content of the second notice is very different from the content of the first notice? The court has said that it is not allowed. The court said that the Commissioner cannot change its opinion based on what? The new notice. Okay. It has to stick to whatever was written in the first notice and revise the order. The Commissioner cannot change the order in between based on the second notice. Second one, the Director General of Income Tax has got some information that you have some unaccounted cash of 50 lakh rupees. Therefore, the DGIT, the Director General of Income Tax, has some information that you have a cash of 50 lakh rupees unaccounted cash. Therefore, it has issued orders under 131 for seizure. Is it a valid order? Not a valid order. 131 is not for seizure. 131 is only for issuing summon. And in case of summon, you cannot seize anything. If the Director General wants to seize this particular item, he has to issue a search warrant under section 132, and search warrant can be issued by 8 income tax authorities, that is Director General, Director, Chief Commissioner, Commissioner, Additional Director, Additional Commissioner, Joint Director, Joint Commissioner. These are the 8 authorities who have the power to issue search warrant. With the help of 131, you cannot seize any item of the assessee. Okay. Next question is a very simple question on DTAA. Just keep one thing in mind. The assessee is 63 years old. Therefore, the insurance premium will be allowed to the extent of 50,000 rupees. Okay. Don't worry about it. 80 TTB will also be allowed. And one important thing, the assessee is purchasing some 4-year fixed deposit in the name of her son. So in the name of her son, if the assessee purchases a fixed deposit, then the deduction under ATC is not allowed, not allowed, not allowed. Okay. I hope it is clear to all of you. And one last question in this particular MTP is question number 6. There is an NBFC
Can NBFC accept 20,000 or more in cash through a loan? Not allowed. Only banks, only cooperative bank, post office can accept 20,000 or more in cash. NBFCs cannot take, otherwise 269 SS will apply. Okay. Now, the individual has deposited 15,000 rupees by bearer check. Is it allowed? It is allowed. Up to 20,000, less than 20,000 rupees by bearer check is allowed. But when it deposits the another 15,000 by cash, at that time 269 SS will apply. Why? Because the provision says that on the date of taking the cash loan, on the date of taking the cash loan, that is the second loan, if there is an outstanding amount, so then outstanding amount and this cash loan, the outstanding of earlier and this cash loan, the together also should not be more than or equal to 20,000. So in second case, 269 SS will apply, and therefore 271D penalty will be imposed on the NBFC. Now, the assessee is what? The NBFC is repaying this. First is repaid by 16,000 rupees, 500 by bearer check. Not allowed, because 269T says that if there is an outstanding of 20,000 rupees or more in your balance sheet, then you cannot repay a single rupee in cash or bearer check. You have to repay by account pay check, account pay draft, ECS or such as electronic mode. So there is already an outstanding of 30,000 rupees and you are repaying 16,500 in cash. 269T will apply, 271E penalty will be imposed. Now, after the first repayment is done, now the outstanding is only 15,500 rupees. Now, if you want to repay that in cash, that is allowed, because on the date of repaying 15,500, your outstanding is not more than or equal to 20,000. So this is allowed. The first one is not allowed. So this is what this paper is all about. Okay. So let's go on to the next MTP, that is MTP Series 2 November 2023, and the very first question over here is exactly similar with same numbers, everything is same, as exactly similar to question number 24 of RTP. Again, ICI has repeated with the same number. They don't have questions now to ask in the examination also. They are repeating same questions again and again. So just try to understand that even the exams are going to be somewhat similar to this only. There are a lot of questions which are going to be repeated out of this compilation of 23 papers which I have done. 8 RTPs, 7 past papers and 8 mock test papers. Most of the paper is going to be repeated out of this only. Okay. Now, therefore, this question I'm not interested. Exactly similar question. Just go through it or else leave it exactly. I have already put the reference also which question it is similar to. Okay. Question number 2. Let's start with this question. Question number 2. The assessee is a partnership firm and it has a profit of 80 lakh rupees. You are supposed to compute the total income of the partnership firm. Under the normal provision, you are not supposed to follow AMT and all. Don't follow AMT and all. Just follow the normal provision. Okay. Now, whenever you compute partnership firm's total income, now the very first thing that we are supposed to do in case of partnership firm is you have to compute the book profit of the partnership firm. After we compute the book profit of the partnership firm, then we compute the remuneration allowable to the firm, and then we compute the total income and tax liability. Okay. In this question, they have not asked to compute the tax liability, only the total income. Therefore, first of all, we will compute book profit and then we'll compute the total income of the partnership firm. While computing the book profit, you have to be very careful. What is book profit? Book profit is nothing but PGBP income only. Net profit as per PNL, all effect from section 28 to 44, and then if remuneration is debited to PNL, you have to add it back to the PNL account. Okay. So let's see one by one. The very first thing, the profit is 80 lakhs. The partnership firm is paying interest of 13% to the partner. Therefore, how much is allowed under the income tax law? Only 12%. Therefore, 1% has to be disallowed. Similarly, the partnership firm is paying interest on loan taken from partner at 15%. Interest on loan is also covered in 40B. Therefore, 12% is allowed. You are paying 15%. Therefore, 3% will be disallowed under the income tax law. Next, the partnership firm is earning some interest on fixed deposit. Now, this is not a part of PGBP income. Therefore, reduce from here and show under what? Show under IFRS. Then, depreciation as per books of accounts will be added back. Okay. Now, the next adjustment is a beautiful adjustment. This is something new. You have to be very careful with this adjustment. The company has purchased a building in 2019, not company, the firm. The WDV of the building today is 36.45. Now, it is sold after 3 years. For what? For 90 lakh rupees. Now, and the differential amount is credited to PNL. First of all, if you have purchased a building 3-4 years back and now you are selling, that building is a depreciable asset. Now, whatever profit is there, you are crediting to PNL. That is wrong. The profit does not deserve to go to PNL. The profits will be going to the capital gains head. Okay. Therefore, first of all, you have to reduce the differential amount. 90 minus 36.45, whatever is the profit, reduce from PGBP income. And then go under what? Under the head capital gains and compute capital gains in case of transfer of block of asset. Okay. Now, this is a block of asset. When did you purchase this asset? In 2022, in 2019. And when are you selling this? You are selling at the end of 2022. It means you are selling after 24 months. Okay. This has a very important relevance in the question. You will come to know in a while what relevance does it have. Now listen carefully, please, all of you. So therefore, now we will compute the capital gains over here. The capital gains will always be short term under block. Therefore, 90 lakhs is the sale consideration and your 36.45 lakhs is your WDV. Therefore, differential amount something around 53.55 will be called as your short term capital gains. But the gain is short term. The asset is not short term. The asset is more than 24 months old. Therefore, the assessee is eligible for exemption under 54EC. Do you remember that or not?
as per the Ace Builders case law or Dempo Limited case law, it was held that the asset in the block may be short term, may be long term, but the gain is always short term. Therefore, if the asset is long term, then you are eligible to claim 54EC exemption. Here, you have purchased the 54EC investments of 60 lakhs on 5th of April, which is within 6 months. But the bonds were issued after 6 months. So what matters is when you have invested. It doesn't matter when the bonds were issued. Listen carefully. 10th of October, you have sold the asset. Now, within 6 months, you are supposed to invest in the new bonds, okay? In the bonds of NHAI, RECL, etc., etc. So you have invested 60 lakh rupees on 5th of April, which is within 6 months, but the bonds were issued after 6 months. It doesn't matter. The bonds can be issued at any time. What matters is when you have invested in the bonds. Are you investing within 6 months? The answer is yes. You will get the deduction, okay? But how much? Only 50 lakh rupees exemption will be allowed to you. That is a very important point to be kept in mind, because in 54EC, you do not get exemption of more than 50 lakh rupees in a financial year, okay? So this is a very, very important catch, which we are going to see in the capital gains head. Right now, we are computing the book profit. While computing the book profit, we are not going to do all these things. While computing the capital gains, yes, you have to do all these effects. Next one is there are 4 partners, but out of that, only 2 partners are working partners, and you are paying a remuneration to them at the rate of 20,000 rupees per month, okay? And which is not debited to PNL. So if it is not debited to PNL, we don't have to add back anything. If it would have been debited to PNL, I would have added back this remuneration, okay? Now this will be helpful to compare with the maximum limit, and whenever the maximum limit will be there, we will compare that with 4,80,000. How did I get 4,80,000? 20,000 into 12 into 2 partners, okay? Next one is very, very, very important. That is point number B. I'll discuss at the end of the discussion. Next, depreciation of 14,000. You're going to claim that depreciation on that. Next, WDV of the motor car, which was purchased in 2020. Remember, if any motor car is purchased and put to use from 23rd of August 2019 to 31st of March 2020, then you will get 15% extra depreciation. Therefore, on this WDV, you are not going to get 15% depreciation. In fact, you are going to get 30% depreciation. Cell phones, which are purchased in the current year and put to use for less than 180 days, you will be getting 7.5% depreciation instead of 15%. And one last thing, which is going to be here, that is 10AA deduction. You will compute at the end of chapter 6A, okay? 10AA is very simple. 7.5 lakhs is your net profit, and multiply by export turnover is 40 lakhs, divide by total turnover is 120 lakhs. But sir, you have said in the class that 10AA is only available if you start your operation before 31st March 2020. Yes, I have said that. But I have also said one thing, that if you have got the letter of approval till 31st March 2020, and then if you commence the operation till 31st March 2021, then also it is available to give benefits in case of COVID cases. Because of COVID, a lot of people got the letter of approval before 31st March 2020, but they were not able to start the business by 31st of March 2020. So the government has given an extension to those people who have already obtained the letter of approval. They can start the business till 31st March 2021. Okay. So SSC has done that. Therefore, SSC will be eligible for this particular benefit. After doing all this thing, just compute your book profit, and after computing the book profit, just compute the total income, and then tax liability is not asked, so don't compute the tax liability. Okay. The next question is a simple question on DTAA. I'm not interested in that question. It's a very, very, very straightforward question, so don't waste much time on that question. Let's come to the next question, which is the question on exit tax. There is a charitable trust which was formed, whose balance sheet on 31st Jan 2024 is given to us. Okay. Now, the charitable trust was registered in 2013. It made an application for registration in 2013 April. It got registration from on 1st of July 2013. Okay. So, application was made in April 2013 and the registration was granted in July 2013. Okay. Now, listen carefully. But the trust was started much before that. Okay. Now, we need to compute the exit tax. Why? Because on 31st of Jan 2024, the trust registration was cancelled. Okay. So, because the trust registration was cancelled, now the trust is no more a trust. They have to pay accredited income tax. How much tax? 34.944% tax on accredited income. How to compute accredited income? All the assets of the trust minus all the liabilities of the trust computed in the prescribed manner. Rule 17CB. What does Rule 17CB says? Let's see. All the assets minus all the liabilities. First one, land. Land you will not take. Why? Because it was purchased before registration. Any asset which was purchased or any liability which was incurred before the registration shall not be included in the accredited income. Only assets and liabilities which are incurred after the registration shall be included. Second one, but land building purchased in 2017. The book value is 800 lakh. What is the value that we are going to take? You should take the book value, you should take the market value or the stamp duty value, whichever is higher. So the market value is 1000, stamp duty value is 1050, therefore you will take 1050. Okay. For listed shares, you will take the average of the highest and the lowest on the date on which the trust was cancelled. Okay. The trust registration was cancelled on 31st Jan. So on 31st Jan, the highest value was 1099, the lowest value is 1051.
take the average of that. On as per that, you will value it. Then bank balance will be valued as per book value. Then scheduled bank fixed deposits will be valued as per book value. Cash in hand will be also be valued as per book value. Then capital fund is not included in the liabilities. That is not a part of liability as per Rule 17 CB. Then creditor 335 is the total creditor, but there is some problem in that. Out of that, 30 rupees creditor is provided on estimated basis for which no bills are received. So this is contingent liability. It is not final liability. It is not crystallized. Therefore, you are not going to take this 30 rupees over here. Only 335 minus 30, that is 305, is the liability that you are going to take. Then compute your accredited income and compute the tax, as simple as that. The tax rate over here is 34.944%. The next question is also a new kind of question, a very important question, very good question for the examination. There is a foreign company who has a branch in India. So now, if a foreign company which has a branch in India, and if the head office allocate some expenses in India, how much expenditure will be allowed to that head office, that branch in India? It will be allowed as per section 44C. And what then 44C says that? 44C says that 5% of the adjusted total income subject to the actual amount allocated in India, whichever is lower will be allowed as deduction. Okay. Now what is adjusted total income? The company has given us a net profit of the Indian branch, which is 28 lakhs and which is after charging the following expenses. After charging the following expenses. Now we need to compute the adjusted total income. We need to take 5% of that and then compare the actual expenses allocated. What is adjusted total income? Adjusted total income is nothing but total income plus few items, okay, which are reduced. All those items which are reduced from the profit, which has reduced from the total income, you have to add back few things. Which all things I have to add back? Am I supposed to add the current year depreciation? No, no, no. Current year depreciation is not added back. Am I supposed to add back the unabsorbed depreciation? Yes, yes, yes. Go and see the formula of adjusted total income for the purpose of 44C. That is, for unabsorbed depreciation is added back. Am I supposed to add the capital expenditure of family planning? Yes, 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 yes. Capital expenditure of family planning is added back. Am I supposed to add the current year expenditure of scientific research? No, no, no. That is not added back. Loss is also added back. Chapter 6 is also added back. And head office expenses already allocated to the P&L will also be added back. You will add back all these things. You will get adjusted total income. Take 5% of that and then compare with 120 lakhs. Whichever is lower will be allowed as deduction to you. Okay. That much deduction will be allowed and then accordingly compute the total income of the SSE. I hope it is clear to all of you. The next question, question number 4. In this, the first part is already done by us. It is exactly similar to question number 28 of RTP. It is copy paste. You can go and see the question number 28 of RTP discussion which we have done. It is exactly similar to that. So we will not waste time on that. Let's move on to the next question. We need to identify whether the following persons are liable to file the income tax return or not. Let's see the first person. A person who has a business turnover of 70 lakh rupees. Remember, any person who has a business turnover of more than 60 lakh rupees, if a business turnover is more than 60 lakhs or if the profession gross receipt is more than 10 lakhs, you are liable to file the income tax return. Therefore, by that logic, the SSE is liable to file the income tax return. Similarly, any person who has deposited 50 lakh rupees or more in a saving bank account, how much? 50 lakh rupees or more in a saving bank account is liable to file the income tax return. Therefore, this SSE is liable to file the income tax return. I don't want to read also other discussions. This is the sufficient reason for me to file the return. Therefore, SSE has to file the return. The next question is exactly similar to question number 5 of November 2022 past paper. You can go and check over there. Question number 5 of November 22 past paper. It is exactly similar to that question. Okay. So don't waste much time. One last question over here is question number 5 has two parts. The first part is a theory part. I'm not interested in that. The second part is a transfer pricing question, which is very important transfer pricing question. At least 4 to 5 times ICI has asked the same question in the examination, not in RTP, MTP. In the exam also ICI has asked this question at least 4 to 5 times. Since I am studying transfer pricing, I have seen this questions many times in the examination. Now, what is exactly there in this question? There is a company Tow Limited, which is in India, and there is a company Tick Limited, which is in Australia. The Australian company holds 30% in Indian company. Therefore, both of them are deemed to be associate enterprise. Now, the Indian company is providing some services, providing some goods, and for that the cost is 3,50,000 rupees. We need to find out the arm's length price as per the cost plus method. As per which method? Cost plus method. Now, what is the arm's length price? How to compute arm's length price as per cost plus method? Remember, as per cost plus method, the very first step is the cost, the total direct and indirect cost which you provide. What is your total direct and indirect cost with respect to the services and the goods which you provide to your associate enterprise? So my total direct and indirect cost is 3,50,000 rupees. Okay, this is my total direct and indirect cost. Then I have to find out the GP margin in case of uncontrolled transaction. GP upon cost in case of uncontrolled transaction. The GP upon cost of uncontrolled transaction is how much? It is 40%, because Tow also provides services to GN Limited, which is an unrelated party, and it charges 40% cost to the unrelated party. Now this 40% should be adjusted. Because this 40% cannot be directly applied, because when I do transaction with my associate enterprise and I do transaction with unrelated party like GN Limited, there might be some functional differences which might be there. So because of the functional differences, the GP might go up, the GP might come down. Therefore, what are the functional differences between the two transactions? One is a transaction which I am entering into with my associate enterprise. Another is the transaction which I am entering into with third party. Therefore, what are the functional differences between the two? The point number one, pay attention please. When I provide services to my associate enterprise, there is no such support from while also derives technological support from associate enterprise. When I provide services to my associate enterprise also give me some services. So please tell me, when I provide services to my associate enterprise also give me some technical support. But when I provide services to third party does not provide me any service. So please tell me to whom I will charge more GP and to whom I will charge less GP. Obviously, when I provide you service, you also give me something in return. So I will charge you less GP. When I provide services to third party, they do not provide me anything. So I will charge them more GP. We are starting from their GP 40%. So I am providing services to my associate enterprise. You are also giving me something in return. So that much GP might be reduced in my case. Therefore, how much services you provide to me? You provide me 10% of, 15% of the normal GP. What is my normal GP? My normal GP is 40%. What is 15% of 40%? It will come to 6%. Therefore, that much GP, I have to charge you less. Because when I provide you service, you also give me some service. So I have to charge you 6% lesser as compared to I charge to what? My third party. The second difference between both of them, when I provide you services, I offer you discount. Whereas when I provide services to third party, I don't offer any discount. That discount amounts to 10% of normal GP. 10% of normal GP will come to 10% of 40%, which will amount to 4%. So when I provide services to associate enterprise, I give discount. So if I give you discount, my GP has to be lesser. When I provide services to third party, I don't give any discount. Therefore, in that case, the GP has to be higher. So in my associate enterprise case, the GP has to be lower. So I have to reduce this 4% over here. I have to less this. Okay. Third one, when I provide services to Tick and Toe Limited, so there is no, when I provide services to my associate enterprise, there is no risk. There is no additional marketing cost that I have to incur. So when I provide services to you, there is no risk. There is no additional marketing cost. So if there is no risk, there is no return. Okay. But when I provide services to third party, there is an additional marketing cost. There is an additional risk. Therefore, high risk, high return. So when I provide services to third party, high risk, high profit. When I provide services to my associate enterprise, low risk, low profit. Therefore, in your case, my profit has to be lower. Therefore, it amounts to how much? 20% of normal GP. Normal GP is 40%. 20% of 40% comes to 88%. Therefore, I have to reduce 8% over here. Okay. And the fourth and the last one. When I provide services to you, listen carefully, I give you 1 month credit. When I provide services to third party, there is no credit. So when I provide services to you, I give you 1 month credit. So in that case, my profit margin has to be higher, because I give you credit, I will charge you more. If I charge you more, my profit margin has to be higher. Therefore, in case of third party, I don't give any credit. Therefore, there the profit margin has to be lower, because I will charge lesser to them. Therefore, how much that amounts to? That amounts to 5% of normal GP. 5% of normal GP amounts to 2%. So in my case, when I give you services, I am charging you, I will charge you more. Therefore, I have to now add back 2%. So first 3 items will be reduced. Fourth item will be less. That will give me arm's length GP. That arm's length GP I will apply on my cost of 3.5 lakh. That will give me my arm's length price. So this is what this paper is all about. Just go through it. And this last question is one of the most important question of this particular paper. So let's move on to the next paper, that is May 2024 mock test. That is the latest one, series 1 mock test. And the first question is a beautiful question. And this entire mock test is a beautiful mock test. Now, there is a company, Sheetal Limited, which is a listed company, which is engaged, which is in Mumbai. The books of accounts are maintained. There are 4 units in this company. There are 4 different businesses which are done by this company. So we need to consolidate the profit of all 4 and compute the PGBP income. Okay. And now at the end, what they are giving us, what we are supposed to compute? We are supposed to compute the total income of the company and optimum income tax liability. Optimum means we need to find out the total income as per the normal provision, the total income as per the special provision, and all those things, and we need to compare them, and then we need to find out whichever is more beneficial. Now listen carefully. There are 2 calculations that we are supposed to make. One more important information that the question has given us: the company has not yet opted for the concessional tax regime. They have not yet opted any kind of concessional tax regime. Now, the only option which they have right now is 115BAA, because 115BA is not possible. BA is possible if you opt in the first year. BAB is also not possible. BAB is also possible only if you opt in the first year of the operations. But BAA is open for every year. Okay. So therefore, we need to make 3 calculations here. Let me tell you how 3 calculations. First, normal calculation. In normal, there will be 2 calculations. One regular provision and one MAT, because they have also given us book profit over here. The book profit of the company is given over here as 520 lakhs. So under the normal provision, you will make 2 calculations, one regular provision and one MAT calculation. and under the 115BAA, only 115BAA, because an assessee opting for 115BAA is not liable for MAT. So accordingly, we need to solve this question 3 times. Okay. So let us first of all solve this question as per the normal provision. Okay. Now there are 4 businesses over here. The first business is the chemical manufacturing business. The assessee is engaged in chemical manufacturing unit, and the profit of the assessee is 300 lakhs. Now they have paid some royalty to someone. Okay. They have paid some royalty to someone, and on the royalty of 10 lakh rupees, they have not deducted the TDS. They have not deducted TDS on 10 lakh rupees. Okay. Now, if they have not deducted TDS on 10 lakh, this 10 lakh rupees will be disallowed to the extent of 30%. Okay. But there is one information which is given in the question, that the other party, that is the payee has included such royalty in his income. Payee has paid the tax. Payee has also filed the return before the due date of filing of return. So will this royalty still be disallowed? The answer is yes. Even if the payee has included the income, paid the tax, and the return is also filed, still the royalty will be disallowed in the current year, and next year it will be allowed to be. It doesn't matter whether the payer has included or not. Even if the payer has included, in the current year it has to be disallowed. In the subsequent year it will not be disallowed. It will be allowed in the next year. So therefore, what is the treatment of this 10 lakhs? 30% of this will be allowed in the disallowed in the current year, and it will be allowed in the next year. Next is, you are making some contribution to notified pension scheme of employee. How much is allowed? It is only allowed if an employer contributes to the notified pension scheme of the employees. It is only allowed to the extent of 10% of the basic salary plus DA in terms. Company is contributing 15% of basic and DA in terms. Therefore, how much will be disallowed? 5% will be disallowed over here. So 33,60,000 is 15%. Therefore, 5% is how much? 11,20,000. You have to disallow that. This is the profit of the first business. Okay. Now, second business, furniture manufacturing business. The assessee has a net profit of 90 lakh rupees. An assessee has bought one trademark of 25 lakh rupees. This is a very traditional adjustment. Now, and they have debited that trademark as an expenditure. Wrong. You cannot debit a trademark as an expenditure. You have to add back 25 lakhs and you have to claim 25% intangible asset depreciation. Okay. Next, the company has paid rupees 3 lakh as interest to non-resident, and the TDS is deducted on time, and it is also paid on time. See, it is deducted in the month of March and it is paid before the due date of filing of return. Therefore, this expenditure of 3 lakhs will be allowed to the assessee. So no effect will be given to this expenditure. Okay. Next one, company paid rupees 7 lakh as tax on non-monetary perquisites of the employee. Do you remember that? If an employer pays the tax on non-monetary perquisites of the employee, then that tax is disallowed under the income tax law under section 40 clauses sub clause 5. So I'm an employer, you are an employee, I am paying your tax on non-monetary perquisite, it is disallowed. Therefore, this 7 lakh will be disallowed under the income tax law. Next, coming to the fertilizer producing unit. Fertilizer producing unit will be eligible for what? Will be eligible for 35 AD. Because if an assessee is engaged in production of fertilizer, it is eligible for deduction under section 35 AD. Now, in 35 AD, assessee has purchased land of 1 crore, land will not be allowed. Building of 2.5 crore, yes, building will be allowed. And 3 crore rupees will be machinery, that will also be allowed as a deduction. Okay. But, what will be the profit? The profit is 220 lakhs. And the company has computed the profit after debiting the depreciation. Therefore, in 35 AD, you don't get the deduction of depreciation. So how will you compute the income? 220 lakhs is the profit after depreciation. Therefore, add back both the depreciation and then take the deduction of building, sorry, not of land, and of plant and machinery. You will get the profit under 35 AD. Okay. Next one, last but not least, warehousing facility of edible oil. Now, it is a normal business. In this business, there is a loss, I guess, because there is a net profit of what? Net profit of 7 lakhs. And on building, you will claim 10% depreciation. And on plant and machinery, you will claim 15% depreciation. So there is a loss. This loss can be set off against the other business income. Okay. Apart from that, the company has also received some application money from the shareholder, and that is deposited in the bank, and they have earned some interest on that particular money. So whenever you receive some share application money, you deposit that in the bank, and on that, if you earn interest, that is not considered to be an IFRS income. That should be set off against the share issue expense. Therefore, this amount should be set off against what? Against the share issue expense. Apart from that, the company has received a dividend of 56 lakh rupees. This will go to IFRS, but the company has also given dividend of 40 lakh rupees. Therefore, for that purpose, the company will claim deduction under ATM. Okay. So we have received 56 lakhs and we have given 40 lakhs as distributed 40 lakhs as a dividend to our shareholder. Therefore, 40 lakhs will be allowed as what? A deduction under ATM. Okay. And last but not least, then we will compute the profit tax of the assessee. The turnover of the assessee for last to last year is 390 lakhs. And because the turnover of last to last year is 390 lakhs, therefore tax will be only 25% plus surcharge if applicable, and cess will be applied. This will be our first calculation in the normal provision. Then we will compute the second calculation in the normal provision, that is book profit, that is MAT. 520 lakhs is my book profit, and directly they have given the book profit, computed book profit. On that 15% MAT will apply, 7% surcharge because the book profit is more than 1 crore, 4% cess. Then whichever is higher will be your calculation number 1. Now I am coming to calculation number 2. What is calculation number 2? Calculation number 2 is 115BAA, because they have told us to compute the optimum income tax liability. So we will compute 115BAA. Now in 115BAA, what will happen? In 115BAA, first of all, you will not be getting the deduction of what? 35 AD. 35 AD will be disallowed over here. So I will disallow 35 AD. Whatever 35 AD deduction I have taken, that I have disallowed. But in 35 AD, I will claim the depreciation. Because in 35AD, I will get the depreciation cut deduction, but I will not get the normal provision cut deduction. Okay, so this I will add back, and this I will take the deduction. Okay. Apart from that, there is no other thing. ATM is allowed under ATM is allowed under 115BAA. Apart from this, there is no other calculation. I will just compute the tax as 22% tax, 10% surcharge, and 4% cess. That's it. This will give me my tax liability. I hope it is clear to all of you. Then I will compare whichever is more beneficial. That I will opt as a taxpayer. Okay. Now let's move on to the next question. The next question is also a very new kind of question. We have not done this type of question in the earlier papers. Okay, so ABC Private Limited is there. Now that is converted into an LLP. So remember, whenever a private limited or an unlisted company is converted into an LLP, the provisions of section 4713B is applicable. Now when they have converted on 1st of October 2023. Now there are a lot of questions that we need to answer, whether the loss can be carried forward or not. Whether the loss can be carried forward from the company to the LLP, the answer is yes. Only a non-speculative business loss and unabsorbed depreciation can be carried forward. A non-speculative business loss can be carried forward for another years, and unabsorbed depreciation can also be carried forward for infinite number of years. But the LLP has to fulfill the conditions. Whatever 7 conditions are given in 4713B, the LLP has to fulfill that. Later on, if LLP violates any of the conditions, then whatever loss is set off, that will be considered to be deemed income. So all this loss carry forward is subject to the conditions mentioned in 4713B. Okay. Second, the company has some assets, that is plant and machinery of 15%. The WDV is 14 lakhs. The plant and machinery of 75 lakhs, on which 35AD deduction is claimed. So whatever asset on which 35AD is claimed, that cannot be, that the actual cost of that asset is nil. Therefore, this will consider to be nil for the LLP also. So if the company has claimed deduction on under section 35AD on any asset, then LLP also cannot claim depreciation on that asset. So forget about this second asset. First and the third asset, we can claim depreciation. Both of them will claim depreciation on a proportionate basis on the basis of number of days. Okay. So 14 lakhs, 40 lakhs, 14 lakhs, depreciation 15%, 2,10,000 LLP and the company. Both of them will take the deduction based on number of days the assets are used by both of them. And whatever is the depreciation which is claimed by the company, that is predecessor, that will be reduced from the cost of the, that will be reduced from the WDV of the asset, and the balance WDV will be WDV of the LLP. Okay. For example, here the WDV of building is 14 lakhs and total depreciation is 2,10,000. Now 1,05,000 is claimed by LLP, 1,05,000 is claimed by company. Therefore, whatever is claimed by company, that will be reduced and the balancing figure will be WDV for the company. Okay, for the LLP. So this is how you are going to compute the depreciation and the WDV of the asset. Next, what will be the cost of acquisition for the land in the hands of the LLP? The cost will be the cost to the previous owner. So whatever is the price at which the previous owner has acquired, for 80 lakhs, that will be the same as cost. Market values are of no relevance. So everywhere, wherever market value is relevant, just strike it off. It is of no relevance under section 4713B. Next, VRS. How VRS is allowed? Generally, VRS expenditure is allowed under section 35 DDA in 5 equal installments. So in the year of conversion, who will get the deduction? In the year of conversion, the new entity will get, that is the LLP will get the deduction, and for the future years also LLP will get the deduction. So accordingly, we are going to take the deduction of this particular 28 lakh rupees. Next, MAT credit will not be carried forward. It is very clearly written in 4713B that MAT credit cannot be transferred to the LLP. It will be lapsed. Okay, and unabsorbed depreciation will be transferred, as I have told you earlier. Now the next question is a very simple question on DTAA. I am not interested much on that. Mr. Money is there, 71 years age is there, etc, etc, etc. It's a very traditional question, nothing great as such, so I am not wasting much time on this particular question at least here. The only thing you need to understand over here in DTAA questions from May 2024, you need to be very careful with the regime that you are following. If nothing is mentioned, you will follow old, you will follow new regime. If they are specifically saying that you have to opt out of the new regime, then you will follow the old regime. Okay, you have to be very careful with this particular aspect in the examination. Now coming to the next question. Next question is on charitable trust and electoral trust. So let's see the first question. What is the first question trying to say? There is a person called as, there is a trust called as Satvik who has sold one of the building. One of the building is sold for 4.2 lakhs. This is the consideration. This building was purchased in 2022 for 2.2 lakhs. So it is sold within 24 months. So if a building is sold within 24 months, 4.2 lakhs minus 2.2 lakhs, 2 lakhs will be STCG. Now for trust, there is an exemption under section 11(1)(a) to save capital gains. So what is the exemption? The exemption says that whatever is the net consideration that you have to invest in the new asset. Okay. So whatever is the net consideration, how much is the net consideration? The net consideration is 4.2 lakhs. So if you invest that in the new asset, your entire capital gains will be exempt. But if you don't invest the entire amount in the new asset, then only a proportionate capital gains will be exempt. So assessee has sold the asset for how much? Assessee has sold the asset for 4.2 lakhs. Then he should have invested 4.2 lakhs in the new asset, but he has not invested 4.2 lakhs. He has only invested 3 lakh rupees in the new asset. Then only proportionate exemption will be allowed. What is the proportionate exemption? Cost of new asset minus cost of old asset. What is the cost of new asset? It's 3 lakh. What is the cost of old asset? It is 2.2 lakh. Therefore, the differential between two will be allowed as deduction. What is the differential between the two? The differential between the two, 3 lakhs minus 2.2 lakhs, 80 lakhs, and therefore the 80,000 will be allowed as exemption, and 1.2 lakhs will be taxable in the hands of the what? In the hands of the Satvik Public Charitable Trust. Okay, I hope it is clear to all of you. Next one is a very simple question, that there is a religious as well as a charitable trust which is running a temple as well as a school. Now it received an anonymous donation. Now 3 crore is received for temple and 8 crore is received for school. Remember, if anonymous donation is received for religious purpose, section 115 BBC is not applicable. Do you remember that or not? But if the anonymous donation is received for what purpose? If it is received for what purpose? If it is received for charitable purpose, then provision of 115 BBC is applicable. So in this case, the provision of 115 BBC is not applicable for temple donation, but 115 BBC is applicable for school donation. I hope it is clear to all of you. Now the next question is a very, very, very important question on electoral trust. Now such kind of question they have never ever asked in examination, electoral trust and all. Now why they have suddenly got reminded of this question? Because of the election. Because there is a union election 2024, there are chances that there might be question on electoral trust or electoral bonds in the examination. So you have to be very careful with these kind of questions in the examination. You read the provisions thoroughly over here. Okay. Now there is an electoral trust over here which is incorporated in 2022. That is last year they have incorporated. So this is the second year of the electoral trust. So this is a very important data for us, that this is the second year of the electoral trust. Okay. Now this electoral trust has received a voluntary contribution of 420 lakhs in the current year, and there is a surplus brought forward from the earlier years. Means whatever donation they have received in the last year, out of that they would have given lot of money as a contribution, as a donation to political party. So the surplus left is brought in the current year. Okay. Now they have also incurred some expenses to manage the affairs of their entity, which is 8 lakh rupees. Now they are asking us question, what is the amount of surplus that can be distributed by the electoral trust, assuming that all other conditions are provided under the Income Tax Act are satisfied? Now listen carefully, there is a very important catch over here. Listen carefully. How much money electoral trust can distribute? Listen, electoral trust can distribute, if it wants to enjoy exemption under section 13B, it has to distribute at least 95% of the total contribution, including surplus of last year. So they have to distribute at least 95% of 420 plus 18 lakhs. That is, they have to distribute at least 95% of 438 lakhs. Then only they will enjoy exemption. But how much they are allowed to distribute, that is altogether a different case. For that also there is a separate provision. That is a separate provision which I am going to tell you now. Listen carefully. If this is the first year of the electoral trust, they can only how much they are allowed to use for the managing the affairs of the business. Okay, so they have to manage the affairs of the electoral trust, right? Because they have to check who has given the donation, they have to keep the record of that, they have to check when to pay the payment to the which political party, whether it is credited or not. So all this is a matter of management. So listen carefully, I am again saying it's a very critical point, it can come in the examination. Again saying the first point, whatever donation they have received, including the surplus of last year, of that 90% should be distributed. Okay, but you need to also see that how much is allowed to use as a managing as an affairs of the electoral trust. They have used how much? They have used 8 lakh rupees. Are they allowed to use 8 lakhs? For that also there is a provision. There is a separate rule for that which is made by central government. So how much they can use, sir? In the first year, they can use 5% of the total, 5% of the donation. That is 5% of whatever donation you have received. Compare with 5 lakh rupees, not more than 5 lakhs. And in the second year, because this is the second year for us, this is more relevant. In the second year, they can use only 5% subject to 3 lakh rupees. Okay. So in the second year, they can use only 5% of 420 lakhs subject to 3 lakhs. So 5% of 420 lakhs comes to 21 lakh rupees. Compare with 3 lakh rupees. Therefore, whichever is lower will be allowed to be used to manage the affairs of the electoral trust. They are using 8 lakh rupees, not allowed. Okay. So out of 438 lakhs, they are allowed to use only how much? They are allowed to use 435 lakhs. 435 lakhs. They can use on 3 lakhs they can use for the purpose of managing the affairs. 435 lakhs is the distributable surplus. So they have asked that only. How much is the distributable surplus? So you have to reduce whatever is the eligible amount to be used for managing the affairs. After that, whatever is left, that will become your distributable surplus. Okay. Now that distributable surplus has to be more than 95% of your total donation. Is it more than 95% of your total donation? Yes. So out of the distributable surplus, you can distribute 416.1 rupees and you will claim 100% exemption in the current year. Okay. So this is how you are going to compute the electoral trust ka exemption and distributable amount. I hope it is clear to all of you. Now let's move on to the next question. Next question is a very simple question on your transfer pricing. There is one assessee, there is another assessee, and one entity gives a guarantee of 12% of the total loans of another entity. Therefore, both of them are what? Deemed to be associate enterprise. If one entity guarantees 10% of the loan of the another entity, then both of them are deemed to be associate enterprise. Okay. Now, suppose they are deemed to be associate enterprise, that we have answered. Now, the question says that suppose the AO makes a primary adjustment of 310 lakhs. Who is making the primary adjustment? The AO is making a primary adjustment of 310 lakhs on 31st March 2023, and the same is also accepted by the assessee. Now, what are the requirements as per the income tax law and the non-implication which the assessee has to fulfill? Okay. So, for example, if the AO makes a addition as per the primary adjustment on 31st of March, what are the requirements that the assessee has to fulfill? Assessee has to bring back that money into India within 90 days on the date of order. If the assessee does not bring back that money within 90 days on the date of the order, then the assessee will be considered to be having given a deemed loan to the associate enterprise, and the assessee will be liable for secondary adjustment. Secondary adjustment is nothing but interest on the deemed loan. So whatever is the amount, 310 lakhs, on that assessee will be liable to pay interest. Okay, interest will be computed as what? Because the transaction is denominated in Indian rupees, interest will be computed as per SBI MCLR plus 3.25%. Whatever is the SBI MCLR plus 3.25% will be considered to be the interest rate, and interest will be computed from 31st March only. From 31st March only interest will be computed. Is there any other way that the assessee can get evade from that? Yes, one more option is there. The assessee can pay one-time additional tax of 18% tax, 12% surcharge, 4% cess, and then the assessee will be relieved from this particular kind of secondary adjustment. Okay, so these are the two options. Right now there are three options. First is you have to bring back the money within 90 days. Nothing will happen. If you don't bring back the money, pay interest, or if you pay the additional tax, then the interest is not liable to pay it after that. Okay, so these are the three possibilities which are there. Now the next question is exactly same as question number 6 of Series 2 MTP November 2022. That's the reason I'm not much interested in that. It is on section 269 SU and 271 DB, not very great question. Okay, next question is again a new question. It's a very good MTP. There are a lot of good questions in this particular paper. The tax assessment was completed on 25th of December. The tax assessment of completed on 25th December of Mr. Raghav, and the department has raised a demand of 28 lakhs. Now, assessee has the following things. Now, the question which is asked over here, the department can recover the money from which all things. The bank deposited which belongs to assessee, definitely the department can recover from them. The receivables from the debtors, the department can ask the debtors to pay the money. Okay, garnish the order. Do you remember that? The department can go to and tell to the debtor that give the money to us and not to the assessee. Third, the assessee has gifted land to his major son. Now, whatever is gifted to his major son, that is not clubbed in the hands of the assessee. Whatever is gifted to the major son, that belongs to the major son. Now, department cannot go to the major son and recover the money from the land. Okay. Now, a diamond necklace given to his son's wife. So, a diamond necklace given to son's wife is clubbed in the hands of father-in-law. Remember or not? If I give something to my son's wife, that is clubbed in my hands. If I give it without consideration, therefore that is clubbed in my hands. Therefore, the department can recover from there. Okay. Plus, I also have an apartment in Australia. That is my apartment. The department can recover from there only. Rule is very simple. Whatever belongs to me, the department can recover. Whatever does not belong to me, but the income can be clubbed in my hands, that can also be recovered by the department. Okay. This is what this question is all about. Now, the next question is on Vodafone case law and its effects. There is an Indian company, XYZ Indian company. This company is engaged in manufacturing and packing material, and it has a wholly owned subsidiary of Flix Inc. XYZ company is a wholly owned subsidiary of Flix Inc. So listen carefully. There's a Flix Inc. which is in country M, which is a foreign company. Indian company is a 100% subsidiary of Flix Inc. Now, Flix Inc. has two shareholders. Angelo holds 50% and James holds 50% in Flix Inc. Okay. Now, so after some time, Flix Inc. is selling the shares. Angelo and James are selling the shares of Flix Inc. Now, when Angelo and it's just like Vodafone case lawyer. Flix Inc. CGP, Angelo and James are what? HTIL, and Indian company is HEL. Okay. Now, Angelo and James, whenever they are selling the shares, whether they will be liable for capital gains or not, for that purpose, they have given us all the data. The capital gains will be chargeable in the hands of Angelo and James if the shares of Flix Inc. derive its value substantially from asset located in India. For that purpose, we need to do a long-term exercise. What exercise? First of all, let's see when the shares are sold. The shares are sold on 1st of June 2023. So 1st June 2023 is the date of transfer. Then we need to see what is the last balance sheet date. The last balance sheet date of the company is 31st December 2022. So 31st December 2022 is the last balance sheet, and 1st June 2023 is the date of transfer. Now, we need to see the shares of Flix Inc. should derive its value substantially from asset located in India. What do I mean by derive its value substantially from asset located in India? Two conditions have to be fulfilled. The assets which are located in India has to be at least 10 crore rupees, and the assets which are located in India has to be at least 50% of the total assets. Okay, these two conditions have to be fulfilled. Now, these two conditions should be checked on which date? These two conditions should be checked on a specified date. So for that purpose, we need to find out first of all what is the specified date. The specified date can be two dates. The specified dates can be last balance sheet date. The specified date can also be the date of transfer. By default, it has to be last balance sheet date. But if the difference in the book value of the asset is more than 15%, then the specified date will be 1st June. If the difference is less than 50%, then the specified date will be last balance sheet date. So while checking the specified date, you have to check the book value of the assets. Okay. So book value of the assets. What is the book value of the assets on 31st December? On 31st December, that is last balance sheet date, book value of asset is 1000. What is the book value of assets on date of transfer? It is 1300. Is the difference between the two more than 15%? The answer is yes. Therefore, the specified date will be the date of transfer. The specified date will not be 31st December. If the difference would have been less than 15%, then the specified date would have been date of balance sheet. So now the specified date is 31st June. Okay. Now on this date, we are going to check the value, whether the Indian assets. Now while checking the value, the Indian assets, you have to check the fair market value of the assets without reduction of liabilities. Now how much assets are there in India? The Indian assets are 600 crores. Check. The fair market value of the assets in the balance sheet of XYZ is how much? Is 600 crore. Now what is the fair market value of the total assets? It is 1100 crore. Okay, so therefore the fair market value of the Indian assets is how much? It is 600 crore, out of which the total assets is 1100 crore. Therefore 600 divided by 1100, Indian assets are more than 50%. Therefore both the conditions are fulfilled. Because both the conditions are fulfilled, Indian assets are more than 10 crore and Indian assets are more than 50% of the total assets. Therefore the shares of Flix INC derive its value substantially from asset located in India, and therefore whenever James and Angelo and James will sell the shares, they will be liable for capital gains in India. So this is how we have done a similar question in the class. We have done all those kind of questions in the regular batch, fast track batch. It is there in our color book also, in our regular batch book also, everywhere. All this kind of questions are already there. Okay. Now there are some case laws over here, but all the case laws we have already done either in RTP, MTP or past paper. 100%. I have written the names also. Pepsi Food Limited we have already done. Lakshman Das Khandela also, the third one is also done. You can check it once if you want. So don't waste time on repeating the same questions again and again. Next is the theory question. Discuss the three tier structure of BEPS action plan. So you need to answer that. The three tier structures are master file, local file and CBCR, and then you have to write few lines in each and every category. Okay. Next question also we have already done. You can check this. We have already done this question. Question number 6. Check please. Done earlier. Same question we have already done. Check it please. Now the next question is a very beautiful question on tax audit report. This kind of question you would have not find in earlier paper, because in earlier paper tax audit was not there in direct tax, it was there in audit. So for the very first time tax audit report question is there. We have done this question also in our class. You can go and check. Okay. There is a firm which is employed, which is in retail business, employed 30 new employees on 1st April 2022 with a monthly emolument, monthly salary of 24,500, which is paid by account paycheck. Okay. So they have paid by account paycheck. In addition, each employee was entitled to 10% employer contribution to the recognized provident fund, and the employee was also paid 3,500 in cash. Okay. The gross total income of the assessee includes profit of 75 lakh rupees. So what is the data? The salary is 24,500 paid by account paycheck. And in addition, the employer is also contributing 10% to the PF, and the employer is also paying 3,500 rupees transport allowance in cash. Okay. Now, the firm has claimed the deduction of 30 employees into 24,500 into 12 as the deduction under 80 JJAA. The CA has also given a report under Form 10DA, and the chartered accountant contend that the emoluments do not include employer contribution, and also cash payment were not to be considered as additional employee cost. The CA said that emolument does not include the PF part, and emolument does not include cash component also of what? Of the cash component of what? Which is paid in the form of a transport allowance. Okay. Now, hence 24,500 per employee is the emolument. Therefore, the deduction will be given. Is this contention correct? Explain the ethical implication. Now, remember, as far as 80 JJAA is considered, 80 JJAA says that the emolument of the employee should not be more than 25,000 rupees per month. Now, emolument will include everything. Everything will be included in emolument except few things. That is contribution made by employer to employee, and certain long-term benefits like severance pay, retrenchment compensation, etc. But emolument will include transport allowance. Even if it is paid in cash, it will be included. So if we consider that, by that logic, it will come to 24,500 plus transport allowance 3,500. Emolument is actually 28,000, which is more than 25,000 rupees. Therefore, the chartered accountant is wrong. A chartered accountant should not have made such comment. Okay. Therefore, he should have reported this in clause 33 of Form 3CD, and if he does not report that, then he is liable for what? Guilty. He is guilty under clause 7 of part 1 of second schedule of Chartered Accountant Act 1949, which you would have done in your audit paper. I hope it is clear to all of you. Now, while taking the emolument, the Chartered Accountant has not taken the cash transport allowance. He should take that also. The total emolument paid to the employee will include all kind of payment made to the employee except the contribution which is made in the form of recognized provident fund. Okay, so this is what this question is all about. One last question we have done earlier. There is an advance ruling who has passed an order, and you are not happy with the order of the advance ruling, and so is it binding on you? The answer is no. Advance ruling is never binding on assessee. The board for advance ruling, you can appeal to High Court. We have done earlier within 60 days. We can also get an extension of another 30 days if there is a genuine reason. Okay, so this is what this beautiful paper is all about. I hope it is clear to all of you. So let's want one to one last MTP, that is the 8th MTP in the series of our discussion and 23rd paper in the series of our discussion. MTP May 2024 series 2, but fortunately for us in this MTP there is very less thing to speak on my behalf, because 90% of the things in this MTP are repeated. 90%, I am not saying 90%. ICI does not have any time also to make a separate MTP for you all. They have just copy pasted the things from the last paper and they have put over here. I hope that in the exam also they do the same thing. They copy paste 90% of the things from our 23 MTPs, RTPs and exam paper and put in the exam. That will benefit us to a great extent, because I don't think so anybody has done this exercise in the entire country. Forget about in English, even in Hindi, nobody has done this entire exercise of compiling 23 papers, so many RTPs, so many MTPs and so many exam papers in a span of 7 to 8 hours, maximum 7 hours. So this is what we have tried to achieve over here. I hope we have been able to achieve it. You guys comment below and let me know, are we able to achieve our target properly or not? Are we able to optimize the resources properly or not? Are we able to optimize our time properly or not? So that in a very small span of time, we are trying to cover many concepts. Highly impossible for ICI now to go beyond this and make a paper. Okay. ICI has to stick to our 23 compilations and make the paper. There is no other option available with the ICI. So let us start with the first question. The first question is a different question, not completely different. To some extent it is different, but rest of the questions, most of them are repeating from the past papers or MTP or RTP. The very first question, there's a domestic company. The domestic company is incorporated. It is engaged in manufacturing and it is incorporated in 2023. And now again in this question, just like the previous question, they have told us to compute the total income, the tax liability in a most beneficial manner. So again, we are supposed to compute multiple calculation, 3 calculation the last paper. First, normal calculation, in normal 2 calculation, regular and MAT, because they have also given us book profit. Then the special provision. Which special provision will apply over here? Our domestic company, which is newly incorporated, it is manufacturing 2023. Therefore, we can follow 115 BAB. 115 BAB can be followed over here. 115 BAB, all the conditions are fulfilled over here. Okay. Now let us solve the sum first of all as per the normal provision. As per the normal provision, the profit is 1 crore 47 lakh. Depreciation will be added back. Then you are buying some intangible assets of 36 lakhs. You add back this, and on that you will claim 25% depreciation, but you will get only 50% because it is put to use for less than 180 days. Therefore you will get only 50% of your 25%. Okay. Next one, you have purchased some gold raw material from your directors, and directors have substantial interest. Therefore directors are related party. Therefore, the excess payment which you have made, 12 lakh rupees or 14 lakh rupees excess, that will be disallowed under the income tax law. The next adjustment is a new adjustment. You have received some subsidy from the state government for buying a new plant and machinery. Now remember, whenever you receive any subsidy from the government or from any person, subsidy, grant, reimbursement for buying an asset, that has to be reduced from the cost of asset. So first of all, reduce from PGBP and then reduce from plant and machinery also. The plant and machinery is mentioned over here. It is purchased for 75 lakhs. So you have to reduce this 15 lakh rupees from here. Okay. I hope it is clear to all of you. Then you have incurred some legal expenses for issue of bonus shares. So whatever expense you incurred for bonus shares, that is allowed under income tax law. Remember, we have done 9 case laws based on this, and whatever expense you incurred for right shares, that is not allowed under the income tax law. Okay. Next one, short-term capital gains on which STT is paid. Therefore, it is covered under 111A. Therefore, reduce from here and show under 111A. You will show under 111A. Okay. 111A capital gains 15% tax. Depreciation under income tax law 36 lakhs. You can claim that as a deduction. Okay. Then you are selling some shares of unlisted company within 24 months. If you are selling within 24 months, then it is short term. Therefore, you have bought for 22 lakhs. You are selling for 12, you have bought for 12 lakhs, you are selling for 22 lakhs. Therefore, 10 lakh will be capital gains. This will be chargeable at 20%. Okay. Short-term capital gains are chargeable at normal rates. Okay. Now, last but not least, here you are purchasing some plant and machinery of 75 lakhs. But out of that, unfortunately, 10 lakh is paid by bearer check. Not allowed. Therefore, if you purchase any asset and if you make the payment of more than 10,000 rupees by other than account pay check, account pay draft, ECS and such as electronic mode, then it is not going to be forming part of your actual cost. Therefore, from 75 lakhs, first of all, reduce 10 lakhs and then 15 lakhs your what? Your subsidy which is received from the government. Therefore, your actual cost is 50 lakhs. On this 50 lakhs, you compute what? Because machinery is acquired and assume that put to use on 1st of July. On this machinery, depreciation is not included above. In point number A, depreciation is not included for this machinery. Therefore, claim normal depreciation 15% and additional depreciation 20%. After doing that, compute the tax liability, and after computing the tax liability, the tax liability will be 25%. Why, sir? Because this is a new company, and if it is a new company, the turnover of last to last year is 0. If the turnover of last to last year is 0, it is less than 400 crore. Therefore, 25% tax rate, surcharge and cess if applicable. Okay. Now you will compute the book profit. Book profit 320 lakhs. On that, you will apply 15% MAT. 7% surcharge because the profit is more than 1 crore and 4% cess. Okay. Then you will compute 115 BAB. Sorry. In 115 BAB, there is going to be only one change. What is that one change? You will add the additional depreciation. Apart from that, nothing else will be added back. So additional depreciation should be added back. After that, you will get the profit as per the 115 BAB. And in 115 BAB, your normal tax rates will be 15%. STCG under 111A will also be 15%, but normal STCG will be 22%. Okay. The normal STCG means what? The STCG on this equity shares will be chargeable at 22% under 115 BAB. Then you will apply 10% surcharge and 4% cess. This will give you the computation of your tax. Then you compare which is more beneficial. The normal provision is beneficial or 115 BAB is more beneficial. Then accordingly you opt that. Okay. Now the second question, as I've told you, 90% of the paper is repeated from past paper and past exam and past MTP, RTP or exam paper. This is exactly similar question. MTP series 2, November 2023. We have done this question. Copy paste question. Copy. You can check it once if you want. The next question is also copy paste. I'm not interested. Almost all the questions are here copy paste now. This question is copy paste. This question is copy paste. We have done all these questions. This question is copy paste. You have done all this question. This question is copy paste. This question is copy paste. All these questions are already done with all of you. Okay, you can go and check it once if you want. Okay, all the questions are done. You can, I'm not just saying in the air just for the sake of saying. I have done so many papers. What it will take for me to do another one paper completely. But if something is repeating, it doesn't make sense to do it again and again. You also should not do on the day of examination. We don't have so much time to do repetitive things again and again. This question is also repeated. This question is also repeated. Check it once if you want. Okay. Now the next question is a case law. There are some case laws over here. All of them are new case laws. We have not done this case laws in the past papers. Definitely we have done all these case laws in the classroom. In our textbook it is there, but we have not done in the past paper compilations. Okay. Now the first question is there is an income tax appellate tribunal decided the case against the SSC. So ITAT has passed an order against the SSC. Therefore the SSC filed an appeal to the High Court. Okay. The SSC filed an appeal to the High Court framing substantial question of law. Because we all know that if you want to go to High Court, there has to be a substantial question of law. A substantial question of fact cannot go to the High Court. Therefore, if you want to go to High Court, you need to have a substantial question of law. So the SSC filed us an appeal framing substantial question of law. But the High Court did not frame the substantial question of law. The High Court heard both the party and then passed the order. Okay, without formulating any substantial question of law. Is High Court also supposed to formulate a substantial question of law? The answer is yes. The SSC will frame substantial question of law under section 260A subsection 2, and the High Court will frame substantial question of law under section 260A subsection 3. Therefore, High Court cannot just rely on the substantial question of law which is framed by the SSC. The High Court has to frame its own substantial question of law. There is a difference between the formulation made by the SSC and the formulation made by the High Court. Therefore, the Supreme Court held in the case of AA Estate Private Limited that the order of the High Court is void ab initio. It is incorrect. Okay, the High Court has to pass a substantial question of law, has to formulate substantial question of law. It cannot merely rely on the substantial question of law formulated by the SSC. Okay, the next question is a cooperative society. It is engaged in marketing of fertilizer and purchase and processing of seeds grown by its members. Okay, therefore it is eligible for deduction under ATP. Now the AO disallowed some expenditure under 14A. Now the question is whether 14A is applicable for chapter 6A. 14A is not applicable for chapter 6A. We have done this case law of CIT versus Scribho, Delhi High Court 2012 judgment in our classroom also. That 14A is applicable when an expense is incurred to earn an income which is exempt under section 10. 14A is not applicable for an expense which is incurred for an income which is deductible under chapter 6A. 14A is not applicable for profit link deduction which is deductible under chapter 6A. It is only applicable to an income which is exempt under section 10. Therefore, in this case, 14A will not be applicable. Okay. Next one, Mr. Sudarshan is a shareholder in a particular company. Now he received a bonus shares from the company which is more than 50,000 rupees. Whether the bonus shares which is received from the company which is more than 50,000 rupees, Dr. Ranjan Pai case law it is, whether it will be chargeable as income from other source as a gift tax. Suppose I am a shareholder in a company and company is giving me some bonus shares. Now whatever bonus shares the company is giving me, whether that will be considered as a gift under section 56 to 10? The answer is no. Bonus shares is not. The Supreme Court has held that in the case of Dr. Ranjan Pai that bonus shares received is not a gift. It is not a gift. Bonus shares is not for free. It is not received for a free. It is received at a cost of capitalization of the reserves. Your reserves in the company is getting capitalized in the form of bonus shares and that is given to the shareholder. It is not an absolutely free consideration received to you. Okay. Therefore, this is not going to be charged under section 56 to 10. Next one, they are asking us some theory questions. Just go through it. Some digital economy, etc. What are the e-commerce and what is the action plan 1 of BEPS? I'm not interested in that. The next question also we have already done. This question we have already done. This question also we have already done. You can check both of them. I'll tell you what is there in these two questions. This question talks about that in 2016 if you have done something, GAR is not applicable. Remember, GAR is applicable in one of the MTP question. I have made you change the date also from 2018 to 2016. So if GAR is only applicable if the transaction is undertaken on or after 1st April 2017. So GAR is not applicable in this case. Second question, very simple. This company can directly give loan to this company, but they are deliberately purchasing some equity in a tax haven company. First, they are transferring the money to tax 7 and then telling the tax 7 company to give a loan to this company. Therefore, the GAR will applicable in this case because the country X company C lacks commercial substance. There is a round tripping of fund. Okay. The main purpose of this transaction is to obtain tax benefit, and if the tax benefit is more than 3 crore, GAR will apply in your case. Okay. I hope it is clear to all of you. Now, the next question is a beautiful question. This is the only question because of which we are doing this particular paper. Otherwise, there make no sense to do this paper. Okay. This is the only reason. This is again a question of tax audit. Now, I can make out one thing, that the two mock test paper which has come for May 2024, in both the mock test paper, ICAI has given one question on tax audit report. So they can make out from this that there can be one question in the exam on tax audit report. In both the papers, they have not asked any question on black money law. Maybe they might have asked question on black money law in the MCQ, but on descriptive question, they have not asked any black money law question. Okay. Now, this is a beautiful question. Income tax department collected some documents from a bank which revealed that a travel company, Mrs. Esther and Travel Company, has remitted substantial amount abroad. Okay. So income tax department got an information from the bank that that particular travel company has remitted huge amount outside India. Okay. For that, the income tax department collected form 15 CB also issued by the chartered accountant, and chartered accountant list of passengers were collected, copy of their passport were collected, travel and invoice were collected on inquiry, and then the income tax department went to the passengers. The income tax department went to the passengers to verify that whether they have actually traveled or not. The passengers say that they did not travel, and the dates mentioned in the documents. The passenger said that we have not traveled. All these documents are fake. Okay. And the chartered accountant also given form 15 CV which is fake. The passenger denied any sort of transaction. The department therefore concluded that the amount remitted on the basis of false invoice. The department therefore said that all this money which is remitted outside India is based on false invoice. Okay. Therefore, there is a FEMA violation, and 15 CB issued by the chartered accountant is also wrong. Okay. Therefore, the chartered accountant has in all issued in a period of 9 months 105 certificates form 15 CB, 22 crore worth of transaction. For every transaction, for every certificate, he has charged 3,500, mostly in cash. Okay. The form 15 CB submitted that the chartered accountant submitted that he has issued form 15 CB based on invoices produced by the company. CA said that whatever invoice the company gave me, I submitted based on that form 15 CB, verifying the KYC documents of the signatory. However, he failed to bring on record the invoices. When the department asked for the invoices from the chartered accountant was not able to give the invoices. He further submitted that since he has not been statutory auditor, he did not examine the books of account. The chartered accountant said that I have just given the certificate form 15 CB. I am not a statutory auditor of the company. Therefore, I did not examine the books of account or conduct due diligence. Can a chartered accountant do like this? And therefore, this is absolutely wrong. 15 CB certifies that he has examined the transaction properly. The very object of 15 CB is defeated over here. The 15 CB is given by a chartered accountant only if he is 100% sure that he has done everything. A chartered accountant should verify the agreement, should verify the document, should verify the books of account, should verify the TDS requirement, whether TDS is properly deducted or not, should verify the nature of remittance. But CA only verified KYC of invoices. Therefore, he is guilty under the Chartered Accountant Act, Clause 7, Clause 8, Part 1, Schedule 2. Failure for due diligence. Therefore, action will be taken against him under the CA Act 1949. I hope it is clear to all of you. We have done a similar question in the class also. This question is there in our question bank also. Okay, you can go and check. One last question over here. A partnership firm is there and they have given the data of the partnership firm. We need to answer whether this partnership firm is required to get the books of accounts audited or not. Now, you please tell me who is required to get the books of accounts audited if your turnover of business is more than 1 crore. But in some cases, if your turnover of business is more than 10 crore, then only you are liable for audit. 10 crore limit is applicable for whom? When the cash receipt is up to 5% of total receipt and your cash payment is also up to 5% of total payment. Okay. Then only you are liable for what? That 10 crore limit. Otherwise, you are not liable for that 10 crore limit. Let's see the cash receipt of this particular firm. The cash receipt, the turnover is 2 crore 78 lakhs. So if the turnover of 1 crore limit is applicable, then this firm is liable for audit. But let's see whether the cash receipt and cash payment is up to 5% or not. Now the cash receipt is how much? This is not the cash receipt. The cash receipt is this one. This is the total cash receipt. The cash receipt is 19 crore and the total receipt is 4 crore 56 lakhs. Therefore, 19 divided by 456 come to 4.16. So the cash receipt is less than 5%. Okay. It is up to 5%. And the cash payment is 3.8 lakhs and the total payment is 2 crore 38 lakhs. Therefore, 3.8 lakhs divided by 238 lakhs. This is 1.597. Therefore, both payment and both receipts are up to 5% of total receipts. Therefore, it will not be liable for what? Tax audit up to 10 crore rupees. So this is what this question is all about. Okay. Next one is also a similar question we have already done. So majority of this MTP paper was already done by us. Okay. So this is what this 8 MTP is all about, completely in full English for my dearest students of South India. Okay. So this is what I have done it for my dearest South Indian students. 8 RTPs, 7 MTPs and 8 mock test paper. Total 23 papers. As a student, you cannot imagine to revise even 5 papers a day before examination. 5 papers is also an upper limit if a student decide to revise itself. But we have tried to achieve the unachievable over here. Okay, we have tried to do something which was impossible. When I thought of this idea, even I was not aware that how I'm going to do that. But your motivation has helped me. Your consistent pushing every time I put a video in Hindi, you guys tell me, please put in English, please put in English. That put a lot of pressure on me. That helps me to record separately a video in English. I hope you all have enjoyed this video, and I have only one sincere request, two requests, which I guess you will fulfill. If you have liked this video, please comment your views below. And if you have liked this video, please share this with most of the students who wants to learn direct tax in English in the finest way possible in this entire country. Okay. Till then, all of you take care. Bye all of you. See you soon with more videos. Bye.